was more on the downside than the upside. What are your index calls for the day?
Yeah, good morning. Yes, and now we are on the verge of that lower end of that small range. So for all we know, it could break on the downside. Since I'm not very keen to suggest taking short positions, the view remains that this market is not bullish as of now, and the best trade is to step aside. For savvy, smart, say professional traders, you could consider short positions with a stop above 25,550. Otherwise, stay away.
Okay.
Got that. Gentlemen, morning, Sudarshan and Mitesh. Mitesh, what about you?
So, good morning, Prashant. I've been maintaining that this market is showing signals of contraction, and I think that view continues. Broadly, it's a 25,200, 25,650 kind of a range. And like many days in the past few days, I maintain that this range will be in force for forcing future, 5 to 7 days at least, because most of the volatility indicators are shrinking. So broadly try to buy the index once we approach the lower end of the range, otherwise avoid entry with stock-specific biases.
Okay. All right, gentlemen, let's talk about stocks as well then. Mitesh, what about you? What stocks are you going with today?
Yeah, good morning, Surbi. I have a mix of buys and sells. On the buying side is Container Corporation with a stop at 603 for targets of 640, and Bajaj Finserv is a buy with a stop at 2004 for targets of 2070. And on the selling side, after a big rally, Solar Industries is showing first signs of profit booking. So sell here with a stop at 16,650 for targets of 16,100. And MCX similarly is the sell with a stop at 84.90 for targets of 82.60.
All right, got that, Mitesh. Thanks so much. Sudarshan, what about you? What stocks are you looking at?
It's a mixed bag today. M&M is a buy with a stop under 3,095. GMR Airports is a buying opportunity. It's also a positional buy with a stop under 89. I have two intraday shorts, JSL, Jindal Stainless, stop above 698, and RVNL, which is the Rail Vikas Nigam. It's a intraday short with a stop above 394. As usual, if you're looking for short positions, be very careful.
Okay, all right. So tread with caution, keep those stop losses tight. Thanks for that, gentlemen. We'll come back to you closer to market opening. Deepan is still with us. Deepan, it's a TCS day. Earnings season is kicking off. And I know we've discussed this for a long time, that, growth is elusive and all of that. But sometimes, they become trading opportunities, these IT stocks, if nothing else. What are your thoughts? Doing anything before the IT earnings season at all, either with TCS or any other company?
You're right, Surbi. It's a trading opportunity. Even when you are bearish on a sector, there can always be surprises because the street has an expectation. And if the company reports numbers beyond expectation, look, a 5-10% up move certainly can take place, and similarly the other way around as well. But either you focus on such trading opportunities or you focus on great long-term stock ideas. And I think that entire Indian IT services industry, the traditional ones, they are out of steam completely. They are secularly, I think, in a stagnation mode. And last 5 years certainly have been not that great in terms of returns or profitability. And I don't know anything which may change and take them to the next growth trajectory. So I think from our point of view, it's an avoid.
Got it. All right, Deepan, India Shelter, do you track that one? That's the one that saw some fund-based buying 2 sessions ago. And yesterday as well, it moved at very, very good volumes. Have you looked at this name?
I did many, many months ago, but I like the basic business model. They are an aggressive home finance company and focusing on the underbanked or the lower end of the segment over there. And that's always positive. And they have a decent track record when it comes to collection. Because when you are, focusing on that segment, the mass market, the lower middle income, your collection strategies have to be extremely strong. And I think they seem to have achieved that. Reasonable valuations as well, I feel. And of course, we are very positive on NBFCs because I think their cost of funding certainly will go down. And that should improve the net interest margins. And in a way, I think companies like India Shelter, and there are others in the space as well, have a good runway for growth because of limited competition per se.
Yeah, absolutely. What we're going to do is we'll just bring in one more name, right? Actually, one more space. We spoke with Digant Haria on NBFCs yesterday. And let's talk about the NBFC space, but housing finance in particular. Bernstein has got sort of a note this morning out. Gaurav is here with the details of what they're saying. Gaurav, good morning.
Well, yes, many companies from housing finance space are in focus, and the reason being that Bernstein has now initiated a report on these companies. First, let's talk about the housing finance companies in the like of Home First Finance, where they have outperform rating. They also have outperform rating on Aptis and Aadhaar. For Home First Finance, what they're saying is that the company actually stands out well in terms of the overall space, and at the same time, they also like the business model because it is growing at a faster pace. Other than that, for Aptis, what they're saying is that the company has high share in the fixed rate loans, which is actually helping the company specifically in a time zone where we are getting the interest rate cuts. And for Aadhaar Housing Finance, what they're liking is that it is actually largest and most geographically diversified player, and that is the reason why they are actually maintaining or rather initiating with their outperform rating. On the other hand, they have initiated on Aavas and PNB Housing with market perform rating. For Aavas, what they're saying is that it is actually lagging its peers in terms of yields and profitability. And on the other hand, for PNB Housing, what they're saying is that the shift towards small ticket size is actually good, but on the other hand, there are some concerns about the business, and that is the reason for now they have kept the market perform rating. So definitely on the back of the positive note coming up from Bernstein on the housing finance companies, we are watching out for all these companies today.
Got it. Okay, all right, Gaurav. Thanks a lot for that. Deepan, you want to come in on this report?
No, I think it's a good report, and we are also quite positive on the housing finance companies. And within the entire spectrum of NBFCs, housing finance perhaps is the safest segment. And these companies, I think, by focusing on the underbanked, the underprivileged segment, certainly have got an opportunity for growth. And all of these companies, I think, have great prospects so long as they're able to manage their collections and NPAs better. And valuations also are reasonable. I think the track record last 4-5 years also been quite impressive. So I would say that if you're looking at increasing exposure to the banking sector, banking NBFC, these category of companies, the new generation, I would call them new generation housing finance companies, certainly can offer outperformance.
Got it. Okay, all right, Deepan. Appreciate you joining in. We look forward to having a chat with you, and have a good day ahead. Well, let's focus on the metal space. That's seeing some selling pressure yesterday. Trump announced some tariffs on copper, 50% on that. Quarter one updates as well have started coming in. Let's discuss what's the call on metals. Rakesh Arora, founder at Go India Stocks, joins in on the show. Hi, Rakesh. Good morning. Good to see you. Let's start off with Mr. Anil Agarwal's stock, Vedanta. You have seen it for the last couple of decades, from I recall chatting with you about it more than 10 years ago. But what's the current stance on it? Viceroy's report is going, hard out at Vedanta. Vedanta says this is totally malicious reports. The timing of the report as well is the problem. What's your take?
So, Nigel, the playbook for these short sellers is very clear. Find companies with, shades of gray and who have high leverage. Unfortunately for Viceroy, they are just 2 years late on this stock. Vedanta Resources already delivered quite a bit from around $9-10 billion to around $4.5-5 billion now. And now servicing that debt is not a challenge at all. Number two is that, Vedanta itself has gone through this whole exercise of demerging, and all the lenders have looked at individual entities on their leverage, on the, whatever the liabilities are. And clearly, they've approved this. So clearly, all the entities are self-sufficient. Otherwise, this kind of approval cannot come from lenders. So I think, the report raises some issues which were kind of well known, but the boat has already sailed, and there's nothing left here to really, gain from short selling.
All right. In fact, when the co-founder of Viceroy joined us earlier today, that's what I had mentioned to him as well. Maybe 2 or 3 years back, this report would hold some ground. But actually going by the action we have seen on Vedanta Limited in terms of deleveraging, Vedanta Resources as well, cutting the debt by half, it appears a little bit late in the game, but they stick to their guns that Vedanta Resources will ultimately default. We'll see how that goes. That said, what's the view on the stock? At around 440 rupees, would you advise buying into it? Because we have the demerger that's in the works, and the stock trades, as we've been mentioning, 4.5 to around 5 times on FY26 EBITDA itself.
So, Nigel, I'll leave that for the investors to figure out. But what we can say is that Vedanta stock is largely dependent on aluminum outlook.
Yes.
And the aluminum outlook has been pretty strong and doesn't look to be weakening anytime in future. They are also getting a little bit more of backward integration in form of bauxite mine, coal, their own captive alumina. So things are looking better only for them. So I don't think fundamentally there's any reason that performance would deter. But valuation-wise, I'll leave it for investors to judge.
Got it. And that aluminum business will be bulk of their SOTP. Cost savings are going to be there on bauxite as well as coal and alumina, which they'll be getting, from their for backward integration. So we'll have to see how that goes. But you're sounding fairly optimistic on the stock. What about the metals pack on the whole? Yes.
One last question, Rakesh. Hi, morning, Prashant here.
Yeah.
So many. Just to complete that loop on Vedanta before Nigel moves on to other areas. Is there like a trigger here for Vedanta, which so many people, HNIs, everybody owns the stock, right? I mean, the value that clearly is there, but is there like a tipping point which will sort of unleash gains here, Rakesh, as you think about it?
I don't think this report really.
No. Forget the report. I'm not talking about the report. I'm saying, is there a? This has come now, as you said, 2 years late. I'm saying. People have believed and bought this over the last 1.5, 2 years, the stock that is. I'm saying, is there a point where it starts to do well and starts to give returns?
No, so Vedanta has been a fund, has done phenomenally well actually in the last 2 to 3 years. Meaning, if you had asked me in 2021, I would not have been able to gauge this kind of turnaround that the management has been able to achieve. And things are only getting better from here. So meaning that inflection point happened 2 years back. And now we are into a steady growth state. So, I don't think there's any inflection point we are waiting for. Obviously, this demerger and everything.
Rakesh, my point is stocks at 450, right? It was 450 in 2010 also. Now, you can add all the dividends, etc. That is the real meat here. Is that what you're referring to? Of course, I mean, in terms of balance sheet, etc., there's been a lot of repair. You said $10 billion down to about $4-5 billion in debt. But I'm talking about price appreciation, stock-wise.
Yeah, so see, what has changed is aluminum outlook. Aluminum used to, be loss-making for them, and they were hardly producing anything. They were not integrated. And aluminum was trading at around $1,600-1,700 at that point in time. Now it is $2,600. So that $1,000 has changed the whole, situation for them. They have such a large capacity, and they had all these issues with Langiger, etc. They were not able to integrate, reduce their cost. But now those issues are getting resolved. So I think we have come back to a point where things are looking really, really stable and strong from them from a fundamental point of view. So. Inflection has already happened, re-rating has happened, and now it is steady growth ahead.
Got it. All right. What about the Ferris pack? If you could tell us what is your top pick out there. Q1 could be a little bit subdued, but the remainder of the year is expected to pick up, right? If you're going to see a revival in construction and we have that safeguard duty in place as well. So what do you like from there?
So, Nigel, near-term outlook is okay for steel stocks because steel prices have gone up and raw material prices have gone down. So there would be quarter-on-quarter margin expansion for steel companies by around 3,000 rupees per ton. So that's a big thing for them. From a medium-term perspective, things are not very clear. It will depend on what China does. There are indications that they might, cut production, but we have to wait and see because one can't be really too sure about, China's policies. So I think near term is strong. Medium term, I think it is neutral at the moment for ferrous stocks.
Okay. All right, Rakesh, great conversation. Thank you very much. We'll leave it on that note for this morning. Thanks so much for joining in. The market has settled in the pre-open session, and what we have is about a 35-point up move on the Nifty for the time being. Mid-cap index is flat. Bank Nifty is not too bad actually this morning, up about 0.25%. We have Gautam Trivedi, managing partner at Napency Capital, right here with us in the studios. Gautam, great to have you in.
Thank you.
So much the market has had to digest, from wars to trade wars to, short seller reports and, so on and so forth.
Yeah.
But, I want to then, the whole thing is regulatory action back home as well, this whole Jane Street saga. I want to start just right there to understand whether what we are seeing in the last few sessions, this last 1 week where the market's gone so quiet that the index barely moves 10 points in a day. Is it just a lull before earnings and further news flow? Or do you think that this overall Jane Street / HFT crackdown of sorts whether that will have a part to play in just the near-term trading action.
Yeah, I think the impact of Jane Street seems to be limited more to the futures and options market, not so much the cash market. And if you look at the, I agree with you that the market's been sort of flattish for over about 10 days now or so. But I think earnings is really what's going to, people are waiting to see which way to drive the market from here on, given earnings. Given the fact that our first quarter earnings were actually pretty dismal, and if you drill down even further, I looked at the numbers actually last night, and I found that the fourth quarter consolidated the Nifty 50 numbers were actually still very, very weak. I mean, PAT growth, and again, I'm talking of consolidated because some people like to slice and dice by saying X financials, X OMCs.
X oil and gas.
Exactly. But if you look at a consolidated Nifty 50, PAT growth was a mere 0.8%, so less than 1% PAT growth. And even for the full year, FY25, the PAT growth was a mere 5.5%, which apparently is a 4-year low. So given this, I think, on a short-term basis, given that the earnings season kicks off later this week into next week and then so on, I would wait to see what the numbers are before incrementally putting more money in the market.
The only thing is, I think we're going in with the season with fairly, solid expectations, because the mood in the market is that we've seen the trough and it just gets better from here. So, estimates ranging between 11% to some of the optimistic ones to 13% earnings growth this year. Do you think that'll play out?
It seems a little challenge at this point because we do start off the fiscal year every year for the last few decades with an extremely high, aggressive...
It's a ritual.
It's a ritual.
Start optimistic, always.
Optimistic, exactly.
Tradition means something, right?
Start on a hopeful note.
No, but having said that, I mean, I hope that the transmission of the 50 basis points repo rate cut starts to happen with the banks. September, we'll see the CRR cut, more money flooding the market. So hopefully all of that should play out and help the Indian economy.
Actually, the crazy thing is that every quarter, if you look at the expectations this quarter, they're very muted. But then if you look at year is made up of 4 quarters, right? But if you look at the annual earnings growth, that is still, as you said, reasonably rosy. But quarterly, if you look at it, it's always very challenged and expected. I mean, look at, is there any sector, if you just look at this quarter, where you think we'll see very good earnings growth? Banks, 30% of the market, NIMs will fall this quarter, next quarter.
That's right.
IT will get hit, TCS. I mean, we're talking about CC decline. We're talking about the extent of the decline. 1.5% could it be larger?
FMCG?
Not happening,
Low single digits, as they always say.
Don't want to sound all dire in the morning.
Thanks, huh?
I think the earnings downgrade's happening here right now in the studio itself. Let's not even wait for the analysts on the results.
But it's been like that, Gautam, right? I mean, there are obviously shining stars within each sector.
Yes.
I mean, for example, in IT, there is Coforge. So there is stuff which does well.
No, but for that matter, in QSR, there's Jubilant, right? Everything else seems to be either single digit or negative same-store sales growth, but Jubilant seems to buck the trend quarter after quarter. So, yeah, you're right. There are certain... even for that matter, let me put it in terms of the shoes category. If you look at Campus, you look at Bata, you look at Relaxo, all struggling. But then you have Metro, on the other hand, who's doing extremely well.
So I read wires and cables. They could do well this quarter. I don't know. Do you look at that space?
No, we do, of course. But again, that's probably having a moment like paints where you're seeing big players coming soon. Not yet, but coming soon, So that's starting to get discounted in the price.
You know, Gautam, since you mentioned Jubilant Foodworks, the report was very, very good, the quarterly update. But how much of it is in the price? That's the problem. Because on the day that they declared it, the stock actually ended down 3.5%. And most sell-side reports that I saw suggested it was good. And even I went through the fine print, it looked pretty good. So your view on that? How much of some of this good news is already in the price?
Well, Jubilant's always been an expensive stock versus the others. So I'm not really concerned about the valuation.
You'll still continue to remain positive on it?
I would remain positive because it seems to be the only, shining light within the QSR space.
Okay, just coming to you, Gautam, we've got the market open. So we'll see if it's absolutely unchanged from yesterday or we've got something going here. No, it's actually 20 points. So 25.
See how excited Prashant is. Put 20 points on the open.
Better than 2 points. So, 20 points on the Nifty. Sensex is, what's that, like we started day before yesterday? Massive 2 points.
Massive 2-point change, yeah.
Well, 85 points on the Sensex. 83,600 is where the Sensex is at. The Bank Nifty is up 80 points, 85 points. The Nifty Mid-Cap Index is up about 40-odd points or so. So it is what it is. Actually, yesterday everything was slightly on this. It was not sliding or anything, but it was down to sideways, except the small cap index, which ended with about a 0.5% odd gain yesterday. So that is, of course, thanks to some individual names there. The Nifty heat map, as you can see on your screen, 35, 36 names are up, and the rest of the stocks are actually lower as we begin this session. I can spot pharma, and I can spot some IT there, Wipro as well. So that's the overall picture. It's a very well-behaved, slow 5-point change on the Nifty.
Okay. TCS, very quiet ahead of earnings, 0.3% lower. Even Infosys, 0.5% lower. So, there's no exuberance or excitement in the IT names. We haven't seen that kind of a build-up at all. Actually, even for the month, if I look at TCS, it's done nothing. It's down to 2.5%. So unlike some of the previous quarters, there's no positive build-up on large IT ahead of the numbers. Let's see what else is down. Reddy's is lower, Cipla's is lower, Sun Pharma is lower. So Pharma is not too hot this morning. Market is now absolutely flat, blinking red and green. On the upside, some of the financials are looking quite okay. Shriram Finance, 0.5% up. Axis Bank, 0.5% up. Bajaj Finance is not too bad. ICICI Bank is up. SBI is at least having a positive start in the green. And Reliance was fairly volatile yesterday. It's sitting on the fence right now with just about a 3 to 5 rupee up move. That's Reliance Industries. Tata Steel is the best performing stock on the Nifty for the moment with a gain of 0.7%. And now we're struggling to do 1 point or 2 points also on the Nifty. So back down to flat.
Not fair, guys. I go third. So, by the time you come to me, it's already flat. The 20-point gains have gone. But, a few stocks in the broader markets are buzzing around. Enviro Infra Engineers, the JV bagged a 390 crore project. So the street likes it. That one has been doing well. It's up close to 4.5%. Volume's fairly decent. SPML Infra, that's another stock I was looking at. In the last few months, the stock has moved, I think, from around 180 to 280. Today, it's up close to 10%. So that's coming one of the top volume gainers out there. PFC and REC, I think there's a brokerage call that's coming in there. A couple of them have mentioned that post this recent correction, actually it's providing a good entry opportunity. So explains why both these two names, in fact, have perked up in trade. On the flip side, you have Quick Heal. That's falling on decent volumes, actually. That's down closer to around 3%. I'm not sure whether or not there is some news flow on that one. But that's down 3.5%. The other one you're looking at is Metropolis. That as well is seeing a bit of a knock in today's trading session. So just keep an eye out on that particular name. And Dream Folks, post this news that's come out with regard to some of those, clients they've been losing and it's impacted their business. In a month, the stock has gone from 270 to around 165 rupees or thereabouts. So difficult times for this one.
It is absolutely the case, difficult times. Markets, though, I think now are down, 3.5 odd points in terms of the change, as you can see up on your screens. We'll talk about individual sectors, names, etc. as we go along. Now, Dream Folks, I don't want to talk about the stock per se, I don't know if you have a view even, but what do you make of the entire it kind of, not in a straightforward way, but talks about the lesser talked about variable in every sector, which is the big, the competition risk in that sense. Here, of course, it's disintermediation, if I can call it that.
That's right.
But any thoughts at all here?
But I think that what you're saying is true. No matter what sector you're in, there is disruption, and if it's not from competition, it's either from technology or AI that's coming in as well. And I think the IT sector in particular is vulnerable to that. That's a real problem in this country. I mean, you could have an irrational player come in and actually damage the industry and take away market share, and survive for several years before cleaning out the competition.
And this direct quick commerce, I mean, just to sort of hop from, again, I thought of it because of competition again, right? Zepto, for example, yesterday said they're raising money.
That's right.
More money. At
a higher valuation.
At a higher valuation. So...
No, I think quick commerce is here to stay. I mean, our view is, my boys don't order anything anymore. They haven't been to a Kirana store ever, I think. I should probably drag them out of the house once and take them. And this is what a real store looks like, not the one on your phone. But the fact is that, it's here to stay. And people, I think, are having less and less patience, whether it's short reels that's causing that to happen, or it's OTT platforms. But people want instant gratification. So if you order a toothpaste, you want it in 10 minutes. You don't want to wait an hour for it.
The reels are the biggest disruption, I think, for mankind in general, at several levels.
Good for customers, good for shareholders as well?
Shareholders of Zepto or
I mean, the entire space, Zepto's, Eternal, Swiggy, do you think, because I'm very, very happy, using the services.
Yeah.
But as a shareholder, would you say that the better time's coming for them?
Yes, because they are taking away significant market share from the Kirana stores.
Yes.
The Kirana stores, of course, there will be some political ramification at some point when they say that, these guys are hurting. They are already hurting, but maybe they hurt even more before somebody takes up their issue. But the reality is, they're here to stay. So probably definitely good times. But specific on Eternal or Swiggy, the competition is so intense, much like the paint industry, where you're seeing large organizations, large industrial houses getting into the business. I don't see how the economics necessarily will continue to be strong.
So Gautam, now put it all together for us. And we haven't discussed the global backdrop, which is amazing because you look at the US market, with wars and with so many headlines, tariffs, it's just going up and up, at least for now. That so-called, great gush of FI liquidity doesn't seem to be making its way to our market anytime soon, at least on a more durable, permanent basis.
Yeah.
Coupled with everything that we've discussed, earnings expectations are low, valuations are high. So what should an investor be doing here in India?
So let's understand what's driving this market. It is pure fund flows, okay? And you got to hand it over to the Indian domestic investor, continue to put money month after month after month. I mean, yesterday's number was, I think, a big shocker to me personally.
23,500, yeah.
Well, that was the net number, but the SIP was 27,300.
Yeah, SIPs were fantastic.
So that's obviously a new record high.
Yeah.
So let's see what's driving that and pertains to what's happening back in the States. If you look at here, you're looking at extremely low savings rate. HDFC's, and I have an account with HDFC Bank, their savings rate is 2.5%. Fixed deposits, 1 year tenor down to 6.25%. So would someone like me be incrementally putting more money in the equity markets? Probably yes, to try and beat fixed income returns. Secondly, if you look at the average age of the investor, I was looking at the NSE Market Pulse, and they have some pretty interesting raw data in there. 40% of the investor base, unique investor base, is below the age of 30. 70% is below the age of 39. If you look at the top 5 states, Maharashtra, Gujarat, UP, and Rajasthan, and West Bengal, this is where the top, about almost 50% of the unique investors come from. If you look at incrementally, where are the new investors coming from? Include states like Tamil Nadu and Bihar. So the equity culture has only just started. I mean, there's more to go, more states to hit and penetrate. So I don't see that slowing down from an India perspective. As far as the US is concerned and FI participation is concerned, the fact is our market's trading at the same valuation as the S&P 500. FIs, when you look across Asia, for example, you got earnings growth that matches ours across Korea, Taiwan, and China for this year. So we're not cheap. FIs have more options to invest in, and the earnings growth back home in the US is huge. First quarter, calendar 24, S&P 500 earnings grew. All 500 companies' average earnings grew by 12%. And that's 28% for the Max 7, 9% for the balance 493 companies. So that's huge earnings growth, and we don't have that here.
Explains a lot. So what should one be doing? I mean, in terms of, like you said, as investors, I mean, we need to be in the equity market for the reasons you just mentioned.
That's right.
But we have all of these headwinds. So where should that money be put?
Money still can be put in the equity markets. Doesn't seem to be an alternative. I mean, gold's the other option in terms of an asset class.
Where in the equity market?
So here's the thing. I know you're going to pin me down on that, but the reality is, of the 1,200 stocks, we ran this screen only last week, of the top 1,200 stocks by market cap, 890 stocks over the past year or so are up 25% or more, which means 300 stocks have underperformed. Second, and more importantly, if you look at over the past 2 to 3 years, there are total sectors that haven't performed at all. I mean, we discussed shoes, we discussed QSR, with the exception of one or two companies that have actually done well. I mean, even TCS over the last 3 years has given us mere 6% return. So there are a lot of sectors out there that haven't done well. And I think the other element to look at are companies which are undergoing a special sit. So we run a public market fund, which is a special sits fund. So you're looking at Ps getting into in terms of ownership or taking chunky stakes. We've seen a lot of that happening over the past several years. You're seeing promoters sell out. That's a big theme. M&A happening in the industry. So there are a lot of chunky things, deleveraging happening. So there are a lot of opportunities that are actually there, but you got to roll up your sleeves and find them.
All right. Gautam, final question from mine before I let you go. I recall being at a cement plant to visit more than a decade ago, and you happened to be there as well. I think I was the only business journalist that managed to sneak in there.
Yeah.
And the street is optimistic. The second half of the year is going to be better for cement companies. And, to be fair, price increases is something that's been good. That's been the lone positive. Hopefully, demand catches up as well.
Yeah.
What's your view on this theme? And do you believe some of these smaller cement players or the ones that have underperformed in South India are better placed?
Yeah, so I think cement's a very regional business. So South India traditionally has not been best in terms of pricing power.
Absolutely.
We haven't played a cement theme as yet. We played it more through construction companies and other ways to play cement. But is the horizon bright? I think the horizon is indeed bright, but it's not going to be, EMS.
So that's not one of your preferred sectors.
It's not a great preferred sector as yet, but it's not going to have great earnings growth. But I think there's consolidation happening, and hopefully that's going to give it even more pricing power.
All right. EMS, you just briefly mentioned that. That's a theme that you've liked in the past. It has a big runway ahead. Valuations, it's debatable where exactly the stocks are at.
Yeah, right.
But would you be looking any kind of bad news to buy into some of these names? Stocks like Dixon, you've had various contradictory reports in the last couple of months.
Yeah.
Some very positive, some very negative. But, 1,350 odd, where the promoter offloaded some stake, that seems to be the zone. It goes there, it bounces back very quickly. Your take?
Yeah, my view is not specific to Dixon, but my view is that EMS is a growing industry. You're still seeing Dixon as an example, giving 80 to 100% quarter-on-quarter top-line growth.
Yes.
So my view is that this is an area one needs to remain invested in. Will the valuation sustain? And that's really something you got to think about. 70 times, 80 times. Some of the other names which are tier 2 versus Dixon are trading at half the valuation. So those are interesting too.
You want to name a couple of them? I think Sirma is one stock that we had discussed in the past.
We don't own it anymore. We own Amber, so that's something we're building a position in. So full disclosure.
Okay, all right. So some ideas finally. See, Nigel managed to pin you down.
I know.
Let you go.
Drinks on me.
Thank you so much,
Thank you.
Gautam. Great conversation, and thanks so much for stopping by at the studios this morning.
Thank you.
All right. Well, that is the market construct. The market, by the way, is now down 21 points. Mid-cap index is flat. Bank Nifty is also flattened out. Continues to be very, very quiet out there. So for the time being, let's put the spotlight on the textile sector. And that's in very, very sharp focus because hopes are running high. Hopes are running high with the expectation that perhaps India will eventually get a more favorable deal and a more favorable rate of tariff than some of the biggest competitors when it comes to apparel and textile. Competitors like Bangladesh, which is at 35%, Vietnam, which now we know is at 20%. So what awaits the Indian textile story? Well, joining in to talk about this, we have Mr. Sudhir Sekhri, Chairman of Apparel Export Promotion Council, as well as Pallab Banerjee, Managing Director and Group President at Pearl Global Industries. Gentlemen, thank you very much for joining in. Mr. Sekhri, if I could open with you, and this makes me a little nostalgic because I started my journalistic career reporting on textiles and apparel, and this was way back. I don't want to reveal my age, but we're talking about the era when, WTO quotas were ending and India was supposed to seize the opportunity in apparel. We did it to an extent, I think, in home textiles and, linen and towels, etc. But then countries like Sri Lanka, Vietnam, and obviously Bangladesh stole a march over us. Now, what are we looking at? I mean, we don't know the final tariff that India gets. There's also the India tariff plus a BRIC tariff. So maybe it's 10 plus 10, 20%. We don't know. But looking at 35% on Bangladesh, do we have a real chance of, a major milestone turn when it comes to our apparel exports?
Yeah, okay. Thank you for having me over. Well, you're right. We have over the past few years, we have been laggards, so to say, and as compared to our neighbors and competing countries like Bangladesh and Vietnam. And that's because of the policies that, Bangladesh, for instance, has an FTA with EU, which we don't have. So they have a huge advantage. Most of the EU retailers, they source around 50 to 70% of the apparel from Bangladesh. So that's a big setback for us. But I think that is going to be addressed very soon once we sign on the dotted line with EU. Coming back to the US, yes, the signing of the FTA has again been and will give impetus to our the apparel trade, and with the BTA with the US in the offing, I think that's going to be a game changer for us. And we believe that we had AEPC had set a slogan 40 by 30. And I think, what the events which are happening, the BTA, the FTA with the EU, that is really going to take us on that ride of 40 billion by 2030.
But Mr. Sekhri, let's also talk in terms of, numbers, and we can only play out scenarios right now because we don't have the final tariff. If I remember correctly, I think our current blended tariffs for apparel exports to the US is somewhere around 5 to 7%, I think 7% from what I gathered. Correct me if I'm wrong. Now, if this goes up to 10%, which is current baseline, if we somehow manage to escape this additional 10% brick duty, what does it mean for our apparel volumes at 10%? And if Mr. Trump levies the BRICS duty as well, which means we're at 20% tariff, then what? Then it could be a setback, wouldn't it?
Surbhi, the numbers,
First of all,
the numbers, I don't know, because I remember Gokul Das, when we spoke Gokul, they said that US already imposes 15 to 30% on apparel imports.
On Indian apparel imports.
On Indian apparel. So the range, it depends on what item, but between 15 and 30.
Okay.
And then there was 26%. So it is 26 plus at least 15, if not more, already. I mean, currently.
Yeah.
If you just take a look at what was announced on Liberation Day. And now we're talking about change from that point. So it's already pretty steep. I mean, 35, 40% if based on Liberation Day tariffs. And now we're talking about whether it's going to be higher or it's going to be low. So just that caveat.
Secretary, just weigh in on this as well. I mean, since you represent the whole sector, the average tariff pre-Liberation Day and where we could be looking at the various numbers that are doing the rounds right now.
Okay. Let me first tell you what is when you talk about pre-Liberation Day, that's called MFN tariff. Okay.
Yeah.
The MFN tariff ranges from anything from 2% to 32%, depending on the category. It's line-wise. It's not a same rate of tariff for every product.
Correct.
Especially for man-made fabrics, it is much higher than for cotton. So on an average, what your colleague just said, on an average, it's about 18%. Okay. Now, with the 26%, which is not going to happen, quite honestly, this the 26% tariff is not going. Reciprocal tariff is not going to happen. We are looking at something between 10 and 26. Now, based on our conversation with the Ministry of Commerce, apparel, it's because it's being a labor-intensive industry, that is a top priority for our government. And they are, they will go all the way to ensure that our industry is not hurt, because if our industry gets hurt, it hurts our employment potential also. So the government is aware of that, and they are very supportive of the fact that our industry needs to. Now, coming back to, see, when you talk about compare with Bangladesh, now Bangladesh was just hit with, I think, 30%.
35%.
35%, okay? Even if we, as a worst case scenario, even if we go to 26%, we are much better off than them, okay? Now, our other competition is Vietnam.
Mr. Sekhri, sorry. So then if in the worst case, what is the tariff, effective tariff then?
Effective tariff will be MFN plus 26% before the BTA gets signed.
Yeah. So in India's case, it's average 18 plus 26, right? That is 44%.
Yes.
Then.
And Bangladesh would be MFN plus 35.
Which is what?
You see, MFN, first of all, please try to understand, MFN stays there.
No, I'm saying what is that effective tariff for Bangladesh against our 44 in worst case? What is their number?
35 plus MFN, which is 18 plus 35.
18 plus 35. Okay, so even then it's going to be lower. But you're saying In our case, your expectation is going to be 18, which is the average, plus something between, this 10 and 26%, right?
Here I'm being very, very pessimist. Otherwise, I think, based on the assurances that have been given to us by the government, I think some lines may even end up with 0%. When I say 0%, please realize I'm not talking about MFN. MFN is something that Mr. Trump can't do anything about. This has to be done by the Senate and the House of Representatives. Okay, that is
in the case of Vietnam, sir, Mr. Sekhri, what is that number?
It's 20% plus MFN.
So that is 38%.
Yeah.
Okay,
right.
so it's kind of it's all coming to in that 30 to 40% kind of range so far, what we've seen, right?
That's right.
You're saying we should be better off.
We will definitely be better off on certain lines. On a few lines, perhaps, because we are negotiating. What the government is trying to do is, on a slow-moving lines, let it be a little higher if they wish to. But on the fast-moving lines, they will definitely gun for a lower reciprocal tariff.
Okay, got it. So that kind of clears up the numbers that from an MFN perspective, we were at 18% average for apparel and textile exports. Now we need to see. So MFN 18% plus question mark.
Reciprocal tariff, whatever it is.
Yeah, whatever is eventually decided. Now, whether it is, 10 or 20 or 20, not 26 like you're saying. Got that. So that clears the math. Let me come to Mr. Banerjee as well. Mr. Banerjee, I mean, you have, large operations. And I mean, a business like yours, I guess, to an extent, you've already de-risked because you've got facilities, I believe, in Vietnam as well. How would an exporter like you, how are you preparing for all that happens? And for your own business, now that Vietnam tariffs have also gone up, what does all of this imply?
Thank you, first of all, for having me on this show. So if you look at the whole manufacturing and the sourcing sector across for this textile and especially for apparels, the biggest country of exports is in China, followed by Vietnam and Bangladesh. These are the three topmost. And then, of course, after that, we have got countries like India, Indonesia, Philippines, Turkey, all these countries who manufacture that garment. And they globally, even if I speak specifically for USA, they have been sourcing from these countries. So whatever they do, immediately a shift would be difficult. For example, like if India, all of us are hoping that get a much better deal. In that case, over the next few years, we have to really ramp up our capacities and capabilities as a country to service this huge potential. Currently, this potential is lying in countries like Bangladesh, Vietnam, and China. One thing is very clear with what's happening from the Trump administration, that de-risk what was spoken about in the in the 15s and 16s and 2017. Now it is becoming more like a decouple. So naturally, as the business moves from China, the two countries which are benefiting or has been benefiting in the last few years have been Bangladesh and Vietnam, who's taken the maximum benefit out of it.
But Mr. Banerjee, that's exactly what we're trying to understand, because obviously, in line with the perhaps smart business positioning, Pearl, for instance, and I'm just taking this as an example, you already had set up facilities in Vietnam and in Bangladesh. If you could just tell us from your current revenue, how much is coming in from your plants in Bangladesh and in Vietnam? I mean, as a rough percentage. And what happens now? Because suddenly the exports from these geographies become uncompetitive. Or maybe, I mean, it's kind of more difficult with respect to those higher tariffs. India will talk about in a bit. Yeah. But what could be a potential hit to you, given the rise in tariffs in both of these countries where you operate?
Yeah, what we are seeing is definitely a positive traction at this point of time. Bangladesh has an advantage because of LDC status. They had a duty-free advantage to the European Union, UK, Canada, China. They have for ASEAN, and a lot of these kind of benefits are there. Like Australia is also a duty-free for them. So that become a hotbed for apparel. And that's why that country, if you see like almost 85% of their exports is in apparel and to all these countries. So what we are seeing is that positive traction continues. If this US, they have given a time till 1st of August to renegotiate, and if Bangladesh can't do anything, then we will see some migration of the US business from Bangladesh to countries which is more favorable. That is one.
Can you just give us an
potential.
estimate? Yeah, absolutely. Got your point. So some of the other countries, I think you'll keep exporting to them, EU, etc., like you mentioned. Out of your total exports, how much is going to the US? And within the US export number, how much is going from India and how much would be Bangladesh and Vietnam?
Yeah. So US is about anywhere between 48 to 50% of our total revenue.
Okay.
And if I look at Bangladesh almost about 70% is going to the non-US countries because of the duty tariff benefits that we have for the other trading partners of Bangladesh. And if you talk of Vietnam is a very heavy for US. And if you see like the negotiation that Vietnam government did with US, some of these US retailers were part of that discussion. So naturally, there's a lot of interest from the US buyers to secure their trade with Vietnam or countries like Bangladesh and Indonesia and all. So that's something we saw happened in Vietnam. One of the things that we heard from Treasury Secretary that maybe this number, what they talked about is 20%, is independent of any other tariff. So we don't know as of now because it's just an interview I think he gave with CNBC day before yesterday. Now, what is the actual fine prints, how it comes out, all those things industry is awaiting.
No, absolutely. I don't envy your position at all. I mean, I can imagine the sleepless nights just wondering which tariff missile is going where, and you have hard assets on ground, businesses on ground. So, Mr. Banerjee, just to sum it up, for the current year, FY25, can you give us some guidance or any guidance at all? I mean, will there be growth? How much growth? Are you scaling back your projections because of all this uncertainty?
No, you see, the industry, humankind has to wear clothes, whether it's US and other markets.
Till we find a way not to.
So what we have
well said.
That definitely, the first deal that has happened.
I'm just kidding. I should introduce some levity into the conversations, and Surabhi said both of you are having sleepless nights. Go on, Mr. Banerjee. Go on.
So what we are seeing is definitely with this complete deal, as per the US president says, that has happened with Vietnam.
A fascinating, insightful conversation we've had, and I think we got to learn a lot, and so did our audience, I'm sure. Thank you very much, Mr. Sekhri and Mr. Banerjee, for coming on here on the program. Well, the next conversation is very much about the markets themselves. I mean, we're not talking about companies listed on the market. We're talking about the market, stock exchanges as a business. We have Metropolitan Stock Exchange, which is on our radar. Why is that on our radar? They've announced that they're raising 1,000 crores in funding. There are venture funds, brokers, AIFs, which will be investing and putting this in total 1,000 crores. And this is the second sort of round of fundraise that we've seen come through. To talk about this fundraise in detail, but of course also talk about the timing of this and what the bet really is here, we have Latika S. Kundu, Managing Director and CEO at Metropolitan Stock Exchange, right here in our studios. Ms. Kundu, great to have you with us here. Thank you very much for dropping by. So I want to start with, this is a very interesting time that you're doing this because there is so much focus, regulatory focus, on what has been the single biggest growth driver for the market expansion, which is the options market, right? A lot of regulatory focus. I don't need to go into the details. We all know that. And yet you're able to get about 1,000 crores, a new funding round from some marquee investors and a bunch of brokers, market makers, etc. as well. What's the pitch that you have for them?
Well, I'll take a step back before I get into the pitch. And that is, the larger purpose is always that we are able to create markets which are for investors, which are healthy, which will be more inclusive, which will be able to create a competition. And I think that's the one thing that's still lacking today. We can see a near monopoly on the cash side of the market, a duopoly on the options. I know everybody's focus is on the option side of the market, and that sounds very exciting. But looking forward, we see to growing a sustainable exchange. And for that, we need the cash market to be equally healthy and to be taken care into a deeper penetration across all strata. So we're looking at a mix where we will have the institutional, the retail, a mix of all types of investors, because the entire focus is not just about having one more platform. It's not that. It is about actually wealth creation into the country.
No, that's the baseline. That's the
Yes.
baseline that we work with, and then we kind of sort of, that need be said. I mean, that's understood. But Ms. Kundu, I'm sure you have Tuesday as the expiry.
Yes.
The options expiry day.
Yes.
Right. I mean, that's a powerful card that you have when you went and raised this money. I'm sure. I mean, without that, I mean, I doubt whether you would have gone to the market and been able to raise the money. So it is still for investors who they're looking to raise money, really. So what is your strategy going to be? How are you going to do it? As you said, it's a duopoly right now. There is NSE, there is BSE, entrenched players. Exchanges globally are also very strong network effect players, right? I mean, something which does well, continues to scale, does well because it is doing well. So in a way, benefits beget benefits. So just what will MSE do in that sense?
So in that sense, of course, we had, you spoke about why they came in for the Tuesday. Some people spoke about the first fundraise, them coming in on the exclusive Friday, which has now become a common Tuesday. So I think the larger picture is about, seriously, yes, options market, we will be penetrating it too, because we do have an exclusive index, SX40, which lies right between the Sensex and the Nifty. And we see that as a very opportune benchmark index, which does have its own features and qualities, and it sits right in the center of the 25 and the...
So MX40 is the...
SX40.
Sorry, SX40 is the index?
Yes.
And everything will be underlying
40,
on the...
Yeah, which are the large 40
and
cap.
how does that derive its prices from? Because...
So, of course, that's the reason I said that, looking at the sustainable exchange, we would be saying that, it's the cash market that we look at as the primary focus to start with, to bring in the liquidity. And as I said, it's a near monopoly there, because for us as market creators, we need to look at it in a more holistic way. Do I have a healthy market? Is it competitive enough? Am I providing enough to my investor? Am I really reaching the goal that the regulator and the country is looking at from a longer perspective? So to do that, focusing just on one options market will not be sufficient. And that is not what we are only looking at.
Is there a message you've got from I'm sure you've been in touch with the regulator, etc. as well.
We firmly believe in.
Okay.
This is a message that we firmly believe in, that,
So cash before options? So
cash before, yes.
Has to be.
Yes.
All right. Hi, ma'am. Thanks a lot for joining in. A couple of basic details then. If you could tell us, most of the companies are listed either on the BSE or on the NSE.
Yeah.
Could you tell us what is your strategy with regard to getting larger number of companies listed on your exchange? If you could help us out with that, what is the strategy out there? Also, if you could give us a few more details on numbers, number of companies, number of members that you have, broking members. What was it, say, 3 years ago? What is it now? Where is it headed? Both those two basic details on companies and brokerage.
Thanks, Nigel. So basically, we do have about more than 200 uniquely listed companies which are not on any other exchange.
Okay.
There are, of course, the other larger companies which are out there on NSE and BSE, which are not listed with us, but they are in the permitted to trade category. This is the same for every exchange that starts. It was so in NSE 30 years back, where you started off with permitted to trade category, and then slowly you list on as you build the liquidity. So I think the focus will be, I'm sure at some point they will come in and list, and that will be also our focus for the existing listed.
Okay.
For the new set of companies, we definitely will look at them coming in, having their IPOs with us for the the platform.
Has the feedback been positive?
We do see a lot of interest gathering. Members, we do have more than 560 members which are registered with us.
Okay.
There were, of course, many more at some point of time when we started off 17 years back, and were a competitive exchange. Now again we're looking at a re-startup model. And we see that will propel through the challenges we have gone through. It's fair enough, but we will look at new companies coming in, listing on our platform, as well as even companies which it could be that in a new category of companies that we may look at that could come in, while getting all the existing companies also slowly coming and listing on our platform.
Ms. Kundu, just want to understand if you can share some milestones, I'm sure some targets that you've set internally in terms of volumes. What are those, by when, how much, if you can give us some sort of timelines, and also how many brokers are with you right now? I think some of them are also investors with you. So if you could just tell us how the scale-up is going to be in terms of getting more volumes on the exchange and bigger participation from brokers.
So we have almost more than 550 odd members who are already registered with the exchange. We are slowly seeing the activation increase. Last 6 months has been a positive turn with more and more members, not only the existing ones activating, but also new members coming in of different categories who are coming in and applying for new memberships. So we are seeing a positive turn on that end. Connectivity is coming in. We have been rolling out new infrastructure. State-of-art data center is what we are going to be now, giving in the next few months. So we are all in the readiness to make sure that we are market ready.
Yes.
Future market ready in terms of infra and tech space, so that when members come and connect, the feel-good experience is very much there on the table for them. So that is what we are focusing on.
Advertising blitzkrieg as well?
Sorry?
You will need to reach out, right? Advertising?
Yes, so we
in a
will
big
start
way
with
to kind
roadshow. We haven't really started on the advertising, but we will, of course, slowly roll out an entire PR plan and a marketing plan.
But how will you fund all this? Because I believe in, let us know the numbers. I think the operating income last year was around 4 crores. So as you go about investing in technology and, the exchange architecture, marketing, how will you fund all this?
Yeah, so the first round of funding did help us with, being able to allocate a good amount of number to the tech space, as well as expansion on general purpose and business, obviously expansion growth plan, whether it be including people. So infras, of course, and tech space is going to be the bigger spend. And road shows through other, marketing techniques, of course, we will.
Yeah, in a way, a lot of the brokers who've come in, I'm assuming they've also been, you've brought them on the cap table because, you've got to make markets, right? You've got to have activity. So the brokers, etc., should help in that sense. As shareholders on the cap table.
Well, I'm sure that, that is something that brokers do see an opportunity.
In a way, it aligns their interests.
Yeah. I would say everybody is looking at, beyond a near monopoly on the cash side of the market and also having, in every sector, in fact, just to move even beyond the exchange space. If you see any sector, the more the competition, it helps not only the sector, it helps every participant, including the existing players, because the market size is only there to expand.
It's going to give us a number. It focuses the mind in terms of a target. What Surubi said.
Volumes, your targets, and for your internally, your own revenue and profit estimates.
So I think we are looking at a 3-year horizon from now, where we look at ourselves becoming completely sustainable in terms of an exchange and also in terms of liquidity. At least within the range of 10 to 12% on the cash segment side of
12 to 15%,
10 to
12% cash market share in 3 years' time.
Yeah. So accordingly, we feel that even the propel on the derivatives would happen. But it will be obviously a slow progression. And while I say that, I think it's not just about the market share. The market size itself is going to grow. I'm looking at we are in a country, we're proud to be in a country where we are just 28 years old. We have a mindset today. We always had a mindset of saving. Today we have the mindset of creating wealth. When that is the propel, so that means I'm looking at a good close to 500 million people at least who should become becoming proper investors and having, whether they come through SIPs, they may not come directly to the market.
Right.
We do understand the concerns on creating that healthy market, and we very much would like to propel that further.
All right. So you turn profitable in the next 3 years is what you're saying? EBITDA positive, market share of around 10 to 12%, and you look to make some entry even in the derivatives market. BSE struggled for around 20 years, but they finally made their mark. So we'll have to see how that goes. Very quickly, that market share is interesting. NSE needs to could possibly list in the next 12 months. They'll list on your exchange as well. Any kind of conversations?
That is something I think you will have to ask at NSE. But we are more than happy to have anyone, that is what the markets are for, that you are supposed to list on any of the exchanges. So yeah, why not? I mean, if they do plan that, we are more than happy.
Competition and support each other as well. That's going to be interesting.
Of course. That's the way it should be, because when it's a healthy competitive market, you will all grow. Everyone will grow.
That's a very specific, nice, interesting point, Nigel.
Need to come up with something interesting, right?
No, I mean, given the interest levels in NSE, that could kind of provide the spark. And a new stock, a big one, biggest exchange, listed, and I mean, yeah, as you said, they are supposed to list. I mean, they were supposed to, if they list in BSE, but now with MSE as well, if it's, why not, as you said?
Yeah. Why not?
I mean, investors want a pie of the whole capital market space in one form or the other, so perhaps they'll be tracking your progress as well.
And more the platforms, I think that only allows de-risking also of, the entire space.
Sure. Okay, all right, ma'am. Thank you very much for joining in and discussing the roadmap ahead for you in the exchange in terms of growth. Let's quickly move on and address a very, very important story that our colleague Timsy is bringing about. This is something that oil marketing companies and their investors have been awaiting for a long time. What will happen to those LPG under recoveries? Well, Timsy is picking up from sources that there could be a fund that the government is setting up for this. Timsy, morning. Tell us more.
Well, yes, that's what government sources indicated to us, that the finance ministry is considering setting up a fund which could range between 32,000 crore to 35,000 crore rupees, only to cater to the OMCs under recoveries that are happening on LPG. The Petroleum Ministry has demanded about 40,000 crore rupees for this, but Finance Ministry feels that about 32 to 35,000 crore rupees of fund could be what can be taken up for a cabinet's approval to cater to this demand. And these proceeds, basically, where will this fund come from? Where will this money come from? Well, sources indicated that these could come from the petroleum excise duty proceeds that the government has raised till now. They'll use the excise fund for this. And the view behind agreeing to take this proposal forward for the cabinet approval is that oil companies are part of the same government family, and government cannot let them suffer by themselves. Their demand is justified and they need to be catered to. Thus, a compensation can happen very soon. That's what government sources, senior officials indicated. So let's see what happened. What happens now, how soon this proposal gets to the cabinet, because Finance Ministry is just finalizing the contours, and soon a cabinet approval could help OMCs overcome these losses.
All right. Interesting story there, Timsy. Thank you very much for that. We'll take a quick commercial break here. We'll focus back on the market with some trades with Mitesh, but we'll also have an interesting primary market company coming up in just a bit. Stay tuned.
Welcome back. Okay, now the market has chosen its color for the morning, and the color is red, 50 points lower on the Nifty. Let's go across to Mitesh for some trading advice. Mitesh, on the index, first of all, looking at this opening and now where it's settled, what would you do? And of course, stock ideas as well.
Morning again, Survi. I've been totally avoiding the index, and you can see that, while it's a 40-50 point kind of move, in percentage terms, it's hardly anything, and the market is still showing signs of contraction. But on stock side, I think a lot of technology names are giving you negative signals. So I think I have chosen HCL Tech as one of these sell calls. Keep a stop at about 1676, look for targets of 1620 to about 1615 on the downside. And Nykaa is seeing good follow-through action. So that's a buy, continuation buy. Keep a stop at about 211.5, look for targets of 225.
Okay, Mitesh, come back to you later. Thank you very much for joining us. We have to take one more commercial break. I have to do that. But on the other side, the management of Smartworks co-working spaces will be with us. Interesting company. They're coming up with a near 600 crore IPO.
Welcome back. Well, let's focus on some primary market action then. Smartworks co-working spaces, 580 crore IPO opens today for subscription. They have set the price band in that vicinity of around 387 to 407 rupees per share. They've also raised 174 crore rupees from the anchor investors. Let's discuss a little bit more on the IPO offering. We've got Harsh Binani, the executive director, and Nitesh Sarda, the managing director at Smartworks co-working spaces, who joins in. Hi, gentlemen. Good morning. Welcome to the stock markets and all the best for this issue. Well, let's get a basic point out of the way first before we discuss more about your business model. You're raising some money and you said you're going to be repaying some debt on that front. So tell us, what was the debt before the IPO? Once you get done with it, what does the debt come down to? And effectively, what would be the rough interest savings?
Thank you, Nigel. It's a momentous day for the company, and thank you for having us here. We are very grateful for the overwhelming support. Yesterday, we had a big anchor allocation, and we are now opening it up to public. The IPO of ours will have a primary raise of 445 crores, which will include 114 crores of repayment of high-cost debt, and the lion's share of the balance will go towards our expansion. In a post-IPO environment, the net debt of the company, which earlier stood at 299 crores in March 31st, 2025, we also had cash balances of 100 crores. Once we repay this high-cost debt of 114 crores, the company is actually going to become net debt positive.
Okay.
And today, we are very excited, especially because, as we've seen, Morgan Stanley widely reported that India is going to be the office to the world. Today, our Prime Minister Modi ji has an ambitious vision of making the country a developed economy by 2047, where the economy is going to grow to about $30 trillion. you can only imagine how much the requirement for office spaces is going to go up during this period of time. And we are here today to fuel that transformation of enterprise India. And we are extremely excited about the limitless possibilities that we are going to see.
Okay, all right. A couple of targets then. If I look at your total, I think you'll have 10 million square feet. You could correct me on that number. And it's moved from 6 to 10 million square feet in the last few years. Where is that number headed? And also number of seats. Currently, I think the capacity is roughly around 200,000 odd. So what would the ambition be? Not in the near term, but say 3 years down the line.
So our growth trajectory has been quite fast. If you look at our growth, as you rightly said, 6 million has moved to 10 million already. Just in the last 3 months, since we've declared this in our RHP, we've signed an additional 1.5 million square foot, moving our total asset under management to 11.5 million square foot. If you look at this space, Nigel, it started off about 8 years back. It's grown to 88 million square foot across India.
Yeah.
This industry generically has been able to grow faster than traditional office spaces. If you look at the projections, CBRE has said that this industry will grow to almost 140 to 147 million square foot in the next 2 to 3 years. So the potential is really, really wide. We've been able to become the largest managed campus operator in the country today. We have over 50 centers. We have over 10 million square foot of space, which is already operational, and are present in 15 cities. Our focus is a little towards mid to large enterprise clients, where we cater to their requirements of over 300 plus seats. And that's the reason we've been able to scale faster than anyone else in the market, because we take large individual buildings, convert them into campuses, and give it out to large enterprise clients.
Gentlemen, morning, and congratulations, as Nigel said, you've come into the market. Nitish, if I can ask you, what are margins like in this business, and where are they now? What do you aspire them to be? How can you grow them? What are levers here?
No. So if you look at our trajectory, in the last 3 years, margins have grown by almost 3.5 times. Our adjusted EBITDA, which stood at 35 crores in FY23, has grown to 172 crores in FY25, with a base increase of from 6 million to about 10 million square foot, and a revenue increase of only 1.7 times, from 700 crores to 1,374 crores. So while the revenue has increased by 1.7 times, our EBITDAs have increased by 3.5 times in this. The growth potential in the industry, as I said earlier, is to scale this up significantly. 147 million square foot is also just a drop in the ocean. As Harsh mentioned earlier, we are becoming the office to the world. The demand, if you look at in India for office spaces today, just the first quarter of this year had more than 48 million square foot of absorption.
Yeah.
So this
when I wanted to come to that. So what are margins now
So our margin last year was at 12.5%.
Okay.
The margin has seen a steady growth trajectory. But the real strength of our business is not in our margin. We are a cash flow strength company. If you look at our margin and compare it with the cash flows, it was actually 240 crores. The trajectory that we've been able to demonstrate during this period has been on an upward curve. And every business, when you start to seed, it initially requires a lot of investment to build it to a critical mass. Once you've reached that critical mass, that's when you start to see enormous profits.
Okay, so just to office to the world, just last question, Surabhi. GCCs are the big growth driver, right? Captive centers. You have them as customers?
We service a lot of GCCs, but how I would give the sectoral mix is that India, about 55 to 60% of India's commercial demand comes from IT, ITES. For Smartworks, that number is 42 to 45. We've not only focused on IT, ITES, but we've also diversified our sectoral base by getting companies in manufacturing, healthcare, BFSI as some of our clients. So we've really distributed our client base across all sectors. And while GCC is seeing a significant amount of increase, but even Indian companies, homegrown startups who have reached a certain size are taking a lot of office spaces.
Okay. I just have a very small, few quick fire, specific questions for you all. You said the company is throwing up about 240 crores of cash every year. Part of the issue proceeds are being used to retire debt. How much debt will you be left with, or will you be able to pay off everything, with the fact that you have cash and you've got the IPO proceeds? If you could just start there, just give us clarity.
Once we repay the 114 crores, the company will be net debt positive. What that means is that we are not going to be debt free, but the company is going to have very healthy cash balances. And we are repaying debt.
How much debt will you be left with?
We will be left with a debt of close to about 200 odd crores.
Okay.
And we are repaying debt in a very aggressive manner. and the company's growth trajectory is also starting to see massive revenue creation. In 8 years, which includes 2 years of COVID, today we are at about 1,350 crores of rental revenue.
Sure.
When you juxtapose this with one of the largest real estate companies, which has a legacy of 80 years, their office rental revenue is about 4,000 crore.
Okay, so you after this whole exercise, you'll be left with 200 crores of debt and roughly 240 crores of cash. Now, I just want to come to that, the model itself. How much of your campuses are owned by you and they're assets on your books, and how much are on a lease rental model? I mean, what's the thought on that going forward?
We're a completely asset-light model.
Totally asset-light.
We do not
okay. So you won't be owning any of the assets.
We take it on long-term leases. That's the reason with only 500 crores of equity infused, we've been able to scale up so.
Okay, so just what is typically the tenure of the leases that you take for these assets and the tenure of the contracts that you sign with your clients? I mean, typically, is it like 3 years? And how frequently do the contracts come up for renewal?
So our tenures with our landlords are towards 15 years, where we have a 5-year lock-in. So post 5 years, we have the ability of moving out. But the total tenure is about 15 years. On the client side, we do more long terms because of our focus on mid to large enterprise clients. 63% of our revenue comes from customers who are taking 300 plus seats. When a customer takes more than 300 seats, they are happy to give you much longer tenures.
Which would be
our average tenure is about 50 months on the customer side, right? So it's long tenures on the customer side, but over and above that, our retention rate is as high as 86%. So even after that 50 months, 86% of the customers end up renewing with us.
All right, out of curiosity, as you'll mention, with regard to the largest real estate company and the likes, you're welcome to the stock market and good to see the IPO. But were you all approached by anyone to buy you all out? Or, instead of listing, maybe someone proposed writing a big check to you all? Did that happen?
We have approached people to buy them out. It's a very unique model that we've created in a very fast-growing space.
But you all were not approached?
We've never.
However, having said that, we today are backed, while the promoters continue holding a majority share in the business, we are backed by a very large minority investor, which is Government of Singapore-backed Keppel Land, who own a 19% stake. They are very long-term on the business, so they in fact reduce their OFSI. So they are going to reduce to about 15%. And the company also has a list of marquee investors who have not only supported us, but reinvested throughout. So we have Madhukela Family Office, Jagdish Master Family Office, Hexaware, Polycap, Deutsche Bank. So that's how we built a great coalition, and we are very excited now as we go to the next.
More details when you all list. We'll pull out some more numbers from you all. But thanks a lot for joining in and giving us all of those details.
Thank you so much for having us.
All right, well, time to slip into a short break. On the other side, our special segment, Market Masters. We'll have Lata who will be joining in. She'll be speaking to Saurabh Mukherjee of Marcellus Investment Managers. Stay with us.
Hello and welcome to a special segment of Market Masters. How will the first quarter FY26 earnings pan out? Will Nifty EPS improve going forward after a rather dull FY25? And what are the top stocks sectors to invest in if there is a growth slowdown given the tariff uncertainty? To answer all this, I have with me Saurabh Mukherjee, founder, Marcellus Investment Managers. Good morning, Saurabh. Always a pleasure having you with us. Well, first up, this top-down question. The Nifty didn't deliver last year. Of course, there were several mid-caps which outshone, as your own portfolio shows. But what is the expectation for the current year? We have, as always, people starting with 12 and 13%. But is that even deliverable?
I think the drivers of earnings growth, even for FY26, Lata, the drivers of earnings growth are still not evident. I think the first quarter will be muted. I think it'll be another 4-5% EPS growth quarter. But it's not as yet clear to me what exactly will drive a EPS pickup in India. Both the private and government capex, it's not evident there'll be a takeoff in either. If you look at budgeted government capex or the private capex noise, it's not evident there's going to be a big takeoff in either of them. Consumption remains muted. RBI is trying its best to reflate the economy, but as I'm sure you're seeing, bank loan offtake is actually going down, not up. So the big hope I have is the India-US trade deal. I'm hoping that the India-US trade deal will galvanize Indian companies to look at new opportunities. It'll make us more competitive. From what I'm hearing, the India-US trade deal will make us more competitive vis-a-vis China in the American market. So fingers crossed in the India-US trade deal, but as yet, I'm not seeing anything which suggests to me there's an imminent pickup in earnings around the corner.
Oh, okay. Well, I'll just throw in a few things that looked positive. You had the huge tax cut, which would mean about 1 trillion for the country as a whole and maybe about a lakh rupees for people in a certain tax bracket. As well, as you pointed out, tax cut and CRR cut as well, which will mean banks can become a little more aggressive than in previous cycles because we've not seen 3% except during COVID years.
Yeah.
And then, of course, the government's capex is not coming down. It is at a fairly high level compared to historical standards, though I agree that it is not rising at a pace that one would like. You don't think all this is enough to engender a better earnings growth than last year?
Sure. So let's focus on the consumer piece first, right? One of the reasons I've been very circumspect about a consumer demand recovery now for the last year is high levels of debt. If you leave aside home loans, if you leave aside mortgages, on household debt as a percentage of GDP. Leave aside mortgages because in India, mortgage debt, home loan debt hasn't really risen materially in the last 4-5 years. Household debt to GDP is around 33-34%. That's the highest ever by Indian standards, and it's amongst the highest in the world. And there's plenty of data from the RBI's financial stability reviews to suggest that a big chunk of middle class India is up to its neck in debt. Now, what that does is if middle class India is heavily indebted, job creation engine is not firing, pay rises, there was a recent survey by a very credible outfit, I think Deloitte is the outfit, a very credible survey which suggests white collar pay rises are at a 25-year low. What that suggests is distributing more credit is not going to be jacking up consumer demand, and ₹1 trillion income tax cut is in the broader context of consumer debt a relatively modest amount. So the consumer piece, it's not evident to me, fires very quickly. One area of optimism here, right, if you're looking for rays of hope, is the real estate conk-off, right? The unit sales of real estate has started falling in the last 3 quarters. And I've always found that when real estate demand conks off, that's when consumer demand starts picking. Because when you buy a flat, it sucks up so much of your income that everything else then is put on the back burner. So if real estate demand is conking off, and all the signs are it is, that ironically could presage a broader recovery in demand for cars and consumer durables and so on.
Okay. All right. So I would assume, therefore, as your note on your consistent performers and on the Marcellus curated portfolio argues, that you are trying to look for companies with moats, companies which can sidestep the overall growth slowdown or the overall, modest level of growth.
Yeah.
You have a lot of finance companies in them. You have HDFC Bank, Kotak Bank, you have ICICI Lombard, two or three NBFC companies, Bajaj Finserv, Bajaj Finance, Cholamandalam. You still think that there is a very good chance of these companies doing well, despite the fact that they will initially see low margins and, of course, credit growth challenges?
Yes, so I think one of the reasons we are doubling down on our holdings in quality lenders, Lata, is the environment has actually become very difficult on the liability side, right? Raising liabilities, getting current and savings account has become really tough. And in that sort of environment, a champion franchise like HDFC Bank is standing out. I think it's standing out honestly head and shoulders above other banks. I think HDFC Bank and ICICI Bank are standing head and shoulders above other banks in consistently being able to garner low cost deposits. The reason for having an ICICI Lombard is relatively straightforward. It's shown itself to be very capable as an underwriter over the last 20 years or so. I would put it right up there as arguably the best private sector general insurance underwriter, and demand for health insurance, auto insurance, and property and casualty is holding up in what is a soft climate, right? Overall, the valuations piece on a good quality lender like HDFC Bank is also reassuring for us, and hence the predisposition towards the good quality private sector lenders in what is a muted demand environment.
Okay. The other two themes that I pick up from investors like you or fund managers has been hotels and hospitals. Because India is becoming more a services consumer, at least the upper part of the K. You have Narayana Hridayalaya, but how do you look at this theme itself?
Yeah, so I think the hospitals piece, I think nicely picked up. I think what's happening is the government has made it pretty clear that they are not going to be building hospitals. The government is saying we are doing Ayushman Bharat. Ayushman Bharat is the general insurance scheme that the public can use to avail of healthcare. And in the more affluent strata of society, medical insurance provided by the employer, or if the employer doesn't provide it, then individual medical insurance has become the norm. And naturally, therefore, the hospital industry is booming. As yet, we're not seeing a supply of high quality beds exceeding demand. There's still a deficit of hospital beds in cities like Bangalore, where Narayana is particularly strong. And I would submit to even the city I live in, you and I live in, Mumbai. There's a deficit of high quality beds. In due course, there will be a supply side response. As we know, every private equity company, every private equity investor in the country is building out a large hospital chain. So in due course, the supply demand mismatch will be closed. But until such time, I think private sector hospitals will be a good play. In hotels, the big supply shortage seems to be corporate hotels, right? So corporate hotels in cities like Bombay, Bangalore, Hyderabad, Chennai, there seems to be a shortage of corporate hotels in business districts, and we're trying to capitalize on that. We're making an investment. We haven't yet fully built the position out, so I'll hold my horses there. But there does seem to be a shortage on hotels and 3-star, 4-star hotels in business districts, and it's very difficult to get permissions and set that up, and especially in southern India, where the GCC piece is booming. Global executives are coming to India, but there aren't enough beds. We think there's money to be made there.
Okay. So you also endorse the hotels and hospitals view. You're seeming to bet on the home building materials. You have Asian Paints, Astral, Pidilite. If you're not very confident of more homes being bought, how does this tie in? And as well, Asian Paints now is no longer the monopoly it was. It is barely first among equals.
Right. So let's address the link between home building and home building materials. Barring Astral, where pipes are usually required when a house is being built for the first time, barring Astral, the other two names, Lata, the paint companies and Pidilite as a play on adhesives, waterproofing, there the link isn't as tight. So 80% of paint demand in India is driven by repainting of houses. It's the maintenance of houses rather than the first time build which drives those industries. In Astral's case, I agree that if home building is slowing down, then there is an impact on Astral's demand offtake. Now coming to the point on Asian is no longer a monopoly, the market share taken by the new entrants is actually de minimis, which is why I guess they're complaining to the authorities. And this has been true for the last 20 years. I don't have data prior to that, but whatever I've seen and read about Asian Paints this century, lots of people have tried to take them on. People have large players from across the world have come and pumped billions into taking on Asian Paints, but they haven't got anywhere. And the usual sequence is come, spend money, complain to the regulator, and then 5 years later, pack up your bags and go somewhere else and try somewhere else. So following the time-tested sequence in Asian Paints, and since it's a time-tested sequence and market share gains for new entrants are limited, we are sticking to our guns and staying with a large position in Asian Paints. And I stress again, I'm invested in this stock through our portfolios. So are my parents and obviously our clients.
Okay. Well, how do you see the EPS growth in your select companies? I mean, even you have given us a table of FY19 to 24 and FY25. And even over there, one has seen the EPS growth fall. It is still good at 13% for your weighted average companies in the CCP, consistent performers. But it is still lower than the 22% you generated from FY19 to FY24. So is earnings growth... what's the trajectory?
Sure. So it's a lovely point you bring out. I think overall corporate India earnings growth is down to 3-4%.
Yes.
Even our investee companies, which used to compound 20% plus, are only compounding now in the low teens, right? But what I've seen in India historically, Latha, is it's when growth evaporates. It's when growth evaporates in the country at large. That's when the market flocks to. That's when the market flocks to quality. So if you think back to the period 2017, 18, 19, the pre-COVID world, right? Growth was tepid.
Yes.
You had those debacles in the lending sector, Diwan Housing, ILFS, and so on. So growth was tepid and quality did really well in those three sectors. In the post-COVID world, growth was abundant, right? There was revenge spending, there was heavy-duty government infra spending. Growth was abundant and quality took a backseat. It's only in the last 6 months or so, as the growth environment has become soft, that's when quality has started staging a comeback. That's when, for example, a stock like HDFC Bank has started flourishing again. So ironically, a low growth environment is bad for everybody. Even our companies suffer in a low growth environment, but because our companies suffer relatively less compared to the broader index in a low growth environment, this is exactly the sort of circumstance in which quality stocks start flourishing in India.
Okay. I do want to take up with you what will happen when the trade deal is announced. You said that you're expecting much for India, but that discussion another day. Let's hope that by the time we meet next time, we will have the contours of the deal with the US. Fingers crossed. Thank you very much, Saurabh, for a many-sided discussion on several sectors and the path going forward, both for GDP growth and EPS growth. Wrap up on Bazaar on that note. Chartbusters coming up.
The Indian markets open lower as range-bound trade continues. The Nifty slips below the 25,500 level as most sectors except metals and realty trade with losses. The broader market trades in line with the key indices.
Power financiers REC and PFC, they rally as Morgan Stanley initiates overweight calls on both the stocks, expecting 12% loan growth CAGR over the next 3 years.
Home First Finance surges as Bernstein initiates an outperform rating on the stock. The brokerage sets a target of 1,650 rupees a share, expecting the company to see faster growth and superior productivity matrices.
IDA rallies as the government allows it to raise funds via capital gains bonds, which allows for lower interest rate and tax benefits for investors.
TCS will kick off the first quarter earnings season with its results later today. A CNBC-TV18 poll sees a constant currency revenue falling in the first quarter of FY26, while margin is expected to be maintained at around 24.3%.
Hello and welcome to Chartbusters. We're coming to you live from the CNBC-TV18 Motilal Oswal studio. I'm Nigel, and with me is Vinny in bright yellow today. Vinny, market's a little bit red.
I'm the only one who's shining in the market since the last week. There's nothing happening there. So I was like, let me bring the shine and come here today.
Modesty, yeah? So we normally have green, red, and now we have yellow as well. But the markets, seem to be in a bit of a flux, in the near term. The Nifty is waiting for cues. Remember, the big cue that's going to be coming on the domestic front is going to be earnings season that gets underway today with big boy TCS that will be reporting their numbers. And, in terms of the mid-cap action, though, you still have more number of stocks that are advancing than the number of stocks that are declining. So that's heartening as well. We had some flashes with regard to Sun Pharma that comes up for you on the screen. That should come up in just a bit. We'll get Ekta to detail that as well. There are some observations with regard to Halol. And split verdict, actually. Some saying that it's not as bad as anticipated. But the stock is actually at the low point of the day. We should keep an eye out on Sun Pharma. I think at some point of time, Director will be pulling that one up for you on the screen. Let's go to Sachidanand Rutekar, though, from Trade Bulls for a technical check on the markets. Hi, Sachi. Good morning. Good to see you win. Markets lagging triggers, right? Waiting by for Trump earnings and wondering what's going to happen next. What's your take? This 25,400 odd level has been holding out. Would you look to buy or would you wait buy?
Good morning, Nigel. Nigel, clearly the range is well defined unless we don't see a breakout above 25,550. We may not see the resumption of direction momentum. On a broader basis, we still continue to be on the bullish side. This is mere consolidation that we are observing. On the lower side, at least for the day, 25,350 is a kind of support wherein some buying can be initiated. Else, I think one should wait for a breakout decisively for this particular level to be taken off at around 25,500, 550. And, some aggressive long positions can be considered once this breakout is in place. When it comes to Nifty Bank, I think there could be some outperformance here. We are liking Nifty Bank and Nifty Auto. The structures are very good. There is a possibility of good relative outperformance within this particular space. So we are of the bias that eventually we may see the Nifty, breaking this particular hurdle at 25,550. And hence, even on a decline, the recommendation is to add long positions, keeping a stop loss somewhere close to around 25,320 on a closing basis. One can, accumulate Nifty near to that 25,400 mark. And on the higher side, review positions once, it is closing towards that breakout zone of 25,500, 550.
Okay. Sachidanand, anything in terms of specifically you're seeing coming in for campus activewear, that's buzzing in trade and, good volumes is what we're seeing as well today. So anything specifically on that front as well as what are your top bets?
Well, campus, the overall structure has been fairly negative. There have been bouts of buying, which we have seen in the past. But if you look at the broader structure, the structure is still weak. We are of the opinion that there could be some more steam in this particular rally, but eventually 310, 330 looks like very significant hurdles. So from a trading perspective, one can initiate some long positions, but the stoppers has to be very specific to that 270 mark where it's 200-day exponential moving average is placed. So I would not recommend adding long positions here, but in case if someone is holding, one can put a stop loss at 270 and review positions close to 310. When you look at stocks, I think Nifty Auto and Nifty Bank, I think they are very significant right now. SBI from that space is still consolidating well. We are expecting that the movement within this 810 to 830 zone, I think it is still valid, and one should stay long with a stop loss at 810 on a closing basis. We are expecting a rebound back to around 825 levels, so a buy on SBI. And the second stock is Maruti. Now, if you look at the last 3 trading sessions, despite of the market weakness, this particular stock has been forming a base near its 50-day exponential moving average support, which is placed somewhere close to around 12,460. So keeping a stop loss at 12,460 itself on closing basis, one can expect a rebound back in this particular counter. And hence, we are recommending building long position for a positional target of around 13,160.
Okay, Sachidanand, thank you so much for joining in with us, giving us a check in terms of what to expect from the market as well as your top bets. But let's shift focus to our special segment where we will get you a few ideas from for profit from Money Control Pro. Sachin Pal of moneycontrol.com is joining in with us to talk to us about the stock that he's tracking closely. Sachin?
Electronics manufacturing company Syrma SGS ended the year FY25 on a promising note with its highest ever quarterly as well as annual net profits. While the revenues in Q4 FY25 were lower by almost 18% year-on-year, the company witnessed a strong expansion in operating margins and witnessed a growth in terms of operating profits by almost 46% year-on-year. Among the different business verticals that the company operates in, it witnessed strong traction across auto, industrials, IT as well as railways. However, there was some weakness exhibited in the healthcare vertical and as well as in the consumer verticals. The weakness in the consumer vertical is primarily attributed to the fact that the company is looking to move its focus away from the low margin consumer business. Well, for FY26, the company is aspiring a top line growth of almost 30 to 35% on a YOY basis with EBITDA margins of almost 8%. And this is backed by a healthy order book of almost 5,300 crores, which is split across different business verticals. Besides, the company is also looking to apply for the component PLI scheme with a technology partner. The company continues to remain on a very strong footing, and the stock has also seen a very sharp run-up in the last few months, and currently trades at close to its all-time highs, which is and in terms of valuation, it's trading at around 40 times FY27 estimated earnings. Given the steep valuation, investors should therefore look forward to accumulating the stock during a weak phase of the market.
Thanks so much for that, Sachin. Surely EMS players are something that are in focus because yesterday only we had a brokerage note also that came in from JP Morgan initiating coverage on this one. Today, Gautam Trivedi also spoke about these EMS players. But on that note, we're going to slip into a very short break. But remember to tune into the all-new CNBC-TV18 Prime, bringing you insights from policymakers, business leaders and economists shaping both the world and India's future. CNBC-TV18 Prime decodes global shifts and their impact on Indian businesses, giving you unparalleled insights. Tune into CNBC-TV18 Prime at 12 noon for the Global Reset, at 1 p.m. for the Big C, and Global Lens at 8:30 p.m.
Welcome back. You're tuned into Chartbusters. You're on CNBC TV18. Well, let's focus on a couple of stocks and sectors. Home first. That one is buzzing post a bullish note that came in from Bernstein. Gaurav joins in to help us out with the detailed analysis on that report. Gaurav, take it away.
Well, yes, housing finance companies, specifically Home First, is in focus today, and the reason being that Bernstein has now initiated a report with buy rating on many of the companies and also market perform on a few. So first, let's talk about companies like Home First Finance, Aptus and Aadhar, where Bernstein has maintained or rather initiated with their outperform rating. On Home First Finance, what they're saying is that it is actually the most preferred pick from the pack, and the reason being that the company actually stands out in demonstrating the ability to consistently replicate its portfolio and its business model across multiple states. Other than that, what they're saying is that there are some key points like faster growth, smaller size, which is helping the company even further. The company in an environment where we are seeing the rate cuts. Aadhar Housing Finance is also one company where they are being a little bullish, and the reason being that they say that this company has the largest and most geographically diversified portfolio, which is helping the company to even grow further. On the other hand, they have initiated with market perform rating on Aavas Financiers. What they're saying is that this company is actually lagging its peers when it comes to yield and profitability, and that is the reason for now they have initiated with market perform. And lastly, for PNB Housing, again they have maintained their market perform rating, because what they're saying is that the shift towards smaller ticket size is actually positive, but on the other hand, the aggressive strategy that the company is implying right now is raising a few concerns, and that is the reason for now they are being a little cautious with market perform rating. But definitely on the back of this news and the note, we are seeing some reaction in the stocks. As of now, we are seeing some uptick in Home First Finance as we speak.
Okay, Gaurav, thank you so much for that. But the Finance Minister Nirmala Sitharaman also called on NBFCs to significantly scale up their role in financial system. Let's listen into what she had to say.
You should aim to reach at least 50% of the total volume disbursed by scheduled commercial banks. Not a big number, considering in the last 4 years, you've doubled. 24 became 48. You can do it even now. So, as India moves forward, NBFCs will have a key role, no doubt, in meeting the credit needs of the future, including in areas like green initiatives, affordable housing, and MSMEs. To reach, and the reach that you have is the biggest strength that you have. By 2047, at least 50% of NBFC credit should be directed towards high growth and high impact sectors. NBFCs, I want to tell you in front of the Department of Financial Services Secretary, you're no longer shadow banks. The stronger regulations and oversight is the best testimony. The stronger regulation and oversight is the best testimony of your importance in the financial system and the broader economy.
All right, let's move on to Bharat Dynamics. That's trading lower following a note coming in from Motilal Oswal. Ria joins us to fill us in with details on that note. Ria?
Well, yes, Motilal Oswal has initiated coverage on Bharat Dynamics with a neutral rating and a target price of Rs 1900, implying a 4% downside from yesterday's closing price. Now, the brokerage has noted that BDL's revenue has been impacted in recent years, largely due to supply chain disruptions and challenges in sourcing critical components, particularly from Russia and Israel. However, these headlines are beginning to ease out, and they are expecting a sharp recovery in revenues going ahead. They are projecting a 35% revenue CAGR over FY25 to FY28. Margins are also seen holding steady in the 24 to 26% range, while operating performance is also set to pick up meaningfully. EBITDA and net profit are expected to grow at a CAGR of 64% and 51% over the same period. Now, the report has also highlighted strong order visibility for the company. They have an existing order book of about Rs 22,700 crores and a potential pipeline of about Rs 50,000 crores, including large deals like QRSAM and the upcoming emergency procurement orders as well. On the macro front, the company is also well positioned to benefit from favorable defense sector tailwinds, be it the rising global defense spends, the growing exports of the Akash missile systems, or the ongoing collaborations with DRDO. That said, valuations do remain a sticking point for the company. Currently, it's trading at 70 times the FY26 estimated earnings, and hence they do suggest waiting for some better entry levels for the stock. On the back of this, the stock has been under some selling pressure, trading about 2.5% lower today.
Okay, Ria, thank you so much for that. But let's move on and talk about TCS because that's expected to kick off its Q1 numbers today. Rima is joining in with us to give us what are we expecting this time? What is the CNBC-TV18 poll indicating? Rima.
Thanks so much for that. So expect a muted quarter from TCS. The most important number is their revenue growth. Constant currency revenue growth is likely to decline by nearly 1.5%. In dollar terms, you will see a growth, and that's on account of the cross-currency movements. Basically, the dollar depreciated a lot against other currencies like the euro, the yen, the pound, etc. But the key number will be the constant currency revenue growth, and that is expected to drop sequentially by nearly 1.5%. So that's a big, disappointment. Secondly, margins. Margins are likely to remain flattish on a quarter-on-quarter basis. Oh, sorry, I forgot to mention, the reason for the revenue drop is because of the BSNL contract, which continues to ramp down. That's the reason why revenues will come under pressure. Now on the margins. Margins are seen likely flat on a sequential basis. Remember, this time there is no wage hike. The wage hike, which typically happens 1st of April, was deferred by the management, citing uncertainty. So the question that analysts have is that then why are margins not going up? Anyway, there is no wage hike, and plus there is lower contribution from the low margin BSNL deal. So, it's reported that BSNL margins are in in single digits. So therefore margins, actually should have gone up when there is a ramp down of the BSNL contract. That's not taking place. So what will you watch? One is a pickup in growth, because the international growth, ex of BSNL, has been a bit subdued, lackluster. The growth was primarily driven by the BSNL deal. So despite strong deal wins, the international growth has been fairly muted. Secondly, we spoke about margins. How will the margins expand from here on? Thirdly, timing of the wage hike. You didn't give it in 1st of April, but now do you think there is scope to give wage hikes for this year? And lastly, the deal wins. Deal wins last quarter were very strong. They came in at close to about $12 billion plus. So how about the deal wins, given all the uncertainty that we've seen in the quarter gone by? Back to you.
Okay, all right, Rima, thanks a lot for that. But let's slip into a short break. As we do that, let's bring you some good news for all our viewers. India's business news leaders now just a click away. Introducing CNBC TV18's all-new app. Get instant access to breaking news, in-depth articles, and financial world updates. All of this at your fingertips. Download the CNBC TV18 app now from the Apple Store, the Google Play Store, or simply scan this QR code that's up for you on the screen. Welcome back. You're tuned into Chartbusters here on CNBC-TV18. Well, research firm Viceroy had come out with a report describing Vedanta Resources as a parasite and Vedanta Limited as a dying horse. While Vedanta has hit back, stating the sole objective of Viceroy research report is creating a false propaganda. So let's get a little bit into details. First, is Vedanta's debt still a problem? If we just look at what they've done, Vedanta Resources first, their debt has nearly halved in the last few years. From around $9 billion, it's down to sub $5 billion. And they've also said that they'll be reducing their net debt by close to $3 billion in the coming year. Out of that, $1 billion done. So $2 more billion is what they are looking at, which effectively means the debt will fall down to sub $3 billion, approximately. So Vedanta Resources actually has done a fair bit of deleveraging. And if you look at their maturity, it appears they're fairly well placed. And because they have some obligations, Vedanta Limited shareholders could be looking out for a bit of a sweetener in terms of, dividend paid. So we'll have to keep an eye on that front, because that's Vedanta Resources' debt repayment, debt maturity cycle. Remember, they've refinanced some of this debt at a lower coupon rate, which will save them on interest costs in the times to come. That's about Vedanta Resources, which is the parent, which has been the problem that how jittery is Vedanta Resources. They're in far better shape, I can tell you, in comparison to a couple of years ago. Moving to Vedanta Limited, they have been undertaking a big capex plan, right? But the net debt number actually has come down. We should pull up what is the recent net debt number. I think my director will get that up for you in just a bit. It's around 53,000 crores. But on a year-on-year basis, as well as on a sequential basis, it compares with around 57,000 crores. However, for metal companies, you normally want to look at it on a net debt upon EBITDA basis. And that number was close to around 2 or even more than that. But in the last few years, it's come down from around 1.5 times, 1.55 times, it's come down to around 1.2. And the management has stated they're looking to bring this number sub that one time odd. So on that front as well, they've done a fair bit of work. So both Vedanta Resources as well as Vedanta Limited actually are in far better shape in comparison to a couple of years ago when things were a little bit jittery. In fact, I questioned Mr. Gabriel, the co-founder of Viceroy Research, and I also spoke to Rakesh Arora of Go India Stocks. While Viceroy believes that Vedanta could be at the risk of default, Rakesh Arora says this report from Viceroy could be a couple of years too late. Let's hear them out.
Vedanta Limited, let's say, it doesn't have the capacity to cover the interest costs of Vedanta Resources. So whether that will create an eventual default, or whether the possible impairment of billions of dollars of Vedanta Limited's assets will lead the creditors to call that debt. That's anyone's game. We're here to report it. Whether we're a bit too early or a bit too late is irrelevant. We've written our research and we think that the end result is a disorderly collapse. We think that Vedanta Limited has been overly promotional in the ability of its business and the ability of its operating assets, which that have been largely overstated.
Are you done with the report, or will you have more reports coming out on Vedanta?
Oh, we have more.
Unfortunately for Viceroy, they are just 2 years late on this stock. Vedanta Resources already delivered quite a bit from around $9-10 billion to around $4.5-5 billion now. And now servicing that debt is not a challenge at all. Number two is that, Vedanta itself has gone through this whole exercise of demerging, and all the lenders have looked at individual entities on their leverage, on the, whatever the liabilities are. And clearly, they've approved this. So clearly, all the entities are self-sufficient. Otherwise, this kind of approval cannot come from lenders. Vedanta stock is largely dependent on aluminum outlook. And aluminum outlook has been pretty strong and doesn't look to be weakening anytime in future. They are also getting a little bit more of backward integration in form of bauxite mine, coal, their own captive alumina. So things are looking better only for them. So I don't think fundamentally there's any reason that performance would deter. Vedanta has been has done phenomenally well actually in the last 2 to 3 years. Meaning, if you had asked me in 2021, I would not have been able to gauge this kind of turnaround that the management has been able to achieve. And things are only getting better from here.
Okay, and with that, we're absolutely out of time on this edition of Chartbusters on CNBC-TV18. Thank you so much for tuning in. The markets have seen a bit of a slip in the last few minutes. Keep an eye out of that. 25,388 around that level is what the Nifty is at right now.
Okay. Hello and welcome to Trading Hour, live from the CNBC-TV18 Motilal Oswal studio. I'm Sonal Bhutra. With me are Hormis Fatakia and Reema Tendulkar. Good morning, guys. It feels like I feel like we're towards the end of the week already. We are, but it feels like a Friday, but not for the bulls for sure. We are at the day's low as we speak. Yesterday we were range bound again. In the last hour of trade, we saw Reliance falling and taking the Nifty lower. But for now, if you look at the Nifty levels, we are way below that 25,400 mark as well. It's an 84-point cut on the Nifty that we are witnessing currently, and it is closer to the day's low. The mid-caps are lower, the banking index is also lower, and most of the sectoral movers are in the red right now. So pharma index down 1%. IT has taken it to the chin as well. Remember, we have the earnings starting today itself. TCS is the first one to report numbers. So all these names are in focus. There's been a sharper fall in the mid-cap index in the last couple of minutes itself. We have the CPSE basket, which is not doing so well. So looks like after being in consolidation for a long time, we are seeing some fall from the higher levels. We'll have to see. A lot of things depend on the earnings as well coming forward, and the big US-India trade deal. There has been no word on that.
Indeed. So yesterday the 25,500 mark got taken out. Today the 25,400 mark has been breached on the way down. Benchmark indices are down close to about 0.3%. And as Sonal said, mid-caps have underperformed. So week to date, the mid-cap index is a cut of close to about 0.9%. Individual stocks, at least in the large cap space, Bharti Airtel is your top loser. That's down about nearly 2%. Pharma names, the Nifty Pharma Index is down 1%. Individual constituents like Cipla, Dr. Reddy's, Sun Pharma losing more than 1%. In the IT pack, it's Tech Mahindra and Wipro, the weakest of the lot. TCS, so far at least, is holding on to the flat line. On the way up, Maruti Suzuki, and Axis Bank. So a couple of these private sector financial, Innocent Bank, Ultratech Cement, higher in trade.
All eyes on TCS later this evening, but even the broader markets for that matter, as the index has gone lower, the broader markets have not had it any better, and they have been underperformers more often than not over the last few trading sessions. 100 points lower on the mid-cap index, and if you take a look at that from the day's high, it's almost 260-70 point correction from the highs of the day. Metropolis is the top loser on the Nifty 500 today, 4% lower on that stock. Defense stocks are not doing well in today's session. Garden Reach is down 3%, Bharat Dynamics is down 3%, Zen Technologies too is down a similar quantum, Data Patterns is down 2%. So selling across the board seen in a lot of these defense names in today's trading session. On a higher side though, there are names like Acme Solar that's doing well, 7.5% higher on that stock. Campus Activewear has been among the top gainers all through the morning within the broader market, 6% higher on that stock. And the other one is UTI AMC. Just a couple of days ago, Antique had come out with a note on these asset management companies where they had initiated coverage on all four of them, and UTI AMC was one of them, and they had projected close to a 12 to 13% upside on UTI AMC, a 1500 rupee price target there. So 4.5% lower, higher on UTI AMC as well. But some of the other names that have done well are the power financiers in the morning today, and that are PFC and REC. Both of them trading with gains today, and they have gotten an initiation from Morgan Stanley. Remember, they are a consensus buy across the analysts who track the stock, and Morgan Stanley is the latest addition to that list. Gaurav is here with more details on this. Gaurav.
Well, yes, definitely power financiers are in focus, specifically PFC and REC, and the reason being that now Morgan Stanley has initiated a note. For PFC, they have given a target price of 508 rupees, while for REC, they have given a target price of 485 rupees while giving the outperform rating. What they are saying is that the stock has been muted if we compare it with their performance in 2023 and 2024, and if we compare it with that, the stock has been muted for the last 9 months, and from here on what they're expecting is that 12% growth is what we can see in loan book, and at the same time the stock can also give ROEs in the term of 17 to 19% over the next 3 years. Given all these factors, when we look at the valuations now, as per Morgan Stanley, the valuation is still at a cheaper rate, and it still looks attractive given the quality of earnings, and at the same time 3 to 4% of the dividend yield that the company is currently paying. And factoring in all these aspects, the Morgan Stanley has now initiated with overweight rating. Definitely on the back of this, stocks are also buzzing. Both the stocks are up in trade today.
Okay, all right. Thank you so much, Gaurav, for joining us with all those details. The other stock on our radar is IREDA. Tell us more about it. Why is the street excited?
Two reasons for IREDA. First is that now government has allowed IREDA to raise funds via 54 EC bonds. Now these are actually capital gains bonds. Let's not forget that using these bonds, company can raise funds at a rate as low as 5.25%. Now these are actually the bonds for tax exemption for investors, and there are this is the sixth company who will be raising the bonds using these this instrument. We have got REC, NHAI, PFC, IRFC and HUDCO who are already using these bonds to raise funds. Now let's also not forget that in FY25 we have already seen that there was some benefit in cost of funds. We have seen IREDA's cost of fund has gone down almost by 20 basis points, and with this new instrument for fundraising, it seems that there will be another tailwind in terms of cost of funds, and we may also see some uptick in net interest margins. Now there is another trigger for IREDA is that the results will come for first quarter today, and let's also not forget that in the quarterly provisional updates we have already seen a strong performance from IREDA, around 32% growth on a year-on-year basis in terms of loan book and around 26% growth in terms of the loan disbursements. So on back of these numbers and specifically the new announcement from government, we are watching out on IREDA, and as we speak the stock is also up in trade today.
All right, Gaurav, thank you for that update. You know, since we are on the subject of PSUs, the couple of other PSUs that are in focus right now. Two of them actually, they came out, some updates came out last evening with regards to them, and both of them, one of them being LIC, the other one being IDBI Bank. Now, LIC for IDBI Bank, of course, sources have told CNBC-TV18 that the long-awaited disinvestment process for IDBI Bank is likely to be completed by October of this year. And that is the latest on the IDBI Bank disinvestment. Now, when it comes to LIC and a lot of these other PSU banks, now the government has given an offer for sale approval for the 5 PSU banks that recently did a QIP also. That OFS could take place later this year. Now, the intention behind this, of course, is for all of these lenders to meet the minimum shareholding norms. And Bank of Maharashtra will meet the minimum shareholding norms via the QIP route. And the other 4 banks will have to do an OFS, because the other 4, which is Indian Overseas Bank, UCO Bank, Central Bank and Punjab and Sindh, all of them have a government stake in excess of 90%. And the QIPs that they did recently, that did not result in a very significant dilution. It was just a 1 or 2% dilution. It still remains above 90%. So these public sector banks this year are likely to raise around 45,000 crore rupees through the QIP route. And a majority of that share, of course, will come via the SBI QIP, which is likely to be worth 25,000 crore rupees. And the rest will take place from other lenders. Now, when it comes to LIC, the government has given an approval for an offer for sale, is what sources are telling CNBC-TV18. And the finance minister also mentioned that systemically important NBFCs should aspire to become banks. They need more banks, and they aspire to have at least 2 to 3 large Indian banks among the top 10 global banks within the next 2 decades, which is by 2047. Now, for LIC, the government still holds around 96.5% stake, because that 3.5% was the only one that they had divested 3 years ago at the time of the IPO. And even within this public shareholding, which is of 3.5%, most of it lies with mutual funds, and close to almost 20 lakh retail shareholders have the remaining 1.7% stake. So at almost 6 lakh crore rupee market cap, stock trading at 0.9 times price to earnings, every 1% that the government will divest here will help them fetch around 6 lakh crore rupees at the current price. So that's LIC for you. Still trading around about its IPO price of 949. It made a high of around 1200. 1222 is the record high that LIC had made. So it has corrected from those levels, still languishing around the IPO price almost 3 years after its listing.
Thank you very much for that. That's the latest on the monetization by the government that IDBI has been long awaited, right? The flagship privatization of IDBI Bank. Let's see if it happens by October, as we've been picking up. Get into a break. On the other side, the Finance Ministry could be considering about 32 to 35,000 crore rupees fund for oil marketing companies. We'll get you more on this story on the other side. Welcome back. TCS will kick off the first quarter earnings season later today. Numbers are typically out around 3:30, 4 o'clock. There is a press conference scheduled at 5:30 in the evening, and then tomorrow we get chatting with the management. Now, before we get to the numbers, just one thing about the valuation. I was looking at Goldman Sachs, and they're saying that TCS is the most compelling on valuations versus the company's own trading history. So a Tech Mahindra, HCL Tech, LTI Mindtree, Wipro, Infosys are all trading above the 5-year average in terms of valuation. TCS is the only one trading at par or at a 2% discount to the 5-year average. Again, so on that front, compared just to the recent 5-year, which is the post-COVID average, all the other IT companies, companies are trading at a premium to the 5-year average. If you compare it to the 10-year average also, TCS is trading at a discount of about, a 16% discount to the 5-year average and a 2% discount to the 10-year average. While all the other IT companies, the large cap IT companies, are actually trading at a premium to their own historical averages. So according to Goldman Sachs, valuations for TCS are most compelling, and will that in a way provide some sort of a cushion on the way down? Now getting to the numbers, expect a muted quarter, top line growth declining by 1.5% in constant currency on a quarter-on-quarter basis. Dollar revenue growth will show a growth, but CC revenue is likely to be weak, and that's because the large BSNL contract is slowly ramping down. Wage margins will be flat on a sequential basis. There is no wage hike. Wage hike typically for TCS happens on 1st of April, but the company, citing uncertainty, said that we're going to push it forward. So the street is saying that if there is no wage hike and your low margin BSNL deal is actually coming down, shouldn't your margins have gone up? But that's not playing out. So what will you watch when it comes to TCS? One is growth, because in the last 1 year, growth was driven by this BSNL contract. It was low margin, but it provided the growth. X of that, things have been slow. So that's one. Secondly, pick up in margins. That's going to be very crucial. The third one is timing of the wage hike. Do they now have clarity to provide a wage hike for their employees? And finally, deal wins, because last quarter, deal wins were very strong at $12.2 billion. So an update on that will be watched.
Okay, we'll be watching out for those important things in the results today, and we'll keep coming back to you for that analysis as well, Rima. But moving on, the oil marketing companies, they are in focus. Sources tell CNBC-TV18 that Finance Minister is considering a 32,000 to 35,000 crore fund for OMCs. That is the Finance Ministry. Tim C is joining us with more details on what she's picking up. Tim C.
Well, yes, what government sources are indicating to us is that Finance Ministry is considering 32,000 to 35,000 crore rupees of fund for OMCs. The proposal, Finance Ministry is soon going to take it forward for Cabinet's approval, and this is to help OMCs overcome the under-recovery or the losses that they were facing on LPG. The demand from the Petroleum Ministry was about 40,000 crore rupees of LPG under-recovery funds. And the government feels that this cushion is going to help the OMCs. To be precise, these proceeds, where will this fund come from? Well, this is coming from the proceeds of petroleum excise duty that is being used to compensate the OMCs. And the view behind this proposal that the government has is that the oil companies are part of the same government family. Government does not want OMCs to suffer, and thus a compensation will happen very soon. Let's see how soon Finance Ministry takes this proposal for Cabinet, because the demand was there, and now with sources indicating that the Finance Ministry is considering the demand very seriously, the next move will be that Finance Ministry moves a proposal for Cabinets not to help them overcome these losses.
Yes, that's right, MC. Thank you so much for joining us with all those details. The OMC LPG compensation has been ongoing for a while. The expectation was that maybe the budget would give up some relief in form of a subsidy, in form of a grant. That did not come about. And since then, oil marketing companies or the investors of oil marketing companies have been watching out for this big development. So it'll be crucial to track as well. Remember to tune into the all-new CNBC-TV18 Prime, bringing you insights from policymakers, business leaders, and economists shaping both the world and India's future. CNBC-TV18 Prime decodes global shifts and their impact on Indian businesses, giving you unparalleled insights. Tune into CNBC-TV18 Prime at 12 noon for the Global Reset, at 1 p.m. for the Big C, and Global Lens at 8:30 p.m. Welcome back. You're still tuned into Trading Hour. Well, we've been pointing out how Nifty has seen that knock from the highs below the 25,400 mark. It did see a wee bit of recovery from the lows, but let's see which way things go from here on. Apurv Sheth from Samco Securities is joining us for a quick technical check on the markets. Apurv, thank you so much for joining in. Tell us what are the next important levels to watch out for on the Nifty?
Thank you. Good morning, and thank you for inviting me on the show. Now, Nifty is trapped in a range of 25,300 to 25,600. So, until and unless we are in this range, the bias will be on the bullish side. So, buy on dips will be the strategy. I would like to be a buyer on dips to 25,300 levels with a stop loss of small stop loss of 100 points. So, 25,200 is a stop loss, and the target on the higher side is 25,500 and 25,600. So that's on Nifty. And amongst the stock picks, Nippon Asset Management India is looking good on the charts. So I think there was a news about ICICI Pru coming up with its IPO. So all the AMC stocks are in trend. So Nippon Asset Management has formed a cup and handle pattern on 2 time frames, that is on the weekly and on an intraday time frame, and it is on the verge of a breakout. So the stock looks good for a recent decent rally. The stop loss would be 770 and the target would be 870. And another stock is Balrampur Chini. So the stock is finding good support around the 580 levels. The today's volumes were high compared to yesterday's and the average volumes. So again, Balrampur Chini also looks good on the charts. So one can buy it with a stop loss of 580 and a target of 660.
Okay, all right. Thank you so much, Apurv, for joining in. So those are some technical levels to watch out for on the Nifty and individual technical picks as well. Well, by the way, just let's take a look at individual movers in the broader markets because that index is not doing so well. There's still some of the stocks which are surging as we speak. Glenmark Pharma, for instance, that stock is up 3.5% right now. We have VIP. This is, I think, the third consecutive day that this stock has done well. So that one is up around 3.5%. We have Nuvama Wealth, which is up 3%. That stock had been trending lower in last couple of trading sessions, but it has made a comeback today. We do have something like a Rallis India, PCBL again. So the chemical space continues to be in focus. Watch out for that one. Expected to be a decent quarter, or at least a recovery quarter for chemical names. So PCBL, another day running higher by 2% as we speak. That's about individual names, but let's talk about some notes which are coming in. Brokerage views. Flare writing is gaining in trade. There is a note from Ambit. Ria is joining us with what the brokerage says about this particular stock. Ria.
Well, yes, Ambit has come out with a note on flare writing. They've analyzed the Q4 FY25 results of the writing instrument players, and they've said that domestic growth this time around has been accelerated, but exports have declined. They've also said that the management expects a demand recovery in both domestic and exports going ahead with growth acceleration seen in FY26. Apart from this, they've said that margins this time around have been impacted across the board given the rise in competition and product mix changes as well as some inflation in the raw material. Now, apart from this, they've highlighted that with domestic and own branded sales now at 85% of the total revenue mix and the addition of high growth segments such as creative and steel bottles, Flair's revenue growth has picked up and going forward, sustenance sales will drive re-rating for the stock. They have a buy call on Flair writing and a sell on the competitor DOMS, and as a result of this note, the stock is up over 5% today.
Ria, thanks a lot for that update. Flare writing, an Ambit note coming in there on the stock, 6% higher now, almost 10% up this week and almost 15% higher in the last fortnight. So good going for that company. But the asset management companies are in focus as well. And this is on the back of an ICICI Securities note. I just spoke about UTI AMC, the note from Antique a couple of days ago. And Vamakshi is here with the latest on this ICICI Securities note on these asset managers, Vamakshi.
Almost, well, there's a note from ICICI Securities, like you said. They believe that there is a case for an increase in AMC multiples, and they have a rationale for this. They say that this could be based on resilient and growing SIP trends, In addition to that, what they also say is that there has been an increased trend of commission rationalization given the kind of growth that they're seeing in their AUMs. Apart from that, they could also possibly benefit from higher consumer discretionary income post the tax cuts as well as the repo rate cuts that we've seen so far. They also believe that there could be a possible push to their growth given that there is a new asset class of MFs, that is the specialized investment fund. They also believe that the most important pointer out here that is driving this rationale is that these companies are facing lower regulatory risks. Now, keep in mind that most of these AMC stocks on an average has surged by almost 34% since the start of FY26. They highlight that despite this, the valuations remain relatively well placed as compared to some of the other capital marketplaces. They believe that all of these AMC companies are, better placed on structure valuations within the capital marketplace. And however, increased competition, the competitive intensity in this industry is a key risk. But nevertheless, they appear to be quite positive on all of these AMC stocks.
Thank you very much for that. The stock which catches my attention is Crizac, the new listing. The issue price was $245. Yesterday's stock was up, I think, 25-26%. It's followed it up with another 6-7% move. And an interesting company, right? It's a platform, a tech platform, which will connect education consultants and agents and foreign universities. And I think they've got about 10,000 plus agents in their platform. They file about 7 lakh plus kind of applications. And look at the way the numbers for the company have gone up. I think 850 crore was the revenue last year versus 274 crore 2 years back. So it's a big jump and clearly shows the number of Indians who are, leaving for higher education abroad. So yeah, interesting company, and it's seeing a lot of demand.
Sunil Singhania's Abacus fund was one of the buyers in yesterday's trade at the time the stock listed. So that is another one. They bought stake worth close to around 110 crores, the Abacus asset management firm from Sunil Singhania. So 7% higher on Crizac, building on to its gains that it saw yesterday, ended almost 25% higher compared to its issue price. Yes, 25% higher.
But this is other interesting news. Like, I haven't verified it, but it was in the papers that the US visa, whether you go for tourist, business, H-1B, doesn't matter. They're going to put in an integrity fee of $250. So your traditional fee is about 15,000 rupees on an average, is what they said. So, and you add this $250 and plus a little bit of processing, etc., you come to about 40,000. That said, this integrity fee is refundable.
Oh, okay.
It's a one-time, it's refundable. Basically, what they're trying to prevent is any sort of a misuse. You shouldn't go there and say that, oh, I want to extend my stay.
Got it.
You have to come back within the stipulated. I mean, you get a grace period of 1 month. So if you, misuse it and you don't comply with everything, then the $250 fee is held on.
But it is not final. There is no.
No, this is a part of the big, bold, beautiful bill.
Oh, okay.
Yeah.
There are a lot of things which are part of the big, bold, beautiful bill. So yeah, alliteration is working there, but
just on the point about that student visas, etc., going abroad, this whole trend is just in the near term. There is that short-term, one-time hit.
He's been doing a lot of things when it comes to immigration, when it comes to visas. So let's see what is finalized, so to say, and comes into execution as well. But we'll do one thing. We'll slip into a short break. When we come back, we'll discuss the market fundamentals with Sahil Kapoor from DSP Mutual Fund. Stay tuned for that.
Welcome back. 100 points lower on the index now at the lowest point of the day. 25,380 is where the Nifty currently stands. We're continuing this market conversation forward with Sahil Kapoor, who is the market strategist at DSP Mutual Fund, joining in. Sahil, good morning. Thank you for joining in. A lot of the current market over the last couple of years has been propped up by this retail fund flow that has come in from the domestic investors, but foreign fund flows have continued to remain elusive at best, if you could call it that, despite being net sellers all through and through this market correction from September until, say, March or April. Even today, they have not seen a meaningful pickup. What would you attribute that to, and when do you see a reversal happening, if you do see one, that is?
Sure. Good morning. So one thing is clear that foreign investors likely have more choices across the world with better valuations, and possibly they are picking that. And second thing is, a lot of foreign flows which come to India are through the passive route. So for example, if $100 flow towards the passive basket, India has 20-24% share, and they get those, India gets that flow. And over the last few years, emerging market as a whole haven't got a lot of flows. Third thing is that when you look at the emerging market basket as a whole, in the last 15 years, it has underperformed global equities by a very wide margin. It is only post-COVID that we've seen a large recovery in some of the emerging markets. And because of this underperformance of the last 10-15 years, I think the passive flows have also sort of reduced towards this basket. So mix of these reasons has made sure that India gets less flows of that basket coming into the Indian markets. Conversely, India has seen a very divergent performance. So our earnings trajectory has been much more stronger versus the rest of the emerging market. But still, I think we haven't really seen the flows that people would have expected or investors would have envisaged. When will these flows come? I have no clue. I don't have a crystal ball to see. I think we've already delivered over the last 5 years on best equity growth across emerging markets, whether it is in terms of returns or earnings growth CAGR, 20 and 24% respectively. Very stable currency, 4% annualized volatility, higher real returns in terms of debt securities, and still we haven't got the flows that we could have. So this combination is the combination of India doing well on all fronts, plus the global money also flowing towards emerging market. I think that is the important combination. As of now, it hasn't really worked.
But at some point, foreign investors are going to feel they're missing out, because as you rightly said, that despite foreign investors not investing in India because of strong domestic demand, etc., markets have done well. The last 20 years, CAGR, for instance, would be close to about 10-11%. So at some point that FOMO will come in, and it's not that valuations have also corrected. So will that factor, play a part in, foreign investors coming back into the Indian markets? How long, can they stay out of a growing market? And what would be your call on Indian markets per se over the next, say, medium term, 2 to 3 years?
I would say that FOMO-led flows may not be the most appropriate thing to, get for India. And think about this, if you go back to, let's say, the 2007 era or the 2002 to 7 cycle, by the time we hit the global financial crisis, nobody in their wild dreams would have thought that United States will come out to be the best performing market in the next 15, 20 years. And that is what has happened. Since then, about 18 years have passed, and S&P 500 or probably NASDAQ has beaten every other index in the world by a very wide margin. Very few stock indices come close to capturing the returns that they did. Nobody would have thought that it will happen from what the US financial markets went through. So my guess is that the performance of the past may not be the most appropriate way to judge whether these flows will come back or not. My sense is that a large performance uptick, which has happened even in US, has made sure that a lot of money still goes to the American markets. And I think once that outperformance goes out, I don't know why, but the numbers speak for themselves. For example, S&P 500 trades at 25, 26 times. And just about 6-7 years ago, let's say in the Trump 1 era, with very similar earnings growth rate, it was trading at about 18 times, right? So it has also re-rated. So maybe it doesn't do as well as it has done in the next 18 years, that will probably give some amount of a fillip to rest of the markets in terms of probably flows, and that could be a clincher. Plus, India will have to continue to deliver the earnings growth that it has, and that itself has become a very large challenge. So my guess is that flows will improve possibly because they are more cyclical in nature, and we are sitting at numbers which we haven't seen in 10, 20 years in terms of FDI flows of less than $1 billion in FY25. I think you have to go back to 2003 to see that kind of a data. And FI equity flows have also been very, very tepid. So cyclically, I think they might improve, but you need a number of factors or confluence of factors to see these flows come back.
Okay, while we're talking about factors needed to see the flows come back, right now we're seeing that markets are seeing a further knock from the highs. The Nifty is down around 100 points. We have the mid-caps which are down 166 points. And it is the banking index which is seeing a further cut. So watch out for the markets. We are seeing it coming below the 25,350 mark as well. It's very close to that, not exactly there. But watch out for the next important level as well. So Sahil, when we're talking about our own markets, valuations have been a talking point for the longest time. Now margins are at its peak. So what, according to you, could be the driver of earnings from here on? Do you think that is something that the markets could continue to be cautious about?
So my sense is that we are already sitting at margins which are quite high. When you look at the full universe of the first 500 stocks and look at the profit margins and EBITDA margins, we are close to at lifetime high levels. And the idea is that can margins go up from where they are right now? It's going to be very, very hard. I don't think except United States technology sector, there is any other index or sector in the world collectively operating at margins that we are right now. So it's going to be very hard for margins to go up. So what's left for our PAT or profit growth to go up? What is the key driver? It's the top line growth or sales growth. And sales growth, as you see, which was in high double digit and even exceeding 20% back in FY23 and 24, for the last few quarters has dipped down to single digits. In fact, in FY25, Nifty did a 1% PAT growth and mid and small cap did a 9% PAT growth. And the reason is very, very similar. Even with very high margins, if you don't get top line growth, PAT growth will just match the top line number. So if you get a single digit top line growth of, let's say, 9-10%, PAT growth is going to be 10%, 9%. And if your ROEs are 15-16%, which is what it is for NSE 500 stocks, paying a multiple of 25 to 27 times is going to be challenging. And therefore, it makes sense for you to tone down your return expectations with what we've seen, double-digit 20-25% return post-COVID. I think those are stellar numbers, but the profit growth of 10% and ROEs of 15-60% do not justify for us to pay a multiple of 25 to 27 times. Therefore, it's very important to look for sectors which are cheaper in terms of valuation, doesn't have froth, and second, be conservative about your return expectations.
All right, Sahil, thank you so much. Insightful conversation there. Thank you for sparing time and joining us today ahead of the all-important earnings season that we are on the cusp of. We take a short break here, but the index now 100 points lower as we speak. More on the markets on the other side. Stay tuned.
Welcome back. You're still tuned into Trading Hour on CNBC-TV18. Well, it's a very stock-specific market in terms of brokerage notes which are coming in. Housing finance sector is in focus. There's a Bernstein note. Gaurav is back with us to join us with all the details from that one. Gaurav.
Well, yes, housing finance companies definitely in focus, and the reason being that Bernstein has now initiated a note on 5 companies. First, let's talk about companies like Home First Finance, Aptus and Aadhar, where they have initiated with outperform rating. For Home First Finance, this remains their preferred pick, and the reason being that what they're saying is company has actually demonstrated ability to consistently replicate its business model successfully across the segments. Other than that, they also believe that the company has strengths like smaller size, faster growth and superior product portfolio, and that is the reason why this remains as their top pick. Other than that, for Aptus, what they're saying is that company has a high share in the fixed loans, and that is the reason in an environment where we are seeing rate cuts, this company is opt to gain. Other than that, Aadhar is also something which is in focus, and the reason being that they say this is the largest and most geographically diversified player, and that is the reason why they have initiated with outperform rating. On the other hand, let's also focus on Aavas and PNB Housing, where they have initiated with market perform rating. For Aavas, they believe that this actually lags peers in terms of yields as well as profitability, and that is the reason they have maintained their market perform rating. And lastly, on PNB Housing, they actually like the smaller ticket size portfolio which they are diversifying, but on the other hand, the transformation what they're doing is a little concerning as per Bernstein, and that is the reason they have initiated with market perform rating. As a result, on the back of this note, we are seeing all these stocks are up in trade and buzzing in trade today. So definitely watching out on this space on the back of the note coming up from Bernstein.
Thank you very much for that. On the broader subject of NBFC, Finance Minister Nirmala Sitharaman called on the NBFCs to significantly scale up their role in the financial system. Speaking at an NBFC conclave, Sitharaman said NBFCs are no longer shadow banks, but systemically significant entities. Listen in.
You should aim to reach at least 50% of the total volume disbursed by scheduled commercial banks. Not a big number, considering in the last 4 years, you've doubled. 24 became 48. You can do it even now. So, as India moves forward, NBFCs will have a key role, no doubt, in meeting the credit needs of the future, including in areas like green initiatives, affordable housing, and MSMEs. To reach, and the reach that you have is the biggest strength that you have. By 2047, at least 50% of NBFC credit should be directed towards high growth and high impact sectors. NBFCs, I want to tell you in front of the Department of Financial Services Secretary, you're no longer shadow banks. The stronger regulations and oversight is the best testimony. The stronger regulation and oversight is the best testimony of your importance in the financial system and the broader economy.
Well, you know, the defense stocks, we just spoke about it at the start of the show, the ones that are not doing well in today's session, Bharat Dynamics being one of them. And the stock is in focus because of a Motilal Oswal note. Rhea is here with more details on this. Rhea.
Well, yes, Hormuz, Motilal Oswal has initiated coverage today on Bharat Dynamics with a target price of Rs 1900, which is a 4% downside from yesterday's closing price. Now, the brokerage has noted that BDL's revenues have been impacted in the recent past, largely due to supply chain disruptions and challenges in sourcing critical components, particularly from Russia and Israel. But now these headwinds are beginning to ease out, and they are expecting a sharp recovery going ahead. They're expecting a 35% revenue CAGR over FY25 to FY28. Margins are also seen holding steady in the 24 to 26% range, while operating performance is also set to pick up meaningfully. EBITDA and net profit are expected to grow at an estimated CAGR of 64% and 51% respectively in the same period. Now, the report has also highlighted a strong order visibility going ahead for the company. They have an existing order book of about Rs 22,700 crores and a potential pipeline of Rs 50,000 crores, including large deals like QRSAM and the upcoming including defense emergency procurement orders as well. Now, on the macro front, the company is well positioned to benefit from favorable defense sector tailwinds, be it the rising global defense spends, growing exports of the Akash missile systems, or the ongoing collaborations with DRDO. That said, valuations remain a sticking point for the company, currently trading at 70 times the FY26 estimated earnings, which is why they are suggesting waiting for a better entry level for the stock. So on the back of this, the stock has been under selling pressure today, trading around 3.5% lower.
Okay, all right. Thank you so much, Ria, for joining us with all those details. Let's move on now. Viceroy has come out with a report describing Vedanta Resources as a parasite and Vedanta Limited as a dying host. While Vedanta has it back, stating that the sole objective of Viceroy research report is creating false propaganda. Earlier today, we spoke to Gabrielle, the co-founder at Viceroy Research, and Rakesh Arora, founder of Go India Stocks, to understand more. Let's listen in.
Vedanta Limited, let's say, it doesn't have the capacity to cover the interest costs of Vedanta Resources. So whether that will create an eventual default, or whether the possible impairment of billions of dollars of Vedanta Limited's assets will lead the creditors to call that debt, that's anyone's game. We're here to report it. Whether we're a bit too early or a bit too late is irrelevant. We've written our research, and we think that the end result is a disorderly collapse. We think that Vedanta Limited has been overly promotional in the ability of its business and the ability of its operating assets, which that have been largely overstated.
Are you done with the report, or will you have more reports coming out on Vedanta?
Oh, we have more.
Unfortunately for Viceroy, they are just 2 years late on this stock. Vedanta Resources already delivered quite a bit, from around $9-10 billion to around $4.5-5 billion now. And now servicing that debt is not a challenge at all. Number two is that, Vedanta itself has gone through this whole exercise of demerging, and all the lenders have looked at individual entities on their leverage, on the, whatever the liabilities are. And clearly, they've approved this. So clearly, all the entities are self-sufficient. Otherwise, this kind of approval cannot come from lenders. Vedanta stock is largely dependent on aluminum outlook. And aluminum outlook has been pretty strong and doesn't look to be weakening anytime in future. They are also getting a little bit more of backward integration in form of bauxite mine, coal, their own captive alumina. So things are looking better only for them. So I don't think fundamentally there's any reason that performance would deter. Vedanta has been has done phenomenally well actually in the last 2 to 3 years. Meaning, if you had asked me in 2021, I would not have been able to gauge this kind of turnaround that the management has been able to achieve. And things are only getting better from here.
Okay, let's get into a break. On that note, on the other side, we'll put the spotlight on NVIDIA and its fantastic journey to $4 trillion in market capitalization. Stay tuned.
Welcome back. Let's talk about the big global development, Nvidia. It has hit the $4 trillion market capitalization number. Hormaz joins us now to take us through the company's stellar rise.
Well, they say bada hai to behtar hai, and a company based 14,500 kilometers away in Santa Clara is justifying that tagline. And how? That is Nvidia for you. The AI behemoth and Wall Street darling has become the first company to cross $4 trillion in market capitalization on Wednesday. It's taken just over 13 months to add the latest $1 trillion to its value. However, take a look at this rapid rise that Nvidia has had. It reached its first $1 trillion in May of 2023. In 9 months, it doubled it to $2 trillion. 4 months later, it was at $3 trillion. And had it not been for Donald Trump and his tariff tantrums, who knows, we might have been doing this just a few months earlier itself. Now imagine Nvidia being a country. At $4 trillion, its GDP will be higher than most countries of the world. In fact, it would be the 5th largest economy globally, behind the US and China, just above Germany and Japan, and followed and just above the Indian economy as well. Now, when I speak about the Trump tariff tantrums in April, they spared no one, and Nvidia shares also fell to their 52-week low. But the bigger part is that the recovery that the stock has seen, it has nearly doubled from those April 7th lows that it had made. That's just a 3-month window. Now, at $4 trillion, Nvidia is 73% of the size of the entire Indian stock market, which stands at close to around $5.5 trillion in market cap terms. Nvidia is the size of 30 HDFC banks, 37 TCSs, and 22 Reliance Industries individually. Now, wealth creation, of course, is the motto to be in the stock market, and Nvidia has done exactly that. Now, since 2013, Nvidia has had only 2 negative annual return years in terms of share price. Its 15-year average returns, a cool 70%. Now, take a look at this. Since 2020, Nvidia has had 4 years where the stock has either doubled or even tripled on an annual basis. This year, too, the stock has gained 22% after the plunge that it had taken earlier in the year. But there are challenges that lie ahead. Export curbs still remain to the Chinese markets. Now, founder and CEO Jensen Huang said that these issues have completely cut Nvidia off from a $50 billion market in China. They took a hit in the first quarter, and another $8 billion hit is anticipated in this quarter as well. Now, the other challenge is the slowing revenue growth. But the definition of slow here is just a case of raising the bar too high. 5 out of the last 8 quarters have seen Nvidia report revenue growth in excess of 100%, some in excess of even 200%. And at this price, at this size, anyone will happily take a 70% revenue growth. But such are Nvidia standards that the street is worried that those 100% growth days will never return again. Lastly, sticking to the saluting the rising sun terminology, Wall Street remains bullish on Nvidia despite the surge that it has seen. 68 out of the 78 analysts have a buy recommendation, and the odd one out, a solitary sell rating. That's Nvidia for you. The journey from $1 trillion to $4 trillion has happened in a jiffy. Now the onus lies with Jensen Huang and the company to embark on the next trillion, one chip at a time.
Thank you very much for that. It's quite incredible, right? As you said, when they came out with their numbers, and there was this whole China hit, I think a $2.5 billion hit in Q1, and they said $8 billion loss expected in Q2. Despite that, the stock is up so much, right? From the April lows, it's up about 80-90%. Pretty fantastic the way Nvidia just goes from strength to strength. Thank you very much for that. Well, that brings us to a close on Trading Hour from the entire team. Thank you for watching.
Stocks still down as hopes of an early mini trade deal with the US fade. Realty as well as utilities gain, while IT and healthcare drag.
CNBC-TV18 learns that Finance Ministry may create a 32,000 to 35,000 crore fund to compensate oil marketing companies for LPG under recoveries. A cabinet proposal may soon be moved for the same, offering big relief to IOC, BPCL and HPCL.
Sources tell CNBC-TV18 that the divestment of ITBI Bank should be completed by October, and offers of a sale by LIC and several state-owned banks are lined up. SBI and some public sector banks will also mop up rupees 45,000 crores via QIP this fiscal year.
Analysts expect TCS to report a soft first quarter with dollar revenues flatlining and margins staying ranged. Favorable currency moves are seen propping the top line even as a ramp down of the BSNL project drags.
NBFCs are no longer shadow banks but systematically significant entities that should aim to reach 50% of the credit disbursed by banks by 2047, the finance minister said the above lines. But she also calls for increased focus on risk management by them.
Well, hello and welcome to Halftime Report, live from the CNBC-TV18 Motilal Oswal studio. I'm Ekta Batra and with me is Vinny Motiwala. Well, it's turning out to be a session where we are under pressure. So we're still waiting for any kind of clarity with regards to a mini trade deal with India and the US. So maybe there's a little bit of uncertainty around that. But nonetheless, for the mid-cap index, down around 0.4%, we have the advanced decline ratio, which is trending on the weaker side, so around 1,800 stocks advancing to around 2,000 plus stocks declining at this point. Well, it is going to be all about earnings season as another big trigger for the markets. So that's going to be something that we're going to be watching out for starting today.
Absolutely, but broader end of the market also, we've seen some of these diagnostic names, Ekta, like Metropolis Health, Dr. Lal, Path Labs, that are a bit under pressure in today's trading session. We have Bharat Dynamics also that's under pressure, as well as Garden Reach Shipbuilders among the names that are losing in today's trading session. And nothing exciting happening on the markets front as well. Nifty at 24,350 around that mark. 25,000, I beg your pardon, 25,360 levels is what the Nifty is trading at as of now, near the day's lowest point. But let's get started with the show and focus on one of the companies that have come out with some recent announcements, that is NIIT Learnings. Now, they've acquired MST Group and this is expanding its footprint furthermore in the European markets. So talk to us about all of this. We have Vijay K. Thadani, the Vice Chairman and Managing Director at NIIT Learning System, joining in with us to talk to us about just that. Mr. Thadani, good afternoon and thank you so much for joining in with us. So obviously this acquisition is around 22 million euro acquisition that has come in, expanding your footprint furthermore in the European markets as well. Could you just start by talking to us about what is the anticipated return that we could expect on this investment? When will we start seeing the synergies coming in for NIIT Learnings after this acquisition?
Yeah, so I think they're very excited about this new addition to the family, MST Group, based in Germany. Which is, I would say, a mini-me company in the sense they are a smaller version of the kind of services that we offer, very focused on Europe. And while we have been operating and working with European companies for a long time, about 30% of our current business comes out of Europe and through European companies. But I think having a footprint and an operation within Europe itself, I think, gives us some very significant advantages. Very importantly, it opens a new segment for us, which we have not been very strong in, which is auto and industrial. And I think Germany is the perfect place for that. Obviously, I talked about the country, and I think it brings some specific capabilities in terms of a platform, as well as in terms of the Quick Start Learning Academies, which is a special feature which this company brings. So I think our excitement comes from the fact that this furthers our objectives in Europe and is consistent with our stated philosophy of adding new companies in our fold, as well as it makes sure that we can leverage the capability that we have built in driving AI in learning. And I think we will have, therefore, much more opportunity to demonstrate what I call a pole position that we have today in utilization of AI and generative AI in revolutionizing the way learning will take place.
Right. Mr. Thadani, you said, 30% I think around of your revenue comes in from European countries. Now, with this acquisition, what could it possibly reach by the end of FY26, FY27? What are we watching out for then? Revenue from European.
Yeah. So I think at this point of time, this acquisition itself will add about 20% to the work that we do from Europe. It's a relatively small company. I told you it's a mini-me, that's how we define, but with very specific capabilities. But I think what we can do together as we go forward is what is exciting us. And I think as we enter the auto and industrial sector, the large capabilities that NIIT Learning Systems has added to the specific capabilities which MST Group has, I think can give us a significant acceleration as we go forward. More about it as we start working together and consolidating, but I think as a strategy, it looks very good to us.
Okay, all right. Well, Mr. Thadani, what about the addition to margins? Once you do integrate the acquisition, what would it be in terms of margins for you all?
Yeah, thanks for asking that question. It's a margin accretive. It's a margin accretive as well as a profit accretive acquisition. So because it's a profitable company, it's been around, stable team, and very committed and very specialized team. So I think we should be able to maintain that trend. And our margins are in a similar range, while there will be an accretion to margins. But I think overall, we should be in a similar or slightly better position as we go forward.
Okay. So when you mean similar to slightly better, your margins in FY25 were at 21.5%. Your profit was at 227 crores. Give us a sense in terms of where you would be post the integration of this acquisition, say on an exit rate for FY26?
I think you'll have to wait for 2-3 weeks. Our quarterly results are due very soon, and we are in a quiet period. So I think at this point of time, I can give you a qualitative as well as qualitative coverage of what this company does and how it will help us.
So I'm not going to...
I think is 2 weeks away.
All right, I'm not going to probe you more on that then. We'll wait by for the quarterly numbers. But when you talk about AI, how exactly is it going to be integrated into this particular acquisition and hence into the company as a whole?
Yeah. So let me take a minute to just say that learning the way it is delivered today stands to get changed very dramatically with generative AI. We are at this point of time, our customers are treading the path cautiously because there are a number of issues involved, but the excitement is building up. In terms of capability, I think NIIT Learning Systems, I use this term pole position. We've done some very good work and have some very good use cases and proof of concepts. And I think this should help us in improving both the effectiveness of every service that we deliver as well as the efficiency. Now, as MST Group is in similar businesses or similar offerings, I think in each one of those offerings, addition of generative AI, we will be able to get much more out of our effort than we are getting so far. So I think to that extent, that's an excitement which will benefit the customers to become more productive and have their workforce more responsive and productive, as well as deliver personalized learning to each one of them, as well as organize themselves in a way that they can deliver operations across international boundaries in multiple languages. So I think those are some of the important benefits that generative AI brings, and I think we will be able to take advantage of those.
Okay. Mr. Thadani, obviously, this is what I'm looking at it as of March 2025, right? Net cash was at around 703 crores. So obviously, this is going to be a cash deal that has taken place, right, for the company, 225 crores. Anything more in the pipeline with the remaining cash that you all will have? What are you looking out for? More acquisitions that we could expect?
Always. We are always on the lookout because that's what this fund has been created for. When the demerger happened at that time, we were very clear that we will use this for inorganic growth as well as specific growth initiatives within the company. We've been very cautious in the usage of money because of the volatility in the market. But I think we are very committed to adding more. And you've been seeing as a group, we've been adding an acquisition every now and then. More to make sure that we add a new segment or a new capability or enter a new geography. So I think if these those guidelines, we are very happy to work with others. And of course, integration involves making sure that the workforce gets completely aligned and on the same path as the company has envisioned for itself.
Right. Just a last one from me, Mr. Thadani. Given that, those geopolitical tensions or across the globe, we're not seeing any sort of a certainty that's still coming, right? How has the trend been so far? Is it still a bit muted overall in terms of demand trends?
The overall uncertainty in the market, I think you report every few minutes, so you don't need to hear it from me. The overall uncertainty is high. Yet there are bright sparks. Just before I was waiting for my turn, you were talking about NVIDIA and the $4 trillion. So there is an excitement, but behind every excitement, there is an uncertainty. So we have to cope with that uncertainty and take that for granted. Therefore, every plan that we develop has to have a plan B and a plan C. I think that's the new way of working. Given that uncertainty, we are also reorganizing ourselves, and you have been seeing that over the years, irrespective of the changes which have taken place, of course, there are blips in our performance as well, like it is for anybody else. But I think we are becoming smarter as we go forward.
Okay, all right, Mr. Thadani, we're going to leave it on that note. It's always a pleasure speaking with you, and congratulations on your acquisition. More on the details and the numbers and what the blended numbers would look like in the Q1 numbers once you do release that. We'll take a short break, but remember to tune in to the all-new CNBC TV18 Prime, bringing you insights from policymakers, business leaders and economists shaping both the world and India's future. CNBC TV18 Prime decodes global shifts and their impact on Indian businesses, giving you unparalleled insights. Tune in to CNBC TV18 Prime at 12 noon for the Global Reset, at 1 p.m. for the Big C, and Global Lens at 8:30 p.m.
Welcome back to Halftime Report on CNBC TV18. And, let's just focus and actually talk about some of these pharma names or what's happening in the pharma sector. Now, anti-obesity drug market is also witnessing a bit of a tug-of-war between semaglutide and trizepatide. Ekta is here on the wall with us to give us insights on this one. Ekta, we have heard a lot about semaglutide, GLP-1. What's happening here now?
Well, the latest numbers, as of June 2025, semaglutide, which is the GLP-1 drug by Novo Nordisk, accounted for around 412 crores of sales, commanding around 66% of the entire anti-obesity drug market in India. The drug, which was still recently only sold in the oral form by Novo Nordisk in India, has grown 16-fold in the past 4 years, completely reshaping the treatment landscape. Novo Nordisk has now officially launched Wegovy, the injectable formulation of semaglutide for obesity in all 5 strengths, and has already clocked around 2.53 crores of monthly sales and selling around 1,788 units just in the month of June since its launch. Experts say that the fact that all 5 strengths of Wegovy registered sales right from the start suggests that many patients who were previously relying on imported, more expensive versions are now switching to the locally available, more affordable Indian launch. And what about trizepatide or Mounjaro by Eli Lilly, the only real challenger to semaglutide as of now? Mounjaro, which launched in March of 2025, has already generated around 50 crores in terms of sales, capturing 8% of the market share within just a single quarter. Consumption has risen sharply from 11,637 units in March when it launched to 87,986 units in the month of June. So the tug of war really seems to be between semaglutide and tirzepatide, now commanding nearly 75% of the Indian anti-obesity drug market.
Okay, that's interesting there. Surely everyone's going in for these Mounjaros, Wegovy. That's what we're keeping an eye on. Thanks so much for that update coming in there in terms of numbers there, Ekta. But on that note, we're going to slip into a very short break. Don't go anywhere. We'll be back with more news and updates after the break. Welcome back to Halftime Report on CNBC TV18. Let's bring on board Aditya Agarwala, Head of Research and Investments at Invest for Edu, joining in with us on the show. Aditya, good afternoon. Thank you so much, as always, for joining in with us. The markets, just in that range, right? We've not seen much of a move since the beginning of July. 25,500, 25,400. Today it's slipped below 25,400, right? So what are we watching out for in terms of levels? Does this bring a bit of a worry, or this is just weekly expiry volatility?
Good afternoon, Vinny. Thanks for the show. It's more of a weekly expiry volatility. If you take a look at the open interest build-up on the call side, it's shifting from 25,500 yesterday to approximately 25,400 to about 25,350 on the call side. And that is exactly where the immediate supports are on the downside, 25,350. And if you take a look at the put open interest, it is also getting accumulated closer to about 25,300, 25,350. So my sense is you will see markets expiring somewhere between 25,350 on the downside to about 25,400. I don't see too much of a short covering rally from here on. Maybe it would be more of a consolidation in today's trading session. But yeah, nothing much to read in that. I'm not too perturbed or not too disturbed with the fact that markets are cooling off a bit today, both on the Nifty and the Bank Nifty. It's more of a consolidation that we're witnessing. And that confidence I'm getting, if you take a look at the volatility index, that's still sitting comfortably below the mark of 14, between that 12 and 11 mark, till the time it continues to oscillate between that mark. My sense is markets will eventually head higher come next expiry, August expiry, and then you will see markets slowly and steadily inching higher. So nothing much to read in this, more of a expiry day move, I would say.
Okay. And your top bets, Aditya?
So I've got a couple of buy recommendations. The first one is from Container Corporation stock. Actually, after a sharp correction, Vinny has formed a decent base. It's going up on decent volumes for past two trading sessions. Moved above its 200 DMA in trade today. Good volume action also and price action both. So I think one should go ahead and buy the stock at current levels for a target of 650 to about 670 on the upside. 650, 672 targets, Vinny. On the downside, I'll place a stop loss at 615. So this is the first stock on my radar. The second one is IIFL Finance. This is one stock after it has been introduced in the FNO space, has seen a cylindrical up move. So I think this is one stock which still has juice left on the upside. I'll still be a buyer in the stock at current levels for a target of 560 on the upside. Place a stop loss somewhere around 510 on the downside. And IIFL Finance is also something that we are recommending to our clients.
Okay, quickly, just wanted your thoughts on a couple of these diagnostic companies which are under pressure today. Aditya, any view on the likes of Metropolis, technically, Dr. Lal's?
Definitely. So hi, good afternoon, Ekta. I think this is more of a profit taking that we're witnessing in this space. The kind of move that these stocks have shown, either Dr. Lal PathLab or Metropolis or Krishna Diagnostics, I think all these stocks are witnessing some kind of a profit taking. I won't read too much into it. Rather, if anything, I will use this correction as an opportunity to initiate fresh long positions if you're looking to add them in your portfolio. These corrections that you're getting, pockets of corrections, is an opportunity to go long. So three names that stand out for us. Metropolis is one that you spoke of. Yes, I will use this correction all the way down till 1950 as an opportunity to go long, look for a target of 2200, 2300 on the upside. Talking of Lal PathLab, that is also something that we're quite bullish on. And in fact, if anything, we believe that this could be the top bet within this space for a target of 3,300, 3,500. Good support on the downside at 2,800. And Krishna Diagnostics, finally, the stock that I spoke of. This too seems interesting to us for a target of 950 on the upside. One can actually look at initiating long positions in that. So not too disturbed by this correction that we're witnessing today. Rather, I would initiate long positions using these corrections in today's trading session.
Okay. Yeah. All right, Aditya, we're going to leave it on that note. Thanks very much for joining in and speaking with us. Well, those are some technical calls. We need to take a short break, but we'll be back and we'll have Kevan Movdwala of Ernst & Young India joining in to discuss the big acquisition which has taken place in the hospital space. Sahyadri's been bought over by Manipal in an acquisition worth around 6,000 odd crores. More details once we're back. Stay tuned. Welcome back. Well, you are still tuned into Halftime Report on CNBC TV18. Well, the big acquisition which has really taken place in the hospital space, Manipal Hospitals will acquire Pune-based Sahyadri Hospitals for a deal which is worth around 6,000 odd crores. And this will be bought out from Ontario Teachers Pension Plan, which is basically the PE fund which held stake in that particular hospital. To talk more about this, we have with us Kevan Movdawala, who's the partner and healthcare sector leader at Ernst & Young India. Kevan, hi, welcome to the show. Thank you very much for joining in. Well, tell us how big this deal is between Sahyadri as well as Manipal, and where does it propel Manipal to?
Oh, so thanks, Ekta. Thanks for having me back. And at the outset, heartiest congratulations to OTPP, Rahul, the Sahyadri management team led by Abrar, and on the other hand, Temasek, Dr. Ranjan Pai, and the entire Manipal management team led by Dilip. Ekta, to summarize in one line, to have really created history in Indian healthcare and specifically on the regional side of things. I've been fortunate to have been a partner to Sahyadri over the last 6 years. And I've seen this exhilarating journey for them over 2 investment cycles. And it's a great, unique story that's really played out for us in the Indian context.
Okay, but if you could just get down to the numbers for us, Kevan, what are the multiples looking like in this particular deal and how does it compare to other deals?
Yeah, so I'll share some broad ranges, Ekta. So if you just look at trailing FY24 EBITDA, the multiples are in the early 20s. And if you take in the late 20s, and if you take the forward multiple, it's in the early 20s. So pretty, solid multiples for a regional chain. And clearly, I think there's been a strong assessment of the value that the asset has really positioned itself. That has really come out well. The markets where it's operating, that is Maharashtra, has a huge value, Ekta, with the state which has 6 crore population, almost 7 or 8 cities with a population of more than 10 lakhs, where you can create a platform of more than 3,000 to 5,000 beds, which gives Manipal a great positioning and dominance in the western part of the region. And specifically deep diving into Pune, it's an interesting city, evolving metro, if you were to call it. The bed density in Pune is 0.5 per thousand Ekta versus 1 in other metros, right? And the organized sector in this market is less than 20 to 30% of the private space. The key specialties, whether it's cancer, transplants, the higher-end specialties in Pune are underpenetrated by 30 to 40% compared to other metros. So it's a great platform, a great story that Sahyadri offers the platform, which is Manipal. And second, Ekta, what is very unique about Sahyadri is its business model, right? It has grown through a ripple strategy approach in concentric circles, having Pune as its epicenter, having added beds in tier 2 cities like Ahilyanagar, Karad, Nasik, serving patients across segments and across the continuum of care, whether it is secondary care to tertiary care. So net, Ekta, a great demonstration of value at the middle.
Kevan, what I want to also understand, you highlighted a couple of points, right? Obviously, like we are seeing such a big acquisition coming in, specifically in the Pune region, right? Manipal has done. So one, in terms of region-wise also, overall, do you think now hospitals and, these consolidations that we've seen happening would move mainly to these tier 1, tier 2 cities going forward? And in terms of specialty as well, specialty-focused hospitals or individual specialty hospitals, that's something that will be seeing more consolidation coming forward.
No, absolutely. And I've discussed this with Ekta in previous sessions as well, that the tier 2 story is really going to drive the healthcare juggernaut, right? We've got a value-conscious consumer who's seeking quality healthcare. We've got doctors and clinicians who are wanting to go back to these tier 1, tier 2 cities to provide quality care at the last mile, and infrastructure where Sahyadri has added Linacs, has added a Tomo machine, cardiac laser over the last few years and invested nearly 900 crores. So I think this segment is where you're going to see maximum potential. And you look at every chain today in the country, at least 2,000 to 3,000 beds are being added by each of these chains in these, what I would call state capitals or tier 1 cities in each state, which is typically 2 or 3 in each state.
Okay, so give us a sense in which hospital chain, listed and unlisted, is actually dominating when it comes to this regional presence, and which one is incrementally looking to add the most or is the most active in that space?
So I think all of them are. I think there's no one example. Ekta. Each geography has its own regional player. So if you look at the south, right, you've got Kaveri in Chennai. You've got Aster, which has mushroomed from a regional player focused in Kerala to now a national player with the merger with QCell, which is quality care. You've got Sayadri in Pune. You've got in Kanpur, UP Regency hospitals. You've got Livaza in Punjab. So there are many such examples of these regional chains who are really driving this local dominance with a flavor which really resonates with patients, resonates with clinicians, and really is driving quaternary care, high-end care to the masses at large at the right price points. I think the key is the right pricing for most of these chains, and they've really struck the right chord with value pricing and being very affordable and driving the best possible care.
Kevan, just a quick one. Manipal is IPO bound as well. Anything indication on that front as well? When can we expect that?
I would let Manipal comment on that. And I think in its growth journey, Manipal's been a great testament of creating M&A through the East acquisitions that they've done. And this is a great example on the West as well. But yes, I think it's a platform now. We would talk among the top 2 or 3 in the country from scale standpoint.
Okay, all right, Kevan, we're going to let you go on that note. I'm sure we're going to revisit the hospital discussion much more in detail as we go forward. Thanks very much for joining in and speaking with us. So that's the word coming in on the Manipal Hospitals deal. We need to take a short break with the news that the market's still under pressure. Nifty down 80 odd points. We'll be back with Kunal Dhamesha of Macquarie Capital to discuss the recent note they've written on the US generics market in the pharmaceutical space. Stay tuned. Welcome back. You're still tuned in to Halftime Report. Well, let's get talking about the US generic space. Macquarie has written a note recently and said that the US generics market is under pressure and price erosion is expected to possibly accelerate. To talk more about the space, we have with us Kunal Dhamesha, who's the pharma and healthcare research analyst at Macquarie Capital. Kunal, hi, welcome to the show. Well, interesting note that you wrote a couple of days ago. Just give us the crux of what you are thinking when it comes to the US generics market on two counts. One is Revlimid generic seeing more competition, possibly sooner than expected, as well as price erosion increasing incrementally from here.
Sure. So basically, a US index market had been, kind enough in the last couple of years. The price erosion has kind of, had kind of come down for the players which were operating in the market, primarily because there were a lot of drug shortages in the US market, and the competition in the US index market had continued to remain stable. Over 2021, 2022, and 2023. And those drug shortages were again a function of some of the companies which went bankrupt when the interest rate in the US started increasing. And then there were a lot of import alerts being given by the US FDA when they restarted the inspection process post-COVID. All those led to drug shortages, which led to benign price erosion over the last couple of years. Now, when we are in a midst of 2025, what I see here is that the drug shortages have been reducing for the last 6 to 8 months now. So from the peak of around 125 molecules under shortages as per US FDA data, now we are down to 80 molecules. Typically, when I do a correlation analysis of price erosion versus drug shortages, when the drug shortages go below 60, that's when the price erosion had been maximum in the past, historically speaking. So, we are on the downward trend on the drug shortages. And secondly, when I look at the competition in the US index market, the way I tracked it is it's a metric which is launched ANDA per unique molecule in the US market. That right now is around 4.85. A year back, 2023, it was around 4.77, and it was pretty stable for 2021, 2022. So, the competition is kind of inching up when the drug shortages are reducing, and that kind of points me in a direction that we might see acceleration in the price erosion in the US index market, which had been benign for the last couple of years.
Okay. Which has been benign, and we could see furthermore a bit of a downfall coming in here as well. Your changes in stance are basis of this as well, right? So now, what do you not like, and what do you like in the sector?
So, we obviously look at which all companies are highly levered to the US index market, right? So, within the large cap pharma names, you have Aurobindo, which almost derives around 48% of their revenue from the US market. And on the other extreme, you would have a company like Sun Pharma, where the US index exposure has come down meaningfully, probably we estimate it at around anywhere between low to mid-teens percentage point of their top line. And hence, anyone who is much more levered to the US index market, that's where we see, there could be risk to the forward earnings. And hence, we have double downgraded Aurobindo from outperform to underperform. And we have also downgraded Dr. Reddy's from outperform to neutral.
Mm-hmm. Okay. All right. Well, yes, Aurobindo and Dr. Reddy's, we want to touch upon that a little more. But first on Revlimid generic, once you see that incremental competition, which are the companies that you think which should be most susceptible in terms of earnings risk?
So basically, generic Revlimid, we have seen a period of limited competition because innovator provided every generic with a limited volume licenses between March 2022 to January 2026. Now, as we are in the last lap of that, the limited competition period, what we will see is many more players entering post January 2026. And in anticipation of that, the price erosion in the generic Revlimid has already started, even as early as April to June quarter. And I believe that the price erosion is probably going to accelerate in the generic Revlimid as well. And as we have published based on our estimates, within our coverage, Dr. Reddy's derive almost around high teens percentage point of the total revenue as a percentage of FY25 revenue from generic Revlimid. And the lowest contribution is for Lupin, which is 0% because they don't have the product. And all other companies are in between that 0 to high teens percentage point in terms of top line contribution from this product.
Right, Kunal, while obviously we're seeing Revlimid going out of fashion now, and that will start coming and in terms of the impact for these companies, but GLP-1, semaglutide, we've seen so much data coming in. Ekta was talking about the numbers as well just a short while ago. So anything that you're liking on that front as well, opportunities there for the company. So which ones are you looking out for?
So I think on the semaglutide, which is going off patent in almost 85 countries, in early part of calendar year 2026, what we are seeing is the meaningful market is Canada. And there, Novo Nordisk, which is the innovator of semaglutide, they reported calendar year 24 revenue of around $1.2 billion from this market alone. And we believe at this point in time, when we look at the Canadian government's website, there are 4 players who have filed for this generic opportunity for Canadian market at this point in time. And within that, Dr. Reddy's is one of the early filers there. So we believe that semaglutide in Canada could offer a decent upside opportunity for a company like Dr. Reddy's. Another company that has filed is Sandoz and Apotex. And there is a 4th company where the name is not disclosed on the website at this point in time. But these are the 3 companies which are currently in race for this large market, which is opening up in early part of calendar year 2026. As for the India market and the other emerging market, my view is that eventually it would be a good big market, but there will be many players who will be competing in this market, and hence I would basically prefer companies who already have a strong presence in anti-diabetic therapy within India market, and within that the top 3-4 companies that I see based on the third-party data provided by IMS is Sun Pharma, Lupin, Eris Life Sciences. These are the 3 companies which are basically top 3 in the anti-diabetic therapy. So they have a better chance of getting a more market share in my view.
Okay, and very comprehensive conversation there, Kunal. Thank you very much for joining in and talking to us and giving us your perspective on the pharmaceutical space. That's Macquarie Capital talking about their likes and dislikes in the pharma space. We need to take a short break as we do that, but we'll be back with more. And as we slip into a break, here is some good news for our viewers. India's business news leader is now just a click away. Introducing CNBC-TV18's all-new app. Get instant access to breaking news, in-depth articles and financial world updates at your fingertips. Download the CNBC-TV18 app now from the Apple Store or the Google Play Store, or just scan the QR code on your screen.
Welcome back to Halftime Report on CNBC TV18. Now let's shift focus on the insurance space. June life insurance data has largely been a mixed bag that has come in. Yash is joining in with us to give us details on this front. Yash, what are the data? What is the data indicating? What are we watching out for now?
Well, let me first speak about the best or the strongest piece as far as the sector itself is concerned, and that's been Max Financial Services. You look at the company's performance in the month of June on any parameter, and it's been more than strong, if I could put it that way. As far as numbers are concerned, it's a strong growth for Axis Max Life Insurance. And what makes this strong growth even better is that the strong growth has come on a strong base, which the company had grown on in June of last year. So June new business premium, that has seen a growth of 21%. The first quarter premium growing by 22%. June total APE growing by 25%. June retail APE growing by 22%. HDFC Life, it's a modest growth on a strong base which the company had to grow on. June new business premium, that has seen reduction at about 6%. Q1 premium though is up 15%. Total APE growing by 8%. Retail APE growing by 12%. ICICI Prudential Life Insurance, weak growth on a favorable base which the company had. So this is the weakest piece as far as the sector is concerned. June new business premium is up 4%. First quarter premium growing by 6.5%. June total APE growing by 11%. Retail APE down 10%. SBI Life, it's a healthy growth for the company on a strong base. June new business premium, that is down 13%. But the first quarter premium, that has grown by 3%. Total APE growing by 10% and retail APE growing by 14% in the month of June. Finally, LIC, it's a weak growth on a modest base which the company's had. So June new business premium is down 3%. First quarter premium has grown by 3%. June total APE is down 9% and retail APE has grown just by about 2%.
Okay, all right, Yash, thanks very much for that. Now, PFC or Power Finance Corporation and REC are buzzing after they got a brokerage note from Morgan Stanley. Gaurav is here with the details on this.
Well, as PFC, REC, both the companies are buzzing in trade today, and the reason being that now Morgan Stanley has initiated a note with overweight rating on both the companies. For PFC, they have given a target price of 508 rupees, and for REC, the target price is set at 485 rupees. What they have highlighted is that both these companies have been underperformers if we compare it with the performance of these companies over the last 2 years. And now, what they believe is that over the next 3 years, the loan book growth can be somewhere in the range of 12%, with EPS anywhere between 17 to 19%, which is actually a strong case for both these stocks. Other than that, even if we look at valuations, at least as per Morgan Stanley, what they're saying is that the valuation is fairly in line, and it also gives an opportunity for investors to invest. And the reason being that companies pay dividends somewhere in the range of 3 to 4%. They already have a stable asset quality, and even if we consider the loan book growth of 12%, the valuation is fairly in line, and that is the reason they have maintained their overweight rating. As a result, we are also seeing some uptick in these counters. So definitely a big case for both these companies, given that a recent underperformance for these stocks.
Okay, Gaurav, thank you so much for that. But, do stay on with us because housing finance sector and the companies over there also are in focus. And this is after a brokerage note that we have from Bernstein as well. Tell us what the brokerage note is highlighting.
Well, yes, Bernstein is being bullish on the housing finance company, specifically on Home First Finance, Aptus and Aadhar. They have actually initiated with outperform rating on these stocks. And with this, their preferred pick remains as Home First Finance. And the reason being that they actually like how the company demonstrates its ability to consistently replicate its business model in various states. Other than that, what they are also saying is that because of the smaller size, fastest growth and superior quality, the company actually stands out well in the pack. Other than that, Aptus is also in focus, and the reason being that they believe that the fixed rate loan book is actually higher for the company, which is good in terms of the interest rate cut cycle that we are seeing right now. Aadhar Housing Finance is also on their radar, and the reason being that the company is one of the largest and most geographically diversified player as per them, which gives them upper edge. On the other hand, let's also talk about Aavas and PNB Housing, where they have initiated with market perform rating. For Aavas, what they are saying is that the company actually lags if we compare it with its peers in terms of profitability and yield, and that is the reason they have initiated with market perform rating. For PNB Housing, they actually like the business model because they are shifting towards small ticket size loan, but what they are cautious about is that the aggressive expansion, which they believe can bring some concerns in the business, and that is the reason market perform is what they have initiated with. As a result, even when we look at the stock performance, we are seeing all these stocks are buzzing in trade today, and we are also watching out on these stocks today.
Okay, all right, Gaurav, thanks very much for that. Well, TCS will be kicking off the first quarter earnings season later today. The company is expected to report a muted June quarter. Reema's here with the key expectations. Reema.
So as you rightly pointed out, expect a bit of a muted quarter. Dollar revenue growth is seen up 0.6%, but constant currency revenue growth is expected to decline by nearly 1.5%. The reason you're seeing such a disparity in the dollar revenue growing and the constant currency declining is on account of the currency move. So there's been a sharp depreciation of the US dollar versus some of the other currencies like the pound, the euro, and the yen, and that explains. But in constant currency, that's the main number that we watch, expect a decline of nearly 1.5%. Margins are likely to be flat on a sequential basis. Remember, this time there were no wage hikes. Typically, the company gives wage hikes in Q1, but on account of the uncertainty, they had deferred it. And the reason why the revenue is expected to be weak is because compared to the prior few quarters, the BSNL contract is ramping down. And the question that analysts have on the margins is that as this BSNL contract ramps down, and BSNL had low margins, some analysts estimate just single-digit margins. So then why aren't the margins expanding? Because our poll throws margins to be on the flatter side. Now, what will you watch? The growth X of BSNL, the international growth, because analysts say that despite good deal wins, the growth has been pretty muted for the international business. Secondly, timing of the wage hike because it was deferred from Q1. And thirdly, the deal wins.
Okay, Reema, thank you so much for that. We'll closely be keeping an eye out on these numbers that will come out today post-market hours. But markets as of now, Nifty has recovered slight bit from the day's lowest point, though not moved much in terms of an up move there. Still down around 82 points is what the Nifty is trading at. The broader end of the markets also today trading in the red. Some of the names in the last 1 hour that have seen a bit of an up move that we could talk about on the broader end is Capri Global. Let's pull that up. That's seen a bit of a spike up in the last 1 hour. We've seen Acme Solar, that's another name that is buzzing in trade as well. Actually recovery from the days, or seeing a bit of a spike up in the last 1 hour, and JSW Energy. Other than that, we continue to keep an eye out on Campus Activewear today. That's seeing a lot of action. Aditya Birla Sun Life AMC among some of the names that are buzzing. Bharat Dynamics on the flip side, that's also a bit under pressure, while Metropolis Healthcare and Dr. Lal Path Labs among the diagnostic names that are not managing to do well. Let's also watch out for Garden Reach Shipbuilders. That is not doing well today, and that's also seen a bit of a fall today in today's trading session, so will be important to watch out for that. Now, other than that, advanced decline ratio today as of now has moved more towards the decline versus an advances that we're seeing coming in, and around 1,300 stocks are on the decline. Decline is 1,400 stocks versus advances at 1,197. So yes, keeping an eye out on that as of now. Again, maybe we could see those lines converging, but that will be something that we'll be watching out for. But with that, we're going to wind down this edition of Halftime Report on CNBC-TV18. Thank you so much for tuning in. Don't go anywhere. Up next, we have Business Lunch to take you through all the market action ahead.
Stocks still down as hopes of an early mini trade deal with the US fade, realty and utilities gain while IT and healthcare drag. CNBC-TV18 learns that Finance Ministry may create a rupees 32,000 to 35,000 crore fund to compensate oil marketing companies for LPG under recoveries. A cabinet proposal may soon be moved for the same, offering big relief to IOC, BPCL and HPCL. Sources tell CNBC-TV18 that the divestment of IDBI Bank should be completed by October and offer for sale by LIC and several state-owned banks are lined up. SIP and some public sector banks will also mop up rupees 45,000 crore via QIPs this fiscal. Analysts expect TCS to report a soft first quarter with dollar revenues flatlining and margins staying ranged. Favorable currency moves are seen propping the top line even as a ramp down of the BSNL project drags. NBFCs are no longer shadow banks but systematically significant entities that should aim to reach 50% of the credit disbursed by banks by 2047. The Finance Ministry has said, but she also calls for increased focus on risk management by them. Well, it's another day in the red. We've managed to slip below that crucial 25,400 mark for today. That is the zone that we had been defending all along, but it has been not such a great day for trade. When we take a look at some of the broader indices, the broader end of the market is also down and out. Take a look at the Nifty mid-cap index. It's down almost 0.4%, Hormaz, and the small-cap index not doing too well either. The advanced decline ratio, as you can expect, largely in favor of the declines.
Welcome to you, Amakshi, to Business Lunch, and welcome to coming to you live from the CNBC-TV18 Motilal Oswal studios. And of course, yes, and as Amakshi was highlighting, right, 25,400, that level is still, the bulls would be hoping that the remaining 2.5 hours of the weekly options expiry, we will manage to cover and defend that level of 25,400 on the downside. As of now, there's a slight recovery from the lows of the day. It's just a 30-point recovery, but even then, it's a recovery nonetheless. 80 points lower on the index. The broader markets too not doing fairly okay for themselves. It's a similar kind of a move seen there as well. 220 points lower on the mid-cap index, and there are a lot of stock-specific moves that are taking place. You're counting down to earnings from TCS later in the day. Of course, that comes after market hours, but we also count down to earnings from IREDA. The other news flow from IREDA is, of course, the approval that it has received from the government to raise funds via those Section 54 EC bonds. So that stock is doing well for itself ahead of the results. So 2.25% higher on IREDA. So good going for that stock. And of course, count down to other results, right, from Tata Elxsi, from Anand Rathi Wealth. So there will be earnings reactions that will be taking place in tomorrow's session as well. But for now, the index remains in consolidation mode, remains in that range, and the weekly options expiry into the final leg now of the trading session. So it will be interesting to see if there are any decisive moves on either side as we count down to the close of trade. But starting off the show with updates on the US tariff war, President Donald Trump has unveiled a new round of tariff demand letters, including a 50% rate on Brazil. It was one of the highest announced so far. Now, the tariffs set to take effect in August also include a 30% levy on Algeria, Libya, Iraq and Sri Lanka. Now, Brunei and Moldova will see a 25% duty, while products from the Philippines will be taxed at 20%. The rates are broadly in line with the figures that the President Trump had floated back in April, although there is a slight adjustment, with Iraq's duties being reduced from 39% and Sri Lanka's lowered from 44%. Now, in response, the Brazilian president has said that the country will respond reciprocally. Let us now listen into what Donald Trump had to say on this.
They have to pay 10% if they're in BRICS, because BRICS was set up to hurt us. BRICS was set up to degenerate our dollar and take our dollar as the standard, take it off as the standard. And that's okay if they want to play that game, but I can play that game too. So anybody that's in BRICS is getting a 10% charge.
Is that immediate, sir, or is
that
if
soon.
They engage in some behavior?
Well, if they're a member of BRICS, they're going to have to pay 10% tariff, just for that one thing, and they won't be a member long. I thought BRICS was, I said this about a year ago, and it largely broke up. But, you know, there are a couple that hang around, but I thought it largely broke up. BRICS is not, in my opinion, not a serious threat. But what they're trying to do is destroy the dollar so that another country can take over and be the standard. And we're not going to lose the standard.
While speaking to CNBC, Oil Minister Hardeep Puri also responded to Trump's threat of tariffs on BRICS countries. Let's listen in.
If there is a situation in which a tariff is imposed on any country or groups of countries, these countries are capable of responding to it, and they will respond to it. I don't think membership of groups like Brazil to BRICS, Brazil, Russia, India, China to start with. Now they've got South Africa. They joined some time ago. They're joining. Other countries have joined in now, etc. Let's leave it at that. They will decide what they have to do.
Few voices carry as much weight as Jim O'Neill, the economist who coined the term BRICS. Earlier, we spoke to him and asked him about Trump's tariffs on the BRICS countries amidst the talk of de-dollarization. Here's what he said.
Each time Trump says something about the BRICS, I'm both amused and even more confused than I am when he talks about many other topics. I sometimes wonder whether he actually really knows who's part of the BRICS and who isn't. In my judgment, the BRICS haven't really done anything. So I'm not sure Trump's statement ultimately is going to mean one thing or another of any great relevance, other than the fact it gives the BRICS greater attention, which I would have thought is the last thing that Trump was trying to do, or should have intended. But such is the strange world of life under Donald Trump. The whole idea that the BRICS countries can realistically jointly develop some alternative currency to the dollar just doesn't really make much sense whatsoever. You know, I've spent much of my professional life developing my years during the build-up and the creation of the euro. And everybody knows the difficulties that European countries went through, but it ultimately, of course, required them to abandon their own domestic monetary policies. The idea that big BRICS countries are going to abandon their central banks for some kind of joint initiative on currency, you know, it's like some kind of fantasy Netflix movie, really.
Moving on then, sources tell CNBC-TV18 that the finance minister is considering a 32,000 to 35,000 crore of fund for OMCs. My colleague Timsy is joining us with more details. Timsy?
Well, that's what sources are indicating to us. The demand of OMCs for a 40,000 crore rupees worth of a boost to overcome the compensation that they needed actually for LPG losses. That is something that is now on the cards. What we are picking up from government officials and senior sources is the fact that the finance ministry is considering a fund of 32,000 to 35,000 crore rupees for which an approval will be sought from the cabinet, and the government, that is the finance ministry here, is going to move the cabinet very soon seeking an approval for this. Now this fund will help OMCs overcome the under recovery on LPG that they have been having, and remember, the proceeds for this fund, that is exactly where this fund will come from. Where will this money come from? Well, this will come from the excise duty collections that the government has had so far. So that is going to fund this particular under recovery losses that is going to be given to the OMCs. The view behind this of the government is that oil companies are part of the same government family, and government does not want OMCs to suffer. Compensation will happen very soon as the cabinet gives a nod. So what we are picking up right now is that the process is now almost at the last leg to give these compensations to the OMCs. Let's see how soon Finance Ministry moves the cabinet and when cabinet gives a go-ahead. Back to you.
Timsy, thanks a lot for that update. And India's oil minister, Hardeep Singh Puri, has defended oil purchases from Russia, saying that it stabilized the global oil market. Speaking to CNBC's Dan Murphy at the OPEC and Allies Summit in Vienna, Puri said that the Indian government remains committed to domestic consumers. Listen in.
Under the very mature and decisive leadership of the Prime Minister, we've navigated all kinds of challenges. We used to buy energy from 27 countries in the world. Today, we are buying energy from 40 countries in the world. Russia used to produce a fair amount of energy, and I asked a very simple question, and then I was told by my friends, please buy, but buy cheap Russian this thing. So they placed a price cap. So energy from Russia was not sanctioned at that point. Energy coming through a pipeline to Hungary was not sanctioned. Going through a pipeline to the Far East, Japan was not sanctioned. So they wanted to put a price cap on the rest of it. And I was not unhappy buying within the price cap. So I don't think that's something that we have navigated the global and energy challenges, and I'm confident that going forward we'll be able to do so again. We will buy from wherever we can. Our commitment is to the Indian consumer. And if there is an international agreement at any point of time that a particular kind of sale should or should not take place, so far the American position was and has been that you should buy Russian oil within a price cap. And we've been buying within a price cap. So beyond that, I don't think we need to go. If people or countries had stopped buying at that stage, the price of oil would have gone up to $130 a barrel. That was the situation in which we were advised, including by our friends in the United States, to please buy Russian oil, but within the price cap. So in effect, by buying from Russia, we were helping the global economy stable prices, and therefore we contributed to global stability in oil prices. There is no such thing as a good price. I would like to see energy markets, including of crude oil and gas. Gas, there's enough coming on the market. Gas, I think prices will come down. But I think prices have to be stable and predictable so that it is worth the while of the global consumer, as also not undermining the investment in the sector. Because much as I'm wedded to energy transition, I think transition by definition means you have to survive from the present to the point of transition.
Well, as we slip into a very short break, here is some good news for our viewers. India's business news leader is now only a click away. Introducing CNBC-TV18's all-new app. Get instant access to breaking news, in-depth articles and financial world updates at your fingertips. Download the CNBC-TV18 app now from the Apple Store or Google Play Store, or just scan the QR code on your screen.
Welcome back. Now, short seller Viceroy came out with a report describing Vedanta Resources as a parasite and Vedanta Limited as a dying host. Vedanta has hit back, stating that the sole objective of Viceroy Research's report is to create false propaganda. Now, earlier today, we spoke to Gabriel Bernarde, who's the founder at Viceroy Research, and Rakesh Arora of Go India Stocks, both of whom have diverging views on the company. Listen.
Vedanta Limited, let's say, it doesn't have the capacity to cover the interest costs of Vedanta Resources. So whether that will create a eventual default, or whether the possible impairment of billions of dollars of Vedanta Limited's assets will lead the creditors to call that debt, that's anyone's game. We're here to report it. Whether we're a bit too early or a bit too late is irrelevant. We've written our research and we think that the end result is a disorderly collapse. We think that, Vedanta Limited has been overly promotional in the ability of its business and the ability of its operating assets, which that have been largely overstated.
Are you done with the report, or will you have more reports coming out on Vedanta?
Oh, we have more.
Unfortunately for Viceroy, they are just 2 years late on this stock. Vedanta Resources already delivered quite a bit from around $9-10 billion to around $4.5-5 billion now. And now servicing that debt is not a challenge at all. Number two is that, Vedanta itself has gone through this whole exercise of demerging, and all the lenders have looked at individual entities on their leverage, on the, whatever the liabilities are. And clearly, they've approved this. So clearly, all the entities are self-sufficient. Otherwise, this kind of approval cannot come from lenders. Vedanta stock is largely dependent on aluminum outlook. And aluminum outlook has been pretty strong and doesn't look to be weakening anytime in future. They are also getting a little bit more of backward integration in form of bauxite mine, coal, their own captive alumina. So things are looking better only for them. So I don't think fundamentally there's any reason that performance would deter. Vedanta has been has done phenomenally well actually in the last 2 to 3 years. Meaning, if you had asked me in 2021, I would not have been able to gauge this kind of turnaround that the management has been able to achieve. And things are only getting better from here.
Well, so some contrasting views coming in on Vedanta from Viceroy Research as well as Go India Stocks. But as we slip into a very short break, remember to tune into the all-new CNBC-TV18 Prime, bringing you insights from policymakers, business leaders and economists shaping both the world and India's future. CNBC-TV18 Prime decodes global shifts and their impact on Indian businesses, giving you unparalleled insights. Tune in to CNBC-TV18 Prime at 12 noon for the Global Reset, at 1 p.m. for the Big C, and the Global Lens at 8:30 p.m. Welcome back. Thanks for staying tuned into Business Lunch on CNBC TV18. Let's shift our focus to some big global developments. Nvidia has crossed $4 trillion in market cap. Hormas joins us now to take us through the meteoric rise in the valuation of the company. Over to you, Hormas.
Well, they say bada hai to behtar hai, and a company based 14,500 kilometers away in Santa Clara is justifying that tagline, and how. That is Nvidia for you. The AI behemoth and Wall Street darling became the first company to cross $4 trillion in market cap on Wednesday. It has taken just over 13 months to add the latest $1 trillion to its value. However, take a look at this rapid rise that Nvidia has seen. Its first $1 trillion came in May of 2023. In 9 months, it was at $2 trillion. 4 months later, in June of 2024, it was at $3 trillion. And had it not been for Donald Trump and his tariff tantrums, who knows, we may have been doing this just a few months earlier itself. Now imagine Nvidia being a country. At $4 trillion, its GDP would be higher than most countries of the world. In fact, it will be the 5th largest economy of the world, behind the US and China, just a shade below Germany and Japan, and just a shade higher than the Indian economy. Now, when I spoke about the Trump tariffs, in April, they spared no one. Nvidia shares also fell to their 52-week low, but the bigger part is the recovery. The stock has nearly doubled from those April 7 lows that they had made, and that's just a 3-month window. Now, at $4 trillion, Nvidia is 73% of the entire Indian stock market capitalization, which stands at just over $5.5 trillion. Nvidia is now the size of 30 HDFC banks, 37 TCSs, and 22 Reliance Industries individually. Now, wealth creation is the motto to be in the stock market, and Nvidia has done exactly that. Since 2013, Nvidia has had only 2 negative annual years in terms of share price returns. Its 15-year average return is a cool 70%. Now, take a look at this. Since 2020, Nvidia has had 4 years where the stock has either doubled or even tripled in value during a calendar year. This year too, the stock is up 22% after the recovering from the plunge that it took earlier in 2025. But there are challenges that lie ahead. Export curbs still remain to the Chinese markets. Now, founder and CEO Jensen Huang said that these issues have completely cut Nvidia off from a $50 billion Chinese market. They took a hit in the first quarter, and another $8 billion hit is likely in the second quarter as well. The other challenge is the slowing revenue growth. But the definition of slow here is just a case of raising the bar too high. Now, 5 out of the last 8 quarters has seen Nvidia report revenue growth in excess of 100%, some even 200%. And at this size, anybody will happily take a 69 to 70% revenue growth. But such are Nvidia standards that the street is worried that those 100% growth days will never return again. Lastly, sticking to the saluting the rising sun terminology, Wall Street continues to remain bullish on Nvidia despite the surge that it has seen. 68 out of the 78 analysts who cover the stock continue to maintain a buy recommendation, and the odd one out, a solitary sell. Now, that's Nvidia for you. The journey from $1 trillion to $4 trillion has happened in a jiffy, and the onus now lies with Jensen Huang and company to embark on the next trillion, one chip at a time.
Well, interesting data out there, Hormas. Surely Nvidia is a stock that everyone had been watching out for ever since the AI revolution picked up pace. But let's wind down this edition by looking at what the indices are doing at this point of time. The Nifty 50 continues to lag in trade, down now almost 90 points now. The mid-cap index also seeing a cut of almost 0.5%, and the small-cap index too down and out in trade today. So that's all we have on this edition of Business Lunch. But don't go anywhere, because Mid-Cap Radar comes up next. Good afternoon. Welcome to Midcap Radar. I'm Sonal Bhutra. With me is Vivek Iyer. We are live from the CNBC-TV18 Motilal Oswal studio. For the markets today, below that 25,400 mark, in the red, midcaps falling a little bit more, and all eyes on TCS results today.
That's right. Good afternoon, Sonal. Like you said, all eyes on TCS results. Earnings season kicks off officially, and a whole host of results over the next month and a half is what we look forward to. It's a red screen, advanced decline ratio, quite weak today. But we have a lot lined up on the show, so let's start off with the top headlines. Stocks still down on hopes of an early mini trade deal with the US are fading. Realty and metal gain, while IT, pharma and healthcare drag. Mid-caps in line.
Housing finance companies in focus after Bernstein initiates coverage on multiple stocks like Home First Finance, Aptus, Value Housing Finance, Aadhar and PNB Housing. Brokerage firm expects Home First to benefit from faster growth compared to peers and Aadhar to maintain its steady growth trajectory.
Flair Writing gains in trade after a buy recommendation from Ambit. The brokerage firm adds that management expects demand recovery in both domestic and exports, with growth acceleration seen in FY26.
CNBC-TV18 learns that Finance Ministry may create a 32,000 to 35,000 crore rupee fund to compensate oil marketing companies for LPG under recoveries. A cabinet proposal may soon be moved for the same, offering big relief to IOC, BPCL and HPCL.
IREDA rallies as the government allows it to raise funds via capital gains bonds, which allows for a lower interest rate and tax benefits for investors. Q1 results scheduled for later today.
Those are the top stories that we are tracking. We'll discuss some of them in greater detail as well. For the markets, it's an 85-point cut on the Nifty as we speak, very close to that 23,400 mark. We'll have to see whether it sustains around that mark or we fall further from these levels. Bank Nifty down 0.2%. We do have the mid-cap index, which is falling a little more, 0.5% gone there. Even the small cap index, that should come up for you on the screen, and that one is falling in line with what the mid-caps are doing. Both these indices at the day's low. So some impact that we're seeing on the mid-caps and the small caps. Now, do remember, this was one index which was not, most of the markets actually was consolidating. But today, mid-caps in particular seeing a sharper cut.
That's right. One particular pocket of the market that's seen accelerating seller pressure is actually the defense pack. They've done very, very well. But today, some of those stocks, especially names like Bharat Dynamics, BDL and BEL, some of the stocks that are taking a bit of a knock today. But these stocks and a whole host of other stocks is what Hormaz has on his list. He's standing by the wall to take us to the mid-caps that are moving around in the session.
Sharper cuts on the broader markets, and you start off with the losers then in today's session as the index has slipped to the lowest point of the day. Metropolis is one of them among the top losers on the Nifty 500 today, 4% lower on that stock. And some of the financial names, look at Canfin Homes, look at RBL Bank. Of course, RBL Bank is in the F&O ban, but seeing some unwinding today, 2.5% lower on that stock. As Vivek just mentioned, defense is one pocket that is not doing well in today's trading session. Bharat Dynamics saw an initiation note coming in from Motilal Oswal, and some of the other names like Zen Technologies, Data Patterns, they too not having a good day in the office, losses of around 3 to 5%. Bharat Dynamics has in fact now slipped to the lowest point of the day. Some of the other movers in today's trading session, and they are the ones that belong to the asset management space. And before we get to that, some of the brokerage reactions. Look at Flair Writing. Ambit came out with a note on that stock. PFC, the initiation coming in from Morgan Stanley, remains a consensus buy among analysts at the highest point of the day. And Home First Finance at one point was up 6%, has given up most of those gains but still holding on in the green. Volume buzzers in today's session. Some of these names, Campus Activewear has been holding on to gains today. Acme Solar is at the highest point of the day, 9% higher on strong volumes, as is Glenmark Pharma, gains of 3.5%. I just spoke of asset managers, and UTI AMC is already at a 52-week high. A note came in from Antique a couple of days ago and from ICICI Securities today as well. And Nippon Life, HDFC AMC and Aditya Birla Sun Life too seeing healthy gains in today's trading session, even after the markets are slightly wobbly. Back to you guys.
All right. Yes, some pockets which are wobbly. Thank you so much for joining in with those names, Hormaz. Let's now welcome Nagraj Shetty of HDFC Securities for a quick technical check on the markets. Thank you so much for joining in. What are the important levels you're watching out for? Do you think we could see a further fall, or we could get back above that 25,500 mark?
Hi, good afternoon, Sonal. Market has been in a range-bound action over the last
few sessions. We have seen 25,550, 600 the upper range and 25,300 odd levels at the lower range. I'm not expecting a bigger decline as of now, even though market has some cut from the high levels. There is a possibility of Nifty bouncing back from lower the support of around 25,300 to 25,250 levels in the short terms, and eventually we could see Nifty retracing towards around 25,550, 600 odd levels in the near term.
Good afternoon, Nagaraj. Nagaraj, what are the individual stocks that are on your radar? Any buy or sell for our viewers today?
Hi, good afternoon, Vivek. I have a two buy side from my side. One is PCBL. PCBL has witnessed some decisive upside breakout of the range action as well as the downsloping trend line in the last couple of sessions, looking attractive at this point of time. And that breakout has accompanied with a rise in volume as well. Currently trading around 432, 433 levels. One can look to buy at this point of time. Immediate target would be around 455, and one can place a stop loss at 420. Second one is from VIP Industries. VIP Industries has been in a gradual up move with a bullish setup, like high tops and higher bottoms over the period of time. Recently, it has shifted into a range bound action, and the last couple of sessions price action is signaling a breakout of the range movement. Currently trading around 449, 450 levels. One can look to buy at this point of time. Upside target would be around 475. One can place a stop loss at 435.
Okay, all right. Thank you so much, Nagaraj, for joining in with those picks and some important levels to watch out for on the Nifty. With that, remember to tune into the all-new CNBC-TV18 Prime, bringing you insights from policymakers, business leaders, and economists shaping both the world and India's future. CNBC-TV18 Prime decodes global shifts and their impact on Indian businesses, giving you unparalleled insights. Tune into CNBC-TV18 Prime at 12 noon for the Global Reset, at 1 p.m. for the Big C, and Global Lens at 8:30 p.m.
Welcome back to Mid-Cap Radar. Well, the selling pressure continues as far as the mid-cap and small-cap end of the markets are concerned. But one particular sector that's in focus and doing relatively better is the housing finance space. This is post-Bernstein note, and Bernstein today has initiated coverage on quite a few stocks within that particular space. Gaurav joins in with more details.
Well, as Bernstein is being a little bullish on the housing finance, specifically on the companies like Home First Finance, Aptus and Aadhar, because they have initiated a note with outperform rating in these stocks. Specifically talking about Home First Finance, it is their preferred pick even in this segment, and the reason being that they believe that the company has ability to consistently replicate its operating model across the multiple states. Other than that, company also have some benefits like smaller size, fastest growth, superior productivity, and as a result, they are actually being bullish on this stock. Other than that, for Aptus, what they believe is that they have high share in the fixed rate loans, and that is something which is actually pushing the stock, and it will also help the stock given that this is an environment where we are seeing rate cuts. Aadhar housing is also something which they are preferring, and the reason being that they believe that company is largest and the most geographically diverse place, which is actually helping the company in placing the company as a different player in this segment. On the other hand, we also have Aavas and PNB Housing, where they have initiated with market perform rating. For Aavas, they believe that the company actually lags its peers when it comes to yield and profitability for the company. And lastly, for PNB Housing, they actually like the business model. They believe that the small ticket loan diversification is a good thing, but on the other hand, aggressive expansion is something where they are cautious, and that is the reason they have initiated with outperform rating. On the back of this note, we are already seeing some traction coming up for all these stocks, and we are also watching out on how these stocks perform in coming days as well.
Okay, all right. So that space continues to be in focus. Thank you so much for that, Gaurav. Bharat Dynamics is the other one. It is in focus. There is a Motilal Oswal note on that stock. Ria is joining us with the details of this one. Ria.
Well, yes, today Motilal Oswal has initiated coverage on Bharat Dynamics with a target price of rupees 1900 and a neutral rating, and this is a 4% downside compared to yesterday's closing price. Now, the brokerage has noted that BDL's revenue has been hit in recent years, largely due to supply chain disruptions and also because of challenges in sourcing critical components, particularly from Russia and Israel. But now they say that these headwinds are beginning to ease out, and they expect a sharp recovery going ahead. In terms of the revenue, they're expecting a CAGR of about 35% over FY25 to FY28. Margins are also seen holding steady in the 24 to 26% range, while operating performance is also set to pick up meaningfully going ahead. EBITDA and PAT are estimated to grow at a CAGR of 64% and 51% respectively over the same period. Apart from this, the report has also highlighted a strong order visibility going ahead for the company. They have a current order book of about rupees 22,700 crores and a potential pipeline of 50,000 crores going ahead, including large deals like QRSAM and the upcoming emergency procurement orders as well. Now, on the macro front, the company is well placed to benefit from favorable defense tailwinds, including the rising global defense spends, growing exports of the Akash missile systems, or the ongoing collaborations with DRDO as well. Now, that said, valuations do remain a sticking point for the company, currently trading at about 70 times the FY26 estimated earnings, and therefore they do suggest waiting for better entry levels on the stock. Now, apart from this, a report from a Brazilian news agency, the Rio Times, earlier this week also revealed that Brazil has dropped plans to buy air defense missiles, which is the Akash missiles from Bharat Dynamics from India, and they are now negotiating with Italy for a more advanced missile system. And this is according to official government sources to the news agency. So on the back of these two news flows, the stock is trading with selling pressure almost 5% lower today.
Thank you so much, Ria, for joining us. Clearly, markets not taking kindly to the fact that the Brazilian order that the street was expecting may come in has not fructified as of now. But moving on, one stock that's doing quite well is IREDA. They report results later today, but an important development came by today morning. Gaurav joins in once again to tell us what's keeping the street excited.
Well, yes, there are two reasons for IREDA to be in focus, and the first one is that the government has allowed IREDA to raise funds via 54 EC bonds. Now, these are also known as capital gain bonds, and what is special about this bond is that with this, IREDA can raise funds with a rate as low as 5.25%. Now, these bonds actually help investors in a tax exemption status, and that is the reason these bonds are popular. But what keeps IREDA special in this movement and what keeps the momentum ongoing is that the cost of fund for IREDA can come down. Let's not forget that in FY25 we have already seen that IREDA has seen 20 basis point of cost of fund easing, and with this we may see some further easing even coming ahead. We already have 5 PSUs who are raising funds via these bonds in the like of REC, NHAI, PFC, IRFC and HUDCO, and IRIDA joins this pack as a sixth one. Let's also not forget that there is second trigger for IRIDA is the Q1 results. Now, from the provisional updates, we have already seen a strong set of numbers for IRIDA. We have seen loan book growth at around 26%, while disbursement grew almost by 32% on a year-on-year basis. So that is also another trigger which is playing out. And as a result, we are seeing the stock is up in trade today.
Okay, all right. So quarter one earnings today. We'll come back to you for the analysis. Gaurav, thank you so much for joining us with those details. With that, we'll do one thing. We'll slip into a break. But before we do that, let's just quickly take a look at some of the stocks which are in focus. Gaurav just spoke about IRIDA, of course, that is in focus. Nykaa is up around 1.5% as we speak. Since the broader end of the market is under a bit of pressure, there are not many stocks which are buzzing the way they did yesterday and day before, but a couple of names which are in focus. The mid caps continue to be at the day's low. We have Borosil Renewables, which is up 3.5%. There's JBM Auto, which is up 2.6%. Prestige Estates, after that stellar set of quarter one update, is also doing well. Some brokerage upgrades coming by as well. So keep these stocks on your radar. But for now, we'll slip into a break. As we do that, here is some good news for our viewers. India's business news leader is now click away. Introducing CNBC-TV18's all-new app. Get instant access to breaking news, in-depth articles, and financial world updates at your fingertips. Download the CNBC-TV18 app now from the Apple Store or Google Play Store, or just scan the QR code on your screen. Welcome back. You're still tuned into Midcap Radar. It's time to talk about the insurance space. Yash is joining us now with the June life insurance data. Yash, how did it look?
Well, the numbers have been mixed if you speak about the sector, but clear outlier in terms of being on the positive side is Max Financial Services. You look at the numbers on any parameter and they come out to be very, very strong. And what makes it even better is that these strong numbers in the month of June have come on a very strong base as well, which was June last year. To speak about specific numbers, June new business premium collection was up 21% on a year-on-year basis. The first quarter premium collection has grown by 22%. Total AP in the month of June has grown by 25%, retail AP growing by 22%. HDFC Life, modest growth on a strong base which the company had. So June new business premium collection has contracted by 6%. First quarter premium is up 15%. June total AP has grown by 8%. June retail AP has grown by 12%. ICICI Prudential Life Insurance, it's a weak growth for the company in the month of June. And what makes it a little difficult to digest is that it's come on a favorable base which the company had. So June premium collection has just grown by 4%. The first quarter premium collection is up 6.5%. June total AP has grown by 11%. And what has really dented the business is the individual business. June retail AP is down 10%. SBI Life, healthy growth on a strong base. June premium growing is contracted by 13%. First quarter premium grown by 3%. June total AP has grown by 10% and retail AP growing by 14%. Finally, for LIC, it's a weak growth on a modest base. So June new business premium has contracted by 3%, but the first quarter premium is up 3%. June total AP is down 9%. June retail AP has grown by just about 2%.
Thank you so much, Yash, for joining in and breaking down the life insurance numbers for us, the monthly numbers that have come in. Well, moving on, AMCs are in focus, post an ICICI Securities note. Pamakshi joins in with more details.
Well, that's right, Vivek. AMC stocks are flying away in trade today, especially UTI AMC, because that stock is sitting at a new 52-week high. Keep in mind that the note from ICICI Securities points out that there is a case for an increase in AMC multiples, and this is largely based on resilient as well as growing SIP trends. Other than that, they also, allude to increased trend of commission rationalizations, mainly on account of the growing AUMs. So that is another factor that is driving this rating. Apart from that, they also believe that the companies could possibly benefit from higher consumer discretionary spends on account of income tax cuts as well as the repo rate cuts, and they could also possibly post higher growth from a new asset class of MFs, which is the specialized investment fund. As compared to some of the other capital market plays, the regulatory risk for these AMCs are much lower, and this is a very important point that they make. AMC stocks on an average since the beginning of FY26 have given an average return of almost 34%, and despite that, they say that valuations remain relatively well placed as compared to some of its peers, but the key risk here is of competitive pressure, so that's something that we'll have to watch out for. But nevertheless, they highlight that there is a case for valuation re-rating as far as AMC stocks are concerned. Resultantly, the stocks are higher today.
Okay, take that point. Thank you so much, Mamakshi, for explaining that note to us. Flair Writing, that is a stock which is surging in how. There's a note from Ambit. Ria is joining us with those details.
Well, yes, today Ambit has come out with a note on Flair Writing. They've analyzed the fourth quarter FY25 results of the writing instrument players, and they've said that domestic growth has been accelerated while exports have declined this time around. They've also highlighted that the management expects a demand recovery in both domestic and exports going ahead, with growth acceleration in FY26. Apart from this, they've said that margins have been impacted across the board given the rise in competition, product mix changes as well as inflation in raw material. Apart from this, they've also said that with domestic and own branded sales now at 85% of the revenue mix and the addition of high growth segments such as creative and steel bottles, Flair's revenue growth has picked up recently, and going forward, sustained sales are expected to drive re-rating for the stock. They have a buy call on Flair Rating and a sell call on the competitor DOMS Industries, and resultantly the stock is higher in today's trading session.
Well, thank you so much, Arya, for joining us and telling us about Flair Instruments, that particular stock doing very well in the session. Well, if we could look at the life insurance names, some of the names clearly post the data that just put out. There's been a sharp reaction. First up, he started off with Max Financial. That particular stock is doing very well in the session, near the day's highest point. In fact, LIC is taking it on the chin. That stock is now almost 2% lower. In fact, slightly more than 2% lower. HDFC Life, ICICI Prudential, all of these stocks reacting quite sharply. The other set of stocks that have seen a bit of a bounce back are actually the OMCs. So the oil marketing companies, especially IOCL. Earlier today, our colleague reported that there could be a buffer made as far as under recovery of LPG subsidies are concerned, and IOC now at the day's highest point. Some of the banks are under pressure. Look at names like Axis Bank, even some of the IT names, a name like Infosys ahead of TCS results today under quite a bit of pressure. Infosys down almost 0.1%. Again, that particular stock under a bit of pressure. But with that, it's all the time we have on this edition of Midcap Radar Mutual Fund Corner when we return.
Hello, good afternoon. You've tuned into MF Corner on CNBC-TV18. I'm Vinny Motiwala, with me Sonal Bhutra as well as always. So now today we're going to be putting the spotlight on a very interesting topic that's picked up a lot of pace, right, and interest as well, factor funds.
Oh yes, and we've seen that massive rise in their AUM as well, and that's exactly what we are going to be talking to the viewers about as well. What makes it a favorable space, this particular category in the volatile market, the assets under management, they have been increasing rapidly. Right now they are around 35,000 crore rupees. So to talk more about this, we have with us Sanchita Mukherjee, Managing Partner and Mutual Fund Distributor at Talk the Walk, and Nisreen Mamaji, CFP Founder at Moneyworks FS. Ladies, good afternoon. Thank you so much for joining in. Nisreen, we are twinning as well. So, and also we've got a lot to talk about today. Let's get started then. The first question to you is to you, Nisreen. What has led to this sharp surge in investor interest when it comes to factor funds? The AUM has been consistently increasing. How much has it risen by over the last couple of years?
Sure, that's a very interesting question, and yeah, we look very good together on the screen. Basically the, AUM is around 35,000 crores of the factor-based, funds. And it's really sharply increased, especially after 2021, because we started around 1,000 crores and we've nearly reached 35,000 crores. Now, the reason, for why this swing has happened basically is, the people feel, obviously it's very sentiment driven, that there is a potential for higher returns in this category of funds because it, kind of focuses on, say, various factors that can drive the market. So because, the human intervention is not, is taken away from the entire stock selection process, the sentiment is that, this kind of a fund will give you a potentially higher return. Also, in case of, it also provides an alternative and diversification with traditional mutual funds or traditional investment products. So based on that, also people like to, try something new. And this is a fairly good alternative, from the passive side as to what, to the traditional investments. Also, when you're trying to navigate a market cycle, a factor-based fund would definitely add some value because it could, it's potentially able to adapt to different market conditions, and that makes it very appealing to investors because of the navigation point of view. Also, there is increased awareness and accessibility now because of the rise of digital platforms. Campaigns are, running throughout, and this makes the accessibility to a wider audience possible, including for retail investors. Also, there are technological advances actually, which gives you an improved access to data and to advancements in tools like AI and big data analytics. So, from the fund management point of view, also this progression will give a surge to factor-based kind of products. And also, it's a multi-factor approach that a person can adopt. So, if you if you take advantage of a lot of factors, it gives your portfolio a lot of balance and robustness. So that's some of the reasons why factor-based have really done well recently.
Absolutely, nicely summarized. A lot of reasons actually, some of those reasons that are pointed out by you as well, Nisreen. Nisreen as well as Sanchita, good afternoon. Sanchita, anything that you would want to add furthermore to that? And also, in terms of factor investing, does it help investors across different market cycles? Does it evade some sort of risk that you may have due to market volatility? Which factors work in which market cycle?
Excellent question, and thank you for having me. I would just add on to what Nisreen was saying. In fact, I just deep dive into what exactly is factor investing and what are we talking about when we talk about factor funds. So factor funds, as she rightly mentioned, it's a subset of the passive style of investing. So traditional products in the passive style of investing would be your traditional index funds and all of that. So within that, if you were to take a subset, which you define as factors. Now, what are these factors? Factors can be, say, a momentum factor. Factor can be a value factor. Factor can be a quality factor. Factor can be a volatility factor, right? And a factor can be a multi-factor, for example. But they're all a subset of the passive style of investing and not really the active fund management business of the mutual funds. Now, when we're talking about each one of these factors, a single factor may or may not, depending on what the factor is, what the market cycle is, what is the methodology the fund has adopted. Depending on all of that, they may and may not actually perform through various market cycles. For example, momentum factor funds typically tend to do well in bull markets, right? It may not actually do very well in a market which is ranging sideways or going range bound. Similarly, but on the other hand, if you were to look at value factors, if you were to look at volatility factor funds, they typically tend to do better when there is sharp volatility in the market, when there are sharp drawdowns happening in the equity market. Their chances of going negative is actually much lesser than your traditional index fund, right? So therein your returns are kind of protected and your volatility is protected. Similarly, value-based factor funds can perform well when typically the markets are trying to get out of a rut and going on an upward swing. Value can emerge as a good factor to have in that case. However, most commonly used term for factor investing, in something that most investors are comfortable with, are the multi-factor investing, because multi-factor is very, very well balanced, as she rightfully mentioned, and typically tends to look at all aspects of the market in terms of if it's range bound, volatile, all of that.
Take that point. So let's take this point forward. Nasreen, let me come to you. What are some of the factors that fund houses are considering while creating a factor-based fund?
Sure. One can be value, and what it actually means is stocks that appear cheap based on fundamental metrics. Okay, and the kind of metrics that we could be using are price to earnings, price to book, dividend yield, or EBITDA. So if you're using any of these metrics, and if it appears to be cheap, the stock, then it would be considered a value factor. Momentum, on the other hand, is when the stocks have shown, a very recent great performance, and you feel that this is going to continue for a period of time. Now, here the metrics that would probably be used would be 6-month and 12-month price returns, relative strength versus peers or the index. And here the logic is that the capital chases winners in the short term and creates a very positive feedback loop. Okay, so that's what value means, momentum means. Then when you're looking at quality typically means a financially strong company with a high earning and a low debt. Okay, so that kind of a company would be, as per the factor base, would qualify for a quality company. Metrics used would be return on equity, debt to equity ratio, profit margins, earnings, and stability. So if you apply these metrics and you pass all the possible bands, you could qualify for a quality company. Another factor is low volatility. What that means is stocks with lower price fluctuations. Okay, so metrics here that would be used would be standard deviation of the returns, the beta, that is volatility versus the market. And here the logic would be it's a more stable stock which would perform on a risk-adjusted basis, especially in volatile markets. Then you could also have size as a factor, like, say a small cap fund, a small cap tilt. And what it means is that a smaller company has a higher growth potential. And here the metrics would be, probably market cap. So anything below 250 in the market capitalization would be considered a small cap company, and this is a small tilt. And historically, the smaller companies have outperformed larger ones over a longer period of time, of course, because that would definitely be the disclaimer. And it also carries a higher risk. So such a company would be following a factor of small tilt. And lastly, you have a multi-factor strategy where a factor-based investment can be done with not only one, but a variety of the above factors, thereby, completing the entire range and also offering, a safer strategy for the investors. So these are some of the strategies that are typically being followed. Yeah.
Okay, the typical strategies that are being followed over there: value, momentum, quality, then there's size also that comes in as well. But Sanchita, does this, actually turn out to be riskier than those traditional categories that we invest in? And how have factor funds actually performed versus and vis-a-vis a non-factor fund?
Really good question. Yes, a single factor will not perform across market cycles. Now, so that by that logic, you're quite right in saying that are they termed riskier? However, a multi-factor fund might actually lend that bit of diversification and stability to the portfolio. That's for sure. And when we were to talk about performances, let's understand now, factor funds are a subset of the passive investing, right? Now, the mutual fund industry as of 30th of June was close to 74.4 lakh crore in terms of AUM, and out of which the passive in investing itself is close to around 12.11 lakh crore as of 31st of May 2025. Now, within that, within the passive subset, if one were to look at factor investing, it is a small subset. So the returns are really not there across market cycles and outperformance to really benchmark whether in reality they have beaten a tried and tested index fund, for example, a traditional index fund which invests across in the broader markets, or whether a factor fund has actually outperformed across various market cycles. That data is not there for us to say very substantially that this kind of a strategy really works in the long run. Now, when it comes to factor funds vis-a-vis an equity diversified, actively managed fund, that is a different debate altogether. Because there, a factor fund, what it does is it's very rule-based kind of investing. There are a set of parameters, methodology, rules, and like she rightfully mentioned, it is a lot of it is system generated and it is invested in that manner. Whereas in the active funds, in equity diversified active fund space, you have the manager. So on one hand, you have the opportunity to dip into the fund manager's alpha creation, in which India offers a lot of opportunities in alpha creation. Or if you want to eliminate the manager risk altogether, one could look at factor fund investing.
Take that point. Let me come to you, Nisreen. What are some of the factor funds that you would recommend for our viewers?
Sure. So, if you are an aggressive investor and you're aiming for high returns and you want to ride the short-term trend, then a very good fund would be a momentum fund, which is the ICICI Prudential Nifty 200 Momentum 30 Index Fund. This tracks the Nifty 200 Momentum 30 Index. The past 1 year returns have been about 35%. It's a low-cost, consistent performer, and it's great for an SIP or STP for 5 years as well. Then, you could, if you're looking for, also in the same category, the Motilal Oswal Nifty 500 Momentum 50 Index Fund is also a good alternative. Here, the universe is slightly larger. It's the Nifty 500. So it would have mid caps and a small cap exposure as well. Slightly volatile, but good for higher return in the longer term. If you're looking at quality in factor, you could look at, this would give you stable returns, protection in the downturns, and it's suited for an investor with a moderate risk profile. So here, one could suggest the Edelweiss Nifty 100 Quality 30 ETF. And this focuses on companies with a high return on equity and a low debt. Also, historically, it's protected the downside. So, for a moderate investor, this would be great. Also, the SBI Quality ETF, which tracks the Quality 30 Index. Then for the low volatility funds, here you're looking at equity exposure, but with less fluctuation, because that's what a low volatility investor would be looking for. And it's for a risk-averse investor. You could be looking at ICICI Prudential Nifty Low Vol 30 ETF. And this is very good for, say, a retiree or a person with a very low risk profile and conservative equity investor. And, it's especially in the bear markets, it would do very well. Also, the Nippon India Nifty Low Vol 30 Index Fund. It's a newer option, but it is gaining, very steady AUM, and it blends very well with growth funds, in any portfolio. If you're looking at multi-factors, which is combining 2 to 3 factors, like it could have quality, value, low vol, for a very balanced kind of a strategy, you can look at ICICI Prudential Alpha Low Vol 30 ETF. It tracks the Nifty Alpha Low Vol 30 Index, and also it's, has a slight tilt towards momentum and low vol for the risk control. Or you could look at the Kotak Multi-Factor ETF. This tracks the multi-factor index, which is value, quality, momentum, and low vol. So this is a very smart beta solution for a passive equity investor. So these are some of the choices. And, if you're conservative, then go for low vol or quality. If you're moderate, go for multi-factor or quality. Okay. If you're an aggressive investor, go for momentum or alpha and low vol.
Okay. Nice list that you've given over there as well, and viewers will surely, be happy with that list coming in there. But on that note, we're going to step into a very short break, and on the other side, we're going to be discussing liquid versus arbitrage funds and which one is a better option for our viewers. So stay tuned for that. Welcome back. You're still tuned into MF Corner. We still have with us Sanchita Mukherjee and Nisreen Mamaji. And in this segment, we are going to be focusing on liquid funds and arbitrage funds. We've seen that savings rate cut that has come by. So does it make these short-term funds in focus? Sanchita, let me start with you this time. Liquid funds versus arbitrage funds. What is better for short-term?
Thank you so much. It's better than keeping the money in the savings account because both of these categories offer a bit of close to around 1.32% to 4% kind of a differential with the savings account rate. So savings account would be close to around 2.5 to 5.5% in the savings accounts, depending on the bank you're in. Liquid funds slightly higher in terms of their historical indicative returns have been close to 6 to 7.5%. Similarly, with arbitrage funds, 6 to 7.5% historical indicative returns. However, the differentiator would be in arbitrage funds, the tax efficiency sets in because these are equity tax rates which are applied on the arbitrage funds. In the liquid funds, they are taxed at marginal rates. So if your slab rate is lower, actually, you might consider it. If your slab rate is in the highest rate, you might like to park your funds in the short term in arbitrage funds.
Okay. Nisreen, I'm going to come to you. What would you say? Which one is the better one for the short-term liquid funds versus arbitrage funds? And obviously, like, Sanchita and even Sonal was mentioning that, interest rates have gone down. So would it make sense also to start shifting to that short-term mutual fund then, or parking your funds over there now?
So yes, it does, because the differential is in your savings account, as Sanchita has already mentioned. So there is a spread of at least, 2 to 3% or 2 to 4% that you could be looking at by making these small changes in the portfolio instead of leaving it idle in your savings account. So, especially liquid or overnight funds make a lot of sense if you want, the liquidity. And you can have potentially higher returns, keep the liquidity, constraints in place. But you also have to understand the risk. When you're moving from a savings bank account to, say, even a liquid fund or an arbitrage fund, you'd obviously have to, the pros would be that you're potentially higher returns. Spread is between 2.5% to 4.5%. Liquidity is there. Like in an arbitrage fund, you would get your money back after 2 days. In a liquid fund, you can get it back the next day. It's low. It's not very high risk. In a liquid fund, it's also very, very pretty much a safe instrument. You can compare it to a banking product also, but the risk of losing your money or not getting your principal back or not getting the interest back is very low. And also for a very short-term goal, it's a pretty good sense to keep your money in either of the two options. Of course, it depends on the tax bracket that you are in. That's already explained by Sanchita. So, obviously these kind of products are not completely risk-free because there's, you have to understand that they are in mutual funds eventually. And so the disclaimer will always be there that there is no guarantee for these products. If you keep it for a longer period of time, you may not beat inflation. So make sure that you use both liquid funds and arbitrage funds as a parking instrument for a very short-term period. The tax implications could arise in both marginal tax rate for the liquid fund, capital gains for arbitrage. So, it would be also making sense to use a combination of both these strategies and not rely on either. So, whichever tax bracket you are in, if you use a combination of ultra-short duration funds, money market funds, and liquid funds, then, I think that you will, based on your investment horizon and risk appetite, you will be able to match your goal.
Okay, that is quite a comprehensive answer to most of the things that we wanted to cover as well. Sanchita, comment on this. What would your end comments be? Because you have pretty much covered everything and we have around 2.5 minutes on the show as well. So please go ahead and tell us what is the synopsis that you've made of parking things into liquid funds or short-term funds, considering other factors like risks as well, as Nisreen mentioned.
I'm so happy that she mentioned the risk factor because, yes, mutual fund returns and the product itself is not guaranteed. But having said that, it is a wise decision sometimes to park monies into these short-term options and not just keep it lying in the savings, because inflation is very much there. I was just calculating the historical average inflation from 2015 till date is close to 5% in India. So if one were to look at very short term, say less than 6 months, one can definitely look at liquid funds, which are essentially money market instruments. And the taxation on that, although I'm not a tax expert, this is a mutual fund incidental advice that is there. The taxation is close to the marginal rate of tax slab that you're in. So if you're at a lower tax slab, that is an additional benefit that you get by parking the money in a liquid fund, because you get to earn that much more incremental, slightly more, say around close to 2.5% over the savings bank rate. So for sure, arbitrage funds, I would just like to point out one small note that anything less than 6 months is kind of avoidable to park it in an arbitrage. Arbitrage typically performs well from 6 months to 1 year as a bridging fund, right? Less than 6 months, the methodology it adopts. What does an arbitrage fund do? Essentially, it tries to make use of the arbitrage between the cash and the future market by making itself market neutral, not having a long call or a short call or anything of that sort. A market neutral, but less than 6 months, essentially what happens, volatility might set in vis-a-vis even the savings account. So if your horizon is above 6 months, one could definitely actively look at arbitrage funds as a bridging fund.
Okay. So less than 6 months, then do not go for it, right? 6 to 12 months, somewhere at that time period is what one could go for in terms of arbitrage fund. But, with that, we are actually absolutely out of time on this edition of Mutual Fund Corner. So thank you so much, Sanchita as well as Nisreen, for joining with us on the show, explaining us, different factors that come into play for liquid and arbitrage fund and when we should be opting for that as well. And thank you so much for the discussion previously as well. But with that, we'll wind down this edition. Thank you so much from Sonal, myself, as well as the team who put this show together. But don't go anywhere. Up next, we have Closing Bell to take you to the last hour of trade.
Go beyond market headlines to understand the reasons for the day's movers and shakers. And get your portfolio ready for tomorrow. Beaming live from the CNBC-TV18 Motilal Oswal studio.
It's a fairly okay start, if you could call it that, for the Asian markets.
25,331 is the support, 25,669 is the resistance.
The intention here is to wrap up the IDBI Bank stake sale as early as October.
Whether we're a bit too early or a bit too late is irrelevant. We've written our research and we think that the end result is a disorderly collapse.
Unfortunately for Viceroy, they are just 2 years late on this stock.
85 points on the Sensex, 83,600 is where the Sensex is at.
FIs have more options to invest in, and the earnings growth back home in the US is huge.
So expect a muted quarter from TCS.
Now, if we look at the Nifty levels, we are way below that 25,400 mark as well.
The Finance Ministry is considering a fund of 32,000 to 35,000 crore rupees, for which an approval will be sought from the cabinet and the government.
The markets today below that 25,400 mark, in the red, mid caps falling a little bit more, and all eyes on TCS results today.
Well, that was the day so far. Hello and welcome to Closing Bell. We are coming to you live from the CNBC-TV18 Motilal Oswal studio. I'm Nigel, and in a bit, a couple of my co-anchors will join in as well. Well, the markets have been a little bit sluggish today. At one point of time, we were down to 140 points or thereabouts, but we recovered from the day's low. So that 25,300 mark at least has got defended as of now. Tech has come off the low point of the day. So that's one index that, has recovered considerably. TCS, remember, comes out with a set of numbers. Let's see what they'll, come out with, because as of now, expectations are not very, very large. So that's going to be important. And the Nifty Bank as well, yet again, taken support at lower levels and popped up in trade. That said, individual stocks, well, they're doing a thing of their own. Case in point being a Nykaa. That stock, in fact, is up at around the 220-odd mark. So good up move is what we've seen. For this week itself, I think Nykaa has seen a very good move. India Shelter was another stock, I think, that has been seeing good amount of delivery-based buying. It made a fresh high, yesterday itself. And today as well, it had popped up in the green. Last two trading sessions, India Shelter is the stock that I'm talking about. That after the kind of run that we have seen, fund-based action being seen, good delivery-based buying, and she's a little bit optimistic on prospects from here on. That as well is up 1.5%. And JTL, another one from the broader markets, that's popped up in trade. They're talking about expanding capacity by around 300,000 tons. That'll be a high margin business as well that they're looking at. So that explains why that stock is up 3.5%. And if you pull up a 1 week time horizon on the stock, that as well has seen a good recovery. I think it's done a quick 10 to around 15% move on that particular name. Well, that said, let's get in our, our expert, Mitesh Thakur, who joins us. Mitesh, it's lackluster trade, you have to say. Directionless, waiting for a trigger. Maybe it comes from President Trump. Maybe it comes from, the result season itself. But the markets are lacking that trigger. The good news is we're defending lower levels. What's your view? Do you think the markets first want to go ahead and correct a couple of percentage points and then pull back? Or do you think for the time being you look to gradually add on to long positions?
Nigel, I think the idea is that the Nifty, has been very kind of in a contracting mode, and that still remains. If you look at the last about 7-8 days of trading data, we have had highs and lows within this range of 25,580, 600. Sorry, about 25,350, give and take 10 points. So broadly, it's a market which is contracting, and therefore no directional bias is developing on the Nifty. In fact, the volatility indicators are all flat. So I'm still not sure that we'll have some directional bias in the coming few days. What can happen is that there are some moving averages around this 25, 200, 250 zone. So we might test them. But again, till we don't close below them, these levels, I think, I would not be really looking at a corrective kind of a move. So I'm presuming that the markets will be still consolidating and will be in this contracting phase. On the stock side, and we've been trading with more of stock-specific biases, Paytm is something, which has caught my eye. Good breakout here today. So I would recommend buy here with a stop below 924. Look for a target of around 975 to begin with. And the other one stock is on sell side, which is PI Industries. Recommend selling here with a stop just above levels of 1490 and look for a target of around 3960.
Got it. Okay. All right. Thanks a lot for that, Mitesh. Well, let's go across to Ria. I think she's standing by. She's here to tell us about Bharat, the dynamics. The stock is in focus after Motilal Oswal note. Ria, tell us what's in the detail.
Well, yes, Nigel, today Motilal Oswal has come out with a note on Bharat Dynamics. They've initiated coverage with a neutral rating and a target price of rupees 1900, which is a 4% downside from yesterday's closing price. Now, the brokerage has noted that BDL's revenues have been impacted in the recent past, largely due to supply chain disruptions and also challenges in sourcing critical components, particularly from Russia and Israel. But now they believe that these headwinds are beginning to ease out, and they expect a sharp recovery going ahead. They're expecting a revenue CAGR of about 35% over FY25 to FY28. Margins are also seen holding steady in the 24 to 26% range, while operating performance is also set to pick up meaningfully going ahead. EBITDA and PAT are estimated to grow at a CAGR of 64% and 51% respectively over the same period. Now, apart from this, the report has also highlighted a strong order book visibility with an existing order book of about rupees 22,700 crores and an order pipeline of 50,000 crores going ahead. And this is including large deals like QRSAM and the upcoming emergency procurement orders as well. Now, on the macro front, the company is well positioned to benefit from favorable defense sector tailwinds, be it the rising global defense spend, growing exports of Akash missile systems, or the ongoing collaborations with DRDO. That said, valuations do remain a sticking point for the company, currently trading at 70 times the FY26 estimated earnings, and hence they suggest waiting for a better entry level for the stock. So on the back of this, the stock has been under some selling pressure today. And apart from this brokerage note, there is another piece of news flow. A report from a Brazilian news agency, the Rio Times, earlier this week revealed that Brazil has dropped their plans to buy air defense missile systems, which is the Akash missile systems from India. And they're now negotiating with Italy for a more advanced system, and this is according to official government sources. So on the back of this, the stock is trading lower by around 4.5% today.
Got it. Okay, all right. Thanks a lot for that, Ria. Bharat Dynamics, not too dynamic in today's trading session. Deven Choksi, MD at DR Choksi FinServ, joins us on the show. Deven, good afternoon. Good to see you. And as always, defense stock, right? You can't keep them out of the radar, either for good or, for not so great things. The pathway is clear. There's plenty of potential for all these companies. India-focused production is going to be something that the street is going to be looking forward to. And defense spend is going up, not just in India, globally as well. What's your view on Bharat Dynamics? The stock's under pressure post that note, but will you be looking at this dip to get into?
Yes, good afternoon, Nigel. Well, I think everything is in price today. If you look at the trail P is about 125.26 for this particular stock. So valuation is fairly scaled up. Even if you have to assume the growth, and I think based on the growth, I think we provide, the rationalized P. Still, we are talking about 60-70 times price earning ratio on the growth itself. In my viewpoint, I think the higher amount of growth is definitely expected. But at the same time, I think the valuations have scaled up. Probably the upside gets limited, at least in the near term. Unless we see some kind of a price correction, I think we will not be able to justify this kind of valuation. Having said that, the fundamentals of the business remain absolutely convincing. I think one is sold completely onto it because government is spending big time money onto it, on the defense orders, etc. And at the same time, I think some of the export markets have also opened up for many of these companies. So in my viewpoint, I think while the fundamental story remains intact, I think the valuation is one thing which one will have to be mindful about.
Got it. All right. Deven, what about the capital market plays? What do you make of them? BSE from the highs has corrected close to 20%. NSE in the unlisted market as well, it saw a big run, pull back a little bit. And today we had, the Metropolitan Stock Exchange MD, who was sounding very optimistic. She was talking about 10 to 12% in the cash market, something that the BSE as well hasn't done after so many years. What's your view on the stock exchanges?
I think in a way, this kind of disruptions are required in the industry. I think one segment of the market was probably overriding the entire capital market segment itself. And as a result of which, I think the lopsided derivative market, either with BSE or NSE, I think has been creating a disproportionate situation, which was not in the best interest of the market either. As such, I believe that in the near term, there is going to be some amount of impact on the volume. But over a period of time, I think the volumes will get rationalized. I think the participants will start coming back into the markets. And I don't see too much of a problem on that front. So maybe, yes, I think with the scaled up valuation, these companies are having some amount of price correction, which may be natural at this point of time. But overall long-term prospects, I remain distinctly convinced about the growth prospect going forward for the all intermediaries, including the stock exchanges.
Just one factor, and Surbhi has joined me as I promised that my co-anchor will appear at some point of time, and she has. So we are just looking at the BSE data, the average turnover per day on the option side, that's back down to the January 2025 levels. So we've seen a sharp pullback, the Jane Street fiasco that's playing out, various other regulations as well in place. So after moving higher, I think it's down closer on 30% from the recent averages. So that's the kind of volume dip we've seen on the BSE. And I'm guessing it's across exchanges as well.
No, absolutely. And this is exactly what we were discussing on Editor's Playbook this week. In fact, do check it out. It'll be available on CNBC-TV18 Access soon enough. And on the Playbook, we were talking precisely about this. All this regulatory action, the talk of losses in the retail segment, 91% people losing money, plus the whole Jane Street episode, and the tightening regulations. In the last 6 months, since regulations started getting tightened, both NSE and BSE, overall options premium has been coming down. And it's coming down at an individual trader level as well. So definitely some sobering effect seems to be playing out. But just to complete the point, Deven, you said that you think long-term, the story is still intact. Which would be the 1 or 2 capital market stocks that you like the most?
See, I think the number of demat accounts are likely to increase. And I think that is where probably our eyes are on both CDSL as well as NSTL. In particular, CDSL, because I think the retail focus of CDSL is much higher. So I think that is one play, which is something looking very interesting from an investment perspective. Of course, I think in the near term, price is already reached. So obviously, you are not getting too much of headroom. But if market gives correction for a variety of reasons, then in such situation, like so CDSL could be, a good choice to add into the portfolio. And subsequently, I think if the stock exchange prices are also coming down, then also I think it will be a good opportunity to buy, because we believe that this particular breaks which have been applied on the option is basically trying to rationalize the markets. Should that happen and the segment players, find the niche, I think they will come back on the volumes. So we remain relatively more positive on the prospects going forward.
Okay. All right. So positive on stock exchanges as well as on CDSL. Got that. Actually, we'll stick with the financial space and now talk about some of the power financier stocks. Both PFC and REC have been up and about in today's trading action. They were up 2-3% last time I checked those stocks. Gaurav is joining in. There's a Morgan Stanley note that is sounding a little optimistic on this space. Gaurav, tell us more.
Well, yes. Power financiers, it seems that they haven't lost their charm yet, because now Morgan Stanley has initiated a note. For PFC, they have given a target price of 508 rupees, and for REC, they have given a target price of 485 rupees. For the last few years, what we have seen is that if we compare the performance in the last 9 months, the performance have been underperforming if we compare it with the past data, and that is the reason why they are now initiating with a note saying that from here on, the companies can grow at a loan CAGR of 12% on a year-on-year basis, and this can also translate into ROE somewhere in the range of 17 to 19%. Considering all these factors, even if we look at the valuations, now Morgan Stanley believes that the valuations are in a favorable terms, and the reason being that company have been showing a very stable asset quality. They have been paying dividends somewhere in the range of 4 to 5%, and at the same time, even if we consider 12% loan book growth, it seems that the risk reward is compelling, and that is the reason they have initiated with overweight rating. As a result, when we look at stock performance, both the stocks are up in trade today. So definitely a positive note coming up on power financiers from Morgan Stanley, and stocks are also reacting positively on that.
Got it. Okay. All right. Thanks a lot for that, Gaurav. Deven, you heard him. PFC, REC, they went out of fashion for a little bit, but then they come back. What's your take?
I think the entire power story remains absolutely sold, completely, convincing for next 5 to 10 years. Government is again, the main spending organization in building the entire power infrastructure, both the generation as well as the distribution infrastructure. And in my viewpoint, that's where these two companies are definitely, emerging stronger. Because on one side, the new projects are coming up, they are lending money. They are buying money at a relatively cheaper cost. They are lending at a reasonably high growth rate. Between 12 to 14% kind of a CAGR growth rate in the AUM is, being expected. And at the same time, valuation-wise, if you look at it, 1 to 1.2 times kind of a price to book value ratio is something which is not expensive for this kind of businesses. So when you are looking at the business, I think from a stability point of view, I think this is a time probably I think to buy into some of these neglected ones into the portfolio.
Got it. All right. I wanted your view, Deven, on Vedanta. But let's run you through the details first. The question is debt still a concern for listed entity Vedanta Limited or its parent Vedanta Resources? Well, Viceroy Research, they certainly raised eyebrows with the explosive allegations. But Vedanta's rebuttal is clear. They are saying that this is just propaganda. Interesting to see what exactly is the truth. But for the time being, let's just focus on the numbers and break it down for you. Vedanta Resources, the parent company, well, they've reduced their debt by over $4 billion in the last 3 years. Earlier, it was at around $8.9 billion. It's down to around $4.9 billion. Now, that's quite a bit of deleveraging that they've done at the parent. The company has said that they're not stopping there. They've already guided another $3 billion of debt reduction in the next 3 years, out of which $1 billion is done. What's better and what's more positive is the way that they brought down the average bond coupon by around 250 basis points. They've also stretched the maturities all the way to 2034. That's good. Now let's focus on Vedanta Limited. You know, we were earlier talking about Vedanta Resources, now Vedanta Limited. Despite the big capex that they're undertaking, the debt actually has declined to around 53,250 approximately as of end of last fiscal. And more importantly, leverage is at its lowest we've seen in the last 9 quarters or so. The net debt to EBITDA at around 1.22 times. That's pretty good. The company is also guided for $5 billion of cash flow pre-capex. That's in the near term. The street as well is hoping for dividends in the vicinity of around 20 to around 25 rupees per share in FY26 and FY27 as well. That'll be good for the shareholders. It'll be even better for the promoter entity because promoter entity gets majority of the dividend. So Vedanta Resources can then service its debt. So the question is there smoke? Maybe. But is there fire? Maybe not. If the management actually walks the talk and the demerger clears the regulatory hurdles, which is going to be very important, the market may just start looking past, the past controversial legacy of the company and instead focus on the fundamentals, which could look up from here on. I, in fact, questioned Mr. Gabriel, the co-founder of Viceroy Research, who had come out with that report, and also Rakesh Arora of Go India Stocks. This is what both of them had to say.
Vedanta Limited, let's say, it doesn't have the capacity to cover the interest costs of Vedanta Resources. So whether that will create an eventual default, or whether the possible impairment of billions of dollars of Vedanta Limited's assets will lead the creditors to call that debt, that's anyone's game. We're here to report it. Whether we're a bit too early or a bit too late is irrelevant. We've written our research and we think that the end result is a disorderly collapse. We think that, Vedanta Limited has been overly promotional in the ability of its business and the ability of its operating assets, which that have been largely overstated.
Are you done with the report or will you have more reports coming out on Vedanta?
Oh, we have more.
Unfortunately for Viceroy, they are just 2 years late on this stock. Vedanta Resources already delivered quite a bit from around $9-10 billion to around $4.5-5 billion now. And now servicing that debt is not a challenge at all. Number two is that, Vedanta itself has gone through this whole exercise of demerging, and all the lenders have looked at individual entities on their leverage, on the, whatever the liabilities are. And clearly, they've approved this. So clearly, all the entities are self-sufficient. Otherwise, this kind of approval cannot come from lenders. Vedanta stock is largely dependent on aluminum outlook. And aluminum outlook has been pretty strong and doesn't look to be weakening anytime in future. They are also getting a little bit more of backward integration in form of bauxite mine, coal, their own captive alumina. So things are looking better only for them. So I don't think fundamentally there's any reason that performance would deter. Vedanta has been has done phenomenally well actually in the last 2 to 3 years. Meaning, if you had asked me in 2021, I would not have been able to gauge this kind of turnaround that the management has been able to achieve. And things are only getting better from here.
Okay, two opposite views out there. Viceroy suggesting that at some point of time there'll be a default. Rakesh Arora suggesting that this report would have been valid actually a couple of years ago, but they've got their house in order. The stock actually has recovered considerably from the low point of the day yet again. Deven, which side of the argument are you on? We know the promoter entity has a sketchy past, but how much of that is in the price? And reports like this, when you have a biased position, it's very interesting to see the kind of action you see post that. Your take.
In fact, I think each and every business is, be it zinc, be it aluminum, be it oil and gas, I think they have been cash-generating businesses and significantly large cash-generating businesses. The debt coverage also, I think, is reasonably under control compared to anybody else, I think, in the world that you may want to look at it. I think they are probably in one of the best metro cycle that I think one is talking about and likely to be in a better cycle, I think that we're talking about. Debt cost is coming down. They are repaying their debt. They are never defaulted in the payments. I think this company deserves to be once again de-rated because I think the valuation-wise, if you look at this company, on a trail basis also, I think the company is quoting it around 11-12 times price-earning ratio. I think EV/EBITDA is compelling. So in my viewpoint, I think the business-wise, this company deserves to be re-rated. Demerger is an overhang. I think once that gets completed, in my viewpoint, I think individual parts would probably start showing up significantly large valuations at some point of time. So we remain committed, I think, on investment, and we believe that I think it's a wait, I think, for the time being for selling this kind of a company from the portfolio.
Okay. That is Vedanta making it to the headlines today. Well, the market's down 90 points, so the move is decidedly lower this afternoon. That's what we're seeing. The mid-cap index is also lower by about 0.3%. So range-bound, but we've been grinding lower now in the second half of the week over Wednesday and today. That's been the story. Mid-cap index relatively better. It's trying to bounce from the lows. Let's see how it plays out. Well, Deven, we'll let you go on that note. Thank you very much for joining in and giving us your perspective on all the themes that we've discussed. Let's take a quick break. We'll come back on the other side, keep tracking the market, and we'll also have Pathik Gandotra joining in with some views.
investing.
Welcome back. Well, the market continues to grind lower slowly. It's not a big fall or anything. The last two sessions, they have been, that just a very slow decline. Pathik Gandotra, partner at Drone Capital Advisors, is with us. Pathik, thank you so much for joining in. Good to have you on the show. So what do you make of things, first of all? What resilience? A decent run up through April and May when all the tariff news was coming through. And now we've gone into a bit of a slumber zone, or basically it's just, a bit of a logjam. Do you expect this time correction to last longer? Could it become a price correction? Or do you expect a quick turnaround again to the highs?
No, so I think it's in a wait and watch mode, because obviously the news that is hitting the markets is mixed. On one side, interest rates are falling locally, and that's going to bolster credit growth and good for interest rate sensitives. On the other hand, there is mixed news on the tariff front, where although your deal, our deal is still hanging in abeyance, but a lot of our competitors in exports have been hit with much higher duties. So obviously that to a certain extent helps us. So there you are there. And also I would like to say that the way at least currently, the way the duties the US has imposed, it appears that all the smaller countries which cannot actually bridge their deficits with the US are being penalized or are being put to higher duties, and which is where we have a sustainable advantage if they use this method of calculation. So whatever our number comes, I think eventually we should be in a good place.
So
I think market is sharing that. I'm sorry, I'm saying market is sharing that optimism, and that's why it's holding on.
Correct. All right. So garment exports is something that you continue to bet on, right?
100%.
Yeah. And what about EMS plays? That's another segment. I think a few months ago or so we had discussed there's plenty of potential. Some of those stocks have done very well. Is there a longer roadmap for them?
Of course, there's an extremely long roadmap for that, because EMS as a business, India is gaining, from doing small assemblies, we are trying to do more work in-house, and more work is getting done in India, and the margins and the value addition that the Indian EMS companies are doing is going to increase. The TAM is extremely large. The point is, as you said, stocks have run up to multiples which are fairly aggressive. And so you might go through a time correction, I don't know, months, years, I can't say, but eventually earnings will catch up, and then you have obviously the long road ahead. So, or all of these companies get into some more areas which are extremely high growth, and then the multiples sustain. So one of the two things will happen, but for the time being, I guess a lot of the run has already happened, and it's time for a healthy correction, either in price or time.
Pathik, you in your initial comments, you spoke about the central bank here in India cutting rates. So various ways to play it. You either play the real estate players, you play the housing finance companies, or you play other beneficiaries like the NBFCs, because their cost of borrowing itself, will go down. It will help them in terms of growth as well as some cushion on the margins. How do you play this theme? Because RBI clearly is in the mood to push up the economy. They've made the intent very, very clear, and we've already got a couple of rate cuts.
Correct. So more than the rate cuts, there's also plenty of liquidity in the system.
Yeah.
That obviously helps borrowing costs of people who borrow wholesale, which is where NBFCs borrow wholesale. And so you see that getting reflected into any stock price. Now, credit growth is picking up, but it has still not picked up to the level which the RBI and obviously we expect. That might take a bit of time. But the point here is that market always prices things ahead of time. So the issue is the NBFCs are a very good place to be. Housing finance companies, I would go for more of middle income housing kind of companies. Those are companies which are doing well, affordable housing kind of companies, where the growth is still stronger than the basic housing loan growth. Those are interesting plays. Real estate, of course, there have been a recent sluggishness in the past. I think that's got a bit to do with the uncertainty in the markets as well. And so once the market stabilizes, I think real estate is a fairly medium-term story where you can get interesting companies.
Okay. Got that. Pathik, in this earnings season, obviously the hopes are also pinned on the consumer space. Mass level consumption, whether it is through QSR or whether it is staples, FMCG, etc. What has your positioning been here? I mean, most people in the market have been underweight. But now it seems that there are like hopes really rising.
There are a few one-off plays here and there, but otherwise, consumer companies are still fairly expensive, and the growth, even after the revival, is not strong enough to justify the multiples at which they are trading. So yeah, they might give positive returns from here on, but I think they'll be better and stronger plays than those. So I would be extremely selective in the consumer space.
What about IT services? When we're starting off the earnings season with TCS today, obviously we all know that they're expecting revenues to fall, constant currency revenue. So unlikely to be a very hot quarter. Do you like anything in technology?
Again, that all these things depend upon the way the India-US relations work out, and the growth in the US itself works out. Because if the whole tariffs that the US is putting turn out to be inflationary, and the US consumer bears them, it'll have a ripple effect down the economy, and which might hit growth somewhere. And that's the problem. That's the problem with IT services. So that is it's too early to say. I would obviously, given the fact that the growth, I don't think the market also expect very strong growth in the next few quarters. I think the sector is best left to neutral or slightly underweight, what I would say.
All right, got it. Pratik, what would your allocation be today? Give and take the uncertainty globally. Earnings could be a little bit softish to start off with. For the year, though, the hope is low teens growth. Give and take that, what kind of equity allocation would you do if you had, some allocation strategy? How much would you deploy to equity? How much would you hold on to? And if you're looking at other safer havens, what would the split be?
Look, we manage our own capital, so it's almost 100% equity at all points in time. Although we have taken some cash and put some investments in gold. That's been one of the things that has happened last year. About 8-10% of our portfolio we put into gold, and so that has done well. But apart from that, we don't sit on cash for very long. There are always lots of ideas available to buy, and so that's where we are. So this is as good of a risk-averse thing that I will do. That some 10 to 15% of your portfolio could be alternate assets like bullion.
So Pratik, to recap, what do you like the most in the market now?
Exporters, without any doubt, like all exporters, which I think will do well, because I think what's happening here, if you see, is there is an FTA signed with the UK, there is a FTA being planned with the EU, which actually will be again a game changer, and the US trade treaty will work to some. It may not be as favorable as we think, but will not be as punitive as it was on April 2nd. So some midway compromise will be reached, which will still be positive for India, because the other countries are getting taxed at much higher rates. So all the three big markets are open for you for a very, very long term. So exporters, I think, are the way to go. That's where one should have a very decent allocation, is what I would say.
All right, Pratik, appreciate you joining in. Thanks a lot. We look forward to chatting up with you. Hopefully, by the next time we do chat, we'll have some clarity on the global piece. But as you've told us, exporters is something that you like. Good chat as always. Well, time to slip into a short break. But on the other side, Nimesh is waiting for us. D-Street Chatter will fill us in with regard to what's going on in the markets as well as individual stocks. And technical experts will join in as well. They'll tell us a couple of trading calls. Don't go anywhere. Welcome back. You're tuned in to Closing Bell. We are coming to you live from the CNBC-TV18 Motilal Oswal newsroom. Well, that said, Nimesh is standing by to help us out with an insight into dealing room. Well, Nimesh, directionless, waiting for that trigger to play out. Market still in the band. Tell us, what are you picking up?
Absolutely right, Nigel. It's been a very, very narrow range for the markets in the last couple of days. Basically on a couple of things. One, there are no fresh triggers for the markets, and also there is a lack of institutional support. If you look at the institutional data for the last many days, X of block deals, it's hardly any participation coming in from the institutional investors, both FIs as well as JIs as well. Even in today's market, it's quite mixed with a bit of a negative bias. But I guess the selective buying in PSUs continues. So that's one space which has seen a bit of interest from large institutions. One day you'll see OMCs. One day today you're seeing the power finance companies doing good. So that rotation continues. But PSU is something where there is a bit of flavor and a bit of interest as well. I think the street is going a bit nervous into the TCS earnings. Most of the IT stocks are down. The index is down 1%. And there is generally a concern about how the earnings are going to pan out for the IT companies. So a bit of nervousness ahead of the TCS earnings. So that's going to set the tone for the IT stocks. But relatively, broader markets have actually been outperforming in the last couple of days. It's not showing up in the index, but there are a lot of individual stocks which are buzzing on a daily basis. Even today, there are so many stocks which are up 5, 7, 10%. And the breadth also suggests that there is a bit of momentum in the broader market stocks. It's the Nifty and the Bank Nifty where there is a lack of participation and lack of trigger, which means that we've been pretty much range bound in the last many days.
Okay, so that's the overall market sense. Nimesh, what about individual stocks? What's buzzing today? What's in news?
Well, the first stock on my list is GMR Airports. That's been buzzing for the last couple of days, and it's backed by good institutional buying. I understand a couple of large long-only funds have been active buyers in the last couple of days. And remember, for GMR Airports, there is an order, a court order, which was supposedly positive for airport companies like Adani Airports as well as for GMR Airports. So we've seen that bit of playing out in terms of institutional buying there. The second stock is Jyoti Structures, a small stock. We normally don't talk about it. Yesterday the stock was up. Even today the volumes are on the higher side. But I understand, interestingly, one very large influential HNI investor has been selling out of Jyoti Structures in the last couple of days. So that's a trigger there. The third stock is IKS. We saw a large block a couple of weeks back. Again, there is an indication of a large block coming soon in IKS. So that's the third name. And the last is Varun Beverages. We saw a couple of upgrades as well coming in of late. But periodically, there has been selling from larger institutions into Varun Beverages. So expect, even in today's market, expect high delivery volumes on the sell side in Varun Beverages.
Got it. Okay, all right. Thanks a lot, Nimesh, for joining in and helping us out with that neat list. Mitesh Thakkar is back with us. Mitesh, you've got a couple of trading calls for us. Please go ahead.
Angela, I have a STBT on Bajaj Auto with a stop at about 83.10 for targets of 82.20. And there was stock of this power finance company. So REC is on the BTST list. Keep a stop below levels of 395. Look for target of 402.
Okay. All right. Got it. Thank you very much, Mitesh, for all the trading advice today. You have a good rest of the evening, and we'll catch up again with the markets tomorrow. Now, as far as this evening goes, it's going to be a busy one because TCS kicks off the Q1 earnings season. And it's expected to be a quiet quarter for the IT giant because constant currency revenue growth is expected to decline 1.4% quarter on quarter. Rima's here with the detailed expectations.
So as you rightly pointed out, expect a bit of a muted quarter. Dollar revenue growth is seen up 0.6%, but constant currency revenue growth is expected to decline by nearly 1.5%. The reason you're seeing such a disparity in the dollar revenue growing and the constant currency declining is on account of the currency move. So there's been a sharp depreciation of the US dollar versus some of the other currencies like the pound, the euro and the yen, and that explains. But in constant currency, that's the main number that we watch, expect a decline of nearly 1.5%. Margins are likely to be flat on a sequential basis. Remember, this time there were no wage hikes. Typically, the company gives wage hikes in Q1, but on account of the uncertainty, they had deferred it. And the reason why the revenue is expected to be weak is because compared to the prior few quarters, the BSNL contract is ramping down. And the question that analysts have on the margins is that as this BSNL contract ramps down, and BSNL had low margins, some analysts estimate just single-digit margin. So then why aren't the margins expanding? Because our poll throws margins to be on the flatter side. Now, what will you watch, the growth X of BSNL, the international growth, because analysts say that despite good deal wins, the growth has been pretty muted for the international business. Secondly, timing of the wage hike because it was deferred from Q1. And thirdly, the deal wins.
Okay, and of course, you'll catch all the action with the TCS top brass, of course, being led by Mr. K. Krithivasan, CEO and MD of the company. The action starts at 5:30 p.m. Of course, that's the press briefing. The numbers are expected any time after 3:30 p.m. That's TCS in focus. Let's move on now. We've got another sector that we're looking at, and that's housing finance. There is a Bernstein note that's putting the spotlight on housing finance companies. We've got Gaurav back. Gaurav, tell us what's Bernstein saying. Do they like any stocks?
Well, yes, Bernstein is being a little bullish on housing finance stocks, specifically Home First Finance, Aptus and Aadhar, because they have initiated with outperform rating. And the reason being that in this pack also, they have actually given outperform rating to Home First Finance because they believe that the company has ability to consistently replicate its operating model across the segments, and at the same time, because of the smaller size, fastest growth and superior productivity, they actually prefer Home First Finance. Other than that, for Aptus, what they say is that the company has high share in the fixed rate loans, and that is the reason why in an environment where the interest rates are falling, this company can actually gain in trade today. Other than that, Aadhar is also in focus, and the reason being that what they're saying is that company has largest and most geographically diversified portfolio, and that is the reason why they like this company. On the other hand, let's also talk about Aavas and PNB Housing. They have actually initiated with market perform rating in these companies. For Aavas, what they're saying is that company actually lags its peers when it comes to yields and profitability, and that is the reason why they have initiated with market perform rating. And for PNB Housing, they have initiated with market perform. The reason being that even though they like the business, how they are actually diversifying into small ticket size loans, but the aggressive expansion is something that they are concerned about, and that is the reason they have maintained their market perform rating. All in all, on the back of the note, we are seeing good traction in all these stocks. So definitely watching out on these counters in the coming days as well as how they perform for investors.
Got it. Okay, all right. Thanks a lot for that, Gaurav. Let's focus on the insurance space. The June life insurance data has been largely a mixed bag. Yash joins us to fill us in with some details on that front. Yash.
Well, of course, Nigel, as far as the sector is concerned, it's a mixed bag which has come through in the month of June. But, a special mention to one company which has been consistently performing. And in the month of June, also the performance has been very, very strong in terms of numbers. No matter what parameter you look at, the numbers have been very strong. And what makes it better is that the strong numbers have come on a very strong base that was in June last year. The company that I'm talking about is Axis Max Life Insurance or Max Financial Services. Very strong numbers on a strong base, as I said. June new business premium collection grew by 21%. First quarter premium collection grew by 22%. June total AP, that grew by 25%. And June retail AP also seeing a growth of 22%. For HDFC Life, modest growth, but on a strong base. June business premium collection down 6%, first quarter growth at 15%, June total AP growth at 8%, June retail AP growing by 12%. ICICI Prudential Life, the growth has been weak in the month of June. And, the disappointment is that weak growth has come on a favorable base which the company had. So June total premium collection growing by just about 4%, first quarter growing by 6.5%, June total AP growing by 11%, but the retail business is what is hurting the company in the month of June. June retail AP, that has contracted by 10%. SBI Life, it's a healthy growth on a strong base which the company had. June new business premium is down 13%, but the first quarter premium growing by 3%, June total AP growing at 10%, and June retail AP growing at 14%. Finally, LIC, it's a weak growth for the company in the month of June and on a modest base. June new business premium, that is down 3%. First quarter premium up just 3%. June total AP down 9% and retail AP growing by just about 2%.
Okay, all right. Thanks a lot for that, Yash. Well, Finance Minister Nirmala Sitharaman called on NBFCs to significantly scale up their role in the financial system. Speaking at a conclave, Sitharaman said NBFCs are no longer shadow banks, but systematically significant entities. Let's listen in to what she had to say.
You should aim to reach at least 50% of the total volume disbursed by scheduled commercial banks. Not a big number, considering in the last 4 years, you've doubled, 24 became 48. You can do it even now. So, as India moves forward, NBFCs will have a key role, no doubt, in meeting the credit needs of the future, including in areas like green initiatives, affordable housing, and MSMEs. To reach, and the reach that you have is the biggest strength that you have. By 2047, at least 50% of NBFC credit should be directed towards high growth and high impact sectors. NBFCs, I want to tell you in front of the Department of Financial Services Secretary, you're no longer shadow banks. The stronger regulations and oversight is the best testimony. The stronger regulation and oversight is the best testimony of your importance in the financial system and the broader economy.
Okay, all right. That was Finance Minister speaking about NBFCs and their role in boosting lending, to larger extent. Well, Amrish Baliga is joining us on the last leg of Closing Bell today. Amrish, good to have you on. Actually, since we were just playing out those sound bites, you tell us, NBFC stocks, what would your favorites be?
NBFC, I really don't have too many favorites because I still feel that on the retail end, there could be more sort of NPS coming in. I think that should be a pain area for most of the NBFCs going ahead. So I would be a bit careful at this point of time. Whereas when it comes to banks, yes, I'm clearly positive, both on the PSU, the large cap banks, as well as the private sector, the larger ones.
All right, Amrish, but normally when you join us, you give us that one stock that you're looking at. And this time it's from the auto ancillary space, Sona BLW. Tell us the rationale of that.
See, that's a leading automotive technologies play with which actually designs, develops, and manufactures highly engineered automotive systems and components. About 74 OEMs, they are the customers. That's across India, Europe, US, and China, and both electrified as well as non-electrified powertrains. 11 state-of-the-art facilities in India, US, Mexico, and China. About 39% of the revenue comes from EVs and 20% is from hybrid. So basically, it's a future-ready model, a de-risk model. And they had taken over Escort's Kubota railway equipment division, which is basically a leader in railway brake systems. So this is one diversification which they made. Q4 revenue was flat. The margins were also maintained, but the stock had corrected. So I think that's an opportunity. Looking at the strong order book position, which is about 24,200 crores, in which EV-related orders is about 80%. And among the fastest growing auto ancillaries, PAT CAGR expected about 25% over the next 3 years. And now clearly diversifying into other areas. I think one of them clearly is the components for humanoid robots. I think that's a large opportunity going ahead over the next 4-5 years. So expected EPS for FY27 is about 14. And with this, my target price is about 624.
Got it.
Okay. Amrish, by the way, we were just discussing Bharat Dynamics, where there's a Motilal Oswal note. They like the stock, but they're not too comfortable with the price, which is why their price target is lower than where the market is, the CMP is right now. Overall as well, defense stocks are cooling off. Today is a day of correction in defense. Would you use the dip to buy anything, or would you stay away given the valuations?
See, if you look at the defense space for the next 5 years plus, I think most of the stocks should be quoting at much better levels than where we are today. Maybe, you can easily be getting about 20-25% sort of CAGR returns. But then, is it the right price to get in as of today? Because, due to the geopolitical issues which I have seen in the recent past, the sentiment have turned extremely positive for the defense stocks, and most of them have run beyond their fundamentals if you see from the current point of view. So I would surely wait for a correction. I think a decent correction may not be as much as what we have seen from, in 2024 and early 25. But then I think we can see a correction of either 10 to 12% more from here. I think that should be a good level to start getting in.
All right, the macro trigger for the Indian economy as well as the markets is that India actually has de-risked itself with regard to the oil price spike. Given the kind of subdued oil prices, what's your view on the OMCs? Input cost for them is soft, so good for their margins. We have state elections that are a few months away, so all probability the margins could remain healthy, even if in case there is a couple of hikes that come about. So we'll have to see how that goes. But what's your view? Valuation's okay? It's a tactical play. Anything can take place. But do you like them?
See, clearly, I think oil prices are on the way down. And we are still getting better levels because of the Russian oil, which clearly is positive for the OMCs because, I mean, what we are seeing on the retail price level, we have not seen any changes at all. And I don't see any changes happening, at least in the near future. In the sense, I don't think there'll be any downward revision of the retail prices. I think the only joker in the pack is the excise duty. Because we have seen excise duties being increased when the prices have fallen, especially when the oil prices have fallen. So I think that's the only joker in the pack. But in case there are no excise duty hikes, I think it's extremely positive for the OMCs. And even at these levels, I think one could be looking at buying something like a HPCL and an IOC.
Okay. All right. Got it. We have to take a very quick break. Amrish, stay on. We'll come back and then get more on the markets with you.
Well, the expiry-related move actually is to the downside. The Nifty is now moving closer to the low point of the day, 25,350. Defending that. By the way, we have some comments that are coming out from Mr. Anil Agarwal. The AGM is on, and they have, we have managed to source a few highlights from there. They're saying that demerger is on track. They remain committed. Last year, in fact, it delivered record numbers. This year, it's looking even better. Stock recovering a little bit from the low point of the day. That said, let's get you some global opinion then. Few voices carry as much as weight as Jim O'Neill, the economist who coined the term BRICS. Earlier today, we spoke to Jim and asked him about Trump's tariff on BRIC nations and the talks of de-dollarization. Let's hear him out.
Each time Trump says something about the BRICS, I'm both amused and even more confused than I am when he talks about many other topics. I sometimes wonder whether he actually really knows who's part of the BRICS and who isn't. In my judgment, the BRICS haven't really done anything. So I'm not sure Trump's statement ultimately is going to mean one thing or another of any great relevance, other than the fact it gives the BRICS greater attention, which I would have thought is the last thing that Trump was trying to do, or should have intended. But such is the strange world of life under Donald Trump. The whole idea that the BRICS countries can realistically jointly develop some alternative currency to the dollar just doesn't really make much sense whatsoever. I've spent much of my professional life developing my years during the build-up and the creation of the euro. And everybody knows the difficulties that European countries went through, but it ultimately, of course, required them to abandon their own domestic monetary policies. The idea that big BRICS countries are going to abandon their central banks for some kind of joint initiative on currency, it's like some kind of fantasy Netflix movie, really.
Okay, that is a view from a market veteran, Jim O'Neill. He's seen many markets, many cycles over the course of many decades. So that was an interesting conversation. By the way, as we're closing down on a quiet day, slightly negative day, Glenmark Pharma is still retaining that 5% gain. Amrish, Ekta was earlier telling us the market seems to be getting excited by one of the new drugs that is in their pipeline. It's a cancer drug. It's going through clinical trials. So maybe there's some excitement there. But I don't know, do you look at Glenmark? Do you like anything else in pharma?
No, in fact, Glenmark, we have had a look, no doubt. But then the stock has already moved up decently well. I mean, it was around 1,400 levels. From there, we have seen an extremely good move to 900 plus. So at these levels, maybe, from a trading point of view, yes, possibly we could see some more momentum up. But for an investor, I would say possibly wait for a while. Maybe levels closer to about 1750, 1725. I think that should be the level to get in. But among the others which we have been suggesting is still continues to be Lupin at this point of time, and Dr. Reddy is the second one.
Amrish, what about IndusInd Bank? It's holding with a gain of 1.5%. At 650, hindsight says that it was a good buy. But at 850, what is it?
I mean, most of the stocks are good buys. I mean, when you have the advantage of the hindsight. But IndusInd, at this point of time, I would just possibly wait and watch. Let us see as to who the new CEO is. And as and when the person comes in, at least for the next 1 or 2 quarters, there'll be a decent amount of cleaning up happening. So I really don't see a major move, at least for the next 2 to 3 quarters. But then post that, yes, I think once all these things happen, we'll have to take a fresh view at that point of time. But right now, as an investor, I would possibly stay away for a while.
Okay. All right, Amrish. Just stay on. We'll quickly go through the market close.
Just one word, Surbhi. TCS. That's the one you should be looking at. The street is sniffing something, numbers are not expected to be good. Take a look at the stock price, currently at the high point of the day.
Suddenly they're supposed to be good.
Sniff.
Sniff.
Let's see. Pre-positioning basically is taking place. That said, it's almost, the end of the trading session. So let's wind down then. A bit of an expiry-related move towards the last half hour of trade, where the Nifty saw a bit of a pullback. And that's why, in fact, we ended closer around the low point of the day. At the start of the show, in fact, the Nifty was down only 70 points, going home with a cut of around 120 points. What lost out? Bharti Airtel came in for some profit taking. That was down 2.5%. You had Asian Paints down 2%, HDFC Life as well. Keep in mind, all these three names actually have been relative outperformers in the recent past, but today they came in for profit taking. What did well? Tisco, that did well. Tata Steel was up close to around 1%. You have Innocent Bank that was up 1.5%, and Maruti Suzuki as well did pretty well. From the broader markets, then what did well? You had Lloyd's Engineering Works. That one continues to move from strength to strength, up close to around 7% even in today's trading session. So solid up move is what we're seeing out there. Sagility, I think there was an upgrade that came in from IIFL, or there was an initiating note coming in from IIFL. So that stock, in fact, was up close to 3.5%. You have JTL Industries. They've announced a capacity expansion. The stock continues to go with its good form. So that stock is well 3.5% higher. And Jyoti Structure is only a 20 rupee name. But in the last 2 sessions, it's moved from 17 to around 20 rupees. Nimesh told us a large seller is gradually getting out of there. So maybe most of the selling getting absorbed.
You know, beyond the headlines, actually, a fair amount of action in the mid-cap market. And people are accumulating the stocks they want to have. Case in point would be a Lemon Tree Hotels, 8% up on Lemon Tree today. Campus Activewear, 6% higher. Borosil Renewables, 5.5% higher. HPL Electric was electrified towards the end of trade with a gain of almost 6%. So, interesting session. The indices have been grinding lower. The market is overall very quiet, but beneath the surface, stock selection and stock picking is going on as always. Well, with that, the bell is gone. The Thursday's trading action has come to an end. And now we're going to take your leave on this edition of Closing Bell. But do stay tuned because we have Markets Forward coming up next with all the action.
Market fails to hold opening gains. The Nifty and Sensex fall 0.5%. The Nifty gives up 25,400. Nearly 40 stocks end lower. IT, banks and PSUs lead the fall, while realty and metal stocks buck the trend.
CNBC-TV18 learns that Finance Ministry may create a 32,000 to 35,000 crore rupees fund to compensate oil marketing companies for LPG under recoveries. A cabinet proposal may soon be moved for the same, offering big relief to IOC, BPCL and HPCL.
Stocks of select housing finance companies and power finance companies perk up in trade over bullish brokerage commentary. For the last few trading sessions, we've been testing the higher end of the range. Today was the day where we tested the lower end of the range. We opened above 25,500 and thereafter we saw a decline. It's a Thursday. Good evening. You're watching us here on Markets Forward, your go-to show where we aim to get you all the key data points to get up for the next day trading day, while recapping what took place on D Street today as well. I'm Bangla Malu, with me, Vinny Motiwala. Vinny, today was a down day. We were down about 120 points. Given the sort of narrow range that we've been in over the last few trading sessions, it looks a lot more than what it actually was. But all in all, we're at the lower end of the range with 25,355 being where the Nifty is. The only difference between today and the other previous days is that at any point in time, if one was short, one did make money, or if at any point in time one entered a long position, one was losing money. So we opened at the absolute high of the day and we closed at the absolute low of the day. So that's a trend that we'll most definitely keep an eye out on. The other thing we'll be watching out for is the big underperformance that we're seeing on India VIX. India VIX is sub 12 right now, which is nearly a one-year low. With all the uncertainty that is there in the world, if the India VIX is not moving, then maybe is this straight pricing in some sort of complacency or not, is something we'll be watching out for. No problems with the mid-cap index. Yes, it was one give and one take for bulls and bears. We had around 1,400 stocks declining for about 1,245 stocks, which were higher. All set for earnings season, as one would say.
Absolutely, all set for earnings season. We'll start with all those IT companies coming out with their numbers. But yes, that's how the market setup looked like today. But here's what we have for you all on the show today. First up, we'll start with the top movers and shakers of the day with Hormaz, and then talk about few individual stocks, select housing finance companies and power finance companies that were buzzing in trade over bullish commentary. RSE as well as PFC saw a notable gain coming in after receiving upgrades from brokerages, while Home First Finance and other housing finance traded in the green as well. Last but not the least, we'll delve into the key market events to watch out for in tomorrow's trading session. On that note, first up, let's go across to Hormaz, who's here from the big wall to talk to us about the top movers and shakers of the day. Hormaz, over to you.
It was a choppy trading day, to say the least, and even as the broader markets were slightly wobbly, the overall market was slightly wobbly. It was the asset managers that stood out in today's session. UTI AMC had a 52-week high. Also healthy gains for Aditya Birla, Sun Life, and the other AMC stocks too saw gains of up to 2% in today's session. Defense stocks were a bit of a dampener today. Motilal Oswal said they would wait for a better entry point in Bharat Dynamics. It showed on the stock price 5% lower today. And Solar Industries, Garden Reach and Peers too seeing losses of anywhere between 3 to 4% in today's trading session. Some of the newsmakers, a lot of it were brokerage reactions. PFC and REC, the consensus buy among analysts continues with the Morgan Stanley initiation seeing gains today. Prestige Estates, the brokerage commentary after the business update shared yesterday, stock ending higher. Glenmark too awaiting updates on a very important development at the company. And Varun Beverages, after HSBC cut its price target today, the stock ending lower. But stocks that ended at a 52-week high in today's session. And of course, we did speak of Glenmark. When look at Sanatan Textiles, India Shelter, Gabriel, all the usual suspects, they are at a high yesterday and they are building on to those gains in today's trading session. Back to you guys.
Right, Hormaz, thanks a lot for that. Those were some of the top gainers today. We had Lemon Tree Hotels as well, which perked up in today's trading session. Something like an Acme Solar was up 10%, along with Borosil Renewals as well. Let's go across to our guest, Amrish Baliga, independent market expert, as well as Ruchit Jain from Motilal Oswal Financial Services. Amrish, let's start with the IT pack. You know, the index was lower in today's trading session ahead of TCS's numbers. The street is not expecting much. But remember, seasonally, this is the best 2 quarters for the IT pack. With the stocks having underperformed, the NASDAQ having outperformed, the outlook for the US economy not as grim as what it was earlier. Would you hazard a bet on the IT pack? If yes, what would be your case? If not, then what's the case here?
No, I think it's better to wait for the management commentary more than the performance for the last quarter. I think the management commentary would be more important because clearly we need to see as to what sort of order flows come in. And as far as TCS is concerned, I think the wage hike issue is still there. And the margins again could be muted. So I think we'll have to see as to when do we see this uptick in margins and the order flows. I think that is most important to be watched out for. So across whether it's TCS, Infosys, Wipro, I think we need to wait for the management commentary.
Okay, wait out for some bit of a commentary coming in here. Richard, any thoughts just on the market levels that one should be keeping an eye out on? Today, obviously, like Mangalam was mentioning as well, we closed at the lower end of that range that the Nifty has been trading at. So what should we be keeping an eye out on now, as well as on Bank Nifty as well?
I think it's been last 2 weeks where we have seen more of a consolidation in the index. We have not seen any signs of any trended move coming in. Now, we have ended right just above the 20-day MA support, which is around 25,280. So the follow-up move tomorrow would be very important in case if the market breaches this 20-day MA. I think it's been almost 20-25 days we have not seen the index going below that 20-day exponential moving average. Then we could see some more price-wise dip. Otherwise, it would turn out to be more of a time-wise correction before we resume the next leg of uptrend. And I think once we see this time-wise correction, there are many sectors or stocks where the momentum readings were a bit overbought post the recent run-up. That would also get cooled off. So we would watch out for that 25,280 mark closely in tomorrow's trading session. If the index manages to take support at that level on a closing basis, then I think we should see a resumption of the uptrend quite soon. But for now, it seems that we would see some more time-wise correction.
All right, some more time-wise correction as against price-wise correction. Let's get you some more on the IDBI Bank stake sale. What we learned from sources that the Indian government intends to complete the IDBI Bank stake sale by October. Currently, remember, the government has frozen the draft share purchase agreement. Is expected to be signed soon. After this, the government will call for financial bids, and that's not all. They've also given an approval for 5 PSU banks offered for sale this year. While Bank of Maharashtra is expected to meet the 25% public float requirement through a QIP, other public sector banks, namely UCO Bank, IOB, Punjab and Sindh Bank, as well as Central Bank, can also go for the offer for sale route.
Okay. Surely keeping an eye out on those PSU banks as well as IDBI Bank is something that we'll watch out for. But stocks of housing finance companies were also buzzing in trade, and this was on the back of a positive brokerage note that's come in this morning. We had Gaurav joining in with us to give us more details on this one. What is the brokerage note highlighting as well? Gaurav, what are we watching out for here?
Well, yes, specifically from the housing finance space, now Bernstein is being a little bullish on the space. What they have done is that they have initiated a note on 5 companies. For Home First Finance, Aptus and Aadhar, they have initiated with outperform rating, and on this other hand they have initiated on Aavas and PNB Housing with market perform rating. First, let's talk about Home First Finance because this is their preferred pick even from the housing finance segment. What they're saying is that the company actually stands out well because they have demonstrated ability to consistently replicate their business model across the locations, and on the other hand they also have advantage in terms of smaller size, fastest growth and also superior productivity metrics, and that is the reason they prefer Home First Finance. Other than that, for Aptus, what they say is that the share of fixed loans is actually higher for Aptus, and that is the reason why this company can gain in an environment where rate cuts are happening. For Aadhar Housing Finance, they say that this is actually largest and the most geographically diversified player, and that is the reason why they prefer Aadhar Housing over other companies with outperform rating. But on the other hand, let's also talk about Aavas. For Aavas, they believe that the company actually lags its peers when it comes to yields and profitability, and that is the reason why they have initiated with market perform. And lastly, for PNB Housing, they actually like the business model. They say that the smaller ticket loan expansion is actually good, but aggressive expansion is something that they are cautious about, and that is the reason they have initiated with market perform. As a result, in a day, we already saw some good traction in these companies, but definitely watching out on this space, specifically given that the rate cuts are happening, earnings are coming, and now a positive note is also coming up from Bernstein.
All right, we take that point. A positive note coming in from Bernstein as well on this space. But stay with us. There were some power finance companies as well. They were buzzing in trade today. there was bullish commentary coming in, and IREDA too. The government allowed the firm to raise some funds.
Well, yes. When we look at power financing, it seems that the space has not lost its shine. First, let's talk about PFC and REC. Morgan Stanley has initiated a note. For PFC, they have given a target price of 508 rupees, and for REC, they have given a target price of 485 rupees. What they say is that if we look at the performance 2 years ago versus now, they have actually underperformed its own track record. But from here on, Morgan Stanley believes that the company can grow their loan book at 12%, and given that the ROE can be somewhere in the range of 17 to 19%. As a result, when we look at valuation, they believe that the valuation is still favorable because company has good asset quality, the loan book is very stable, and at the same time they are also trading at a favorable level. On the other hand, let's also talk about some NBFCs like IREDA. Now this company was in focus because government has allowed IREDA to raise funds via 54 EC bonds. Now these bonds are also known as capital gains bond. What it does is that it will actually bring down their interest rate and the cost of funds. Let's understand how. These bonds can be issued at a cost of around 5.25%, which is lowest if we compare it with the other instruments. And this was actually an ongoing movement for IREDA. Now this decision has come from government, which is actually a positive thing. Let's also not forget that in FY25, we have already seen IREDA actually lost around 20 basis points in cost of funds. So there was some benefit which was there, but we may see some more benefit coming in because of these instruments. Let's also not forget that the results are also due today, and we have already seen good set of numbers. Loan book has grown almost at around 26%. Disbursements have grown almost at around 32% on a year-on-year basis. So that is also one of the bullish trigger for the stock today. As a result, it ended with more than 2% gains.
Okay, thank you so much for that, Gaurav, for giving us a roundup in terms of housing finance companies as well as PFC, REC, as well as IREDA. But Amrish, I'm going to come to you. First, let's just talk about these housing finance companies. Obviously, we have this positive note that's coming from Bernstein as well. Your thoughts in the housing finance space? Is there anything particularly that you like? Home First Finance today was surely something that was buzzing in trade. Aptus Value is also something that they spoke about. Anything that you like here and where you find value right now?
See, this rate cut by RBI, I think that was a very big positive for the affordable housing space. And most of the listed housing finance companies are actually funding, mostly in the affordable housing space as compared to premium housing. So from that point of view, I think it's extremely positive for the housing finance companies. And here, other than the ones which you spoke about, I would be positive on LIC Housing as well as Canfin Homes.
All right, LIC Housing and Canfin Homes. Rojit, on the charts, anything particular that stands out from this space?
I think LIC Housing Finance has seen a long consolidation phase, and it seems that the stock now is forming a good support base around its 200-day exponential moving average. In this entire consolidation of last 1.5 2 months, 580, 590 has been acting as a support whenever we are witnessing declines there. So the price-wise downside here seems to be very limited. So we believe that if one is looking from a positional perspective, then this consolidation offers a good entry point at current levels with stop loss below 580. Canfin Home has already seen a good up move, so this would be one stock where a buy and dip approach should be kept. And in case if we see any kind of retracements in the near future, this should be considered where risk reward ratio would become favorable.
All right, take that point. Thank you so much for that. Let's talk about another important development that has come in from the Finance Ministry. They're considering a 32,000 to 35,000 crore rupee fund to compensate oil marketing companies for LPG under recoveries. And this is as per sources. The proposal will soon be moved for cabinet approval. Timsy, what are your sources telling you? Because it was very recently that we had the management of one of these oil marketing companies join us, and they said that they have been assured by enough to be taken care of from the ministry when it came to under recoveries.
Well, that's right. What government sources are indicating to us is the fact that the Finance Ministry could soon move a cabinet note, a proposal to create a fund of about 32 to 35,000 odd crore rupees, which will be helping the OMCs to overcome their under recovery sort of a thing that they have from the LPG, the losses that they were bearing on this. And this is for the last 15 months that these OMCs were having these losses, these under recoveries on account of LPG, and that's what the government is now looking to address. Petroleum Ministry, for that fact, had actually demanded 40,000 crore rupees. And right now, what sources say that the Finance Ministry is currently assessing what is the exact quantum of under recoveries which can be addressed. And given this fund will be created. To be fair, Union Cabinet will be approached to give a clarity on this or to give an approval to use these funds for OMCs. Now, where will this fund come from? Well, this is going to come from the collections that the government is having on account of excise duty collections on petroleum, so that is going to lead to the proceeds to this fund. When we speak to the officials, they said that the government view is that oil companies are part of the same government family. Government does not want OMCs to suffer. Thus, compensation will happen soon. Right now, government is assessing what should be the exact quantum of under recoveries and based on which this particular fund can be moved forward for a cabinet approval. Let's see how soon Union Cabinet decides to allocate this fund to OMCs and how soon the cabinet gives a nod, something that we'll have to wait and watch for. We'll keep you updated.
Okay, thank you so much for that, Timsi. Ruchit, anything on the charts and technicals that you're looking out for in terms of these OMC names or IOCL, BPCL, HPCL, anything there?
So IOC looks interesting in these names, although HP and BP also has a good uptrend, but both these names have already seen a good price-wise up move. Whereas IOC, after consolidating post last quarterly numbers, has recently given a breakout from that consolidation. So here, I think a catch-up move would be seen, and although it's not that high beta name, but a slow and gradual up move towards 165 could be expected in IOC.
Okay, thank you so much for that. But, thank you so much, Ruchit, as well as Amrish for joining in with us on the show and helping us understand different stocks and what they look like right now as well. But with that, we're going to slip into a very short break. After the break, we'll get you top corporate voices along with key market events to watch out for on the other side. Welcome back to Markets Forward on CNBC-TV18. Now, let's go across to the top corporate voices that we had during the day on CNBC-TV18. So, firstly, we had Smartworks, the co-working space that is IPO for the company has opened up for subscription today. And speaking to CNBC-TV18, the firm's top brass said that it had signed an additional 1.5 million square feet in the last 3 months. Smartworks is focused on mid and large-sized enterprises and is projecting an EBITDA margin of 12.5% in FY25. The firm has also seen an increased demand for Indian companies and homegrown startups as well. The net debt is expected to be around 200 crore rupees post the IPO.
All right, with that, we'll also talk about Pearl Global, the management of garment suppliers. They joined in and they said that they'll have to ramp up capacity and capabilities on the back of good traction right now. They've seen good demand coming in from the Vietnamese operations, and they've added that they've ramped up their Vietnamese capacity itself by 25 to 30%. They're optimistic that the US imposing lower tariffs on Vietnam will cause a shift in demand. Further, the company is also preparing for options just in case Bangladesh attracts higher traffic.
And finally, we had Vijay Thadani of NIIT Learnings, who told CNBC-TV18 that 30% of its business currently comes from European markets, and he said that the acquisition of MST Group has given the firm a significant advantage and should add 20% to its revenue from Europe. Now, he added that the margins would be in a similar or slightly higher range from the current levels.
Right, and Finance Minister Nirmala Sitharaman has said that the NBFCs are no longer shadow banks but systemically significant entities. In fact, she spoke at the NBFC conclave, the Finance Minister, who said that the NBFC credit should aim to reach at least 50% of the total volume disbursed by scheduled commercial banks by 2047. So that's a target that she's been given to the NBFC community. Hear out what she had to say.
NBFCs, I want to tell you in front of the Department of Financial Services Secretary, you're no longer shadow banks. You should aim to reach at least 50% of the total volume disbursed by scheduled commercial banks. Not a big number, considering in the last 4 years, you've doubled. 24 became 48. By 2047, at least 50% of NBFC credit should be directed towards high growth and high impact sectors.
And before we wrap up this edition of Markets Forward, we bring you the key events to watch out for in tomorrow's trading session. Ria is standing by to give us that list. Ria.
Yes, let's take a look at the key events to watch out for tomorrow. The UK releases its GDP, industrial production and trade balance numbers. Over in the US, the monthly budget statement and the IEA's oil market report will be tracked closely tomorrow. In India, watch out for the Q1 FY26 earnings from Avenue Supermarts, Aditya Birla Money and Elcon Engineering, among others. On the corporate side, Mahindra Logistics and Religare Enterprises will both have board meetings scheduled to consider fundraising options. And apart from this, NSE is set to launch its electricity futures tomorrow, so keep your eye out on all of these events.
All right, with that, what we'll do is take your leave on this edition of Markets Forward. Thank you so much for watching. Stay tuned to CNBC TV18 with all the news and updates coming in for you after this short break. Stay with us.
Well, it is the start of earnings season. TCS reporting its Q1 earnings. The numbers largely in line with expectations. Rima is standing by to decode the TCS fine print for us. Rima.
Thanks so much for that. Just got the early numbers, as you said, largely in line with street expectations. On the top line, the company's delivered 63,437. That is a modest decline of 1.6% on a sequential basis. EBIT margins at 24.5% marks an expansion of about 250 basis points not 250, 25 basis points on a quarter-on-quarter basis. So 24.5% versus 24.2%, slightly ahead of what the street was anticipating. 24.3% was the CNBC-TV18 poll. And on the profit line, the PAT has come in higher by 4.4% at 12,760 crore. Now, amongst the numbers, the only relevant one is the margin performance, and margins have come in at 24.5%, higher by 30 basis points on a quarter-on-quarter basis. The total contract value, that's the deal wins, have come in at $9.4 billion. This is less than the $12.2 billion that we had in the prior quarter, but it's largely in line with the 4-quarter average, which is about 9.8. And the company has been talking about deal wins ranging between 7 to 9, 8 to 10 billion dollars. So margins have been in line with the expectation. Attrition has inched up, so 13.3% has become 13.8%, and the headcount, just trying to calculate what the headcount is on a year-on-year basis. The company says the headcount has gone up by more than 6,000, but on a sequential basis, this time around, the headcount has also gone up. So that's a positive. Let me just quickly read out the statements that have come through. The continued global macroeconomic and geopolitical uncertainties caused a demand contraction. On the positive side, all the new service lines grew well. We saw robust deal closures during the quarter. We remain closely connected to our customers, helping them navigate the challenges impacting their business through cost optimization, vendor consolidation, and AI-led transformation. Remember, this time we've got a new COO, Ms. Aarti Subramaniam, who's joined as the CEO of the company. She was earlier with TCS, and then she joined Tata Sons along with Chandra. Now she's back with TCS, and this is the statement that she's said. Across industries, clients are increasingly shifting their focus from use-based approach to an ROI-led scaling of AI. Samir Suksariya, CFO, talks about robust cash conversion, helping us make strategic investments for the future. So in a nutshell, it's not a bad performance. The only number that I'm still awaiting is the dollar revenue growth, if you could have that. Constant currency revenue growth on a year-on-year basis has declined by 3.1%, and the dollar revenue has come in at 7,421. So if you could let me just try and calculate what the dollar revenue performance is. 7,421 is that's a decline of about 0.6%. So dollar revenue has fallen by 0.6%. On a sequential basis, and this is lower than the CNBC TV18 poll, which was expecting a growth of close to about 0.5%. So these are the basic numbers. Just to recap, lots of numbers we spoke about. It's an okay set of numbers. On the top line, dollar revenue has fallen by 0.6%. Slightly worse than what the street was anticipating, which was a growth. We don't have the constant currency quarter-on-quarter growth, but on a year-on-year basis, it's declined by 3.1%. And I think this also will be slightly worse than what the street was anticipating. So at least on the growth front, it's been a tough start. Can't blame them. It was a tough environment. Remember, the geopolitical, there was no clarity on tariffs because of the 90-day pause. So the whole quarter went in that. Where the company has done well is the margin defense. So they've managed to expand their margins to 24.5%, coming in slightly ahead of consensus expectation. What would have aided the margin performance this time vis-a-vis historical Q1 levels is one, perhaps lower contribution from the margin dilutive BSNL deal. And remember, this time around, there were no wage hikes. The company had deferred their wage hikes from Q1, citing uncertainty in the environment. And they said as and when the business settles down, the environment settles down, they will come back with the quantum and the timing of the wage hikes. So that is one clarity that we await from the management. So all in all, I think I would have to say that weakish on the top line. Margin performance is okay. Deal wins are healthy given the environment. Deal wins have come in at $9.4 billion. And I think the workforce has also gone up on a quarter-on-quarter basis. The total employee this time have come in at 6 lakh and 13,069. And this would be a sequential increase of 5,000 employees. So that's a positive, because an increase in the headcount is an indication that perhaps demand is there, which is why the company is going out there and adding to their bench strength. And we've seen the attrition also inch up to 13.8%. Prakash Diwan is now joining in. Prakash, your initial thoughts on TCS's Q1 performance?
So, fortunately, the stock has gone into earnings with very, very low expectations. So from that perspective, while I might be disappointed given what estimates were, but it doesn't seem to be something which is way off the mark. In fact, there could be, if I force myself to see some of the silver lining, it is the TCV, the value that the number of people, the workforce kind of, as you rightly said, going up. So they are kind of gearing up for some sort of improvement, but I don't think there's anybody who has any timeline to when things will start looking up. So this was bound to happen. It's a quarter that you would want to wish away quickly. Just hum and haw numbers, nothing very spectacular. And that's the way the numbers seem to be for even TCS.
Okay, so what was it that you said? Hum and haw? Kind of numbers this time?
Yeah, absolutely. There's nothing, you could keep talking about it, but there's nothing much to find out from this thing in terms of what direction it will take, what strength it will get. Yeah, absolute hum or numbers, whatever you want to call it, but nothing spectacular. Either side, bad or good.
Okay. By the way, what I'm learning from analysts is that the constant currency revenue has declined by 3.3%. And this is much weaker than what the street was penciling in, which was a drop of 1.4, 1.5%. Very few on the street, I think, had penciled in about a 3.5% kind of a decline. So it's, I'll just wait for the company to confirm it. But from the analyst community, it appears that the constant currency revenue growth has fallen by 3.3%. I think there was a CLSA at a little, with numbers above 3%. There was a BOFA with, anticipating a decline of about 2.5%. But other than that, so many analysts like JP Morgan, Axis, Kotak, they were all expecting a drop much less than this. So revenues have fallen by 3.3% in constant currency. We don't have the confirmation from the company, but they have indicated that on a year-on-year basis, revenues are down 3.1%. So it's balanced. Revenues are a miss. On the other hand, the company has shown operational resilience, but again, that's courtesy no wage hike, and the order book continues to be robust. Now, the question is, when do all these deal wins start converting into revenues? But it's been a weak start to the year. So, Prakash, based on how the stock has performed, because valuation-wise, there is still some comfort compared to the company's own historical levels.
Right.
What has been the positioning going into the numbers?
No, that's what I started off saying, that fortunately it's not gone into earnings with very high expectations, or rather with hardly any expectations, because this was a quarter that is so uncertain that only after a couple of big bellwether names coming up with earnings will the sector start getting a semblance of expectation or trends. I think TCS and this 3.3 constant currency decline that you spoke about could also get mitigated if the management comes up and says there's a spillover in the next quarter and things could probably look up. So, I don't think the stock has anything negative around itself, but in the absence of positive triggers, it's going to be very difficult for the sentiment to start picking up, for more allocations to be coming their way. So we'll have to probably now wait for the next quarter. September end is where the next reference date becomes. I don't think June end will bring any kind of a major change to the stock.
Sandeep Agarwal is now joining us. We also have Sushovan. Sandeep, do you have the constant currency revenue performance on a sequential basis, and how would the numbers stack up versus your own expectations? Sandeep? Okay. We also have Sushovan Naik, IT research analyst, and Anand Rathi, institutional equities, joining us on the phone line. Sushovan, how would the numbers compare versus your expectations, and how do you expect the market to react?
Hi, is my voice audible? Hello.
Yes, we can hear you. Go ahead.
Okay. So,
We can hear you. Go ahead.
Yeah. The numbers, if you look at it, I guess what we were expecting was a constant currency growth of negative 1.9%. But basis these numbers, it comes out to be around 3.1 to 3.2%. That's the basic constant currency growth decline that we see, which is more than what was expected. But if you look at the positive aspects, I think the margin benefit, which is now 24.5%, and the TCB number, we expected that to be $9 to $10 billion, and it has come out to be $9.4 billion, which are positive. But the top line decline is slightly more than it's quite more than anticipated as such. That was what my initial thoughts were.
Got that. Sandeep is now back with us. Sandeep, your initial take?
Yeah, hi, good evening, and thanks for having me on the show. So I think, these results as such are no event. There are two silver lining. One, that, they have added headcount, which is up 5,000 quarter on quarter with an increased attrition, if I'm not wrong, which is a positive sign. That means that, they are optimistic about the demand environment. But also remember, 5,000 is on a base of 6,38,000. So nothing very big. At the same time, the miss in the revenue is quite sharp. So I would say this is a little poor number. Although TCV is in line with expectation and some headcount is the only silver lining. Margin, I'm not very excited because it is only 30 pips increase, and that too when you are not giving wage hike, and there is also no impact of BSNL this quarter. So I would read this result as no event to slightly negative.
Do you think EPS estimates get cut?
I think Street will, because the estimates themselves are so low, though, so I don't think that, there will be much changes in numbers because the low expectation of growth itself was very low and the expectations have been built in that way. So a decline of 3% versus 1.9 or 1.5, I don't think much flows down to the bottom line. So maybe 1-2% cut, but multiples should definitely go down a little bit.
So, Shoman, if, assuming it's about a 3% negative start to the year in terms of a top line, what can they end the year with, FY26 in terms of a top line? And what would you advise clients to do now?
No, I would keep on holding to be fair because, our expectation was in FY26, we had anyways built in a number of around $31 billion, which is almost a 3% growth is what we had built in. So it will possibly be a slight cut from here, but nothing very material to be fair is what my view would be, because we had anyways expected that the first two quarters would not be that great given the demand scenario that's there. So it's in the second half where we believe there will be with the discretionary demand coming back is what we believe should be back in the second half of this financial year. I would not advise to cut positions or something. The top line was steeper than expected, and as Sandeep said, it's possibly more neutral to negative. I would concur with that, but I would not advise to cut positions or something in those lines. It's my limited submission.
So Shovan, Sandeep and Prakash, thank you very much for joining in. So TCS disappoints on growth in the first quarter of FY26. Dollar revenue has declined by 0.6%, close to about 0.5% on a quarter-on-quarter basis. Constant currency revenue growth too has fallen by 3% on a year-on-year basis. So it's disappointing on growth, which means that the outlook for FY26 is still a little uncertain and hazy. Where the company has scored well is on the margin defense, 24.5% margin. Deal wins have been fairly strong considering the uncertainty in the uncertain environment. And even analysts point out that the company hiring 5,000 employees on a sequential basis and the attrition ticking up on a sequential basis could be read positively, which means attrition only goes up when there is an opportunity also for employees to move where there are growth prospects. So that may be a positive signaling, but there is no taking away from the fact that at least on the growth front, things are still very tough and challenging for TCS. With that, it's back to you in the studio.
All right, Rima, many thanks for joining us. That's TCS for you at this point in time. Pretty much in line with expectations and not a bad performance given the uncertain environment, as Rina was pointing out. We will head into a break, but there's a lot more that we will take up right after this. All the other day's top stories coming up. Well, let's talk about the market action today. Failing to hold on to the opening gains in Nifty and the Sensex, 0.5% lower. The Nifty gave up 25,400. Nearly 40 stocks ended lower today. IT banks, PSU companies led the fall, while realty and metal stocks bucked the trend. And staying with market-related news, the government has plans to complete the divestment process of the much-awaited IDBI Bank by October this year. Sources have said the government has approved the offer for sale for 5 public sector banks this year. Public sector banks, including the State Bank of India, plan to raise around 45,000 crore rupees via qualified institutional placement, and that is this fiscal. Sources also say the government has given its approval for LIC's follow-on public offer, so that is what we should expect. The finance minister is likely to seek the cabinet's approval to allocate a compensation package for oil marketing companies. Sources have said the package will be worth between 32,000 to 35,000 crore rupees. Now, this package will be used to offset the losses that oil marketing companies have incurred by selling subsidized LPG in the current financial year. The compensation will be funded from the proceeds of the excise duty on petrol and diesel. Remember, this has been on the cards. It was expected in the budget. It was then expected post the budget, and now it looks like it may come through. President Trump has threatened to impose 50% tariffs on imports from Brazil from the 1st of August. The president announced his plan in his latest tariff letters, which was shared in social media. Now, in the letter to Brazil, Trump has accused Brazil of attacks on U.S. tech companies. He's also claimed that the country conducted a witch hunt against former far-right President Bolsonaro. In response, Brazil's President Lula has warned of reciprocal measures. NBC News' Alice Barr has the report.
President Trump reigniting trade tensions with a new series of letters to trading partners imposing tariffs from 20% on imports from the Philippines up to 50% on Brazil.
Brazil, as an example, has been not good to us, not good at all.
The president acknowledging politics played a role in the hefty Brazil tariff, pointing to the prosecution of his ally, former Brazilian President Jair Bolsonaro, for attempting to hold on to power after losing Brazil's 2022 election, calling the trial a witch hunt that should end immediately. President Trump has drawn parallels to his own criminal charges after losing the 2020 election that were dropped when he won in November. Brazil's current president saying the country will not accept being abused and will respond to the tariffs. As President Trump also said the U.S. has a trade deficit with Brazil, when the U.S. Trade Representative says it was actually a surplus for the U.S. last year. The president asked how his administration arrived at the new tariff rates.
The formula was a formula based on common sense, based on deficits, based on how we've been treated over the years.
The Senate's top Democrat slamming President Trump for not delivering on his promised 90 trade deals in 90 days.
He kicks the can down the road again and again. He talks a big game but shows little follow-through or strategic understanding.
As the president asserts setting tariffs by letter is a more efficient means to a deal.
Well, all eyes on whether President Trump is going to send out more letters this evening. Now, public sector banks have raised concerns over the Supreme Court's order on Bhushan Steel's insolvency case before India's parliamentarians. The Parliamentary Committee on Finance met today, and these concerns were raised in that meeting. Parikshit is standing by with more. Parikshit, take us through the concerns that have been raised by banks in the meeting with parliamentarians.
Well, the Parliamentary Committee on Finance held a meeting today to review the working of the Insolvency and Bankruptcy Code. One of the key issues discussed was the impact of Supreme Court's judgment liquidating Bhushan Steel and rejecting JSW Steel's resolution. Sources tell us that the heads of 3 key public sector banks raised concerns about the efficacy of the IBC in light of the Supreme Court judgment. The banks told the committee that reversal of the implemented plans undermines the conclusion of the resolution and repayment reversal affects accounting and profitability. According to the bank representatives, the judgment raises concerns about the commercial wisdom of the Committee of Creditors and may even deter future participation in distressed asset resolution. This opens doors to retrospective challenges in completed cases of corporate insolvency resolution. The banks flagged concerns that the judgment has created legal uncertainty among successful resolution applicants. The banks also suggested recommendations, which include that it is important to honor the commercial wisdom of Committee of Creditors. Number 2, there is a need to preserve economic value while ensuring accountability. Number 3, we need a clear legislative provision to deal with appeals against plans already approved by the Committee of Creditors and the NCLT. Number 4, there is a need to safeguard the interest of assenting creditors, and it is also important to consider timelines for appellate courts to act on appeals. Finally, appellate courts must be limited from intervening in resolutions unless there is a fundamental violation of the law. We must add here that a parliamentary committee consists of MPs from both the ruling party and the opposition, and this body can only make recommendations to the government after hearing various stakeholders.
All right, Parikshit, many thanks for joining us. Now, the Supreme Court has raised serious doubts over the Election Commission completing the Bihar voter roll revision exercise within the stipulated timeline. It's also asked the Election Commission to include Aadhaar, the voter ID, as well as the ration card as a proof of identity. The court was hearing a batch of petitions challenging the legality of the exercise months before the Bihar elections. Ashmit joins us now to take us through what the court said and where this now leaves Bihar's electoral rolls. Ashmit.
Well, it was almost a full day of arguments before the Supreme Court, and primarily there are two concerns that are weighing on the minds of the apex court. Number one, the compressed timelines of it all. The Supreme Court casting doubts over the 90-day timeline that has been prescribed for this intensive revision of the electoral rolls. The Supreme Court asking questions of the Election Commission as to why being done in such a short span of time, why is it being linked to the Bihar elections, what happens to voters who get excluded, will they have time to in fact appeal before the Bihar elections against any removal that may take place? Will there be time to, in fact, conduct hearings? All of these questions raised on quote-unquote practical questions being raised by the apex court being posed towards the Election Commission. This was one. The second key doubt is under the SIR, there are 11 documents that are provided for verification of your name on the electoral roll. Now, the question being asked is that why is Aadhaar, the voter card, as well as the ration card excluded from this list of 11 documents? And the question that was put forth before the Election Commission is that the voter ID card is issued by the Election Commission itself. Another question that was posed is that the Aadhaar is provided under the Representation of People's Act. The law provides for using Aadhaar as means of identification, and despite that, it's not been excluded as a part of the 11 documents that are cited under the SIR. And on account of both these questions, the Supreme Court has asked the Election Commission to consider the use of Aadhaar, the voter ID card, as well as the ration card for conducting this electoral revision. This was, in fact, one of the strongest demands that had been put forth by the petitioners. They want Aadhaar to be included. They want the voter ID to be included. And on account of this order, the petitioners not seeking any interim stay. However, the hearing in this case will resume later this month on July 28th. Back to you.
All right, Ashmit, many thanks for joining us. With that, it is time for us to wrap up this edition of Business 360. Do stay tuned. The news will continue right here on CNBC-TV18. We're back in a moment.
Talk Money.
Hello and welcome to another brand new edition of Let's Talk Money. I'm your host, Surabhi Upadhyay. The futures and options market almost never ends being in the headlines and in the news. From SEBI cracking down on multiple expiries that both the exchanges were offering us, to tighter regulations overall, to the latest Jane Street saga. Now, I want to focus on this last event that I mentioned, Jane Street, SEBI taking on a global giant HFT, which is high frequency trading, algo firm for alleged market manipulation. So the question is, does this large event and this ongoing legal battle, does it have any bearing on us mutual fund investors? Do we need to make any changes to our investments, to our portfolios? Is there anything to be wary of given the SEBI order? Well, that is what we'll start discussing on the show today. And to do that, I have with me Niranjan Avasthi of Edelweiss Mutual Fund. And in a bit from now, we'll also bring in Misbah Buxmusa of NJ Wealth to talk about overall MF investing trends and where we stand at the end of the first half of this calendar year. Niranjan, thanks so much for taking out the time. I know this is a tricky issue. A lot of people are a little hesitant in talking about it, but we thought it's important to clear the air so that mutual fund investors know what's going on. So first things first, tell us your interpretation of what's happened. We know that this is a big legal case. It's probably going to go on in the courts. And SEBI is looking to impound a large sum of money, almost 5,000 crores, because it feels that this one global entity was, abusing our market framework. Should mutual fund investors be worried?
Right. Thanks, Ruby. Thanks for having me. So my one-line answer is absolutely not. Mutual fund investors should not worry. Thankfully, SEBI has many guardrails and very strict regulation around how mutual funds can participate in F&O market. The issue that has happened has impacted or will impact most likely the weekly option market in India. Mutual fund per se do not usually get into or participate into weekly option market. Largely, mutual funds are allowed to participate in F&O only for hedging and rebalancing purposes. And the participation is largely in the futures market. And if at all in the option market, it is in the monthly expiry market. So weekly expiry market, mutual funds largely do not participate. And hence, there is nothing to worry for mutual fund investors because of this entire issue.
Okay, so that's reassuring to hear that we don't need to worry. But just to understand this a little better, Niranjan, what you're saying is that mutual funds, equity mutual funds, whether it's large caps or mid cap or a flexi cap fund, typically they will not have any participation in the options market. If at all, they might have some hedges, but that's through the futures market. Is that right?
That's correct. That's correct.
Okay. Also, are there any regulations that restrict mutual funds from overall F&O trading? We know that the regulation for mutual funds is far more tighter. It's the new asset class, this, the other SIFs, where SEBI is looking to relax it. We'll come to SIFs later, but just set the rules straight in terms of F&O. What can mutual funds do and what are they prohibited from doing?
Great. So in mutual fund, if you see, largely hybrid mutual funds are usually the ones which trade or take exposure into F&O market. As per regulation, mutual funds are allowed to participate in futures and options only for hedging and rebalancing purposes. No naked exposure is allowed, no leverage is allowed. So if at all a future exposure is taken, it is only for hedging purposes. Even if it is taken in the option market, it is probably a covered call strategy, which is against hedged. At the same time, leverage is not allowed. So even if there is an exposure into futures or option, the overall exposure in the mutual fund portfolio cannot go beyond 100. So the beta that we talk about is basically within that limit of 1. So once the leverage is not allowed, a lot of other risk parameters gets checked. Now within hybrid funds, if you see, there are funds like Balanced Advantage Fund, which take exposure into hedging, into futures for hedging purposes, because they reduce equity level from maybe 70-80% to as low as 30-40%. This reduction in equity exposure is done via taking some future exposure. But as I said, it is a hedge exposure. There is another category, which is equity savings fund. Equity savings fund also use derivative exposure, but again, it is to create an arbitrage exposure, which is completely hedged, 100% hedged. Other funds like multi-asset allocation funds, they may also use derivatives, but again, it is for hedging purposes. So largely mutual funds, as I said, are allowed to take exposure only for hedging. There is no leverage allowed. Mostly only hybrid funds usually take these exposure. None of the other equity funds or diversified equity funds usually take exposure to options. They may take small exposure to futures, to take maybe exposure to a stock which is not available in cash today, but usually with an intent to take delivery and not speculative. So mutual funds do not take any speculative exposure. They are not allowed to take speculative exposure into derivatives market.
I think that's a really important headline, and that we should all remember, and all mutual fund investors should keep it at the back of their mind, that mutual funds do not look to speculate and make trading gains with the F&O market. They use the F&O market purely from a hedging standpoint, or like Niranjan explained, if they can't get a cash market stock immediately, then maybe take a futures position with the intent of eventually taking that cash stock and holding it in the portfolio. But Niranjan, I get your point. So the MFs don't play in and out of F&O with the intent to make speculative gains. But given what's happening in the market right now, and that now Jane Street is being told that they need to wind up all their positions, and apparently they had very large positions in the market, could this in the interim impact the hedges that mutual funds have?
So, as I said, the entire issue which has happened is largely related to weekly options. Mutual funds do not participate in that segment. Whatever winding up may happen will happen in the weekly option segment, and there may be some illiquidity concern, or the volumes would be lower. But later on, this will make up, because there are other participants in market, whether it is AIF or maybe SIF coming into picture over the medium term. However, MF, which usually operates in futures market, almost 80-90% exposure is only through future market. That is not impacted. Volumes will be consistent out there. And even if it is in the option, it is in the monthly space. So largely, whatever winding up will happen may impact the weekly option. Liquidity may come down, to some extent. However, mutual fund again will stay immune to this, because they are not the participant in that weekly option market.
In the weekly options market, yeah, absolutely. And that's where a lot of tighter regulation is also happening. That's what I was saying, that the regulator has reduced the number of weekly products per exchange to just one a week. Now there is some chatter about whether instead of weekly options, whether it will be made fortnightly. So you don't speculate every week. You limit it to just once in a fortnight. It's all within the realm of sort of chatter and talk. We need to see what the final regulations could be from SEBI on this account. Fair enough, Niranjan. So that point has been driven home loud and clear. But now I want to talk about second order effects, and if at all that should, worry us. A lot of the capital market stocks were doing so well in the last 12 months. Stocks of brokers, of stock exchanges, wealth management companies, really doing extremely well. Now, with this whole volatility and the whole Jane Street saga, against many of these stocks, including, whether it's exchange names like BSE, etc., or wealth managers, these stocks have started correcting. Now, investors have been writing into us as well, saying, should I be worried? Should I be booking profit? What should I do? Is there a larger capital market issue which will take some time to sort out? What would your suggestion or advice be?
So the entire capital market story, if you see, it's largely structural, right? In the last 3-4 years, especially after COVID, the financialization of saving that has started has actually taken shape, and forget about only broking, right from mutual fund industry to other capital market, whether it is wealth management, have been doing well because of this structural change in the way household savings is getting into financial assets. Having said that, recent times, definitely valuation of some of these capital market stocks have been on the higher side. We've seen some dip in volumes also in the option market, specifically after SEBI taking several steps in last 1.5 year. If you compare last 1 quarter numbers versus numbers in the first half of 2025, there is some bit of drop in the number of trading accounts, in number of volumes, in terms of turnover as well. So that, apart from this event, also definitely had some impact on the capital market stocks. But I think so that will be limited.
Let me bring in Mr. Misbah Baksmusa of NJ Wealth into the conversation as well. Mr. Baksmusa, thank you for joining in, and for the benefit of our viewers, I do want to point out that NJ Wealth is among the largest, probably the largest mutual fund distributor in the country. So obviously a huge role to play when it comes to expanding the industry, in terms of expanding investor education as well. Mr. Baksmusa, I know you don't want to directly comment on the issue, but I'm just wondering, because we've been getting a lot of queries from viewers. Viewers are curious. They want to know whether this whole Jane Street issue is just a, it's an issue for the courts, it's an issue for direct traders, or whether from a mutual fund standpoint, does it impact anything as well? And apart from this, overall, the F&O market, I mean, on and off, like I've been saying, a lot of issues, a lot of regulatory action. Have you been getting any queries on this from your client base?
Yeah, very good morning, and thank you, Survi, for inviting me. So, I've been also been reading the Jane issue in the media. But to be very honest, we being an organization which has been promoting mutual funds and systematic way of investing into mutual funds and not offering derivatives on our platform, we have never got a query as to what's really happening from our large base of investors. But I think so few things that we have to learn from this particular issue which is popping up, that and again, I think so SEBI had been publishing the data of the extent of the loss the F&O traders have been incurring in the last last 3 financial year data they have been consistently publishing, and the kind of losses the investors are making out, investing into F&O. I think so it's a big learning for the young generations who have been investing through this F&O market, that invest into equity is not very simple, or probably making money from it in a very short period of time is just a fancy. If you really want to make money from your investments, you have to be very disciplined, long-term, systematic, and probably mutual fund is the best investment vehicle, So I think those are the learnings rather than worrying about, because as my colleague previously also said that mutual funds are not affected by this particular event. And that's what the beauty is, that our regulations are so strong in mutual funds. And probably we have a history now of nearly 30 years of the regulation in place. And we don't have any instance in mutual funds which have occurred in the last 30 years, which is of worry to an investor. And people have made money out of it. So yeah. Yes, I think that there are good learnings which the young investors should take from such events and try to probably change their investment habits.
Absolutely. And SEBI has been really going over again and again with its study. And that's the findings of the study, by the way, are very consistent. Almost every year, SEBI study says that 90% plus retail traders end up losing money in F&O. And in fact, this year's study is telling us that the losses are going up. The losses have increased 40% this year. Which, brings me to a final point on this whole issue of F&O and how we investors should look at F&O, is the whole concept of SIFs. These new investment funds that the AMC world is going to launch, and these will be far more sophisticated than plain vanilla mutual funds. And we just heard, Niranjan, you were telling us that mutual funds cannot take very sophisticated speculative positions in F&O, but SIFs will be allowed to do that. So then what would your thoughts be? I mean, is it a right time, or maybe it's not such a great time to be launching SIFs till our F&O market stabilizes and the regulation stabilizes?
Not really, Surbi. If you see, SIF also comes under the gamut of mutual funds, and SEBI is again put very, very tight guardrails when it comes to SIF as well. Only one difference which, pertaining to F&O trade, and the difference between MF and SIF is that SIFs will be able to take 25% exposure, up to 25% exposure to naked shorts, whether it is in the futures market, or they can write options in the option market. This 25% has to be part of the portfolio. Again, here, they haven't allowed leverage. Most speculative trading happens because there is a higher leverage available in derivative market for retail investors. Even in SIF, the gross exposure the total exposure of the portfolio will not be allowed to exceed 100%, which means if you have 100 crores in your portfolio, 75 crore can be invested in equity shares or stock, cash market. Remaining 25 crores can be used for hedging purposes, for taking naked short exposures. But again, the overall exposure cannot exceed 100 crores.
Let me quickly take maybe a 30-second view from Mr. Baksamusa on this, because like I said, NJ has been one of the largest distributors in the country when it comes to plain vanilla mutual funds. What about SIFs, Mr. Baksamusa? Niranjan is making a strong case for them because they'll be far more regulated rather than me as an individual investor trying to dabble in F&O and do all kinds of pluses and minuses. Maybe it's better to let experts do it for me. There's a strong argument there. Your quick thoughts on whether we're ready for SIFs?
Very honestly, Survi, at this juncture, we as an organization are also in process of understanding SIF. But our core philosophy is that globally and even in India, the structure of mutual fund is so simple, so efficient. From a regulatory framework, is one of the best structure an investor could have. And in India, currently, only 5 crore investors have invested into mutual funds. So as far as we as a distribution house is concerned, we see that a lot of things currently needs to be worked in making investor understand this concept and try to get more and more people invest into mutual funds to really bring in the financial inclusion. As you rightly said, yes, SIFs are going to come in. We will understand it. But I strongly believe that it will never be a very core product in the investor basket. Probably it will be a pudding or probably some small portion, depending upon a certain need of certain investors, will definitely get fulfilled. But we need to see and understand it more detail before I really comment on it.
No, absolutely. And let me plug in our earlier episode of Let's Talk Money here as well. Viewers, in case you want to know more about SIFs, because you'll be hearing a lot more about these specialized investment funds in the months ahead. Check out our playlist on YouTube, because we've done a full show on what are SIFs, what are the kind of trading strategies they're looking to deploy, whether their returns will be better than MFs. So do catch that show as well. But for now, a quick break. Then we talk about some of the other trends that MF investors can watch out for the remainder of 2025.
Let's talk money. Let's talk money.
Welcome back. You're with us on Let's Talk Money, and this week we're discussing what the ramifications of the Jane Street episode could be, if at all, on mutual fund investors. And our guests agree that it really is not a issue of bother at all for MF investors, because MFs are very, very tightly regulated and they do not speculate in the futures and options market. So, gentlemen, let's move on to some other thoughts. I mean, overall, what we've seen in the last couple of months, still actually the June data, which just came out this morning, is that total equity flows coming into mutual funds, they were dwindling. I mean, from highs of 40,000 crores every month, we had come down to about 19,000 crores in May. Now it's recovered to about 23,000 crores in June. But really, what are we in for? Mr. Baksmusa, if I could come to you, NFOs were pulling in a lot of money in 2024, up until a couple of months back. What are the big trends that you see ahead in terms of more offerings and investor appetite? I mean, do you see us getting back to MFs pulling 40,000 crores in equity funds every month?
See, to my understanding, most of the time in mutual funds, the major flow into mutual funds, the major source had always been SIPs, right? And if you see the trend, SIPs are continuously increasing. So at an industry level, we are now at around 28,000 crore of SIP. So without much of doing, this 28,000 crores are expected to come in. Now, from a per se level, as I previously also said, the crux is not about that level of 40,000 going to 28,000. In the past also, we have seen some periods where the money have dwindled and again picking it up. So that's a very normal, natural phenomenon of a market, where at some point of time, money automatically increases, or at some point of time, it goes down a bit. But I think so from a very long-term perspective, the need of an hour is that how we are able to make more and more people participate into mutual funds. And to us, SIP is the most logical way for participating into the equity markets, because it's the only way where at every level, if the markets are going up, investors are happy because their values are going up. If the markets are going down, again, it's a win for an investor because you are gaining more number of units, right? So I think so the SIP had been the heart of this industry, and it's very, very good that that particular thing is growing very, very steadily. The time is coming that at what high speed we are able to increase that SIP, how we are able to reach to more number of investors. That would bring in a lot of consistency as to how money is coming into the equity markets, and that will give the stability to the market also. And probably from an investor perspective is also a great win-win over a longer period of time. So as an organization at NJ, we are just working on to, spreading the awareness about mutual funds and spreading the awareness about the simple concept of SIP. And and it's very, very pleasantry to see that number overall in the markets are going up.
Yeah. No, absolutely. Niranjan, final thoughts with you in terms of what can investors expect from the industry for the remainder of this year. Like I said, lots and lots of passive launches have been happening. In fact, even now, when I look at the NFOs, mostly it's happening on the passive side. Once in a while, we get a large, actively managed fundraise. But what should investors expect from you guys in the coming months?
Right. So I think so. The industry will keep coming up with innovation and multiple fund launches as the time fits for the investors. And I think so, as you said, the number of launches has come down drastically. Most importantly, what the point to note is in the last 6 months, it has been a challenging months for mutual fund investors. And at the same time, it's quite heartening to see that SIP numbers continues to be very, very strong. Which shows that retail investors' faith in mutual fund has just started, has been very, very strong. As far as NFOs are concerned, I think so, yes, passive launches will be there. But I think so a large part of, product gaps have been filled in last 1 or 2 years. That also could be one of the reason why, the NFO pace has come down. Passive, yes, there could be a lot of innovation that can come in, especially in the smart beta phase, because largely the plain vanilla index funds or ETF offerings are full today. But yeah, I mean, let's see how the time goes. And most importantly is investors should continue investing in their existing funds. And at least from that perspective, we are seeing the trends being very, very healthy.
Okay. All right. Well, investors are keeping the faith. They're still making a beeline, for instance, for a lot of mid-cap and small-cap funds. So there's enough appetite out there. And let's see how the markets also shape up in the second half of the year. Gentlemen, thank you very much. A helpful discussion. Lots of perspective there for all the mutual fund investors in the country. Thank you for joining in. And viewers, keep sending us your feedback, comments and queries. Tell us if you want us to address any newer topics. And we'll see you again on the show next week. Thanks for watching.
Let's talk money.
Hello and welcome to News Center. I'm Parikshit Luthra. The Election Commission's decision to conduct an electoral roll revision drive in Bihar just months ahead of the state's assembly elections has stirred a controversy. Opposition parties have alleged that the move is aimed at disenfranchising close to 3 crore voters who may not be in a position to furnish the required documents. The RJD and the Congress held a protest march against the Election Commission's decision in Patna. Congress's Rahul Gandhi and RJD leader Tejasvi Yadav led the rally. The BJP-led NDA has defended the revision exercise, accusing the opposition of trying to come up with an excuse ahead of a certain defeat in elections. The Supreme Court has raised serious doubts over the Election Commission completing this exercise within the stipulated timeline. It has also asked the Election Commission to include Aadhaar, voter ID, ration card as proof of identity. The Apex Court was hearing a batch of petitions challenging the legality of the exercise months before the Bihar election. Ashwin Kumar joins us now. Ashwin, what were the court's observations?
Well, it was almost a full day of arguments before the Supreme Court, and primarily there are two concerns that are weighing on the minds of the apex court. Number one, the compressed timelines of it all. The Supreme Court casting doubts over the 90-day timeline that has been prescribed for this intensive revision of the electoral rolls. The Supreme Court asking questions of the Election Commission as to why being done in such a short span of time, why is it being linked to the Bihar elections, what happens to voters who get excluded, will they have time to in fact appeal before the Bihar elections against any removal that may take place? Will there be time to in fact conduct hearings? All of these questions raised on quote-unquote practical questions being raised by the apex court being posed towards the Election Commission. This was one. The second key doubt is under the SIR, there are 11 documents that are provided for verification of your name on the electoral roll. Now, the question being asked is that why is Aadhaar, the voter card, as well as the ration card excluded from this list of 11 documents? And the question that was put forth before the Election Commission is that the voter ID card is issued by the Election Commission itself. Another question that was posed is that the Aadhaar is provided under the Representation of People's Act. The law provides for using Aadhaar as means of identification, and despite that, it's not been excluded as a part of the 11 documents that are cited under the SIR. And on account of both these questions, the Supreme Court has asked the Election Commission to consider the use of Aadhaar, the voter ID card, as well as the ration card for conducting this electoral revision. This was, in fact, one of the strongest demands that had been put forth by the petitioners. They want Aadhaar to be included. They want the voter ID to be included. And on account of this order, the petitioners not seeking any interim stay. However, the hearing in this case will resume later this month on July 28th. Back to you.
All right, joining us now to discuss this is BJP spokesperson Radhika Khera. Advocate KK Manan will be joining us, and Anwar Pasha, spokesperson of the RJD, will also be with us. Radhika Khera, in a big way, this is a question mark for the ruling party as well. The party had been defending the revision of electoral rolls for the state of Bihar, and today the Supreme Court has asked some tough questions. They've said, go ahead with this exercise, but why now? We have no problem with the timing, but with this exercise. And why are you excluding Aadhaar? What is the right of an ordinary citizen of Bihar to appeal in case he is disenfranchised? And also, what about the right to appeal? So some tough questions being raised there for the Election Commission. The opposition is going to ask questions on this. How would you respond?
The opposition today isn't defending democracy. They're defending illegality. Let's be very clear. When more than 4 crore voters in Bihar have voluntarily submitted verification forms, when the Supreme Court has refused to stay the process and has acknowledged the constitutional validity of the Election Commission's actions, then what exactly is the Congress and RJD going to protest about? Also, let me remind you that the next date of hearing is post the last date of when the documents have to be submitted. So the stand of the court is very clear in that as well. Now, we have the RJD and the Congress and their India alliance, jo bhi wahan Gathbandhan mein hai, what are they fighting for? Are they fighting for Indian voters, or they're fighting to keep infiltrators on the electoral roll? The court today has made no bones about it. It is said that this matter this is a matter that goes to the root of democracy and refused to grant any interim stay. I will repeat myself, refused to grant any interim stay. Instead, it has asked the Election Commission to consider including Aadhaar, voter ID card and ration cards. That's fine. In fact, yesterday I was on a debate on your sister Hindi channel, and I believe one of your producers also said that he managed to get his verification done by using an Aadhaar card. Now, the EC has already said that they're going to consider it, and in some cases, the BLOs are also considering it. Now, what is the protest for? The truth is very uncomfortable. The opposition knows it cannot win Bihar through illegitimate votes. We've seen that. So it's preparing grounds for excuses, claiming rigging in advance, questioning the EC, and calling the entire democratic process into question. Rahul Gandhi and Tejasvi Yadav led street rallies while the matter was sub judice. That's not politics. It's an open attempt. I repeat myself. It's an open attempt to pressurize the judiciary and delegitimize democratic institutions. And I want to ask this. Was it not under RJD rule that Bihar earned the name of booth capturing capital of India? And the same RJD, which was led by Mr. Lalu Prasad Yadav and Rabri Yadav, the mother and father of the same Tejasvi Yadav who was protesting today, did we not witness rampant voter-led fraud and muscle power during the Lalu Rabri era? We did. Today, when the process is transparent, legally backed by Section 21(3) of the Representation of the People's Act with full opportunity for correction, appeal and redressal, they are calling it undemocratic. The truth is, they are not fighting voter suppression, they are fighting voter purification. This is not a bunch for democracy, it is a bunch to protect fake votes and power at any cost.
Anwar Pasha, Anwar Pasha of the RJD, you've got the BJP saying that this electoral roll revision, this special intensive revision was required to, to do away with fake voter ID cards and people who should not be participating in the voting process. The Supreme Court today has asked some very tough questions. How would you take your campaign against the special intensive revision here onwards?
Thank you so much. We had our parliamentary election some 1 year back, and it was the same electoral roll on which the election was conducted by the Election Commission. Before the parliamentary election, there was a normal, I think, ordinary revision of the electoral roll. Not only that, just 6 months back, a process of revision started in October 2024 and ended in January 2025. After these two revisions, now suddenly the Election Commission says that this electoral roll is bogus and they want to revise it. And this is not a normal revision. This is not ordinary revision. This is a special intensive revision, which means that entire electoral roll is declared null and void, and a new set of electoral roll is going to be prepared. And the timing is also very important. Just 1 month or 1.5 months is being given for this, a special intensive revision. This is not possible. Around 8 crore people are there as voter, and all the names from the voter list has been deleted. A fresh inclusion of the names will take place. And for that, the conditions that has been put by the Election Commission are very, so strict that the common people cannot fulfill it. People do not have those documents which is required for this special intensive revision. So all this shows that the Election Commission is conducting this special intensive revision at the behest of the BJP, because BJP knows it well that they are not going to win this election in Bihar. So they are quite desperate. They want, this is very interesting, this is very unfortunate, that a government is bent upon depriving the people from their voting rights, from the constitutional rights. So their democratic rights. They have deprived them, and they are trying to exclude those people who are poor people, marginalized people, who will fail to produce any document in support of their citizenship. So this is our main concern.
Right. Mr. Pasha,
our main concern is for the poor.
Let me also get in. I'm going to come back to you. Let me also get in Advocate KK Manan. Advocate Manan, do you expect more challenges? This is not the end of it. Today, the Supreme Court has said you cannot rule out Aadhaar as a proof of citizenship, a proof of residence. This has to be factored in. And in the coming months, there could be more legal challenges.
You see, the fingers are pointed out time and again so far as Aadhaar card is concerned by the Honorable Supreme Court. But at the same time, I don't agree for the purpose, you see, that in this 2 months or 3 months, I think the election is there. After the parliament election, they should have, if they wanted to exercise this power or doing this job, or they should have done immediately after the elections. 1, 2. I can give you example because the bogus votes are definitely in Bihar, no doubt in it. Because I have 4 employees, domestic servants, 3 drivers. All the 7 are from Bihar. They have the voting rights in Bihar also and in Delhi also. Now the question is that where they should exercise this right, whether in Bihar or here. Whenever they go to Bihar during the elections, they use this exercise here. Or whenever the election in Delhi, just a few months ago, election in Delhi was, and they all voted in Delhi also. So for that purpose, Election Commission is doing the exercise correctly. But the time, that is the question now, because the opposition or the other parties against the BJP, they are making hue and cry, no doubt in it. To some extent, they are right. But at the same time, it is not a very big issue. Rather, they should have cooperated for this purpose. And I know that my father was a sarpanch in the village. Whenever this election voter list used to be prepared, people comes from the election commission. He used to prepare. He used to add the names of the new persons, and it is the duty of the every party, their supporters also in the village. But other thing which is very important is that the documents, as the Honorable one Supreme Court judge has asked, whatever the documents are being asked now, even he is not ready with those documents immediately. For that purpose, I think 15-20 days are there. If 15-20 days are there. So I don't think that Election Commission doesn't have the power to prepare the voter list. Who will prepare the voter list? Who is the other agency?
Okay.
Who is the other institution?
All right, Mr. Manan, Mr. Manan, the point that the court is raising, we are fine with the exercise, but don't link it to the Bihar election, because we don't have a problem with the exercise. We have an issue with the timing. Radhika Khera, respond to that.
Parikshit, I want to even respond to the RJD spokesperson's melodrama. This is not a protest to protect voters, like I said. It's a panic attack by a party that just got electorally wiped out in the Lok Sabha. Now, he was talking about this is the same voter list that we went to Lok Sabha elections with. Well, in May 2024, on this very voter list, the BJP-led NDA won 31 out of 40 seats in Bihar. RJD and Congress together, just 7. The people of Bihar crushed them out. That's the verdict that they could not digest, and now they're attacking the referee. Let's go back to the Supreme Court. Now, they went to the Supreme Court. The court refused to stay the process. That is one thing very clear. It did ask pointed questions like, A, is this revision outside law? Answer is no. 2, does the EC lack authority? Answer is no. 3, is cleaning a bloated, potential corrupted voter list unconstitutional? Answer is absolutely not. Yet, and we've seen how the next date is, like I said, I'll repeat myself, it is the next day after a couple of days after this entire process ends. So that is the day that the Supreme Court has given for the Honorable Supreme Court has given for the next hearing. We have to read into that as well. Now, having said that, now Rahul Gandhi and Tejasvi are doing road shows and crying wolf. Why? Because they have thrived on fake voters, infiltrators, and stolen ballots. A clean voter roll is a death sentence for their politics, and they've seen a sample during the Lok Sabha elections. So I'm going to be very blunt. This isn't about saving democracy. This is about saving their fake vote pack. They are not scared of disenfranchisement. They're scared of exposure. When the court questions the timing, the EC explained this is the first digital roll purification post 2003 mandated under section 21(3) of the RPA. It's legal, it's necessary, and it's overdue. So those who are crying the timing thing, let me ask, is there ever a wrong time to clean a voter list? Or is it only wrong when your political frauds are being caught? And finally, when the RJD says, again, once again, I'll say that they fought the Lok Sabha on this list, yes, and Bihar fought back, and that is why the tantrum is happening, not for democracy, but to stop their funeral in November.
All right, Anurag Pasha, my final question to you. One of the points that the opposition has made is that more than 3 crore voters may not be able to meet this criteria. Birth registration levels in Bihar are very low. Now, this is for voters not included in the 2003 electoral roll, and they are now required to provide proof of citizenship. But why wasn't this correction done over the past so many years? Is it enough for political parties to say birth registration levels are very low? What was being done about this on the part of successive governments, successive political parties who were in power in the state for 2 decades?
Yeah, that is the question. Why after 22 years, after the 22 years? It was conducted in 2003. And after 2003, tell me in which state this revision was carried out, a special intensive revision? Election after elections have taken place in many states. Why only for Bihar? This is insult of Bihar, people of Bihar. This is a onslaught on the people of Bihar. that this is attack on the voting right of the people of Bihar. You first carry out a digital intensive this revision, a special intensive revision in the whole country. We have no objection. If you are saying that their voter list is bogus, then the present elected government in the center, the BJP government in the center, is a bogus government. They should resign first, and they should go for a special intensive revision for entire country. Let there be intensive revision in the entire country. Why they have chosen only Bihar? It means they are targeting Bihar because they know that unless such things are done in Bihar, unless they deprive a particular section and the sizable section of the people in Bihar from their voting right, they cannot win election here in Bihar.
Okay.
They have seen the last assembly election, the result of the last assembly election. We emerged as the first with the largest party in Bihar, and we are about to form the government. But due to their mishandling and malpractices in the counting, we were not allowed to form the government. We could not get that number in Bihar. So this tactics they adopted in the
we're running out
last
of time,
election.
but I'd like to thank you for joining us. And Radhika Khera and KK Manan as well.
They are not going to
It's a
succeed
story
in it.
that's
Will not allow
not
them.
ended anytime soon. Some tough questions for the Election Commission today from the Supreme Court. There will be a next date of hearing. There could be more legal challenges as well. We're taking a short break, but coming up on the other side, Karnataka Chief Minister Siddaramaiah has rejected the possibility of a change of leadership in the state. More on this when we return. Welcome back. Karnataka Chief Minister Siddaramaiah has rejected the possibility of a leadership change in the state. His statement comes a day after Deputy Chief Minister D.K. Shivakumar met senior Congress leader Priyanka Gandhi Vadra at her residence. Siddaramaiah said that he will complete his 5-year tenure and brush aside talks of him paving the way for D.K. Shivakumar to take over later this year. His comments came hours before his meeting with the Congress leadership. CNN News 18's Pallavi Ghosh decodes the tussle for the Karnataka Chief Minister's post.
But Siddaramaiah has very much made it clear that he's a fighter and there's no question of him giving up his gaddi in Karnataka. Over the last few days and weeks, there has been a lot of speculation with many of D.K. Shivkumar's supporters actually demanding that he should be made the chief minister. Well, that has been made clear very much by Congress sources. But the fact that both DK Shivkumar as well as Siddaramaiah are parked in the national capital fueled the speculation that was there going to be a 2.5 year kind of a rotation pattern where there could be a change of guard. The fact is that Siddaramaiah is very rooted to the ground. He's also someone who has a large amount of support of the MLAs. But DK Shivkumar is also no pushover. He's someone who has the eyes and ears of the Gandhi siblings. He's seen as a troubleshooter and a fighter. But when Network 18 spoke to Siddaramaiah, he made it very clear to me that I am here for 5 years. There is no vacancy and I'm not giving up. From his kind of confidence and his candidness, it is very clear that Siddaramaiah would make life hell for the Congress top leadership in case he is replaced. And that is the reason why he is overconfident about the fact that at least for the 5-year term, there can be no change of guard. He also dismissed all the speculation that the High Command was angry with him as far as the caste survey is concerned. So Siddaramaiah gets to stay, no change of power, that's the message. But what is going to be the key point to point out is to see whether DK Shivkumar's camps would be happy with this kind of assertion coming in from the Chief Minister.
There is no vacancy so far as the CM chair is concerned. This has been said by Mr. DK Shivkumar himself. Then where is the question of tussle between me and DK Shivkumar?
There are supporters of Mr. DK Shivkumar who are putting forward the fact that after 2.5...
There are supporters to DK Shivkumar and there are supporters to me also. And they are making their statements on their own. But not much. See, there are not only DK Shivkumar, there are so many people, they want to become the Chief Minister. No, my answer is very clear. Whatever decision taken by the High Command, both of us, Mr. DK Shivkumar and myself, they should follow.
Which is that you stay on as the Chief Minister? Because, whenever these talks happen, it leads to instability.
I said I will remain as a Chief Minister. I will continue as a Chief Minister. I will be there for full 5 years.
And Samsung has launched its next generation of foldable smartphones, Galaxy Z Flip and Fold, and the more affordable Flip 7 FE. The new devices are more AI-focused and powered by Android 16. Prices range from 90,000 rupees and can go upwards of 2 lakh rupees depending on the storage options. My colleague Ashwit Kumar spoke to Samsung's mobile head of marketing, Aditya Babbar, on the latest launch and the brand's strategy going forward.
How affordability has played the role at the consumer buying decision. We have been at the forefront of, making this device more affordable for the consumer. When we take affordability today, Ashmit, there are very different sense of affordability at the consumer. When I stand at the shop floor, I see a lot of consumer walking in and saying, I want to trade in my old device. So the need there is to get the best value. Now, there are a lot of consumer who walked in and says, I want 6,000 rupees EMI, give me the phone. Now, the onus is on to us that how do we really, come up with a need set which is addressing both of these consumer needs and how can we make it more affordable. So we have worked on both. We have made a Galaxy upgrade program. Today we have the long-term EMI and we also have for all our power users a memory upgrade. So they can pre-book the 256 GB and get a free upgrade to 512.
Wonderful. Let's also get a sense of how the broader market is doing. At least from the numbers coming out from reports, they seem to suggest that the first half of 2025 has not been great from a consumer spend perspective. How has the first half of 2025 done for you? What has your experience been?
So, in terms of volume, if I talk about last 2-3 years, the market is fairly at the same number. The market is not growing. But what is the good news is the market above 30,000 have shown a very, very good growth of almost 36%, which continues in the first half this year. For us, that market has been growing faster. We have consolidated our share from 24 to 30% odd. So premiumization is taking place, and the premiumization is taking place on account of, for us, at least on account of democratization of AI, affordability and expansion of AI at the retail front. Those have been our key drivers.
With that, it's a wrap on this edition of News Center. More news and updates continue right here.
Well, let's talk about the market action today. Failing to hold on to the opening gains in Nifty and the Sensex, 0.5% lower. The Nifty gave up 25,400. Nearly 40 stocks ended lower today. IT banks, PSU companies led the fall, while realty and metal stocks bucked the trend. And staying with market-related news, the government has plans to complete the divestment process of the much-awaited IDBI Bank by October this year. Sources have said the government has approved the offer for sale for 5 public sector banks this year. Public sector banks, including the State Bank of India, plan to raise around 45,000 crore rupees via qualified institutional placement, and that is this fiscal. Sources also say the government has given its approval for LIC's follow-on public offer, so that is what we should expect. The finance minister is likely to seek the cabinet's approval to allocate a compensation package for oil marketing companies. Sources have said the package will be worth between 32,000 to 35,000 crore rupees. Now, this package will be used to offset the losses that oil marketing companies have incurred by selling subsidized LPG in the current financial year. The compensation will be funded from the proceeds of the excise duty on petrol and diesel. Remember, this has been on the cards. It was expected in the budget. It was then expected post the budget, and now it looks like it may come through. President Trump has threatened to impose 50% tariffs on imports from Brazil from the 1st of August. The president announced his plan in his latest tariff letters, which was shared in social media. Now, in the letter to Brazil, Trump has accused Brazil of attacks on U.S. tech companies. He's also claimed that the country conducted a witch hunt against former far-right President Bolsonaro. In response, Brazil's President Lula has warned of reciprocal measures. NBC News' Alice Barr has the report.
President Trump reigniting trade tensions with a new series of letters to trading partners imposing tariffs from 20% on imports from the Philippines up to 50% on Brazil.
Brazil, as an example, has been not good to us, not good at all.
The president acknowledging politics played a role in the hefty Brazil tariff, pointing to the prosecution of his ally, former Brazilian President Jair Bolsonaro, for attempting to hold on to power after losing Brazil's 2022 election, calling the trial a witch hunt that should end immediately. President Trump has drawn parallels to his own criminal charges after losing the 2020 election that were dropped when he won in November. Brazil's current president saying the country will not accept being abused and will respond to the tariffs. As President Trump also said the U.S. has a trade deficit with Brazil, when the U.S. trade representative says it was actually a surplus for the U.S.
Revenue declined by 3.1% year on year and by 3.3% on a sequential basis. Our rupee revenue grew by 1.3% year on year to reach 63,437 crores. Our operating margin stands at 24.5%, representing an expansion of 30 basis points over Q4 of FY25. This translates to 15,514 crores of operating profit. Our net margin for the quarter has come in at 20.1%, translating to 12,760 crores. Consequently, our EPS reached 35.27 per share. Cash from operations was at 12,804 crores, representing a strong conversion at 100.3% of net profit. On a sequential basis, North America was flat at about 0.1% growth, while UK and Europe declined by minus 0.3 and minus 3.1% respectively. Amongst new growth markets, Asia Pacific remained flat, while Middle East, Africa and Latin America declined sequentially. India declined by 32.6% in this quarter. Among the verticals on a sequential basis, technology and services grew by 1.1% and manufacturing grew marginally by 0.2%. BFSI declined by 0.5%, consumer business declined by 2.2%, life sciences and healthcare declined by 1.2%, communication and media declined by 3.1% and ERU declined by 0.6%. TCS banks and BFSI products and platform continued their growth momentum. The number of customers from whom we make more than 100 million declined by 1 to 62 customers on a year-on-year basis. However, we saw good addition of clients in the 10 million, 5 million and 1 million revenue bands. Our customer base of 1 million stands at 1,336, an increase of 26 over last year. We had a strong order book closure again this year. Our order book for the quarter stands at $9.4 billion, up by 13.2% on a year-on-year basis. North America TCV came in at 4.4 billion, BFSI at 2.5 billion, and consumer business at 1.6 billion. Most geographies and business groups had strong order book closures. By the end of Q1, our net employee count stood at 613,069, a net increase of 5,090 associates since Q4 of FY25. Our IT services attrition stood at 13.8%. In this quarter, we also saw new service lines delivering growth. Essentially, amongst our services, AI, data, TCS Interactive, and cybersecurity led the growth. On AI, clients are accelerating their focus to scaling AI across enterprise. We are increasing our investments across the AI ecosystem, including infrastructure, data platform solutions, AI agents, and business applications. Our AI solutions such as TCS Wisdom Next and Sovereign Cloud are seeing good traction across industries and markets. We are also scaling AI expertise across the company. Our 114,000 associates with higher order AI skills as of this quarter represent one of the highest number in the industry. In Q1, we applied for 171 patents and were granted 119 patents. The board has recommended an interim dividend of rupees 11 per share. Also, this will be Milind's last quarterly press conference. He has been a distinguished colleague and had a stellar record of service over 38 years in the industry, integral part of our management team all these years. Joining TCS as a trainee in 1987, he rose to lead the manufacturing business group and subsequently became the CHRO. On behalf of TCS, I would like to thank him for all his contribution. Thank you, Milind. As announced last quarter, Sudeep will be taking over from Milind. Where is Sudeep? Nobody can miss him. Okay. With that, I hand it over to Kritika. Thank you.
Thank you so much, Kriti. We'll start with Reema Tendulkar from CNBC-TV18. As always, we want to accommodate everybody, so 2 questions, and feel free to take your questions one by one.
Kriti, let's start with growth. Break up this quarter in terms of BSNL ramp down and how international markets did, and the outlook. Does growth come back in Q2, or the deals which were paused are still paused? And what about your guidance for the full year, which you stated last time, that growth will be better in FY26?
Okay. Reema, as we said, the sequential degrowth was by 3.3. Out of that, minus 0.5 would be attributed to international, and remaining 2.8 would be attributed to BSNL winding down. From a outlook perspective, we are still confident and optimistic that international revenue in FY26 would be better than our FY25 revenue. Overall, it will be too early to call out when growth will resume, which to a great extent depends on more clarity emerging in the macroeconomic scenario. But I think with all the trade discussions coming to a close, the new bill that's been enacted in US gaining presidential sanction approval, I think things should become clearer maybe towards the end of July or early August. So.
Aarti, great to see you, and look forward to more conversations with you. New service lines have done well. Can you quantify the kind of growth and provide some color on the deal wins? And Samir, if you could just tell us a little bit about the margin, the breakup. What was the tailwind that you got on account of the BSNL ramp down? Milind, explain to us the 5,000 headcount addition and the timing of the wage hike.
And the?
Wage hike, when you planned.
So Reema, from a new age service line perspective, when you look at AI, data, cybersecurity, interactive, some of the modernization services in terms of movement to cloud, application modernization, these service lines have grown well this quarter. And we see, especially on AI and data, strong demand from our customers. Customers are investing in industry-specific solutions. AI for modernization is coming across as a strong theme because Gen AI is now becoming the tool to really understand the legacy code and use Gen AI to convert and forward engineer to a modernized architecture and application. So these are all new opportunities. And when you look at enterprise solutions, modernization with SaaS platforms, so significant demand there as well.
Can you quantify growth for us in new age service lines?
We don't call out service line specific numbers, Rima, but
We know the deal win number, 9.4, but the outlook going forward, how's the pipeline?
the pipeline across these services looks pretty strong.
Our Q1 margins were at 24.5%, sequentially improved by 30 basis points. And that's despite of building for capacity, or we invested into capacity and continued our other investments for long-term growth. And the tailwinds which you talked about mainly came in from reduction in the quality of revenue or reduction in third-party expenses and support from currency.
5,000 addition, which you see it in every quarter, so there's no difference here. It means we obviously started the quarter the way we started and realized that there are some business challenges towards later end of the quarter. So this, yes, the number is here, and we'll obviously leverage some of these resources for future quarters, obviously. With respect to wage hikes, we have not made any decisions so far on wage hikes, and we'll let you know as soon as we do that.
Thank you. Next question from Sajid Mangat from NDTV Profit.
Hi, Kriti. In your statement, you mentioned about demand contraction. Can you give us a sense of what exactly you're seeing at this point in time? Because in Q4, you said that it's a wait and watch for you, and now the commentary is much more, in the sense it's more bearish in nature when you're talking about demand contraction there. Because when you spell it out, your QOQ, CCC, constant currency numbers, you said only 0.5% decline was from international and 2.8% was because of BSNL. So just if you can elaborate more on what exactly you mean when you say there's a demand contraction which is there.
Yeah, see, as I said, international was minus 0.5, and there are 2-3 levers at play, like we discussed last time also, where clients have decided on a project, but where they think the ROI is not immediate. The same story with the discussion, but only the bar on ROI goes up. So you find more projects are getting paused or delayed. And in some places, we find the decisions where we thought a transformation project, the decision would be taken in this quarter so that we can start the project. Those decisions get delayed where the ROI clients are not clear about the return on investment on those projects. So the overall framework on which the projects are getting delayed or paused are very similar. But again, as you would see, like we had a minor, very small growth of our small. It's a growth in North America, and UK and Europe had a degrowth.
How much of that is linked to what's happening in the US with respect to tariff negotiations and others? And because North America grew for you on a quarter-to-quarter basis, so how much of that is linked to that?
It will be very difficult to quantify, saying that X percentage of growth was impacted by tariff discussion. But if you look at industries, for instance, consumer industry is more impacted by tariff. Manufacturing, auto industry is more impacted by tariff. But certain industries like banking are not directly impacted, but have a second order impact because consumer confidence is low. But it will be very difficult to quantify X percentage to a particular event or a situation.
Ati, hi. Can you give us a sense of the kind of AI deals which are coming in? Because $9.4 billion of total contract value in this quarter. How much of, what percentage, if you can put to AI? And if you can also give us an indication of what is the kind of productivity gains that you are bringing into the clients? Because what we are hearing on the ground is that, the gains are very limited to the extent of 10 to 15%. Are you able to bring in more productivity gains when you are engaging with your clients with respect to new orders?
Sure, Sajid. When you look at AI, I think first the nature of opportunities, right? So customers are looking at building industry-specific solutions with AI, domain solutions. So that's an area of opportunity where we are seeing increased demand. And the second area I would say is modernization, which I briefly talked about earlier. And how do you leverage Gen AI to really modernize your legacy applications? I think there's again strong demand there. The third area is customers are looking at now that they see the ROI from the AI projects as they move from pilot to really delivering value. Customers are looking at how do we scale AI within their enterprise. So they're looking at how do I set up an AI office, setting up AI centers of excellence jointly with us. How do they create AI platforms so that their AI initiatives can scale across their value chains and functions? So those are the areas where we see the demand coming in. And in terms of, when you look at where AI is being applied from a service delivery perspective, right? So these are the bespoke new builds that you do, new application development. And then when you look at, application operations, right? Or infrastructure operations, that's where the productivity gains are starting to show. And also, all of us are hearing so much about coding assistance for development. So the savings are, the productivity gains are there for the coding. But when you look at the software being built, there is much more end-to-end, right from conceptualization all the way to testing and delivery. So, but the coding part of the value chain, we are seeing productivity gains.
Samir, 30 bips jump in margin for you. Your SG&A expenses came down by 2% on a quarter-to-quarter basis, if I'm not wrong. 9,300 crores, right? Means it is showing it's fallen there. And your other income has gone up by nearly 600 crores. So if you take these off, then you have a flat net profit which is coming on the bottom line. So can you give us an indication of why SG&A expenses, where do you get that gains from SG&A expenses and the addition in other income?
Okay, so on the SG&A expenses, there is nothing one-off to call off. We'll continue to drive productivity. Overall, if you see sequentially, it has been flattish too, as you have been calling it out with the gain. As a percentage of revenue, it has been flattish, nothing, and we will be focused on driving efficiency across our various line items. On the other income, the 600 crores which you called out as a one-time, we have received some interest on income tax refunds that is accounted out there.
Milind, 6,000 net employees, if I'm not wrong, but your attrition is at 13.8, which is a 2-year high. Are you seeing attrition inching up again?
I think definitely it is a little more than our comfort level. We are 11 to 13% is our comfort range. It is a little more than that. We continue to make efforts to bring it down. Through continuous employee engagement, doing all the right things which we normally do with our people. We continue to do that and bring it down. Is what our aspiration is always, and that is what we will continue to do.
And the gross target remains the same, 40,000?
Well, it's definitely a big landmark deal for Glenmark as well as for the Indian pharma industry, where Glenmark has signed an out-licensing deal with global big pharma company AbbVie for one of their molecules under development for multiple myeloma, and they've out-licensed it to AbbVie. It's going to be an upfront payment of $700 million, milestones of $1.2 billion going forward, and even double-digit tiered royalty payments if in case this molecule is successful and does come to market. We have with us Glenn Saldana, who's really the man of the moment, to talk to us about this big landmark deal which has taken place. Glenn, thank you very much for joining in. Well, if you could just go through the finer points of this big deal which has taken place for IGI, which is your innovation subsidiary.
Thank you, Ekta. So clearly this is a huge moment for us, right? I mean, we've been working on this for 25 years in the innovation space. And I think 2001 really is a world-class asset, right, which can be transformational for patients. From a partnering perspective, the way we've structured it is we've partnered with AbbVie for US, Canada, Europe, China, Japan, most of the developed markets, and Glenmark will commercialize this product eventually, right, in India and all emerging markets. So the two of us will make sure this asset is successful going forward. IGI clearly is a 100% subsidiary of Glenmark and has done a phenomenal job in developing this asset, getting the phase 1 data. As you know, we have phenomenal data in patients in the phase 1 trial, where the recent presentation we made at ASCO, we had almost 79% ORR and almost 30% of the patients had complete remission. And these are patients who've gone through all prior lines of therapy in multiple myeloma and then eventually come on to 2001 have shown this response. So very exciting times. We are super excited about partnering with AbbVie, great partner, huge global capabilities and huge resources to make 2001 successful and bring it to the market.
Okay. So explain the financials to us. $700 million is what you would get upfront, $1.2 billion in terms of milestones, and the remaining would be royalties.
That's correct. So we get a $700 million payment upfront, and as soon as we get regulatory approvals, that money will be received by us. The milestones, the $1.2+ billion of milestones, are spread into clinical development milestones. So as the molecule progresses to clinics, we keep getting milestones. Regulatory milestones, so as the molecule gets filed in various markets, we get and approved, we get milestones. And then we get sales-linked milestones. So cumulatively, that number comes to $1.25 billion, for the asset. And then once it's commercial, we get royalties on sales, which, as you know, some of these innovative products, the life of the royalties is pretty long. So this could pretty much be an annuity if the molecule makes it to market.
Okay. So let's first understand where exactly this molecule stands. Phase 1B currently. Explain that to us. How nascent is this molecule at this point in time?
So ISB 2001 is still at a relatively early stage. The good news is we have patient data in about 40-50 patients. We have good clinical data that we presented at ASCO. So very good safety profile, good efficacy data. But it's still early stage, so it has to go through a significant amount of clinical development as we go forward.
Okay. So AbbVie is now going to take over the entire development of this molecule, we understand. When do you think that it will probably hit the market or show any kind of results?
So AbbVie takes over all clinical development from here on. In terms of time frame, I can't give you a specific time frame, but typically molecules, if you look at other assets, right, in the space, they typically take about 4 or 5 years at least to get to commercialization.
So say 2030 would be a good target to probably expect something tangible coming in from the molecule or hitting commercial sales if it is successful, that is.
So again, I can't specifically talk about ISB 2001, but typically it's about 4 or 5 years to commercialization.
Okay. Well, let's talk about how you're going to use the funds now. Let's start with $700 million, 6,000 crores of cash on books. It will be on Glenmark's books. Tell us how exactly is this $700 million going to be utilized?
So the way we're looking at it is IGI will continue development of various other assets that they have. They have a great multi-specific antibody platform technology, which they will continue to exploit. And they will continue. So they spend about $70 million a year. So that spend will continue. Clearly, a big part of this upfront will be allocated to their spends. The balance, some of it will get dividend out to Glenmark, and the rest will sit as cash on the books.
Any plans of rewarding the shareholders of Glenmark who waited very patiently for a possible R&D deal?
We'll definitely consider, right, increasing the payouts to shareholders. I think we'll put it up to the board and get that approval.
Now, this $1.2 billion in terms of milestone payments, what is it contingent on? Any kind of, milestones that you can share with us, and when can we probably expect them to come through?
I think the milestones are all based on certain meetings, certain events, right? So specific events like completing of a certain phase of clinical development or regulatory filing or regulatory approval. So they spread all over. So it's hard to say when these will fructify.
Now, the royalty payments, if in case the molecule is successful and it comes to market, how long will the royalty payments last for? And typically what you've seen in terms of molecules, and the size of this particular molecule for multiple myeloma, how much do you think it can probably garner for you?
So the multiple myeloma market today is about $30 billion, estimated to be about $50 billion by 2030 globally. So when you look at the market size is very large. In terms of royalty payments, typically some of the novel drugs have a life of at least 15-20 years of exclusivity. So the royalty payments can be significant as and when these drugs come to market.
Well, you've done this deal at a time where there is a lot of challenge when it comes to, funding, especially for biotech companies. How challenging was this particular deal in this environment of uncertainty?
Big Pharma has always had deep pockets, and given the clinical data that we had and the level of efficacy and safety that ISB 2001 demonstrated, we had a lot of interest around this asset, right? And we're happy that AbbVie, we concluded the deal with AbbVie as a final partner.
You're not telling us how many companies actually approached you, the big pharma companies that approached you.
I think all that is history, Ekta. Finally, we have AbbVie as a partner, and we're excited to have them as the final partner.
You're going to have a significant amount of cash on books. We've seen that there are a lot of companies that are looking at acquisitions, and we've seen the Torrent JB Chemicals deal, which has just taken place recently. Will M&A be something that you would consider?
Well, for the next 1 year, we're going to stay focused. I don't think you would see us do anything on the M&A side.
What about in-licensing?
In-licensing has always been a part of our strategy. For example, we did envafolimab to further leverage our oncology capabilities in India and emerging markets. And we will continue to look for in-licensing opportunities both in India as well as globally. We recently launched the Beijing 2 assets in oncology in India, zanubrutinib and tislelizumab, right, Brukenza and Tevimbra. So we're constantly looking at in-licensing of assets both for India and emerging markets in the 3 therapeutic areas which we operate, which is primarily dermatology, respiratory, and oncology.
So weight loss drugs, obesity is not on the cards right now.
Well, I think for us, weight loss and obesity will fall in our diabetes franchise, which is mainly India-specific. But if you look at globally, we operate in derm, respiratory, and oncology. So those are the 3 areas which we continue to look for, both in licensing assets as well as developing further novel assets.
Any other big molecules you think that you have on IGI's books which will probably show the same kind of potential?
Well, IGI, one thing we know is the multi-specific antibody platform that they've developed, right, that we've been developing over the last 10 plus years through the BEAT platform. now actually works, right? So that's a phenomenal achievement. And we think we can leverage this platform to come up with a number of additional assets. The most near-term one is 2301, which will come into the clinics next year, which again is an NK cell engager, which we're pretty excited about.
Well, this is not only a deal for Glenmark, Glenn, but in context of where India stands when it comes to R&D, we've always been considered to be on the back foot. Do you think that India somewhere is coming of age, considering that we had a small deal with Orchid Pharma, we had something with Wockhardt, and now Glenmark, obviously?
I think a lot of it is company specific, but I mean, my personal view is innovation trumps anything else in our industry, particularly in the pharmaceutical industry, because it's all about helping patients with better therapies, better treatments, which will drive the success of companies wanting to invest in innovation.
But do you think India has come of age, and that's where the next story lies for India, the R&D story? Or is it company specific?
I think it's company specific, Ekta.
Give us, Glenn, end this conversation by telling us what is Glenmark's vision now that you've struck this deal. You do have, your generic business also. You have your India business. You have your consumer business. Give us a sense in terms of what the 5-year, 10-year vision for Glenmark would be here on.
Well, Glenmark will continue to move up the value chain, right, into launching novel products, innovative products as we go forward.
Okay. And quickly, Glenn, you're talking to us at a time where there's a lot of uncertainty when it comes to the trade tariffs and what could be announced even for pharmaceuticals. What is your sense in terms of what we should be possibly expecting?
Well, I think it's still playing out, Ekta, so it's hard to say what happens on the tariff side.
Hypothetically, if there's a huge tariff of, say, on pharma exports, how do you think Indian companies will probably manage that? There were reports indicating even 200%, which sounds outlandish, but your sense?
I don't want to speculate right now. For me, this moment is all about ISB 2001.
Okay. All right, Glenn, thank you very much for joining in, and congratulations on putting India on the map when it comes to R&D. Thanks very much.
Thank you.
Welcome to the Medicine Box. I'm your host, Ekta Batra, and today we are talking about something that is becoming one of India's biggest health concerns, obesity. The numbers are hard to ignore. Nearly 1 in 4 Indian women and men are now overweight or obese. Even our youngest are affected. The number of overweight children under 5 has jumped from 2.1% to 3.4% in just a few years. And here's what really stands out. We're gaining weight together as a family. Today, all adults are either overweight or obese in 1 in every 5th Indian home. A Lancet study now predicts that by 2050, 45 crore Indians, that's over a third of us, could be overweight or obese. And we may have one of the highest numbers of obese children in the world. This isn't just about how we look. Obesity is now being seen as a chronic disease. It often comes with a yo-yo pattern of weight gain and loss, and it plays a huge role in serious conditions like diabetes, heart disease, high blood pressure, cancer, and even Alzheimer's. In fact, 8 out of 10 people with type 2 diabetes are also overweight, a combination doctors now call diabesity. But here's what's new. For the first time in India, we now have access to 2 globally talked about drugs, Mounjaro and Wegovy. Launched just weeks apart, they've shown impressive weight loss results globally, and they're stirring up a lot of buzz. So the big questions are they the game changers we need? Who should take them? Are they safe? And what happens when you stop? We're joined today by Dr. Ambrish Mittal and Dr. Sonali Kagne. Welcome to the show.
Thank you.
Well, Dr. Sonali, let's kick off the show with you. If you could just give us the key differences between the 3 weight loss drugs that exist in India now. Wegovy, the injection by Novo Nordisk for weight loss, Rybelsus, which is the oral semaglutide by Novo Nordisk, and Mounjaro by Eli Lilly.
Okay. Wegovy and Rybelsus, the molecule is the same, which is semaglutide. The only difference is Wegovy is an injection which is to be taken once a week, and the oral tablet is to be, the Rybelsus, which is an oral tablet, it is to be taken once a day. If we compare the weight reduction efficacy of these 2 molecules, Wegovy is much better for weight reduction as compared to Rybelsus. Both these, the semaglutide molecule is, it belongs to the group of GLP-1 receptor agonist. Whereas now coming to Mounjaro, Mounjaro is a dual GLP-1 and GIP receptor agonist, and it is also an injection form which is to be taken once a week. The weight reduction efficacy of Mounjaro is currently the highest amongst all the molecules which are available. So it is to the extent of 22% average weight reduction compared to 17% with Wegovy and around 10% with Rybelsus.
Okay. All right. Dr. Mittal, how do these drugs work at this point? Because a lot of the feedback that we've got is that it sort of reduces the noise in your brain when it comes to cravings, when it comes to hunger pangs. Tell us, how do these drugs work?
So all these drugs work via the GLP-1 pathway. GLP-1 is a hormone that's secreted from the intestine and acts on the pancreas as well as the brain. Whenever we eat food, there is secretion of GLP-1. It acts, endogenous GLP-1 acts on the brain to control our appetite and satiety. It tells us when to stop eating. These drugs act through that pathway and they act on the brain to tell us to stop eating and also to reduce our appetite. So the primary weight reducing action of Ozempic or Wegovy or Mounjaro is via their brain action. There are other actions also, like slowing the movement of food in the stomach, but those are all secondary. The primary action responsible for weight loss is the brain action.
Dr. Mittal, now give us a sense, if somebody walks into your clinic with diabetes and say is overweight as well at this point in time, give us what you are prescribing to them based on different BMI scenarios.
So for diabetes management in an overweight or obese persons, GLP-1 drugs are the first line of choice now, more and more. And as they become more easy to use and more accessible, they should be offered to most patients with diabetes who are overweight or obese.
Okay, so would that be
BMI cutoff, yes. So those above 30, even without diabetes, would be candidates for these drugs. Those who have a BMI over 27 and have diabetes, you're talking about diabetes, so those above BMI 27 with diabetes will definitely be candidates and should be offered these drugs.
Okay, so somebody who has a BMI between 25 and 29 and is not diabetic,
correct,
would they be eligible for these drugs?
Ideally, we would like to look at the other causes, why they are gaining weight. We need to look into their lifestyle and try our best to, kind of make them lose weight with these other modifications rather than jumping on to the these drugs. because most of the times when they are in this weight category, some incidents would have happened recently or in the last 2-3 years or so, because of which they have started gaining weight. For example, in a woman, it can be a postpartum condition. For someone else, it is a sedentary job which has recently been changed. For someone whose job, the working hours are so long that they are not finding time for the exercise, or recently they have changed their eating habits or something. So there is some factor because of which they have probably gained the weight, or they were overweight to start with for quite some time, but they have never taken some effort to lose weight. And most of the times the awareness that this BMI of 25, generally we label them as healthy rather than overweight or obese.
Yeah.
So we have to change that mindset. Most of the time, if you look at average build wise, it looks like, okay, this person is normal. So we probably have to change that definition in mind. And this is probably the best time in the weight journey, where if you are aware that this is not my ideal weight and this is a little overweight, and if you just take care of small factors, you will definitely lose weight, and we need not jump for these medications for say.
Okay, so in that case, it's only lifestyle modifications. And what if that same patient comes back to you and says, you know, I tried, I lost 10 kgs after 3 years, I put it back on, now what do I do?
So if in that category, they have already tried everything.
And they still don't have diabetes.
Fine. If they have already tried everything possible, still they are unable to lose weight, and they have some other comorbidities, not necessarily diabetes, but some hypertension, obstructive sleep apnea, or they have weight-related issues, then in that case we might consider for till the time they can probably continue their lifestyle and lead to a little weight loss, wherein they can just maintain the lost weight with the continued lifestyle modification.
Okay. Well, Dr. Mittal, what about somebody who walks into your clinic and has a BMI of over 40, is morbidly obese? What would you recommend to them?
So anyone who comes in with a BMI of more than 40, the first choice is always bariatric surgery. We've been saying this for years and years and years, but the problem is that most patients do not agree to go under the knife. So I think it's a huge task. And, such patients keep coming back. We keep discussing back and forth, lifestyle, a different diet. Now, at least if they disagree for surgery, we can help them. Maybe we won't bring them to target. It's very important to understand that if you lose 5 kilograms or 10 kilograms, you're helping yourself a lot. You need not always reach your target body weight. So if patient is unwilling for bariatric surgery, I would certainly put them on the GLP-1 drugs. In addition to this, there are patients who have agreed for bariatric surgery, but where the surgeon wants a little bit of weight loss to make the surgery easier or less difficult. And in those cases also, we are using these drugs quite liberally in preparing patients for bariatric surgery. So there is a role in those over 40 BMI, but there, of course, the first line treatment is bariatric surgery.
Okay, Dr. Sonali, what about you? Somebody comes in and says 110 kgs. What would you recommend to them?
So again, as I discussed, we need to start from the beginning, find out the causes, and depending upon the choice, basically, as Dr. Mittal has rightly mentioned, that many individuals, despite their BMI being even 44, 48, also sometimes they do not agree for the surgery most of the times. So in those cases, we might put them on this.
So do these drugs work effectively on them?
Yes. So basically the individual variation would be there, but these drugs which have shown this significant weight reduction in other BMI ranges, they will also have the effect in this BMI range.
say somebody who is 110 kgs loses 15% on this particular drug,
correct,
whichever one that you prescribe, and that has to be taken over a period of time, I assume, maybe around a year odd.
So basically, we need to continue to use that medication in order to, maintain the lost weight. It's not that we are using it for 1 year and then we are advising them to stop the medication, because as with any other weight reduction strategy that we use, be it diet, be it physical exercise, once we stop doing or taking that particular care, we tend to regain the weight.
So the weight will come back on once you stop using it.
Yes, definitely.
Okay. So I'll get back to that in just a minute. But this 110 kg person loses 15% of their body weight, comes down to say around, 93 kgs, best case scenario, say even 88 kgs. Then what happens? Do you continue prescribing the drug, and does the dosage of the drug increase?
Yes. So if we need to increase the doses to achieve the target weight, we will keep on increasing the dose to that extent which is, approved by the for the drug, for that particular drug. And on that maximum drug, we will look at the whatever weight the person is losing, and we'll continue that maximum tolerated dose to maintain the lost weight. And with time, the person might keep on losing the weight, and simultaneously the other lifestyle modification will also help for them to continue the weight reduction. See, the most important effect in this, someone who has been on a higher side on the weight and was unable to lose weight for some or the other reason for a very long period of time, once they start seeing the change in their body and they start losing weight, they become so motivated in following up with the diet, regular exercise, that they themselves would like to stop this drug over a period of time and continue the lifestyle modification, which I have seen in many of my patients. That kick for sticking to the lifestyle, that is given by these drugs. So as we call them as a facilitator for weight reduction, not in terms just of by the chemical nature, but because of the result that they are showing to the patients. So it is also quite useful in them.
Okay. But Dr. Mittal, this is not a magic pill. You still need to follow your exercise regime. You need to follow your diet. It's not a pill that you pop and then, the weight just melts off, is it?
Yeah, absolutely. And I think I strongly second what my colleague said. Basically, the fact is that people are frustrated because they've attempted all lifestyle measures and have not succeeded in losing weight, or if they did, it came back. Now, when they see changes in their weight with the medication, they become motivated. And I have many patients like she's describing, where once they get this result of 10 kg weight loss, it motivates them to follow their lifestyle much more intensively and to try that weight. But remember, again, weight loss drugs, Ozempic, Wegovy, Mounjaro, are all part of a program for weight reduction. It's a journey. They are not standalone drugs. You start taking the medication and lose weight, don't do anything else. You will lose weight if you just take the medication. And that's a bit of a risk, because you're just going to lose muscle along with fat, all those things. But if you are exercising regularly, taking the right diet, enough protein, enough fiber, enough hydration, you will get the maximum benefit from these drugs. Plus, you'll be able to reduce the drug dose as you go along, and some of you may even be able to go off it. So the key
part is... When you go off it, Dr. Mittal, just to interrupt you there, when you go off it, how do you sustain without the drug? Because it's going to be, a little more harder to do the exercise and to maintain the diet, because you had that additional push from the drug, but now you don't.
Absolutely, and that's the real question here with the use of these drugs. There is a certain category of patients, older, diabetics, overweight, where it's clear, like all diabetes medication, this is a lifelong medication. So no discussion. We start insulin injections, you take them lifelong. So similarly, if you're a 50, a 5-year, 60-year-old diabetic who's got onto this, very likely you're going to use it lifelong. And we do tell patients that you might need it lifelong. The issue will be about people who are just using it for just weight, and especially younger people. People who are in their 30s or 40s, how can we say it's going to be lifelong? Within those who are not very obese, who fall in borderline BMIs or just at 30, 29 and who worked very hard and brought their BMIs down, we will try and taper gradually. What I'm currently doing is most of my patients who started some time back are now on a maintenance dose or a very low dose of medication. And once they're stable on that dose, not putting on weight, I try and take them off. This I'm talking again of relatively younger patients who are not diabetic. For someone who has diabetes, it's an anti-diabetic drug. So it's pretty fair to use it lifelong.
Okay, what about the factor about side effects? What are the side effects that people need to be aware of? We've spoken about how, or it's publicly noted about, nausea, etc. But I'm going to just drill down on the more serious side effects which have been recorded. For example, there's a recent study which was published by JAMA linking GLP-1 drugs to age-related macular degeneration. And there are eye conditions that it's been linked to. How comfortable are you with that, Dr. Mittal?
So I think that's the single biggest question with these drugs at the moment. Firstly, clinical trials have not shown that. The data that's being presented, and I read the JAMA paper, is basically about large numbers of patients who have age-related macular degeneration or NAION, and they found that within those patients, the number of patients taking GLP-1 drugs was higher. Okay, so the association is not firmly established. There are plenty of studies showing no association. Having said that, we have to be alert about that. We cannot just dismiss it. Any signal should not be taken for granted. So therefore, as a precaution, I am advising eye check to all my patients before initiation of the therapy and once a year. That's the best we can do at present. If at all this effect is found, this side effect, I think it's exceptionally rare, and we really don't know the final answer yet as to whether it's really there or not.
Okay. Well, Dr. Sonali, there's a black box warning for thyroid tumors. How seriously would you take that? It's been found in animals and not in humans in terms of the clinical studies, but we don't have long-term data on that.
Correct. So basically these GLP-1 receptors, they are found in a huge number in the rodent's thyroid gland. Whereas if we compare it with the humans, we don't have the GLP-1 receptors, those many on the human thyroid. And therefore, like sir said, we have been using these drugs from last 20 years, but we could not find a significant increase in the number of this medullary thyroid carcinomas with the use of these medications as of now. Although we do take that in consideration if someone is been on these drugs and comes with the suspicion of that thyroid swelling or tumor. In that case, we might evaluate. And so because it's not seen in the trials in humans yet, there is no even the screening protocol that we should keep on screening the patients for these cancers.
Okay, so as of now, the rewards outweigh the risks, you would say, for thyroid as well as eye conditions?
Yes. Yes.
Okay. What about the muscle loss? Because that's, some people lose as much as 25 to 39% of muscle loss. In any case, Indians eat less protein and don't hit the gym on a regular basis for weight training. Is that a condition that you think about twice?
Yes. Basically, that is the most important factor to be taken into consideration, and that is why we should not just consider this medication as just a magic pill. And as we were discussing, it has to be a part of the a broad spectrum obesity program where we are all ensuring the high protein diet, ensuring the muscle strengthening, the weight training exercises along with these drugs and the lifestyle modifications, so that we can minimize the lost weight. Obviously, as you rightly said, when we are getting the benefits in terms of reduction of the comorbidities along with the weight loss, we are considering this medication irrespective of the lean muscle mass which we are muscle mass loss which we are seeing. But for that, we have to be always proactive in terms of preventing that lean muscle mass.
Okay. Well, I have a couple of viewer queries, and I'll just request you to keep your answers extremely brief for this. Dr. Mittal, about the misuse, the fear is that, people are fearing that their children could misuse the drug as they become teenagers, or that population wants to lose around 5 kgs, take the drug, stop the drug. Do you think that's a key risk, especially with the fact that semaglutide is now going to become generic and is going to be much more easily available?
Well, I would like to look at it positively. I think my patients have more options, and I think that if it becomes cheaper, it has, even greater number of people have access. But you're absolutely right. I agree. The potential for misuse is high. And we really need to regulate the sale of these drugs very tightly. Otherwise, yes, this kind of misuse is very much possible. In fact, I'm getting a lot of requests from people who are just like, a BMI of 24 and they want to be 23, something like that. So we need to be cautious.
Okay, Dr. Sonali, how do we address the larger issue of obesity in India? When your patient comes in, what is the first line of recommendation for you to the patient?
So I always start my consultation with the basic questions about all the lifestyle factors that we take into consideration, right from the diet, the exercise, their sleep hygiene, what time they get up, how long they watch the TVs or they have been working on the screen, and what are the how is the environment at home in terms of domestic environment, the socio-economic environment, and all those things needs to be considered because they are again equally contributing to the weight issue.
Okay, all right, Dr. Mittal as well as Dr. Sonali, thank you very much for joining in and giving us all of this perspective. Dr. Mittal, I do understand that you've written a book on weight loss drugs, so I'm sure that would be helpful as well. But thanks very much for joining in on the Medicine Box and talking to us.
On. Was this the right bet to make?
Absolutely. First, I want to start by congratulating you because you chose me as a participant in Young Turks back then, not knowing actually whether our fledgling enterprise and company was going to survive. Here we are, Sula celebrating our 25th anniversary this year. It's been a fantastic ride. I would not have given it up for a million years for anything else.
Hardest part of the journey so far?
We are forever knocking on doors, even in our own country, saying, look, we are Make in India. This is a farmer, full 100% Indian farmer grown product. We are so proud of this. Please favor us So that is something that is non-stop and still goes on today.
Has it gotten any easier? Has it gotten any better doing business in the wine business in India?
Oh yes, come on. I just want to look back at where we were in 2001, 2002. We were able to sell 40,000 bottles in 1 year. This year, 12 million bottles, 300x.
With the FTAs being inked or likely to be inked, the India-EU FTA, the US FTA as and when it happens, UK has been done. And, you know, the alco-bev industry is saying this is bad news. How do you see it?
There's a lot of work that we need to do to gear for that. The market is going to expand. There's no question about it. I do believe that there should be a minimum import price. That's something that we've made our position very clear to the Commerce Ministry, and we are always in discussion. So we do have a seat at the table.
What keeps you going today?
I think that there's probably nobody in India who knows wine as well as I do. I think that's a fair statement to say. And if anybody is going to continue to lead this wine revolution for another few years, that's going to be me.
One of the huge mistakes people make is that they try to force an interest on themselves. You don't choose your passions choose you. Jeff Bezos perhaps speaks for many entrepreneurs, including my guest today. He was first featured on Young Turks 23 years ago to talk about his fledgling startup that he was attempting to do the unthinkable, which was make in India in a heavily regulated sector. 2 decades on, Rajiv Samant is still making in India, now clocking sales of 1 million cases annually. From vineyards in Nasik to a spot on the Lal Street, it's been a journey of passion, perseverance, patience, and some pain too. So grab your favorite beverage and settle down as I talk to the man behind India's largest winemaker. Rajiv, it's great to have you back on Young Turks and good to see you.
Fantastic to see you, Shireen. 23 years later, wow.
And you're still around, and as am I.
We're still around and looking younger than ever.
Well, in your case, yes, I must admit. But, you know, what has the last 23 years been like for you? As I said, when we spoke, when you started Sula, you know, the decision to exit the valley, leave Oracle, move back to India, get into the wine business, you know, 23 years on, was this the right bet to make?
Absolutely. First, I want to start by congratulating you because you chose me as a participant in Young Turks back then, not knowing actually whether our fledgling enterprise and company was going to survive. You know, most companies don't survive beyond the first 3 to 5 years. Mm-hmm. And yet here we are, Sula celebrating our 25th anniversary this year. It's been a fantastic ride. I would not have given it up for 1 million years for anything else.
You know, 25 years on, and today you're a listed entity, Rajiv, and I will talk about the post-listing, you know, approach that you have and how that's changed your mentality to entrepreneurship as well. But as I pointed out, passion, perseverance, patience, but a fair amount of pain as well, right? I mean, let's talk about that. What's been the hardest part of the journey so far?
Absolutely. Look, when you were interviewing me back then, we were actually going through our maximum pain because regulatorily it was such a minefield. But then we got so many of the rules changed to benefit wine in Maharashtra, in Karnataka, and that really helped us. That really helped the wine industry and Sula take off. But in other states, I mean, we have so many blows that we take, you know, in so many states, they favor imported wines over Indian wines. So we are forever knocking on doors, even in our own country, saying, look, we are Make in India. This is a farmer, full 100% Indian farmer grown product. We are so proud of this. Please favor us. So that is something that is non-stop and still goes on today.
And those doors are not opening?
Those doors sometimes open a little bit, sometimes one will open, two will open, one will shut, so it's always constant. You know, a large part of my job is not only running the company, but it's also meeting officials, powers that be, bureaucrats, trying to persuade them that there's this beautiful thing called Indian wine. It's really like a miracle. You know, come on, support us.
It really is like a miracle, isn't it? I mean, how many licenses do you need to apply for today to be able to sell in a market, for instance?
Oh, wow. You know, when you ask me if I want to sell in India today,
yeah.
you know, we're talking about 26 different states that we're selling in, each one of them with a painstaking bunch of documents, etc., that you have to redo every single year. It's not automatic renewal. Every single year, you got to go through that label registration, etc., etc. So if you ask me how many documents do I sign in any given year, you know, I would say well over 1,000 signatures from my side.
Okay. 1,000 doesn't seem that absurd though, right?
Okay. Maybe I'm totally underestimating then. So do you sign 1,000 documents in a year?
I don't.
You know, there are many other people in our organization who sign many other documents. So mine are just, you can say, the apex documents, and still it comes to that.
So has it gotten any easier? Has it gotten any better doing business in the wine business in India?
Oh, yes. Come on. I just want to look back at where we were in 2001, 2002. We were able to sell 40,000 bottles in 1 year. This year, 12 million bottles, 300x. I look back at, you know, what we expected to achieve back then. We never thought that we were going to reach this place. 1 million cases. Asia's largest wine producer outside China. I mean, this is really something. And today, Indians are drinking wine. Everybody knows what wine is. Everybody knows that wine is very different than spirits. There's a thriving wine market and, you know, wine consumption that's going on that just did not exist back then. So I look back with thinking, wow, what we've achieved, a lot of pride. You know, it's a totally different story. Of course, we have to keep progressing because we are listed. But come on, it's a totally different situation today than
What's
20 years
changed as
ago.
far as the Indian consumer is concerned? Obviously, there's a greater awareness about wine. There's also more consumptive capacity. People are spending more. Discretionary income has gone up. But what have been the big trends that you've tried to cash in on?
Sure, awareness, sophistication, and also a much broader audience and a much broader base of consumers and consumption. When we first started, we were literally only in Mumbai, Delhi, Bangalore. That's it. Today, you know, we are in probably 100 cities across the country with a decent amount of sale going on in most of those. Of course, wine still continues to be very much metro oriented. So if you look at it, probably metro sales are something like 70% of our sales. But at that time...
And not even all metros. It's very few metros that contribute to a lion's share of those sales.
But back then it was 99%, apart from maybe Goa, which you almost can count in. But now it's, you know, it's come down to 70%. It's still very much metro, but you have also tier 1 cities. You have states where we were just not available in at that time, and it's gone to then. And women, if you ask me in one word, today women are totally fine to have a social drink. And at that time, it still wasn't the case.
Well, I guess there are many trends that have changed, but are you worried about the trend that we're seeing now with Gen Z of moving away from spirits, moving away from alcohol? I mean, people are now setting up wellness, you know, bars and so on and so forth. People are meeting at coffee shops and doing rave parties in coffee shops with coffee. Does that concern you that we're seeing a trend away from the spirits business?
You know, a little bit, but not in a huge way. So yes, the trajectory might have changed and might have got dampened a little bit for all alcobev, including wine, including Sula. But the fact of the matter is India is a very different market. We can't take cues from what's happening in the US and in the West and, you know, wholesale import that over here. Because yes, Gen Z is different. But remember, Gen Z in India is drinking a lot more, at least in terms of wine, than millennials, just because of women. In our parents' generation, women did not drink, or, you know, very rarely, very few. Today, that's completely changed. So in the case of wine, it makes a difference. Yes, FY25 has been a little bit tough, but then if you...
A little bit tough? Is that an underestimation of how tough it's been? Because it's been...
It's nothing.
Year, right?
I want to point out that flat is nothing compared to what happened to us during the economic crisis. That was a 20% reduction in our sales. But then, you know, we had 50% growth before that, 50% growth after that. But, you know, we've had years in the past where we had a 20% dip. I always say, look, if you want to get from this place to that place, it's never a straight line. It's going to go like this. So flat this year, after 3 years of breakneck growth, perfectly natural, that's fine. It's a breathing space. And we move forward on our growth path.
How much of this is on account of inventory and stocking? How much of it is because demand has fallen?
It's a bit of both, but definitely the inventory and overstocking did have something to do with it. Coming out of COVID, things just exploded, and definitely you did have some amount of overstocking happening throughout the system, including at consumers' houses. You remember that we, for 2 months or 3 months, could not buy anything. People were desperate. I was getting calls from people saying, hey, can you send us some wine? I was like, I can't. And so people, from having 2 bottles of wine at home and other things, suddenly decided to stock 2 cases. Now they've probably come back to 3 or 4 bottles. That has also happened.
So, you were talking about the Gen Z customer. How are you now sort of gearing up to cater to what Gen Z wants, both in terms of the way that they're consuming, but also what they would like to consume?
So Sula, as you know, Shireen, has always been a pioneer. So many of the things we've done, new varietals, for instance, bringing it out for the first time. A wine in a can, that was a big one that we've just done recently, and it's taking off very nicely. We are so proud to be the partners on board Indigo in their new international business class. Our wines in a can were chosen directly by the CEO, and that's doing really well. So lots of things like that. We have a lot of projects going on. I know right now the big trend is lower alcohol, and that's something we are looking at. Most recently, we're launching a still muscat for the first time. Recently, we launched a Pinot Noir. So, in the wine sphere, we're doing a lot. We're giving the consumers what they want. And even in terms of tourism, we always have a pipeline of projects. Tourism, by the way, this year, things are going really well. I'm happy to say on that front. That continues to be a great growth business for us. So, lots and lots of more offerings.
It's interesting that you talk about low alcohol, because I think that this is perhaps a point that the FMCG business is going through as well. The low sugar, no sugar, sort of conversation is impacting the way that people produce their products, what they're launching as well. Do you see that as being a sort of inflection point, even as far as your business is concerned? Is it big enough, you think?
Definitely, it needs to come onto our radar now. Definitely. However, having said that, let's remember that wine is still less than 1% of all alcobev consumed in this country. So there's still a lot of runway ahead, what I see as tremendous opportunity, unlimited opportunity ahead to still convert a few more people. If you're talking about moving low alcohol, remember wine itself within the alcobev category is low alcohol. So if you move from a spirit to wine, already you're moving low alcohol. I think there's, for us, far more opportunity there, considering that, 80% of consumption is probably spirits and 15-16% is beer. So moving people from spirits down to wine, I think, is a bigger opportunity than moving people in wine from, say, 12% to 7%. That's the way I look at it.
But is 12 to 7 something that you're considering looking at
Very
this point
much.
in time?
So our still muscat, for example, is going to be at 7%. It's going to be the first real Sula classic, with the iconic Sula Sun. Lower alcohol wine. So those are the kinds of things we're doing all the time. We had launched our Diya range earlier, which is very well known, very successful, and that is already at 8%, and already we sell a lot of it.
You talked about tourism, and that has become a big revenue generator for you. What do you believe is the road ahead as far as wine tourism is concerned? I mean, hospitality has taken off, especially post-COVID, and everyone is reaping the benefits of that, including you. Is that going to be much more of a focus area for you to offset the kind of flattish growth that you've seen this year on the wines business?
Tremendous potential. There's no question of it. So we are not going to refocus, because we've always been focusing. I have always felt since day one that wine tourism needs to be a big pillar of a successful wine operation anywhere in the world, and especially in India, where we need to put wines in front of people and get them to taste it. So as you know, it's people well aware that we have 4 lakh visitors a year coming to our vineyard. It's the most visited vineyard on earth, and still there's so much more work to be done. So I'm very happy to say, we have a new hotel opening up soon in just a month or 2. We have new tasting rooms opening up. So I would say there's limitless opportunity in this sphere.
So how do you see the rise of the experiential economy? I mean, that's what everyone's talking about. Every brand is trying to find ways of creating immersive engagement experiences, outside of tasting rooms, outside of the boutique hotels and so on and so forth? How do you encourage much more of the experiential aspect of Sula? What's the thought on that?
Well, Sula has been way ahead of the curve.
You were actually.
Yeah, we launched our first Sula Fest in, wow, I don't even remember the thing, but more than 15 years ago, 17 years ago, we had our first Sula Fest. That was a revelation. That was for the first time that a consumer brand in India was holding a big party for thousands of people on their own campus and getting people to taste and experience for the first time right there. So we've still, we brought it back this year in 2025. Huge hit after 5 years of absence, and we have plans for rolling that out even further. But I must say that a tasting room is something special. So when you say people are even going beyond tasting rooms, I think that the experience starts with tasting room. And we have been so successful. We do something like 1 lakh tastings a year just at our campus. So that's the way. If you say, how are you getting people turned on to wine in India? Sula is way ahead of the curve.
So in terms of expanding the tasting room experience geographically, over the next few years, what's the expectation?
Well, I'm very pleased to say that we have a beautiful new tasting room coming up just outside Bangalore. We have our Domain Sula campus there, which has been around for a while. But this is taking it to a totally different level. And we hope to announce the opening.
What's going to be new? What's going to be different?
Well, it's a gorgeous tasting room with a gorgeous view, which we were not able to do so far on an elevated level. Right now, we have a much smaller experience there at Domain Sula outside Bangalore. We're going to be tripling the size, quadrupling the size of the whole property in terms of the tourism part of it, and it's going to be fantastic.
So take me through how...
And there's a vineyard view. So our current small restaurant there doesn't have a vineyard view, but the new tasting room is going to have a vineyard view, something like Sula at Nasik.
So what could this mean in terms of revenue and the potential for revenue growth over the next few years, just on the wine tourism, the tasting rooms and so on and so forth?
So you have to remember that the wine tourism, it gives you a small revenue boost in that year. But what it does do is it allows you to showcase your wines to so many more people. It allows you to have private events there, etc., etc. So you have a knock-on effect. You have a multiplier effect that gives you much more revenue over the years to come, which is a little bit more difficult to quantify. But suddenly, if you have a beautiful, gorgeous, desirable place to visit, to taste wine right where it's made, just, we're talking 2 hours outside Bangalore. So it's fantastic on the Mysore highway. It really opens up so much. So many more people will come there. I expect we could see 50% more footfall happening there than we have now.
The way that you name your wines, of course, Sula comes from your mother's name, but many of the names are deeply personal.
Absolutely. So that's another, remember I was talking about the design and naming is another thing that, I love doing. So yes, Sula is named after my mother, Sulabha. Rasa, some people say it's named after me, Rajiv Samant. The source.
It is, right?
You could say, but Rasa also means the essence, it means the juice. So there's so many other things that it could mean. So it all comes together very well, and we'll just leave it a little bit cloudy. The source, we decided to name our resort at Nasik the source because it was the source of all good wine in India. That was the place. And then we decided to name the wine after the source. Beyond, because you really feel like you're going beyond, leaving behind all the stresses, beyond all the stresses of everyday life. That's been a big hit for us as well. So I do enjoy definitely the naming. Madeira, one of our wines, was the name of my freshman dorm at Stanford. So that's how come Madeira. So,
when you were at Stanford, did you think that this would be life for you?
I went as a good Indian boy expecting to be an engineer, I must admit, but very quickly realized that I preferred the arts, I preferred literature, and I preferred history quite often to engineering. So at some point, by the end of it, I suddenly realized that I probably wasn't going to be an engineer, even though I joined Oracle right afterwards, but I quickly quit. But never did I imagine in 1,000 years that it was going to be wine.
Except that it is, and that's how it's turned out to be. The sun is shining on Sula and the wine business. How did the logo come about?
So we wanted a very Indian feel to our wines. We wanted to say we are proudly Indian. You had a couple of guys before us producing wine who were very French in their outlook. They had very French-sounding names, or their tagline was French wines, French traditions. We said, no, we are not French. We're making wine in India, and let's be proud of it. So the sun is a very proudly Indian sun. And then we were the first to write on our front label, produce of India, big and bold. So that's the way we did it. And we really struck a chord back then. A lot of people said, are you sure? And I said, yes, we're going to do this. And in fact, that's the way it's turned out. Dindori, which is a very famous wine of ours, our Dindori Shiraz is possibly India's #1 premium red, is a taluka of Nasik district. That was something, that Kerry Damsky, our our advisor, Californian advisor, said, why not name it? I must credit him with this. Why not Dindori? And I said, yeah, actually, that has a nice ring to it. So, those kinds of things, we've been very proudly Indian since day one and continue to be.
How much of the journey is serendipity?
There is some in that. I mean, my dad was born in Nasik, right? So this is a big thing. And then when I came back to India, I had no idea I wanted to make wine. And we just went there for a family function. And, we just went out to this small piece of land. I've probably said this in 2001 as well. And, that was a place, grassland, with lots of cobras, leopards, all what have you underneath. And that has become the beautiful piece of land that is Sula today and has just created the wine revolution.
Welcome to the Global Dialogue. I'm Shireen Bhan. My guest today has been a regular on CNBC-TV18 since he took over as the CEO of Cisco, and that's now been a 10-year story. Joining him for this conversation today is the President and Chief Product Officer, Jeetu Patel, as well. Chuck Robbins and Jeetu, thank you so much for joining us here on CNBC-TV18. What an absolute pleasure to have the two of you back. Chuck, I want to talk to you about India, but before that, I have to talk to you about what's happening in the world. You also have a ringside view of what's happening in DC because you look at the business chamber as well. You wanted tariffs to be surgically imposed. It's anything but that, right?
I would say that's correct. I think where we'll land will be much more of a view. If you didn't know how we got there, you will think they were surgically deployed when we get to the end, is what my perspective is. I think the process we're going through right now is the way the administration wants to go about it. But I do believe that, look, they want a strong economy in the U.S. They clearly want to solve some of the trade barriers that exist around the world, and a lot of those are real. And I think their intent is correct. I think most of us in the business community would prefer a different approach, but this is the one we have, and I think they'll end up in a good place, though. I think they're going to end up in a good place.
He's made it clear that the tariff deadline has now moved from the 9th of July to perhaps the 1st of August or somewhere down that line. We don't know just yet. And perhaps there's room for further negotiations, even as far as the rates are concerned. But for a company like yours, you have manufacturing here in India, you have manufacturing in Malaysia, you have manufacturing in Vietnam. What does it mean for you? I mean, Vietnam, a generalized 20% tariff. Malaysia is now up to 25% from 24% as per the latest letter that he sent out. What does this mean for a company like yours that's manufacturing across the globe?
Well, this is the issue in the business community right now is the uncertainty just freezes everyone. Because if and when we get to the end game, then we can adapt appropriately. And so If you look at the tariffs that were put in 2018, I think it was, you know, we knew what they were put in, and we were able to kind of flex our dynamic supply chain in order to adapt to those things. And we'll do the same to the extent we can once we see what the end game looks like. But right now it's just it's a little more complicated, looking at a multi-quarter P&L for the business because you just don't know which tariffs you have to consider. So what we've effectively decided to do is we're just going to look at our numbers based on what's in effect today. And then, I mean, we can do all sorts of speculating and scenario planning, but tomorrow they could be useless. So
what's the impact as of today? As you said, we don't know what finally any of this will end up to be. What's the impact as of today?
Well, for us, it's not meaningful yet because a lot of the products that we sell are under the 232 investigation that is happening now, the national security view on some of the technology stuff. So as of now, we don't have meaningful impact, which again is the reason we're anxious to get to the end so we know exactly what we're dealing with.
Well, let's talk about India. I mean, it's been a 30-year journey for Cisco here in India. We spoke last year when you set up your facility in Chennai. How's the India story shaping up? And in the context of this global uncertainty and tariff uncertainty, what role do you see India likely to play?
India is one of the top 3 countries around the world from our perspective. If you look at the next 5 to 10 years from a growth perspective and an opportunity perspective, G2 and I came here together September, I think was the last time, and we left with this unbelievable view that we needed to begin to invest even more heavily here. And we were very pleased, I was very pleased at least, and that we had already made the decision to deploy the manufacturing platform. You know, we've had a couple of false starts on manufacturing over the years. This time we did it right. We went full node. We turned it into an export hub. We had a plan for multiple products. We're now doing PCB assembly. So we've got that rolling, which is a good baseline. We've got our R&D and Innovation Center in Bangalore, which is really good. We have an education program going around the country right now where we've educated millions of Indians with digital skills. I think 650,000 in the last 6 months alone. So we see a huge opportunity. And as we leave here, we see even more. I mean, by lunchtime yesterday, G2 and I had 5 more ideas of things we needed to be doing in India. So we're working on that with the team. So
G2, what are those 5 more ideas that we should expect you to deliver on from an India perspective?
I think if you take a step back, I mean, I'm from here. I actually grew up here, and there's such a huge advantage that India has right now because of the demographics, the young workforce. I think we are kind of in this mode of just getting into this AI wave, the second phase of the AI wave. You're moving from, chatbots intelligently answering questions for us to agents that are going to conduct, automate workflows and conduct tasks and jobs autonomously. And so what I think we have is this unique opportunity in India where there's going to be an exponential rise in throughput per capita. And that'll require India to make sure that they've got the right infrastructure build out. And just like you folks had the huge infrastructure build out during mobile, and you were very successful, I think there's going to be data center capacity build out that's going to be a huge opportunity for India. And I think there's hopefully a lot of opportunity for Cisco to participate in that and helping India on a couple of dimensions. One is to make sure that we're infrastructure ready, but second is safety and security. Yeah. I think with AI, there's a lot of concern that, if people don't trust these systems, they aren't going to get used. And so we provide the common kind of capabilities for safety and security. And so our hope is, whether it be with the public sector or the private sector, we want to make sure that we actually participate in helping India get the most of the advantage from AI that's possible.
I'll talk about the agentic AI inflection point that we're currently starting to see in just a second, but I want to talk about India in the larger context, Chuck. R&D facility, and Cisco's been a long-term committed investor in India, now manufacturing here in India as well. Do you believe that India could potentially offset, as and when we do have this trade deal with the US, could potentially offset some of the manufacturing uncertainty that you deal with today?
Well, I think they already are, and because we're not only manufacturing products for India, but if you look at the first product line that we brought up in the manufacturing facility here, it's the only line we have in the world for that product. So we actually distribute to the entire world for this product just out of India. So that's what I meant by making it a full node here. So I think that's our plan. We've added 2 more products since.
2 more products since. Yep.
And so I think it could absolutely play a major role. We're never going to consolidate everything. We're in 13, 14 countries. You got to have you need regional distribution for geographic reasons for high volume products. You have to take taxes and tariffs into consideration. You have to the risks associated with certain places, redundancy, resiliency, all those things come into play when our teams are thinking about how we run our supply chains. Proximity to components is another thing, which is something we need to get
done
going
here in India.
Yeah, it's a big thing we need.
So would it be fair to assume that you could look at adding capacity here in India anytime soon?
I think that's what we're doing now. Yeah, we're ahead of where we thought we would be relative to the volumes we're producing here now.
So what could that potentially mean in terms of expansion and investments?
Well, if it's being as successful as it is now, I think there's an opportunity for us to continue to grow it.
Okay. Jitu, let's talk about what's happening on the AI side. And I know that you previously said that AI is a seismic force, and you're seeing a major inflection point today as far as agentic AI is concerned. Now, from an infrastructure perspective, what's the role that you believe Cisco is likely to play? We're talking about AI hubs, we're talking about AI factories, but in real terms, what does this now mean?
Well, if you think of what the constraints of AI are, infrastructure is a big constraint, and there's a trust deficit. Those are the 2 big areas that we should think about. And on the infrastructure side, what are we constrained with? We're constrained with power, we're constrained with compute, and we're constrained with network bandwidth. Imagine if there were billions of digital workers that get added to the workforce that actually behave like humans, that are able to get jobs done autonomously. You're going to need a lot more network bandwidth. You're going to need a lot more compute. And you're going to need to be where there is power availability, because right now there's a shortage of power globally. And so that's where we come in the fact that we provide power-efficient networks that are low latency, high performance, that can really, really help kind of catalyze the movement for AI. And right now we've got some great partnerships all throughout the world in building out these data centers. And I feel like India is going to be a great market for that to happen as well, because there's also a need for sovereignty of data. So there's more and more nationalistic, priorities that are being pursued by countries, and so you're going to need to make sure that you honor those, and so we can help with making sure that those build-outs also have a sovereign element to it.
I want to talk about jobs, and you said that, look, the second narrative is more interesting, but I think the first narrative is what everyone's concerned about. In the near term, in the medium term, what does this mean as far as jobs are concerned? We've gone from some CEOs talking about the potential of having a white-collar bloodbath to some saying that this is going to be significantly disruptive. Chuck, what is this going to mean for jobs in a real way?
Well, I think there are certainly jobs that are going to go away. Any massive new technology innovation will ultimately replace jobs, even the advent of the internet and all the things that you now do online versus standing in line, as an example. So that's going to happen. There's going to be some basic stuff. I mean, there's a lot of discussion around basic contact center agents and things of that nature. But I think over time, what I'm telling my team is, figure out how you make your teams more productive, to Jitu's point, so that you can mitigate the number of new hires you need. I actually think you can look at this in 2 ways as a CEO. You can look at it as enabling your organization to move faster, deliver more innovation, and do greater things for your customers more quickly than you used to be able to. Or you can say, I'm going to make my company more efficient, and I'm going to increase my EPS by cutting costs. I think that's interesting in the near term. If your competitors take the other path, you lose. So I think you're going to see people aggressively use AI to try to move faster, So G2 and I have talked about like using AI coding capabilities, not to eliminate a bunch of engineers, but to increase the degree of the speed of innovation that we're able to deliver to our customers, which makes our engineering teams cringe because they're moving pretty fast now. But
I mean, what I would urge people to think about is worry less about AI taking your job, worry more about someone that uses AI really well actually having a higher risk to your job. Because if you're not dexterous with the use of AI, you will soon become irrelevant in your contribution. And that actually is going to be a far greater impact.
Yeah. No, I get that, and Jensen's been pretty much saying the same thing, but when you talk about net hiring, that you're probably going to look at hiring differently. I mean, in a real way, how much are you hiring today, and potentially what could that number look like maybe a year down the line, considering the fast-paced adoption of AI?
Well, we're still hiring a lot of people. I think we have probably thousands of recs open right now, so I don't think there's any danger on that. But what I'm trying to do is not have the 1,000 be 10,000. And it's early right now for people to get really comfortable with this. But our teams, all of our teams, the leaders that work for me, have a mandate to figure out how are you using AI in your function. How are you? And every CEO is giving his team the same, giving his or her team the same mandate. It's just that's just what it is. But again, I don't think it's about eliminating jobs per se. There will be some of that. It's about making your people more effective so your organization can move more quickly and take care of your customers more effectively.
I think if we think about the list of ideas we have and the amount of resources we have to prosecute those ideas, the list of ideas is far greater than the amount of people we have to prosecute them. And if AI can augment that, we would actually be able to prosecute a much larger list of those ideas.
So give me numbers. What is it meant in terms of efficiency? What is it meant in terms of productivity? What's the kind of uplift that we've already seen internally for Cisco?
So if you think about coding, for example, engineers, today the industry is starting to see maybe 15, 20% uplift in coding, maybe 30% on the optimistic end. I mean, could we have 70% of the code eventually written by AI, maybe 80% of the code written by AI? And what that would allow us to do is have engineers worry less about syntax and much more about ideas and architecture. And that's what we want to try to get to, is can we get people to actually up-level as a result of this? And so it's the lens we look at is not from a cost lens as much as what kind of throughput capacity per capita can you increase as a result of AI. And that actually gets exciting, because one of the most underhyped parts of AI is the original insights over time that AI will be able to generate that will allow us to think about solving problems we couldn't even dream of solving today.
Yeah.
And that's probably the area that we should be focused more on, because you'll be able to solve problems in every industry, by the way. Healthcare, the way we cure cancer should be very different a decade from now than what it is today.
Yeah, well, that certainly is the hope. that certainly is the hope. And 3 years from now, exactly.
You know, the worst thing about what he just said is my COBOL skills are not going to be needed anymore.
How have you upgraded your tech skills?
I'm way behind. I take him with me.
But speaking of upgrading skills, I mean, M&A, and is that going to be a large part of strategy as the AI era starts to unfold? You've done a large acquisition with Splunk, but how much of building out this AI capability is going to be organic versus inorganic, Chuck?
Well, the good news for us is that particularly since G2 has taken the entire product portfolio over, he's much more of a build it than buy it leader, which is good. And then if you look at what we've done in the last year, since Splunk, last year and a half, 2 years, there's two big things I would say. Number one, we have really thought hard about keeping our powder dry for potential acquisitions in the AI space. So we've kind of, with the exception of security, maybe observability and other things, we're sort of not looking anywhere else, because we just want to make sure that if something, because everything's moving so fast, so you don't know what's going to exist 6-9 months from now that doesn't exist today, or you don't know about today. That's the first thing we've done. And the second thing we've done is we've shifted hard to an investment strategy. So we have invested in, I can't even,
most leading vendors in the AI, I would say right now.
G2 has a new one every third day, I think, that he wants us to invest in. But it's been great for us because as we've invested, we've done it in conjunction with what does a partnership between us and them look like? What's the value we're going to derive other than just being an investor? And we thought about this when we started, but boy, the value of these partnerships, the learning, I mean, all of a sudden now Kevin Weil, the chief product officer, has joined our board, and he's providing immense value.
But Chuck brings up an interesting point. The strategy should never be about M&A in a company. The strategy should be about innovation and building.
Right.
If a company can accelerate that strategy, we shouldn't be shy to deploy our balance sheet. But it's a very risky thing to say my product strategy is going to be dependent on whether or not a transaction happens, because these things, I mean, there's a 1 in 10 chance that these transactions actually happen.
And especially with the valuations that we're seeing today. Well, what do you make of the kind of valuations that these companies are going at?
You got to remember, I'm old, so I've seen this movie. I've seen this movie a few times, and you know, water will find its own level at some point. It'll settle down, but we've seen this 2 or 3 times in the last 20 years.
We have, but you know, let's talk about what's real, and I want to tie this down to your numbers. You've already exceeded your $1 billion target as far as AI orders are concerned, coming in at $1.3 billion. What's the expectation now?
Well, the expectation is more.
How much more?
Well, we said on the last earnings call that we weren't going to give a new target, because when I gave that target, first of all, when I walked off the earnings call, my team looked at me like I was crazy, because they were like, well, where'd that come from? Not really, but it was me putting it out there because I wanted to indicate to the investors that I was serious about my belief that we were going to have a role to play in the infrastructure for AI. And I wanted them to know that I'm putting this out there to tell you that we're going to. And one of our competitors put out a number that was slightly less than that. And I think that competitor was viewed as being better positioned. And then we have since blown through that number. And so now they're just going to see it show up in our continued, you know, our steady growth that we're going to show as a company going forward, because it's only getting bigger. And it's expanding in the enterprise. We're really just on the front end of the enterprise play here.
Yeah, you know, you're right in pointing that out, and Jeetu, that's what I want to understand from you, that you know, the big story that's playing out at the enterprise side, you've already surpassed the target that you set for yourself in terms of AI orders of $1 billion. At the enterprise level, in terms of the pace of adoption, what are you seeing? What could that number potentially look like?
Without giving a number, let me actually give you the larger trend that's happening in the enterprise, where you're seeing re-acceleration of private data centers also in the enterprise for AI inferencing workloads. And that'll actually have a positive effect for us, because we'll be a benefactor of that, because we provide compute, we provide networking, we provide security, we provide a full stack solution. All of those things actually help enterprises where infrastructure is today still too complicated. We got to make it plug and play. And Cisco has all of the software and hardware and full stack capabilities. We make our own silicon that really helps to provide that full stack. In addition to that, I'd say that what you should keep in mind at a macro level is, and I'm thinking about this phase as the second phase of AI. The first phase was chatbots, the second phase is agentic. The chatbot phase, the inference volumes are very kind of sporadic. You'd see peaks, but you'd also see a lot of drops in inferencing volume. Whereas in the agentic era, imagine if you have an agent that today probably works autonomously for 20 minutes.
Yeah.
Eventually it'll work for 2 hours and 2 weeks and 2 months and 2 quarters. When that happens, there's going to be a much more persistent, sustained demand for inferencing, which is going to just be a direct benefit to companies like Cisco who provide the infrastructure. So you should think about Cisco as an AI infrastructure company, very similar to the way that during the gold rush there were picks and shovels companies that benefited. Cisco is going to benefit because we provide and fuel the infrastructure.
And we haven't even talked about what robotics are going to do to the exactly. Robotics are just going to take it.
Yeah, physically I will be
to another level.
Yeah. You know, but what are we talking about in terms of timelines by when this could potentially be real on the ground, humanoids, robotics, all of that, and the kind of disruptions that we're likely to see on account of that? Well,
I'll give you a couple comments, and G2, he's deep in the middle of this, but I think on on the robotic side, you see it in manufacturing today, you see it in industrial companies today, and it's only going to continue to expand. You see it in surgical rooms, operating rooms, right? So I think that's place. From a humanoid perspective, I don't know what you're...
So I would say right now what you're seeing with robotics is special purpose use cases are what will actually get adopted first. One of the big benefits that we had with language models is you had a lot of free internet data that you could train the models on. With world models, which is the models that you need to have for physical dimensions of robots actually getting trained on it, we just don't have enough data in the world. And so that takes a little longer. So a generic robot that can do everything from pick up your kids to, from school to go cook a meal for you, all of those pieces aren't going to happen for
I just saw a robot cook a meal for me while we were in the valley, but picking up your kids, I mean, how far out is that?
Well, that's actually closer because of the autonomous vehicles.
Vehicles, that's right, yeah.
But what you will see is these robots will be special purpose, and you're not going to have one generic robot because the models take a long time to train because we just don't have as much physical data. But I think even over the course of the past, I'd say 6 months, the progress that's been made in the robotics side is pretty huge.
Well, let me end then by asking you, Chuck, you said that chaos is the new normal that CEOs have to deal with, but really this kind of chaos, is it going along as per expectations, or has it defied your own expectations of how chaotic it was likely to be?
I did say that because most CEOs today have sort of developed as executives during this 20 years of sort of on and off crisis mode and uncertainty and chaos. And so it's you don't find a lot of CEOs that are going, well, I think I got to slow down for a while till this thing settles down, because nobody believes it's going to settle down. I mean, and now we're dealing with so many complexities. You're dealing with the tariff situation, the geopolitical dynamics, the wars, the supply chain shocks, the nationalism. I mean, it's a super complicated world to navigate. But I think most CEOs wake up every day and say, this is the world we have, so we just got to go get it done.
So it's not wait and watch, and it's not pause. You're saying you're making the investments that you need to make.
You have no choice. Yeah. You may have temporary pauses, like I was talking about. Like our team's not making a ton of investments on moving supply chain elements around right now because we need to understand the end vision first.
Yeah.
But in other areas, you have no choice. You get left behind. You will absolutely get left behind.
So let me end by asking you for the India number. What's the aspiration on how much you intend to export from India, and how much you intend to also invest or add in terms of capacity in India?
I have no idea. I will tell you this. G2 and I are pressing our team in a massive way here that we should be able to triple the size of the business here in a much more compressed window than our team believes. My team's listening to this interview right now, so we want to make sure. And that's going to require us to invest. It's going to require us to invest our time and our team's time. G2's coming here with his entire product leadership team in January. They're going to do an offsite here. We're going to host a big event here that's going to focus on cybersecurity, AI. And so we have to invest here to enable our teams to actually achieve what we see as being possible, and that's what we're going to focus on.
Well, we look forward to seeing you both again in January, and appreciate you joining us here on CNBC-TV18 to talk to us about what's happening in the world and what's happening here in India. Chuck and Jeetu, many, many thanks for joining us on the Global Dialogue.
Always great to see you.
With that, it is time for us to wrap up this edition of the Global Dialogue. From all of us here on the team, for now, goodbye. Many thanks for watching. The news will continue on CNBC-TV18. and welcome to On the Record with me, Shireen Bhan. My guests today have a 30-year legacy in the real estate business. They delivered India's first real estate trust, and they've also delivered 75 million square feet. Joining me now to talk about the real estate sector's trends, but more importantly, what's ahead for the Embassy Group, Jitu and Aditya Virani. Gentlemen, appreciate you joining us here on the program. Let me start by taking you back. It's a 30-year legacy, as I pointed out, for you. A lot has changed in India's real estate sector. Plenty bad, but some good as well. The last few years have been good for the real estate industry. How would you sum up the journey so far?
So when I started on this journey and I joined my father, there was a whole sense of people who were making these smaller buildings, smaller offices, doing construction really the crude way. There was nothing comparable to what it is today, because today the industry is as international as anywhere else in the world, you could see. We had all these Gujarati contractors all over the place. People always were looking, all developers always thinking of how to build an extra floor. And, this over the time just transformed into these large business parks and, large developments in one location. And I think it's just the evolvement of maybe the newer generation stepping in. Wanting to do things differently, and I see I'm in the middle region where now I have kids in the same business, and I can see that they want to do things more differently than I did. And I would see the journey. The office space was, my father built office space with 500 square feet office space. The toilet inside was just for the owner of the office.
Yeah,
and people strolled down the corridor to use the common toilets. And now all of a sudden we have these large business parks with huge floor plates, and concept of single office hasn't gone. And I think that's given the birth of flexi office, a great opportunity. So I think it's just the people, the newer generation coming in, and India's fast adaptability to international standards, and to a lot. I think there's a lot of these for companies coming in, the GCC companies, the internet companies coming in. I think technology companies, that's actually changed the outlook, how Indian developers started looking at his product. And a lot of design elements started coming in. Otherwise, there was no design. I still remember in 1996, I appointed a lighting consultant, and my father told me I was crazy to spend so much money, because all of them built nice buildings, but nobody lit them up correctly.
Yeah.
And that was a big thing. So you learn traveling abroad, you see things, and you want to implement it. And now I'm the victim of the same that my dad was.
They're telling you what to do now. It is.
But yeah, so the whole cultural thing was, to make this one building, look at the laws, try to exploit everything from one development, which I think is, taken a backseat. And I would honestly, not because I'm in this business, but I would say that all my colleagues in the business and generally the business in India, we are as comparable as any international developer anywhere in the world.
Well, he talked about the next generation. So let me come to you, Aditya. It's been about 9 years for you at the Embassy Group as well.
Yeah.
As you look at the road ahead, the legacy that you take forward as well, and the opportunities that you are looking at, how different is the landscape today from what he inherited?
Yeah, look, 9 years have flown by, and even in those 9 years, I've seen a transformation of what Indian real estate was then and what it is now. And I think the big theme is the institutionalization of the asset class. Moving from these small offices that were strata sold, financed off plan, to now very institutional, large ticket. We did the first REIT, these large assets that are owned by huge institutions or REIT type of a trust. I think the whole financing of the asset class has changed. I think the whole design aspect of the asset class has changed. And I only think it's going to keep evolving, and you're going to see that strata grade B office actually slowly die a slow death. And that's the way forward actually for this asset class.
When we talk about the way forward, and you've set some pretty aggressive targets in terms of what you believe you're going to be able to deliver. As I pointed out, you've already delivered 75 million square feet. What's the expectation, given the fact that everybody believes that this is going to be India's moment as far as manufacturing is concerned, this is going to be India's moment as far as GCCs are concerned. Real estate has been seeing an upswing with regulatory changes like RERA, etc. coming in. What are we really talking about in terms of penetration, in terms of untapped potential?
I think that I mean, there are big industry stalwarts in this, but I don't think anybody has a clue that what we're in for, because urbanization, is actually right now at a much slower pace than it should happen. And as that happens, and I think, for the younger generation, it's a huge opportunity where it just is going to explode multiples than what has already happened. People are always looking at the luxury market, but it's the mid segment.
Hello and welcome to the CNBC-TV18 special. Over the next 30 minutes, we are unpacking a trend that is both massive in scale and quietly reshaping ownership in corporate India. We're going to be talking about promoter stake sales.
India's promoters, the ultimate insiders, have been steadily selling down their stakes. And this isn't a short-term trend. Over the past 4 years, data shows that a clear trend of exits of promoters is accelerating. Promoter holding across listed companies is falling.
Well, but here is the paradox in that sense, right? The other side of the argument. In a market which is flush with retail inflows, where earnings momentum hasn't always kept pace with liquidity, could this steady promoter selling have actually prevented the market from melting up, overheating in that sense?
And to make sense of this, we are joined by someone who's watched India's capital markets for over 4 decades, whose voice is as respected by promoters as it is by investors. Ramdev Agrawal, co-founder and chairman of Motilal Oswal Financial Services. He's also our guest editor for the day for the next 30 minutes.
So, as always, Rima and I'll take it easy, and Ramdevji will conduct the questions in just a bit. Our expert panel also, though, comprises of Pranav Haldia, who will be doing some of the answering to Ramdevji's questions. He's managing director of Prime Database. He's, of course, crunched the numbers on stake sales and ownership patterns as well. We have Rahul Saraf, India head of investment banking at Citi India, to decode the rationale behind these exits and also what promoters are doing once they sell with that money. And of course, Feroz Aziz has joined CEO at Anand Rathi Wealth on how a chunk of this promoter cash is actually making a comeback right into the market in a different avatar, not just stock markets, but all kinds of financial assets as well. But, before we get to the conversation and the Q&A, let's just start by laying out the data and what this puts out, just to frame our discussion in the right context. And here is the data. Over the last 5 years, private equity and venture capital exits have surged. In 2023, sell amounts crossed 1 lakh crore for the first time. And 2024 saw a record 534 deals worth over 1.15 lakh crores. In just the first half of 2025, we've seen nearly 37,000 crores worth of exits. Now, this trend is even more striking among company promoters. These are private promoters that we're talking about. In 2023 and 2024, promoter stake sales touched 1.16 lakh crore and 1.1 lakh crores respectively. This is almost double the amounts seen just 2 years ago. In 2025, we've already crossed 64,000 crore rupees. And by the way, it's only July, so I mean, you've got half a year to go. As a result, private promoters' shareholding, I mean, if you just look at these numbers, how it's impacted their shareholding across listed companies on the NSE, it's steadily declined. From 45%, which is what private promoters held at the end of 2021, it's now come to under 41%. That's about 4.5% percentage point drop in just over 3 years. It's massive. On the flip side, where has all this money gone? Domestic institutional investors, powered by largely SIPs, have been stepping up with their shareholding, which has risen from 13% to over 17% in the same time period. So it's almost a transfer from promoters, private promoters, to institutional shareholders, which is largely DIIs. Here's the kicker. For the first time ever, possibly, the value also of DII holdings now exceeds that of FIIs. FII ownership of listed companies was around 16 lakh crores more as compared to DIIs. Basically, it was FIIs owned 16 lakh crores more of all listed companies over DIIs in 2021, right? That 16 lakh crore has all but disappeared, and then some. DIIs actually now own about 1.6 lakh crores in listed equities more as compared to FIIs. So actually, I mean, it's been an absolute dramatic change in terms of the composition of the market, even within institutional shareholders. And DIIs have really emerged as the big kind of, block which has absorbed a lot of this supply which has come in. So that's the data. But now let's get the context and the perspective. Ramdeji, great to have you with us here. Yes. Thank you very much for joining us.
Very nice to see you.
And the data is striking, right? There is no doubt about it.
I was broadly having, but you put it very nicely. The data is absolutely crystal clear. That trend is building up. And, one of the things you said in the beginning, so retail investors are giving a floor, the resilience to the market. And the promoter selling is going to give that, it is going to save the market from melting up. So that's a fantastic thing to have, because it avoids a crash in the market. It also avoids the melt up in the market. Okay. Second, and this gives a sustained expansion of the capital market activity. Because if you have floating stock of say 30%, or there are a lot of companies there are 25, or government companies there are 15, 10% is there. So your activity is going to be small. But as your floating stock, which is now 60% on aggregate basis, floating stock goes to more like 75%. So what happens is that all the market intermediaries, one is the index, because of index expansion, say by 12-13%, and other is the volume expansion by 4-5%. So more customers, more stocks to trade, and of course the tailwind of economy, which is sustained at 7%. So I think it's a complete Goldilocks kind of situation, because in the stock market, any kind of melt up is borrowing from the return of the future, which creates problem. Now it will be very good for the market and for the market sustained
expansion. The numbers we put out, it shows that private promoter holding is now about 40%. It's come down about 4.5% in the last three years, roughly. You think this pace will continue at this rate?
If you see, now there are two things. Prices of the stocks are not determined by who is buying and selling, because number of stocks remain same fundamentally. So what decides the price of the stock is the earnings momentum. You see Indigo, they sold I think 25-30%, and at every price from 1500 to almost as late as last week at 50. So, and both the promoters have sold. So clearly market wants earnings growth, the company to become bigger and better. If that is happening, so in aggregate, if the Indian corporate profit, which is about say 15 lakh crores, that goes to say in 2 years time or 3 years time to 20 lakh crores, I don't think who buys sells. Then actually the game will be even bigger for the capital market participants. Foreigners will come, domestics will come, and more stocks will be there. So the stock price will not be impacted. But temporarily what will happen is the stock, it also depends on, because promoter knows the value of the company and what is going to happen in next 3, 4, 5 quarters or something like that. If the motive is not that much positive, See, if I want to set up a family office and I sell by 5-10%, or I want to do philanthropy and I want to sell, that's a very ultimate positive thing to happen. But if I know for sure that outlook 2 years down the road is going to be very bad, or he can see that, and because of that, it is being sold. So that will have little.
What a sea change, right, Rima? I mean, 10 years back, 15 years back, I remember. I mean, promoters used to sell, and we used to.
It was a taboo.
It was one of the red flags.
Yes.
With companies, promoter sales.
Yeah.
But not anymore.
Yeah. So this is the maturity of the market. I mean, in US, all the promoters, like I believe, Bill Gates holds hardly a percentage or two of Microsoft. So he has sold across. I mean, over the year he has sold. Jeff Bezos, this thing, Musk. They keep selling, and that to a good chunk. So markets are not that much perturbed in US, and hence that broader trend. This is an expansion of the market. We are about 5 trillion. In next 4 to 5 years, 6 years, will become 10 trillion large market. And it is required. This kind of liquidity buildup is required because we've got tons of small companies. If you have 60-70% owned by the promoters, how, I mean, where is the depth? I mean, a lot of fund managers, they won't be able to participate in those stocks because whenever you go to buy, the impact will be 10%. When you go to sell, it will be 15-20%. So that makes the market very primitive. So this is the best market, yeah.
So it's a sign of market depth and not distress.
No, not distress for sure, yeah.
So what are the broader implications of this? You spoke about how that this is a structural positive for everything related to capital markets. So from an investment point of view, if this continues, should one be looking at brokerage stocks? Should one be looking at wealth managers or some of these exchanges? I mean, what's the best way to play it?
Yeah, so now from here, the next derivative starts. Who are the guys who are selling? So all the market intermediaries, like the guys who are going to come, they are the guys, iBankers, they are advising them to sell. So that, I mean, they are going to make their own fee. Then after that, see how do I say, this promoter holding doesn't exist actually. It exists only in the digital paper. That 50%, 1 lakh crore value of the company, 50,000 crore has no relevance for the market. It's just there for decoration. But the moment you melt it, it is there for everybody. I mean, first the promoter is free to consume for their own consumption and philanthropic purposes. Nobody can do philanthropy by not selling the stock. I mean, just the dividend is not good enough to kind of do big projects. So that is one. Second is that promoters can also look for parallelly promoting a very large, kind of new ventures in the family members or themselves, and unrelated family ventures. So basically, if you are a textile company and you want to get into steel, now you would not like to diversify within the textile company that particular thing. You sell 5-10% and promote for 1,000 crores, 2,000 crores, another equity base, and promote a new venture. So a lot of these possibilities are there. Wealth effect will be there. You can consume. I mean, you see all these 400, 200, 300 crore flats being bought. They are all coming out of the market cap melt down, whether it is IPO, whether it is QIP, whether it is actual selling. So wealth effect has to come.
As an investment house, what is the capital markets has been your favorite area?
Yes, so I can see what happens. One is that, of course, one time the deal value and then some commission you make. But that's the smallest part. Immediately this money comes in wealth management. So wealth managers, they get the corpus. So 2, 3, 4 of them will be nominated and everybody will get very large chunk of, I mean, you can see large deals and all the money is again coming back to the market. So actually at one level they provide the, what you call, melt up against the melt up, and again they come back to give the flow to the same market by diversifying the portfolio.
Correct.
So that activity is, so it expands the wealth management platform, it expands the AMC platform because wealth managers, they allocate the money to the mutual fund products or private equity products. So every aspect of the capital market activity will get a boost.
You said that there could be multiple motivation why a promoter may want to sell part of his stake in the company, right? Some will be altruistic for philanthropy purposes, etc., diversification, next generation. But then you will always have these few bad, apples. So how can a retail shareholder identify and beware? What are the warning signs in such cases?
It is for the person who is buying the stock. His consideration is not who is selling, because in any case he's a non-owner of the company. So he is going to buy the company, and it is coming from whatever sources it is coming from. It is coming from existing retail or it is coming from the promoter. It's a legitimate source for him. Just because the promoter is selling, the prospect for the future is not changed. But since it is coming from promoter, he should be a little extra cautious. Why he's selling? Maybe he can ask the broker, or he can ask the selling party what exactly is prompting you to sell. Probably most of the time you know why they're selling.
You know what we're going to do, Ramdeji, is take that commercial break, and then we'll get you your guests, not my guests, your guests on the other side. So, we'll do that. This discussion continues, but we'll widen the scope. Ramdeji mentioned wealth managers as a space. So we have Feroz Aziz of Anand Rathi joining us. All the data that I put out in the beginning, that was coming from Prime Database, and Pranav Haldia will join us, and he's got a really good eye for data in terms of what is coming up ahead as well. And of course, making a lot of these deals happen is Rahul Saraf, India investment banking head for Citi. So all three on the other side with Ramdeji coming up. Welcome back to our special market show. The market editor, and of course our market editor today is Ramdev Agarwal of Motilal Oswal Financial Services. We also now have Pranav Haldia, Rahul Saraf and Feroz Aziz with us to give us a rounded perspective. And I'll throw it across to Ramdevji in just a bit. But Pranav, that data that I used to kind of set up the entire discussion came from Prime, and excellent data as always. And that question which I put to Ramdevji, and he also said you'll have the best idea. Is the pace of these sales, as you see it in terms of the pipeline, I mean, is it as strong? What we've seen over the last few years has been very strong. Is it likely to be as strong going forward as well, both in terms of the IPO pipeline, secondary sales, PE, VC exits? What's your sense?
Firstly, I would just mention that I think with all the promoter exits that you've seen over the last 2-3 years, there's really no reason to panic. The calendar year 2023 saw 36 lakh crore of promoter exits, and calendar year 24 saw 1.40 lakh crores. And this only includes bulk and block and offer for sale, which is used by promoters to meet the minimum public shareholding requirement. But you've seen that there's not been any meltdown in the secondary market. And in fact, we're going from strength to strength. So I think, this is, going forward as well, one can expect a lot of promoter sell downs taking place. We have to understand that, given the kind of IPOs that you've seen over the last 2-3 years, there are a lot of promoters who need to exit and bring down their stake to about 75% within the 3-year timeline to meet the minimum public shareholding requirement. And, block deals is one of the means which they use to reduce their stake. Even apart from this, you are seeing, of course, promoter exit for a whole wide variety of reasons. When promoter is buying, it's always considered to be a good sign. In my view, it should be always taken as a good sign. But when the promoter is selling, I think that's something that you alluded to earlier as well. It can be for a whole wide variety of issues. Of course, one of the issues can also be to, book some profit. They might feel that it's already well priced or the future may not be too bright. So as an investor, I think it's very important to keep a close watch on both promoter buys and promoter exits. One final point I would like to make as far as promoter exits are concerned is that, one of the things which we need to look at, apart from for the reason of sale, is also that the promoter should continue to hold a good amount of stake post the deal. And the deal should not have idly happened at a huge discount. So if these things are in place, then I don't think it's a really worrying sign as far as investors are concerned.
Rahul and Feroz are with us. Rahul, let me ask you. You work in so many deals and you're in touch with so many promoters who come to you for all kinds of things. What is the underlying motivation, as you see it, Rahul? I mean, the bulk of it.
Sure, Prashant. I think if you step back in terms of the capital allocation needs of the family, whether it's to create a family office 5-10%, whether it is to buy a big house, as Ramdev said, or is it for diversification? I think all of those are very important factors to understand what is the motivation. Is it for philanthropy? And what we've seen is Indian promoters are actually selling for any of these 4 reasons, but not necessarily to sell because they don't believe in the business. In general, when we see 45 to 40%, bulk of that is, yes, 1 or 2% or 3% sell downs, but you have to put in context the MNC sell downs. Some of the promoters who are MNCs have sold down for capital allocation needs globally. Private equities who are promoters have also sold down because that's their business to, of course, sell down over a period of time and churn capital. Pranav talked about new age companies who actually have very low founder or promoter stake by itself. That skews the data as well. There will be some dilution of stake as well because new capital raise for growth has happened. And then last but not the least, in some cases, the minimum public shareholding has to be met and therefore promoter sell down. So all of that has to be put in context when we look at the promoter sell down, both in absolute terms as well as in percentage terms. I think that therefore the motivations have to be looked at in that context. And yes, 5%, 7% sell down is okay. But I don't believe that Indian promoters, Indian families will have a significant sell down all the way to 25% or below, because as a culture, we have the culture of passing down to the next generation. The big family offices that are getting created are still getting created on the back of control on the basic flagship business. That control is not going away. As against in the West or even in the East, like if you take Japan, the inheritance tax is there, where for the next generation, they have to pay 55% tax. And the only way they can pay is by selling the stake. So I think some of that has to be put in context when we think about what happens 5 years from now or 10 years from now.
Feroz, on the subject of setting up family offices, how much of the money, to your mind, is fed back into the capital markets, re-enters the capital markets?
Yes, Rima. Before I go to that question on the previous topic, I have 3 important points which I want to make. And I really pray Ramdevji's 25% happens. Because in the S&P 500, we are looking at close to about 80% of the companies have 100% free float. And we have not more than 10% of them who have more than 80% free float. There are only 6% of the companies who have more than 90% free float. We are a country with promoter holding, financialization happening. If there's a paradigm shift and there's capital movement, we are a country with 940 lakh crores of household savings, adding 40 lakh crores, out of which only 6.7% is in equity. and largely top 500 companies, because that's what is mandated to domestic institutions as their tier 1 benchmark. So if there's no promoter holding, there will be bubbles, retail will lose money. That's point 1. Point 2, if I personally think that there's hardly any promoter selling in NSE 500 companies. Let me put some math to that table. Out of the Nifty 50 companies, 5 of them have done a stake sale in the first quarter. In the last year, if you look at Bharti Airtel, okay, and Kotak, very second decimal, and Bharti Airtel was 1.21%. After dilution, there's still a promoter holding of 52%. In NSE small cap, which is a little more flamboyant kind of an index, you have a sale from HFCL Limited, and after the sale of 4.2%, we still have a 34% promoter holding. So 34% it's not the last mile out, right? And if you go with this, these are the top 5 sales in those indices of 250 companies. Top 5, the fifth top 5 is 1.58% dilution and is left with 53% promoter owning. So that's point 2. Point 3, if Jane Street should not happen in India again, which SEBI has very rightly, under the auspices of great executive directors there who understand derivatives, your cash market has to be liquid. Otherwise, there could be manipulation in stocks using derivative markets. What did exactly Jane Street do? That was already, on your channel, I've said this twice, that it's so easy. If you have 250 stocks in the derivative index, if cash market free float is not there, वो stock move करेगा, put call खरीदेगा, और पैसे इधर से उधर transfer करेगा. You lose money in cash, you make significantly more money. So having low free floats creates manipulation opportunity and overpricing. So that's on point 1. Point 2, does the money find back its way in the family offices? The answer, like Ramdevji said, it's absolutely right that it comes back into the capital markets. Point 3 is, I think the money temporarily comes into capital markets. Anybody who is in the business likes to pull that money over a period of couple of years back into doing another business. But Uday Kotakji had actually said that the next generation of those big promoters actually want to just manage the money. So I think immediately 90% of the money comes back into capital markets, 30-40% goes back into the economy, rightly so. And because the debt capital is more expensive today, for the last 2.5 years, repo rates have been at 6.5, and that's why equity valuations plus high interest rates is creating promoter selling. And that's project is viable at equity. You don't need debt for it. So that's why you see they're deleveraged.
Yeah, no, absolutely. Ramdev, just a quick point. I mean, as Virosh said, Rahul said, a lot of the money is family offices, comes back into the market. So they're diversifying in that sense.
Yeah.
Actually, isn't that also a signal, as we were saying, they are the promoters are the ultimate insiders. If they are, so essentially they think that this is a great time to actually take some money, put it into family office, all kinds of other financial assets, house, whatever, right?
Yeah.
And then and maybe, as Firoz said, later use that money to start something new, not the business in which they first sold. So is that a bit of a signal at all, or no?
It depends all on the company, you know. Like some of the companies, say like in Indigo, you know, one of the partners is kind of just going out of the partnership. So he sold his entire large chunk, 25-30%. So that is a dissolution of partnership. He was a promoter. So that kind of thing. So every company will have a different reason. You know, I'm only worried about one concern where company knows, because promoter knows everything. I mean, if anybody knows the future of the immediate future, 2-3 years, it is the promoter. So, unfortunately, the investors, they have a very patchy knowledge of the future of the companies. And hence, there should not be arbitrage between the person who knows a lot more to the person who knows a lot less. That should not be the motivation. Otherwise, if I want to buy a house, I want to diversify into a new business, you have fundamental right to, I mean, that's the basic purpose of listing, where you can have the cake and eat it. I mean, in 75% also you control the company, at 50 also you control the company, at 10% also you control the company, if control is an issue.
Thank you once again for joining us here, Firoz. Great that you could come down. Appreciate your time here. Rahul, appreciate you joining us. And next time, hope to see you in the studios. And Pranav, thank you very much for providing all the excellent data and, of course, the perspective as well. It's a wrap on this edition from Breema and me. Thank you very much for watching this edition of Market Editor.
Hello and welcome to India Business Hour. I'm Ashmit Kumar and here are the headlines that we're tracking this evening. TCS reports a 3.3% revenue decline on a constant currency basis sequentially in Q1. Margins beat estimates, deal wins remain steady but drops below $10 billion. Company says attrition at nearly 14% is above its comfort zone. Glenmark signs a landmark licensing pact with US pharma company AbbVie to develop and sell a drug to treat multiple myeloma. Glenmark retains rights to India and emerging markets. AbbVie will pay $700 million upfront for exclusive rights to North America, Europe, Japan, and Greater China. Rohit Chawla steps down as the CEO of Hindustan Unilever after 2 years at the helm. Priya Nair, who is currently the president of Beauty and Wellbeing at Unilever, will take the reins, becoming the first woman to lead India's largest consumer staples company. Public sector banks raised concerns about the efficacy of the IBC resolution process after Supreme Court judgment in the Bhushan Steel case. Sources say that 3 major banks have told a parliamentary panel that the judgment, which scrapped JSW Steel's plan, may open doors to retrospective challenges and impact investor confidence in resolutions. Finance Ministry may be considering a 32 to 35,000 crore fund to compensate state-run oil marketing companies for their under-recoveries on LPG. Sources say that proceeds from petroleum excise duty may be used towards compensating the companies. Government plans to step up the divestment drive. Sources say the sale of IDBI Bank should be completed by October. Stake sale in LIC gets the green light along with other public sector banks. SBI and other state-run banks will also raise 45,000 crore rupees through a qualified institutional placement. US President Donald Trump threatens to impose 50% tariff on Brazil, cites the trial against former far-right leader Bolsonaro as one of the reasons. Brazilian President Lula says his country will respond with reciprocity. Trump also sends letters threatening higher tariffs to 6 other nations. Supreme Court raises serious doubts over Election Commission completing the Bihar voter roll revision within the stipulated timeline. Asks the poll body to consider Aadhaar, voter ID and ration cards for verification. Questions why the Election Commission is refusing to accept Aadhaar and voter ID, which was issued by the Commission itself. At least 119 people confirmed dead after flooding in the US state of Texas. More than 100 people still remain missing in what is the worst flood to hit the US in nearly a century. Well, beginning with the day's trading action, the market failed to hold on to opening gains, with Nifty and the Sensex falling 0.5% each. The Nifty gave up 25,400, while nearly 40 stocks ended lower. IT stocks, banks, as well as PSU companies led the fall, while realty and metal stocks bucked the trend. Well, here's the top story this evening. Q1 earnings season kicked off with a mixed bag coming in from TCS. The IT giant reported a 3.3% revenue decline on a constant currency basis sequentially in the first quarter, while margins beat the estimates. Deal wins remained steady but dropped below the $10 billion mark. Reema Tendulkar now joining us with the TCS Q1 report card. Reema, take it away.
So the one-line summary of TCS's numbers is that growth disappoints. It's a much weaker start to the financial year. Margins are in line, deal wins are steady. So the company's top line, constant currency revenue growth, has declined by 3.3% on a sequential basis. This is much worse than consensus expectation, which was anticipating a drop of 1.4%. The problem is the international markets, which is ex of BSNL, which has been propping up growth in the Indian market. So one, the contribution of BSNL dropped sequentially, so that explains the reason for the revenue decline. But even the international markets, revenues have fallen by nearly 0.6%. And again, it's the global uncertainty which weighed on growth. Deals got deferred, deals got paused. No major cancellation, not big, but decision making was impacted. So all that hurt the top line, and it was much worse than what the company and the street was anticipating. On margins, 24.5%. marks an expansion of 30 basis points on a sequential basis. One reason is there were no wage hikes this time. And two, there was a slightly lower contribution of BSNL sequentially, which was margin dilutive. Deal wins have been fairly robust. They've come in at $9.4 billion, lower compared to 12.2 in the prior quarter, but largely in line with the 4-quarter average. Headcount went up by nearly 5,000 on a sequential basis. This perhaps can be explained because the company added to their headcount, anticipating a recovery in demand, but that recovery in demand didn't take place. So the company was just left with higher capacity. Attrition also inched up a little bit, 13.8% versus 13.3%. But in a nutshell, growth still remains very uncertain given the tenuous global environment, and the company's Q1 revenue growth has disappointed the street.
We are still confident and optimistic that international revenue in FY26 would be better than our FY25 revenue. Overall, it will be too early to call out when growth will resume, which to a great extent depends on more clarity emerging in the macroeconomic scenario. But I think with all the trade discussions coming to a close, the new bill that's been enacted in US gaining presidential sanction approval, I think things should become clearer maybe towards the end of July or early August.
It's a little more than our comfort level. We are 11 to 13% is our comfort range. It is a little more than that. We continue to make efforts to bring it down. Through continuous employee engagement, doing all the right things which we normally do with our people, we continue to do that and bring it down. Is what our aspiration is always, and that is what we will continue to do. We honor all the offers. It's very important that we honor all the offers. That we will do. So that process is gone, and we have offered. So we'll go through that. How and when that will happen, how many will come in each quarter, will depend on the business situation.
Well, the other big story this evening, Glenmark has signed a licensing deal with US pharma company AbbVie to develop and sell an oncology drug to treat multiple myeloma, which is a cancer of plasma cells. Glenmark will retain rights for India and emerging markets. AbbVie will make an upfront payment of $700 million and could pay up to $1.2 billion. Speaking to CNBC-TV18, Ekta Batra, Glenn Saldana said that he expects the molecule to transform the multiple myeloma space. He added that the molecule is currently in phase 1 and could be commercially used in the next 4 to 5 years.
Clearly, this is a huge moment for us, right? I mean, we've been working on this for 25 years in the innovation space, and I think 2001 really is a world-class asset, right, which can be transformational for patients. From a partnering perspective, the way we've structured it is we've partnered with AbbVie for US, Canada, Europe, China, Japan, most of the developed markets, and Glenmark will commercialize this product eventually, right, in India and all emerging markets. So the two of us will make sure this asset is successful going forward.
So explain the financials to us. $700 million is what you would get upfront, $1.2 billion in terms of milestones, and the remaining would be royalties.
That's correct. So we get a $700 million payment upfront, and as soon as we get regulatory approvals, that money will be received by us. The milestones, the $1.2+ billion of milestones, are spread into clinical development milestones. So as the molecule progresses to clinics, we keep getting milestones. Regulatory milestones, so as the molecule gets filed in various markets, we get and approved, we get milestones. And then we get sales-linked milestones. So cumulatively, that number comes to $1.25 billion, for the asset. And then once it's commercial, we get royalties on sales, which, as you know, some of these innovative products, the life of the royalties is pretty long. So this could pretty much be an annuity if the molecule makes.
When do you think that it will probably hit the market or show any kind of results?
So AbbVie takes over all clinical development from here on. In terms of time frame, I mean, I can't give you a specific time frame, but typically molecules, if you look at other assets, right, in the space, they typically take about 4 or 5 years at least to get to commercialization.
Well, a big change at the helm of India's largest consumer staples company, Hindustan Unilever. Rohit Java has stepped down as the MD and CEO of the company. Java was appointed in June of 2023 and has ended his stint at the helm after 2 years. Priya Nair, who's currently heading the beauty and well-being division at Unilever, will take the reins. She will be the first woman to lead the company and has been appointed for a tenure of 5 years. Java's tenure will come to an end on the 31st of July. Priya Nair joined HUL in 1995. She became the executive director of the home care business between 2014 and 2020. From 2020 to 2022, Priya Nair was the executive director of the beauty and personal care segment. Since 2023, she has been the president of well-being and beauty divisions at HUL's global parent company, that's Unilever. The HUL stock has underperformed under Rohit Java's tenure. The stock declined by over 9% since Java took charge of the company in June of 23. In contrast, the benchmark Nifty 50 has rallied by 35% during the same period. Now, to Delhi action now, the finance minister is likely to seek the cabinet's approval to allocate a compensation package for oil marketing companies. Sources have told us that the package will be worth around 32 to 35,000 crore rupees. This package will be used to offset the losses the companies incurred from selling subsidized LPG in the current financial year. The compensation will be funded from the proceeds of the excise duty on petrol and diesel. Meanwhile, the government has plans to complete the divestment process of IDBI Bank by October of this year. Sources have told us and said that the government has approved the offer for sale for 5 public sector banks this year. Public sector banks, including the State Bank of India, plan to raise around 45,000 crore rupees via qualified institutional placement in this fiscal. Sources have also said that the government has given its approval for LIC's follow-on public offering. Well, speaking of public sector banks, several of them have raised concerns over Supreme Court's order on Bhushan Steel insolvency case before India's parliamentary panel. The Parliamentary Committee on Finance met today, where these concerns were raised. Parikshit Luthra is standing by with more details. Parikshit, take us through some of these concerns that have been raised by these banks.
Well, the Parliamentary Committee on Finance held a meeting today to review the working of the Insolvency and Bankruptcy Code. One of the key issues discussed was the impact of Supreme Court's judgment liquidating Bhushan Steel and rejecting JSW Steel's resolution. Sources tell us that the heads of 3 key public sector banks raised concerns about the efficacy of the IBC in light of the Supreme Court judgment. The banks told the committee that reversal of the implemented plans undermines the conclusion of the resolution and repayment reversal affects accounting and profitability. According to the bank representatives, the judgment raises concerns about the commercial wisdom of the Committee of Creditors and may even deter future participation in distressed asset resolution. This opens doors to retrospective challenges in completed cases of corporate insolvency resolution. The banks flagged concerns that the judgment has created legal uncertainty among successful resolution applicants. The banks also suggested recommendations, which include that it is important to honor the commercial wisdom of Committee of Creditors. Number 2, there is a need to preserve economic value while ensuring accountability. Number 3, we need a clear legislative provision to deal with appeals against plans already approved by the Committee of Creditors and the NCLT. Number 4, there is a need to safeguard the interest of assenting creditors, and it is also important to consider timelines for appellate courts to act on appeals. Finally, appellate courts must be limited from intervening in resolutions unless there is a fundamental violation of the law. We must add here that a parliamentary committee consists of MPs from both the ruling party and the opposition, and this body can only make recommendations to the government after hearing various stakeholders.
Right, Parikshit, thanks a lot for that. The banks, of course, have also preferred a review petition before the Supreme Court. It is yet to be taken up. Moving ahead now, the co-founder of Viceroy Research, Gabriel Bernarde, says that Vedanta Resources is likely to default in the near future. Yesterday, the US-based short seller took short positions on Vedanta's debt and alleged that the company's group structure resembles a Ponzi scheme. Vedanta has called Viceroy's claims as baseless and motivated. Speaking to CNBC-TV18, Viceroy researcher and co-founder explained why they took a bet against Vedanta and promised to release more reports and share their findings with the regulators. However, Rakesh Arora of Go India Stocks has said that Vedanta has already cut its debt and that restructuring its business is also done. So there is little reason for short sellers to target the stock now. He also added that the company is now in a steady growth phase. The Vedanta Group has already hit back, calling the report a malicious combination of selective misinformation and baseless allegations.
Vedanta Limited, let's say, it doesn't have the capacity to cover the interest costs of Vedanta Resources. So whether that will create an event of default, or whether the possible impairment of billions of dollars of Vedanta Limited's assets will lead the creditors to call that debt. That's anyone's game. We're here to report it. Whether we're a bit too early or a bit too late is irrelevant. We've written our research and we think that the end result is a disorderly collapse. We think that Vedanta Limited has been overly promotional in the ability of its business and the ability of its operating assets, which that have been largely overstated.
Are you done with the report, or will you have more reports coming out on Vedanta?
Oh, we have more.
Unfortunately, it was late on this stock. We delivered quite a bit from around $9-10 billion to around $4.5-5 billion now. And now servicing that debt is not a challenge at all. Number two is that it has gone through this whole exercise of demerging, and all the lenders have looked at entities on their leverage, on the, whatever the liabilities are, and clearly, they've approved this. So clearly, all the entities are self-sufficient. Otherwise, this kind of approval cannot come from lenders. Vedanta stock is largely dependent on aluminum outlook. And aluminum outlook has been pretty strong and doesn't look to be weakening anytime in future. They are also getting a little bit more of backward integration in form of bauxite mine, coal, their own captive alumina. So things are looking better only for them. So I don't think fundamentally there's any reason that performance would deter. Vedanta has been has done phenomenally well actually in the last 2 to 3 years. Meaning, if you had asked me in 2021, I would not have been able to gauge this kind of turnaround that the management has been able to achieve. And things are only getting better from here.
Coming up, Supreme Court raises serious doubts over Election Commission's completing the Bihar voter roll revision within the stipulated timeline, asks the poll body to consider Aadhaar, voter ID and ration cards for verification. And you can also catch all CNBC TV18's news and updates on YouTube, Facebook, Instagram, X, and Jio Hotstar. At least 120 people have died in the devastating flash floods in Texas, with country alone accounting for 95 fatalities. Ongoing search operations are underway to find people who are stuck in the debris. Among the dead are 59 adults and 36 children, with 27 victims still unidentified. Israeli forces have intensified air and ground attacks on Gaza, killing at least 55 Palestinians since dawn. This as the US President Donald Trump extended the time frame for a truce in the enclave to next week. However, Hamas has said that talks in Qatar have been difficult, citing Israel's insistence on keeping troops in Gaza. Ukraine's President Zelensky has called on the West to hit Russia after Moscow launched a massive air attack. Russia fired a large barrage of drones and missiles on Ukraine's capital of Kyiv. Officials reported at least 2 deaths, 13 injured, and fires in apartment and non-residential buildings. US President Donald Trump has threatened to impose 50% tariff on imports from Brazil after the 1st of August. The US president announced his plan for his latest tariff letter, which was shared on social media. In the letter, Trump accused Brazil of attacks on US tech companies. He also claimed that the country conducted a witch hunt against former far-right President Jair Bolsonaro. In response, Brazil's President Lula warned of reciprocal measures. NBC's News' Alice Barr has filed this report.
President Trump reigniting trade tensions with a new series of letters to trading partners imposing tariffs from 20% on imports from the Philippines up to 50% on Brazil.
Brazil, as an example, has been not good to us, not good at all.
The president acknowledging politics played a role in the hefty Brazil tariff, pointing to the prosecution of his ally, former Brazilian President Jair Bolsonaro, for attempting to hold on to power after losing Brazil's 2022 election, calling the trial a witch hunt that should end immediately. President Trump has drawn parallels to his own criminal charges after losing the 2020 election that were dropped when he won in November. Brazil's current president saying the country will not accept being abused and will respond to the tariffs. As President Trump also said the U.S. has a trade deficit with Brazil, when the U.S. Trade Representative says it was actually a surplus for the U.S. last year. The president asked how his administration arrived at the new tariff rates.
The formula was a formula based on common sense, based on deficits, based on how we've been treated over the years.
The Senate's top Democrat slamming President Trump for not delivering on his promised 90 trade deals in 90 days.
He kicks the can down the road again and again. He talks a big game but shows little follow-through or strategic understanding.
As the president asserts setting tariffs by letter is a more efficient means to a deal.
Back home, the Supreme Court has questioned the Election Commission over the timing of the Bihar electoral roll revision drive. The hearing lasted almost the entire day in the Supreme Court today. Towards the end of the hearing, the Supreme Court concluded that the petitions have raised an important question going to the very roots of democracy. Now, multiple petitions have been filed challenging the Election Commission's 90-day special intensive review of electoral rolls just before the Bihar elections. The Supreme Court raised 2 major concerns with the proposed intensive review. The first issue was about the timing of the entire exercise. The review has been compressed into a 90-day window. It is here that the court casts serious doubt on if the Election Commission could even complete the review before the Bihar elections. The court asked multiple questions to the Election Commission. Why is the review linked to the Bihar elections? What happens if one voter gets excluded from the voter list? Is there time for that voter to file objections and seek a hearing, seek a review? The court was clear that the entire exercise seemed rushed and impractical. The second key concern that was raised was over the limited list of documents that were permitted under the intensive review. The petitioners flagged how even Aadhaar and the voter ID card were not permitted for approval of names on the voter list. Here again, the Supreme Court questioned the Election Commission on the opposition to use of Aadhaar. The Supreme Court expressed its confusion on why the Election Commission would oppose Aadhaar when the very law that is authorizing this intensive review, that's the Representation of People Act, allows the use of Aadhaar for identification. The Supreme Court also questioned why the voter ID, which is issued by the Commission itself, was not permitted under this review. So after hearing both sides, the Supreme Court has formed a prima facie view that the Election Commission should consider voter verification with Aadhaar card, voter ID card, as well as the ration card. No interim stay of the special intensive review has been allowed, as the petitioners didn't push for it after the court allowed for use of Aadhaar and the voter card. The next hearing of this case is scheduled for July 28th. Now, in more news, the death toll in Vadodara bridge collapse rose to 18 even as search operations continue. Multiple vehicles fell into the Mahisagar River when a portion of the Gambhira bridge collapsed. Incessant rains continue in Delhi and parts of the national capital. The downpour also caused waterlogging in several areas, prompting traffic diversions and flight diversions. Meanwhile, intermittent overnight rain in Gurugram brought the city to a standstill. The city was hit by 103 millimeters of rain in just 90 minutes. The Met Department expects rainfall in the national capital region to continue today and tomorrow. Now, semiconductor giant Nvidia has become the first company to cross $4 trillion in market capitalization. That's as much as India's annual GDP. Hormaz now joins us to give us a sense of Nvidia's growth story and the challenges that lie ahead.
Well, they say bada hai to behtar hai, and a company based 14,500 kilometers away in Santa Clara is justifying that tagline, and how. That is Nvidia for you. The AI behemoth and Wall Street darling became the first company to cross $4 trillion in market cap on Wednesday. It has taken just over 13 months to add the latest $1 trillion to its value. However, take a look at this rapid rise that Nvidia has seen. Its first $1 trillion came in May of 2023. In 9 months, it was at $2 trillion. 4 months later, in June of 2024, it was at $3 trillion. And had it not been for Donald Trump and his tariff tantrums, who knows, we may have been doing this just a few months earlier itself. Now imagine Nvidia being a country. At $4 trillion, its GDP would be higher than most countries of the world. In fact, it will be the 5th largest economy of the world, behind the US and China, just a shade below Germany and Japan, and just a shade higher than the Indian economy. Now, when I spoke about the Trump tariffs, in April, they spared no one. Nvidia shares also fell to their 52-week low, but the bigger part is the recovery. The stock has nearly doubled from those April 7 lows that they had made, and that's just a 3-month window. Now, at $4 trillion, Nvidia is 73% of the entire Indian stock market capitalization, which stands at just over $5.5 trillion. Nvidia is now the size of 30 HDFC banks, 37 TCSs, and 22 Reliance Industries individually. Now, wealth creation is the motto to be in the stock market, and Nvidia has done exactly that. Since 2013, Nvidia has had only 2 negative annual years in terms of share price returns. Its 15-year average return is a cool 70%. Now, take a look at this. Since 2020, Nvidia has had 4 years where the stock has either doubled or even tripled in value during a calendar year. This year, too, the stock is up 22% after the recovery from the plunge that it took earlier in 2025. But there are challenges that lie ahead. Export curbs still remain to the Chinese markets. Now, founder and CEO Jensen Huang said that these issues have completely cut Nvidia off from a $50 billion Chinese market. They took a hit in the first quarter, and another $8 billion hit is likely in the second quarter as well. The other challenge is the slowing revenue growth. But the definition of slow here is just a case of raising the bar too high. Now, 5 out of the last 8 quarters has seen Nvidia report revenue growth in excess of 100%, some even 200%. And at this size, anybody will happily take a 69 to 70% revenue growth. But such are Nvidia's standards that the street is worried that those 100% growth days will never return again. Lastly, sticking to the saluting the rising sun terminology, Wall Street continues to remain bullish on Nvidia despite the surge that it has seen. 68 out of the 78 analysts who cover the stock continue to maintain a buy recommendation, and the odd one out, a solitary sell. Now, that's Nvidia for you. The journey from $1 trillion to $4 trillion has happened in a jiffy, and the onus now lies with Jensen Huang and company to embark on the next trillion, one chip at a time.
Right, Urmas, thanks so much for that. But with that, it's a wrap on this edition of India Business Hour. Thank you so much for watching. The news and updates will continue right here on CNBC-TV18.
Market fails to hold opening gains. The Nifty and Sensex fall 0.5%. The Nifty gives up 25,400. Nearly 40 stocks end lower. IT, banks and PSUs lead the fall, while realty and metal stocks buck the trend.
CNBC-TV18 learns that Finance Ministry may create a 32,000 to 35,000 crore rupees fund to compensate oil marketing companies for LPG under recoveries. A cabinet proposal may soon be moved for the same, offering big relief to IOC, BPCL and HPCL.
Stocks of select housing finance companies and power finance companies perk up in trade over bullish brokerage commentary. For the last few trading sessions, we've been testing the higher end of the range. Today was the day where we tested the lower end of the range. We opened above 25,500 and thereafter we saw a decline. It's a Thursday. Good evening. You're watching us here on Markets Forward, your go-to show where we aim to get you all the key data points to get up for the next day, trading day, while recapping what took place on D Street today as well. I'm Bangla Malu, with me, Vinny Motiwala. Vinny, today was a down day. We were down about 120 points. Given the sort of narrow range that we've been in over the last few trading sessions, it looks a lot more than what it actually was. But all in all, we're at the lower end of the range with 25,355 being where the Nifty is. The only difference between today and the other previous days is that at any point in time, if one was short, one did make money, or if at any point in time one entered a long position, one was losing money. So we opened at the absolute high of the day and we closed at the absolute low of the day. So that's a trend that we'll most definitely keep an eye out on. The other thing we'll be watching out for is the big underperformance that we're seeing on India VIX. India VIX is sub 12 right now, which is nearly a one-year low. With all the uncertainty that is there in the world, if the India VIX is not moving, then maybe is this straight pricing in some sort of complacency or not, is something we'll be watching out for. No problems with the mid-cap index. Yes, it was one give and one take for bulls and bears. We had around 1,400 stocks declining for about 1,245 stocks, which were higher. All set for earnings season, as one would say.
Absolutely, all set for earnings season. We'll start with all those IT companies coming out with their numbers. But yes, that's how the market setup looked like today. But here's what we have for you all on the show today. First up, we'll start with the top movers and shakers of the day with Hormaz, and then talk about few individual stocks, select housing finance companies and power finance companies that were buzzing in trade over bullish commentary. RSE as well as PFC saw a notable gain coming in after receiving upgrades from brokerages, while Home First Finance and other housing finance traded in the green as well. Last but not the least, we'll delve into the key market events to watch out for in tomorrow's trading session. On that note, first up, let's go across to Hormaz, who's here from the big wall to talk to us about the top movers and shakers of the day. Hormaz, over to you.
It was a choppy trading day, to say the least, and even as the broader markets were slightly wobbly, the overall market was slightly wobbly. It was the asset managers that stood out in today's session. UTI AMC had a 52-week high. Also healthy gains for Aditya Birla, Sun Life, and the other AMC stocks too saw gains of up to 2% in today's session. Defense stocks were a bit of a dampener today. Motilal Oswal said they would wait for a better entry point in Bharat Dynamics. It showed on the stock price 5% lower today. And Solar Industries, Garden Reach and Peers too seeing losses of anywhere between 3 to 4% in today's trading session. Some of the newsmakers, a lot of it were brokerage reactions. PFC and REC, the consensus buy among analysts continues with the Morgan Stanley initiation seeing gains today. Prestige Estates, the brokerage commentary after the business update shared yesterday, stock ending higher. Glenmark too awaiting updates on a very important development at the company. And Varun Beverages, after HSBC cut its price target today, the stock ending lower. But stocks that ended at a 52-week high in today's session. And of course, we did speak of Glenmark. When look at Sanatan Textiles, India Shelter, Gabriel, all the usual suspects are at a high yesterday, and they are building on to those gains in today's trading session. Back to you guys.
Right, Hormaz, thanks a lot for that. Those were some of the top gainers today. We had Lemon Tree Hotels as well, which perked up in today's trading session. Something like an Acme Solar was up 10%, along with Borosil Renewals as well. Let's go across to our guest, Amrish Baliga, independent market expert, as well as Ruchit Jain from Motilal Oswal Financial Services. Amrish, let's start with the IT pack. You know, the index was lower in today's trading session ahead of TCS's numbers. The street is not expecting much. But remember, seasonally, this is the best 2 quarters for the IT pack. With the stocks having underperformed, the NASDAQ having outperformed, the outlook for the US economy not as grim as what it was earlier. Would you hazard a bet on the IT pack? If yes, what would be your case? If not, then what's the case here?
No, I think it's better to wait for the management commentary more than the performance for the last quarter. I think the management commentary would be more important because clearly we need to see as to what sort of order flows come in. And as far as TCS is concerned, I think the wage hike issue is still there. And the margins again could be muted. So I think we'll have to see as to when do we see this uptick in margins and the order flows. I think that is most important to be watched out for. So across whether it's TCS, Infosys, Wipro, I think we need to wait for the management commentary.
Okay, wait out for some bit of a commentary coming in here. Richard, any thoughts just on the market levels that one should be keeping an eye out on? Today, obviously, like Mangalam was mentioning as well, we closed at the lower end of that range that the Nifty has been trading at. So what should we be keeping an eye out on now, as well as on Bank Nifty as well?
I think it's been last 2 weeks where we have seen more of a consolidation of the index. We have not seen any signs of any trended move coming in. Now, we have ended right just above the 20-day support, which is around 25,280. So the follow-up move tomorrow would be very important in case if the market breaches this 20-day mark. I think it's been almost 20-25 days. We have not seen the index going below that 20-day exponential moving average. Then we could see some more price-wise dip. Otherwise, it would turn out to be more of a time-wise correction before we resume the next leg of uptrend. And I think once we see this time-wise correction, there are many sectors or stocks where the momentum readings were a bit overbought post the recent run-up. That would also get cooled off. So we would watch out for that 25,280 mark closely in tomorrow's trading session. If the index manages to take support at that level on a closing basis, then I think we should see a resumption of the uptrend quite soon. But for now, it seems that we would see some more time-wise correction.
All right, some more time-wise correction as against price-wise correction. Let's get you some more on the IDBI Bank stake sale. What we learned from sources is that the Indian government intends to complete the IDBI Bank stake sale by October. Currently, remember, the government has frozen the draft share purchase agreement. Is expected to be signed soon. After this, the government will call for financial bids, and that's not all. They've also given an approval for 5 PSU banks offered for sale this year. While Bank of Maharashtra is expected to meet the 25% public float requirement through a QIP, other public sector banks, namely UCO Bank, IOB, Punjab and Sindh Bank, as well as Central Bank, can also go for the offer for sale route.
Okay. Surely keeping an eye out on those PSU banks as well as IDBI Bank is something that we'll watch out for. But stocks of housing finance companies were also buzzing in trade, and this was on the back of a positive brokerage note that's come in this morning. We had Gaurav joining in with us to give us more details on this one. What is the brokerage note highlighting as well? Gaurav, what are we watching out for here?
Well, yes, specifically from the housing finance space, now Bernstein is being a little bullish on the space. What they have done is that they have initiated a note on 5 companies. For Home First Finance, Aptus and Aadhar, they have initiated with outperform rating, and on this other hand they have initiated on Aavas and PNB Housing with market perform rating. First, let's talk about Home First Finance because this is their preferred pick even from the housing finance segment. What they're saying is that the company actually stands out well because they have demonstrated ability to consistently replicate their business model across the locations, and on the other hand they also have advantage in terms of smaller size, fastest growth and also superior productivity metrics, and that is the reason they prefer Home First Finance. Other than that, for Aptus, what they say is that the share of fixed loans is actually higher for Aptus, and that is the reason why this company can gain in an environment where rate cuts are happening. For Aadhar Housing Finance, they say that this is actually largest and the most geographically diversified player, and that is the reason why they prefer Aadhar Housing over other companies with outperform rating. But on the other hand, let's also talk about Aavas. For Aavas, they believe that the company actually lags its peers when it comes to yields and profitability, and that is the reason why they have initiated with market perform. And lastly, for PNB Housing, they actually like the business model. They say that the smaller ticket loan expansion is actually good, but aggressive expansion is something that they are cautious about, and that is the reason they have initiated with market perform. As a result, in a day, we already saw some good traction in these companies, but definitely watching out on this space, specifically given that the rate cuts are happening, earnings are coming, and now a positive note is also coming up from Bernstein.
All right, we take that point. A positive note coming in from Bernstein as well on this space. But stay with us. There were some power finance companies as well. They were buzzing in trade today. there was bullish commentary coming in, and IREDA too. The government allowed the firm to raise some funds.
Well, yes. When we look at power financing, it seems that the space has not lost its shine. First, let's talk about PFC and REC. Morgan Stanley has initiated a note. For PFC, they have given a target price of 508 rupees, and for REC, they have given a target price of 485 rupees. What they say is that if we look at the performance 2 years ago versus now, they have actually underperformed its own track record. But from here on, Morgan Stanley believes that the company can grow their loan book at 12%, and given that the ROE can be somewhere in the range of 17 to 19%. As a result, when we look at valuation, they believe that the valuation is still favorable because company has good asset quality, the loan book is very stable, and at the same time they are also trading at a favorable level. On the other hand, let's also talk about some NBFCs like IREDA. Now this company was in focus because government has allowed IREDA to raise funds via 54 EC bonds. Now these bonds are also known as capital gains bond. What it does is that it will actually bring down their interest rate and the cost of funds. Let's understand how. These bonds can be issued at a cost of around 5.25%, which is lowest if we compare it with the other instruments. And this was actually an ongoing movement for IREDA. Now this decision has come from government, which is actually a positive thing. Let's also not forget that in FY25, we have already seen IREDA actually lost around 20 basis points in cost of funds. So there was some benefit which was there, but we may see some more benefit coming in because of these instruments. Let's also not forget that the results are also due today, and we have already seen good set of numbers. Loan book has grown almost at around 26%. Disbursements have grown almost at around 32% on a year-on-year basis. So that is also one of the bullish trigger for the stock today. As a result, it ended with more than 2% gains.
Okay, thank you so much for that, Gaurav, for giving us a roundup in terms of housing finance companies as well as PFC, REC, as well as IREDA. But Amrish, I'm going to come to you. First, let's just talk about these housing finance companies. Obviously, we have this positive note that's come in from Bernstein as well. Your thoughts in the housing finance space? Is there anything particularly that you like? Home First Finance today was surely something that was buzzing in trade. Aptus Value is also something that they spoke about. Anything that you like here and where you find value right now?
See, this rate cut by RBI, I think that was a very big positive for the affordable housing space. And most of the listed housing finance companies are actually funding, mostly in the affordable housing space as compared to premium housing. So from that point of view, I think it's extremely positive for the housing finance companies. And here, other than the ones which you spoke about, I would be positive on LIC Housing as well as Can Fin Homes.
All right, LIC Housing and Can Fin Homes. Rujit, on the charts, anything particular that stands out from this space?
I think LIC Housing Finance has seen a long consolidation phase, and it seems that the stock now is forming a good support base around its 200-day exponential moving average. In this entire consolidation of last 1.5 to 2 months, 580, 590 has been acting as a support whenever we are witnessing declines there. So the price-wise downside here seems to be very limited. So we believe that if one is looking more from a positional perspective, then this consolidation offers a good entry point at current levels with stop loss below 580. Can Fin Home has already seen a good up move, so this would be one stock where a buy on dip approach should be kept. And in case if we see any kind of retracements in the near future, this should be considered where risk reward ratio would become favorable.
All right, take that point. Thank you so much for that. Let's talk about another important development that has come in from the Finance Ministry. They're considering a 32,000 to 35,000 crore rupee fund to compensate oil marketing companies for LPG under recoveries. And this is as per sources. The proposal will soon be moved for cabinet approval. Timsi, what are your sources telling you? Because it was very recently that we had the management of one of these oil marketing companies join us, and they said that they have been assured by enough to be taken care of from the ministry when it came to under recoveries.
Well, that's right. What government sources are indicating to us is the fact that the Finance Ministry could soon move a cabinet note, a proposal to create a fund of about 32 to 35,000 odd crore rupees, which will be helping the OMCs to overcome their under recovery sort of a thing that they have from the LPG, the losses that they were bearing on this. And this is for the last 15 months that these OMCs were having these losses, these under recoveries on account of LPG, and that's what the government is now looking to address. Petroleum Ministry, for that fact, had actually demanded 40,000 crore rupees. And right now what sources say that the Finance Ministry is currently assessing what is the exact quantum of under recoveries which can be addressed. And given this fund will be created. To be fair, Union Cabinet will be approached to give a clarity on this or to give an approval to use these funds for OMCs. Now, where will this fund come from? Well, this is going to come from the collections that the government is having on account of excise duty collections on petroleum, so that is going to lead to the proceeds to this fund. When we speak to the officials, they said that the government view is that oil companies are part of the same government family. Government does not want OMCs to suffer. Thus, compensation will happen soon. Right now, government is assessing what should be the exact quantum of under recoveries and based on which this particular fund can be moved forward for a cabinet approval. Let's see how soon Union Cabinet decides to allocate this fund to OMCs and how soon the cabinet gives a nod. Something that we'll have to wait and watch for. We'll keep you updated.
Okay, thank you so much for that, Timsi. Ruchit, anything on the charts and technicals that you're looking out for in terms of these OMC names or IOCL, BPCL, HPCL, anything there?
So IOC looks interesting in these names, although HP and BP also has a good uptrend, but both these names have already seen a good price-wise up move. Whereas IOC, after consolidating post last quarterly numbers, has recently given a breakout from that consolidation. So here, I think a catch-up move would be seen, and although it's not that high beta name, but a slow and gradual up move towards 165 could be expected in IOC.
Okay, thank you so much for that. But, thank you so much, Ruchit, as well as Amrish, for joining in with us on the show and helping us understand different stocks and what they look like right now as well. But with that, we're going to slip into a very short break. After the break, we'll get you top corporate voices along with key market events to watch out for on the other side.